of Asian economic giants.
And also the ASEAN summit coming just days after China released that new map indicating the areas that it sees at its own territory. What are we expecting from the summit?
Yes, well, it seems rather extraordinary timing for China going into this summit. It could have been an opportunity for China to look more involved with Southeast Asia, given that President Joe Biden of the US is not coming this time, which has been seen as a disappointment for some. So it could have been an opportunity to kind of improve ties with Southeast Asia, but instead China's chosen this timing to issue this new map to reassert its claims over parts of the South China Sea that a lot of other Southeast Asian countries also claim. And so we saw an outcry last week from the Philippines, from Vietnam and so on, saying, oh, we don't accept this, and we can expect those issues to be raised, I think, with Lee, which could mean that his first attempt at this ASEAN summit may not be particularly auspicious.
US President Joe Biden won't be present at the summit. How is that likely to be received?
Right, we've all seen a sort of widespread issue of complaints in the media about this. Instead of Joe Biden, we have Kamala Harris, who will be the vice president, will be in place. And you know, she does have a very full agenda while she's there. She's definitely going to reach out to people as much as she can. But with the best will in the world, the vice president is not the president. And Jakarta would have wanted the kind of glamour and the prestige of hosting the president as the chair of the ASEAN summit this year. So it is going to be a disappointment, I think, to some degree. There have been rumors about whether this means something about poor ties between Indonesia and the US. That's not really clear. But I think it will at least show that the US isn't as fully engaged in the region as it might be, even though the US side has made clear that it's reaching out on a bilateral basis to a lot of countries, including the Philippines, and with President Biden going to Vietnam shortly.
A politics reporter in Tokyo, Isabel Reynolds there. Let's bring in, for some more analysis going into this set of meetings, Richard Hajdarian, who's the senior lecturer at the University of the Philippines. He joins us now from Jakarta. Richard, great to have you with us. And we've just talked about President Biden's absence, of course, disappointing for the host nation. But also, we have the situation where, of course, Xi Jinping will be absent from that as well as going into the G20. We'll be watching that as well. What's the dynamic that is most interesting to you and the issues that kind of top the agenda for you for ASEAN?
Well, interestingly, President Biden will be visiting Vietnam, which is an emerging strategic partner for the United States in the region. So you have two former nemesis really, burying the hatchet and trying to build some sort of a robust partnership in light of shared concerns, especially over China, but also shared economic concerns. So that's why I think some people were slighted here in Jakarta, because they were expecting Biden to also visit Indonesia, not only for the ASEAN meetings, but also for some high-level discussions with President Joko Widodo, who is on the way out in his legacy months. Now, I think the overall understanding in the region is that the United States is in a catch-up mode. So it's true that Xi Jinping also is not attending, but people are expecting the United States to put something constructive on the table, literally constructive. It's true that China's Belt and Road Initiative has not been meeting its targets over the past few years. In countries like the Philippines, we have more of a pledge trap than a debt trap. But the reality is the United States doesn't have any kind of a counter proposal, and it's Indo-Pacific Economic Framework. To be honest, it's very ASEAN-like, a lot of symbolism, not much substance. So we're hoping for the United States, whether it's Kamala Harris or top American officials in the coming months, to give more concrete details on how the Indo-Pacific Economic Framework is going to move forward. As far as ASEAN itself is concerned, it has a number of crises in its own backyard, from the festering civil war in Myanmar, which is now raising discussions about potential expulsion, full expulsion of the junta from the regional body, to new members like East Timor, not to mention, of course, the South China Sea dispute, which is a big issue for the Philippines, Malaysia, and Vietnam. And President Marcos Jr. is going to be in town and is going to push hard for the centrality of that issue in the regional discussions.
Yeah, how do you expect that to be played out?
Well, I think Indonesia is responding to this on two levels. On one hand, it is at least claiming that there has been some sort of breakthrough in the negotiations of the code of conduct, a legally binding code of conduct in the South China Sea. But honestly, as someone who has been observing this and writing on this for the past decade, and this is something that was raised, just a year, after I was born, in the late 1980s, I'm not very optimistic about really a real breakthrough on the code of conduct front. Nevertheless, interesting things are happening because Indonesia right now is pushing for the first ever all ASEAN naval drills. It was supposed to be in North Natuna Sea, which is close to the South China Sea. Cambodia and some China-friendly countries push back against that, so it will be in South Natuna Sea from what I understand. But nevertheless, that's a move in the right direction because ASEAN has to show a common front and show more operational interoperability. But also on the sidelines, expect Philippines, Vietnam, expect Philippines, Malaysia, Indonesia to also discuss their maritime borders and how to resolve those maritime borders based on the United Nations Convention Law of the Sea.
How much is the fact that the leaders of the two largest economies are not attending this ASEAN summit? How much is it from them lacking this strategy towards Southeast Asia or just the relevance of ASEAN itself?
Yeah, I think as far as ASEAN is concerned, ASEAN centrality is more of an aspiration, to be honest, if not some sort of pretentious or self-proclaimed role. It's something that we have to gain. It's something we have to earn. And the reality is that what you're seeing nowadays is more trilaterals. U.S., Korea, Japan, more quadrilateral, India, United States, Australia, Japan, but also Philippines, Australia, United States, and Japan. And I think the emergence of this minilateral, security-oriented, new Cold War-ish kind of blocks, not to mention expansion of the BRICS, they tell you something about diminishing confidence in ASEAN in terms of playing its role. And Indonesia, in fairness, I think they really realize that. But they have to make some big moves if they want to put the regional body on an even keel in the coming months.
Do you expect that to happen? What's next for the group?
Well, I mean, this is legacy months also for President Joko Widodo, and Indonesia had a very successful year last year as a rotating president of the G20 summit. I think they defied a lot of expectations. So I won't be surprised there would be some interesting mini breakthroughs here and there. But I think the increasing reality is that ASEAN 10, as 10 members, you cannot really get much out of that if they're going to continue to operate based on unanimity, not really consensus, but unanimity. That's how they operate on very sensitive issues, whether Myanmar, South China Sea, and so on and so forth. But I think more and more unilateral coordination among key ASEAN countries, between key ASEAN countries and external powers, that's the way forward. But I think the Indonesia way would be to spin this as a more economic-oriented summit and meeting and year, because the theme is actually ASEAN as an epicenter of growth. For the first time, we're growing faster than China in a generation. So I think they'll try to put a spin on this by overemphasizing the economic front, but more unilaterally dealing with the geopolitical issues.
Richard Haydarian, good to have you with us, senior lecturer at the University of the Philippines. We have more to come on Daybreak Asia. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Tens of thousands of homes temporarily lost power in Taiwan as Typhoon Haikui made landfall on Sunday afternoon. The storm's radius enveloped much of Taiwan, bringing heavy rain and wind to the island and disrupting power to more than 40,000 households. Authorities had earlier shuttered offices and schools and canceled more than 200 flights. Haikui was the first typhoon to hit Taiwan directly since 2019. Also, the cleanup continues in Hong Kong and along the coast of Guangdong after Super Typhoon Saola swept through over the weekend. Bloomberg Intelligence estimates the total damage bill from the two storms could top $1 billion. Let's get more from insurance analyst Stephen Lam. Stephen, so how destructive were Saola and Haiku compared with other storms in recent years?
Yeah, good morning, Heidi. Sherry. So the losses, it seems, could be less than what we had anticipated. So the key here is that for Saola this time is that even though it's closer and the wind is stronger than Manku in 2018, we noticed that the flood damage is actually much less than Manku. So that's why we will bring down the estimate. I think at the current observation right now, we're thinking about tens of millions of US dollars in terms of losses. So that would be comparable to what we had in 2021 in Lion Rock. Most of the damages that we have observed were mostly in broken glasses, some scaffolding that went off, solar panels that blown off the roof, hundreds, 1,500 fallen trees across the city so far.
Are insurers seeing above average typhoons this year?
Yeah, absolutely. To be honest with you, so in China right now, the fourth one is called Haikui. That's already way above the annual average of 3.2. Now, mind you, we're only in the middle of the season right now, just early September. Typically, the typhoon season can last through end of October, sometimes into November as well. Closer to Hong Kong here, we noticed that the signal 10 for Saola is actually the fourth one in the past 15 years. And compared to the prior 15 years, Hong Kong only needed to hoist typhoon signal 10 for one time in the prior 15 years. So the signal 10 basically means it's hurricane force with a wind speed of about 118 kilometers per hour and above.
So how prepared are insurers then for the spike in typhoons?
Yeah, so I think that's another key point to note. The city, Hong Kong, Macau, and southern China are way more prepared due to the lessons learned from Hato in 2017 and Manku in 2018. So a lot of the businesses, small shops, with early signal, they would guard up their shops and put up boards to avoid flooding situation. Now, however, with the higher frequency and the large losses in the last few years, the insurance price premiums have actually gone up as well. So we insurers are charging the direct insurers more during the current season. So we can see that some of the direct insurers actually have lower protection than prior years. So they're more exposed in simple terms during the current typhoon season.
Stephen, we know that extreme weather is likely to probably get more common, heat certainly for this year as well, but we've seen in the US some major insurers actually ending certain coverage for climate-related risks. Is this something that will become more common?
Well, I think in this part of the world, actually, we should see quite the contrary, because Asia, the insurance penetration, the insurance protection is actually much lower than North America. Based on our study, is that on average, any storm or any large natural catastrophe, only 15% of the economic loss is covered by insurance, versus about 50% in the United States. The key here is about the public education, which the city in Hong Kong and China has been pushing quite hard in terms of increasing the insurance penetration.
Bloomberg Intelligence insurance analyst Stephen Lam there with us. Taking a look at how markets are trading, we are seeing broad upside. Of course, it is that long weekend scenario in the US, but here in Asia on this Monday morning, we're seeing a sea of modest gains, if you will. The Nikkei 225 up by just about 0.4%. We are seeing upside here in Australia as well, going into RBA decision week, expecting a third consecutive hold from the central bank here. And broadly, we are seeing regional sentiment just lift as traders are really considering that US jobs number on Friday, really supporting that optimism optimism that a soft landing scenario is perhaps more possible than before, and that the Fed is nearing the end of that tightening cycle as well. That is it for Daybreak Asia. Our markets coverage continues ahead of the start of trading in Greater China. This is Bloomberg.
Nine a.m. in Beijing and Hong Kong. Welcome to Bloomberg Markets China Open. I'm Yvonne Mann. Our top stories this morning. Asian stocks open weaker as traders focus on China's efforts to halt its economic slowdown. Markets in the U.S. shut for the Labor Day holiday, so you're not getting that much read-through. We are seeing Asia slightly lower this morning. The clock is ticking for country guarded to avoid its first default. China's housing crisis now threatening to engulf its surviving developers, with about 2/3 of 50 major private builders in default. And a teardown of Huawei's latest phone shows Washington's sanctions may have failed to prevent China from making advanced chips. That sort of scoop that really lifted some of these chip makers like SMIC up some 10% in Hong Kong yesterday. We'll see if that lasts. But certainly front and center is still going to be on the property market, given how much those stocks really rallied and really drove the charge on that rally yesterday. In China. We'll see if we see another sort of day of this as well. You take a look at how the market action so far. Futures are still pointing to a little bit of red when it comes to China here. So we might not see another sort of robust sort of session. And you take a look at U.S. futures. We're slightly lower here this morning. You're not getting that strong refill from Europe as well. So, market sentiment is not that as risk on as yesterday. Asia Pacific, as we said, down about 1/3 of 1%. And we talked about, right, that grace period for that dollar bond and country bond. We're still figuring out, is it today that it ends or the 6th? So, it's going to keep the market guessing, of course. But then again, we did see a rebound in Chinese high yield yesterday as well, which we'll talk about a little bit later on. Asia is doing this here right now. It's Japan that seems to be leading those losses here at the get-go. Taiwan just coming online. We're watching, of course, those Korean inflation numbers that came out a few hours ago. Should the market be concerned about a resurgence of inflation after we saw CPI rise to 3.4%? Take a look at bonds, of course. Bond futures in the U.S. are doing this here right now. We did see a bit more of that sell-off in Europe and fixed income as well. And of course, the RBA, it is Phil Lowe's last meeting, set to stand pat. Obviously, we're going to talk a little more about his legacy a little bit later on. Japan's also getting a 10-year auction later on today as well. Key to watch. As demand seems to be faltering when it comes to JGBs, what are these bond auctions going to yield? And of course, we're watching Chinese 10-year yields at 264 this morning. We're getting those CPI numbers out of Philippines as well. Take a look at that. We're talking about resurgence of inflation. We're seeing another economy that's dealing with that, rising some 5.3%. That is still much higher than what the estimates are. And here's what, dollar is pretty mixed here across the board. Euro dollar 108, just below that handle. Dollar yen's at 146, and your renminbi seeing a bit of weakness, but we're at 727.83 here this morning. Still watching oil markets. Of course, we're still near those mid-November highs. Brent is inching ever closer to $90 here once again. So we're watching very closely where this oil rally takes us, and Shanghai crude continues on for another day. Iron ore as well, catching a slight bid here this morning. And yes, as we recap, of course, that is CPI print out of the Philippines. So that is quite a beat when it comes to these numbers. We're going to watch very closely. Month on month, this CPI price is also rising some 1.1%. So still seeing that price pressures there in the Philippine economy. We'll see if that really means that the BSP can remain on this hold sort of pattern that we've seen. Of course, we're going to watch Philippine markets those are closed, not opening just yet, but at the bottom of the hour as well. Take a look at when it comes to this rally recap. Obviously, it's the property market. Take a look at what we saw when it comes to not just Country Garden. I thought it was record volumes that were traded yesterday on just that stock alone. Double-digit gains for a lot of these developers as well. On the back of these housing policies that have come through, Beijing seems to be widening its rescue of the property market here. And when we talk about Country Garden, that was one of the beneficiaries, right? Of course, it bought some time. They made that renminbi payment on that bond, the ringgit bond as well. Excuse me, they got extension on the yuan bond. But what is more important for investors the next 24 hours is going to be on the dollar bonds. And what does this mean, right? That grace period ending today till tomorrow. Our Bloomberg opinion columnist, Julie Ren, is saying that Country Garden still has some options to get out of its debt crisis. She joins me now. What can they do to turn this around?
I think what Country Garden should do is to buy itself time and just hope for the best. Because what we've seen is that China is trying to rescue its housing sector now. What we saw last week was the first nationwide policy easing. And hopefully, Country Garden will have some time to work through its debt crisis. And to Country Garden's advantage, they have about $10 billion US dollar bonds due outstanding, but nothing is due this year. Nothing is mature this year. So what they need to do is just to pay the 22 million coupon and buy itself time and keep the financing window open. And onshore, they are doing the same thing, right? The 3.9 billion yuan bond that was due last Saturday, they got a last-minute extension all the way to 2026. And they have two more biggish bonds due, one in late November, one in early December. And they from what I hear, they are trying to engage creditors to say, let's extend and give us some time.
Yeah, buying time, as you say. People often compare Country Garden to Evergrande. You're saying these two developers are completely different. In what ways?
They're completely different. I mean, Evergrande is a lost case. It's gone. It has negative equity. Country Garden, it has a similar asset size, but its liabilities is only 60% of China Evergrande. And also, Country Garden's biggest problem is delivering pre-sold homes that consumers already bought. Once you take that aside, that part is really not that big. It's workable. Like in terms of dollar bond, it has about 10 billion yuan, $10 billion outstanding. Country Evergrande has 40 billion. It's much smaller in size.
So what do you think is going to be the biggest pressure points for Country Garden then?
It's basically delivering pre-sold homes. Yeah. I mean, by some estimates, JP Morgan estimates that Country Garden has to spend 160 billion yuan this year alone on construction cost. So what I think it needs to do is to negotiate with pre-sold home buyers and say, let me return you some money, and I'm not going to finish all these projects. I have to abandon some because it no longer makes sense.
Okay. Julie, thank you. Julie Ren there, Bloomberg opinion columnist on Country Garden here this morning as the clock is ticking now for us to hear any sort of news about this dollar bond today. Let's bring in Eddie Lowe, Chief Investment Officer at Maybank Group Wealth Management. He joins us live from Singapore this morning. Eddie, obviously we've seen a whole slew of housing policies nationwide now in China. I'm just wondering, in terms of market sentiment, this rally that we've seen really kind of play out in the last few days, can it really last now?
Well, I think it's definitely encouraging to see a broadening of the property support measures, including the first-tier cities. And so far, we have read reports about positive sales momentum in the first-tier cities. Now, having said that, it remains to be seen if this positive momentum can be pushed out to the second and third-tier cities. So we won't be surprised to see if there will be going to be further fallout of the private developers, more debt restructuring or even consolidation. But having said that, systemic risk, in our opinion, is actually quite low because of the fact that I think one of the reasons is because the Chinese banks have actually actively reduced their exposure to the developers over the past few years.
So the fact that you're seeing a widening of policy support, I'm just wondering, does that give you more impetus to add more exposure to China, or are you doing otherwise?
Well, I think the near-term support measures is definitely going to give some relief to the market. So we won't be surprised to see a further bounce since the market has pulled back quite considerably in the month of August. Now, having said that, the very constrained policy responses actually over not just past month, but actually over the past 12 months, coupled with a very damaged confidence, be it in consumers and business, suggests that it will take time to repair. So we are suggesting to take a more prudent approach towards investing in China and focus on areas of resilience, including consumption, new economy plays, EVs, as well as some state-owned telcos and energy plays for their resilient dividends.
Okay, I'm just wondering, just given the macro backdrop, right? The stimulus in China is taking longer to take effect or actually kind of, help in this recovery. You have Europe that seems to be seeing higher inflation but deteriorating growth. And then you have a U.S. economy that seems to show really signs of resilience as well. What's sort of the macro strategy then around that?
Mm-hmm. Well, I think if you look at the global growth, our view here is that, while there are signs of moderating activities, it's not entering a recession anytime soon. Particularly in the U.S., I think the growth has been much more resilient than what everyone was anticipating at the beginning of the year. But having said that, having a robust growth means that inflation could also stay high, right? So, the central banks are not, while they may actually, like for example, the Fed may start to pause, but we are not expecting any rate cuts anytime soon. So I think this struggle or this tug of war between growth and inflation is going to keep markets volatile, and therefore, our suggestion is really to stay diversified and focus on quality investments.
Okay, is that really just fixed income? Is that where I'm still going to get the best risk reward?
Yes, I think from a risk reward perspective, we do see better value in fixed income relative to equities. Even though we say that rates are going to stay high, we are thinking that treasury yields are near their cyclical tops. And one of the analysis that we did was that S&P earnings yield is actually trading at the historical trough spread versus the 10-year treasury yield, suggesting that, hey, the value of 10-year treasury yields are actually much more attractive at this juncture. And, should the economy actually deteriorate much faster than expected, I think the U.S. treasuries could serve as a good hedge. And because of that, I think we also see value in building some exposure to short-term investment-grade bonds for defensive carry.
Of course, we've been talking about, this relationship between bonds and stocks where, the correlations are basically broken down. I'm just wondering, is this something that you see longer term as some sort of new normal that we're seeing, or do you think that these correlations can reassert itself again?
Well, we do believe that rates could stay at a much higher level than what we have seen since the GFC, given the fact that the structural factors such as deglobalization, the need to diversify supply chains, I think that could actually keep inflation at a higher level versus historical average. But having said that, the correlation between bonds and equities, we do think that at this juncture, there is a possibility that it could restore where, bonds tend to perform better in times of economic slowdown versus the equities, instead of just being positively correlated like what we have seen actually last year.
Yeah, and what is the equity strategy? It looks like you've downgraded China and Asia ex-Japan to neutral. You're upgrading Europe to neutral. What's the thinking behind that?
Well, I think generally we take a neutral stance towards global equities across major markets. With China, we notched down our optimism a little bit because we think that it takes a little bit more time to rebuild confidence, and consequently, because of the heavy weight of China in Asia ex-Japan, we notched down our view on Asia ex-Japan as well. Conversely, I think European equities have actually slightly underperformed global peers year to date. Even though macro data suggests that outlook remains challenging, if you look at the valuation, it's actually trading at below historical average. So while growth is going to be challenging, we do see downside to be much more limited versus at the start of the year. Right, but I think what's important to note here that even though we are neutral across major markets, we do see opportunities to generate alpha in our sector picks. So I think in particular, we favor energy, healthcare, and consumer staples, in addition to selected tech stocks.
The energy story is interesting, right? Where you're seeing oil really build some more momentum now. We've gone from, $70 to close to $90 for Brent. Are you saying that it's time for these stocks to actually play a bit of catch up here?
Yeah, indeed. What we did was actually when we looked at when we did our second half outlook, we saw that energy stocks were underperforming in the first half, and oil was at $70 per barrel. And we thought that OPEC Plus being very disciplined in their supply further curbs, I think that could lend support to oil prices, offsetting some of the demand concerns. And in addition, oil could also serve as a good hedge against geopolitical as well as climate risk, right? So while energy stocks have actually indeed outperformed over the past 2 months, since in third quarter, we do still see further room for it to rise and outperform further.
Eddie, thank you so much for joining us. Eddie Lowe, joining us from KL here this morning, Chief Investment Officer at Maybank Group Wealth Management. Just want to remark, when it comes to L'Occitane, this is, of course, the beauty products maker that listed here in Hong Kong. Shares indicated about 28% lower in this Hong Kong auction. What we're hearing so far is that the boss has basically ended those talks on a potential buyout deal to take the company private. So it seems like this could add some more pressure on the stock as well. Jefferies is saying, look, that's going to be a surprise to the market here. Maybe it's suggesting there's a discrepancy between the controlling shareholder and the minority shareholders on an offer price. So we could be seeing a pretty big move on L'Occitane a little bit later on here this morning. In terms of the renminbi fix, that's what we're counting down to here this morning as well. I'm guessing we're going to see another sign of strong support. 727.39 is the survey here. Of course, we are also counting down to those Caixin PMI numbers for services and composite. Here we go, 717.83. So yes, we are talking about a 56 pips. There you go. I think I got it right. Let me know if I got it wrong. Consensus here. Our producer Ernest is off today, so he can't help us with our fast math. But I believe it's around that time. But there you go. 728, just under that handle here goes to dollar China. Still seeing a bit of weakness here this morning. Still ahead. We have S&P Global Ratings joining us here in the studio to explain why they think the property sector will continue to struggle until at least next year. Charles Chang joining us. But first, Bloomberg can reveal that despite U.S. sanctions, Huawei's latest smartphone is powered by a homemade 7-nanometer processor. What that says about Beijing's tech ambitions next. And we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. Will this rally continue? Future suggesting maybe not this morning. But again, the weather, post Saula, clear skies here this morning. This is Bloomberg.
Thursday.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
All right, we are watching, of course, chip stocks very much in focus. Yesterday, it was a massive move on SMIC. We'll see if we'll get that here today on the back of this Bloomberg story. Of this teardown of this new Huawei phone. We're not seeing a whole lot of read-through here in some of these chip makers here today. In fact, Samsung Electronics is down about 0.7%. SoftBank, of course, that ARM IPO roadshow kicks off as well. But yes, let's back to that story here. Bloomberg has learned that Huawei and China's top chip maker have built an advanced processor to power its latest smartphone. It's a sign that China is making early progress in domestic chip making, flying in the face of U.S.-led tech sanctions. Let's get more now from our Greater China Senior Executive Editor, John Liu. It's certainly a story that moved the market yesterday, John, but we want to hear more of these details of this teardown. What did we learn exactly?
I think the most important thing we learned, Yvonne, was that this chip that is in this Huawei phone is a 7 nanometer chip. What that means is the U.S. sanctions that were imposed were aimed at preventing China from getting to 14 nanometer technology, which is about 8 years behind the cutting edge. The 7 nanometer chip that we found, or Tech Insights has found in the Huawei phone, is 5 years behind the cutting edge. That means China is making a lot more progress than expected on being able to create its own technology, its own chips for use in things like phones and lots of other gadgets.
So, what does it mean about these U.S. sanctions then? I mean, in some ways, did it actually hamper their technological advance, or is it in some ways making China just double down on this technology and really continue to put more resources towards it?
I would say at present, it's probably too early to make a call on that. There are a lot of questions. Yes, Huawei and SMIC, SMIC have been able to make this chip, but can they make it at great volume? Can they make it at great economic cost? Are they going to be able to put this out on the market at a competitive price? These are all questions we don't know. This Huawei phone that they started selling, it sold out very quickly. That suggests that they don't have a lot of these phones stockpiled and potentially not a lot of these chips waiting to be used.
All right, and we're seeing another day for SMIC shares gaining in the pre-market here, about 0.7%. John Liu, thank you so much for bringing us that story from your team, our Greater China Senior Executive Editor John Liu, joining us out of Taipei here this morning. Of course, we're watching chip shares lost a 10 as well, that pre-market, and we are seeing falls in the double digits here as the chairman ends those buyout deal talks. You take a look at how SMIC is doing, seeing some gains here this morning, but in the pre-market, we'll continue to watch what plays out in this China session here today. Just 8 minutes ago, Caixin PMI services numbers also on tap here. We got plenty more ahead. This is Bloomberg.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
All right, just a few minutes away from the open, and of course, we are watching very closely what happens in the property market here today with Country Garden. Either today or tomorrow, that grace period for that dollar bond does end, and whether we can see the property developer actually avoid a default, that's the key thing here. But then again, you look at China's high-yield bonds, and we actually saw quite a rebound here yesterday. In fact, that index gained the most in more than a month. But then again, we lost some 5% in August. That was the most since May. And we're still talking about what? The gauge still down 14% or more this year. So we are still set for a third year of declines, at least when it comes to Chinese high yield. Is there still sort of tactical opportunities in this sector is another question. Take a look at analyst actions for you. China Southern, 8 shares cut to a hold at HSBC with a price target of 450 cents time. Focusing on the tech sort of rally here as well. Cut to hold at HSBC. And Guangshen Rail, A shares raised to a hold at HSBC as well with a price target of 330 renminbi. So the agenda here today, we talked about northbound flows. In fact, foreign investors bought the most mainland stocks in 5 weeks. That certainly is a telling signal that maybe we're seeing a little bit more foreign interest back into this market, but one day doesn't make a trend, right? But certainly is a good signal. Property we talked about, chip stocks with the Huawei story as well. Country Garden dollar bonds, of course, very much in focus. And we have some data out of Hong Kong as well as China, those Chinese services composite PMIs. Will we continue to see maybe a little bit more green shoots in the economy in terms of the data? It was mostly the manufacturing side. Maybe we'll see still that contraction or that fear of contraction when it comes to services. Hong Kong PMI is also out for August as well. And then there's still a lot of speculation. Paul Chen talking a bit more about they're never excluding the possibility of a stamp duty tax cut, right? So certainly that is one that we're watching out very closely. Trip.com. The earnings were quite a bit of a blowout here. We're not seeing that reaction follow through from the ADRs. The Hong Kong shares are just slightly lower here this morning, but Laosatan, that's the big one. We're down 28%. Alibaba Cloud, they're eyeing some fundraising with some state firms as well. But yes, the Laosatan story is basically these buyout talks. to maybe take the company private, end it basically. So that's surprising the market in some ways. SMIC continuing another day on the back of that Huawei story as well. Here's how the property developers are doing. Of course, Country Garden front and center. We're down some 1% here after we saw quite a bump in the shares in Hong Kong yesterday after reopening. Evergrande's up about 3% still. We're watching China Wanka, China Ocean Land, Bloomberg Intelligence is saying these are some of the names that are very much in focus here that might be next year in terms of payment pressures. And we got that open coming up next. Futures lower here this morning. The open is next. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Good morning. You're watching Bloomberg Markets China Open. Just 45 seconds away till the opening trade here in Hong Kong as well as in Shenzhen, Shanghai. Looks like we are seeing, coming off of some of the highs yesterday already, that optimism on housing stimulus and really that reopening of Hong Kong. Looks like we are seeing a little bit more downside here today. We're back lower about 0.7% in the pre-market in the Hang Seng. Dollar China is at 7.28. Another strong fix on the PBOC here today. And of course, we're waiting, Country Garden, any news now that we have seen that dollar bond grace period ending possibly today or tomorrow. Still some confusion about that one here, but certainly the property markets, stocks very much in focus here, just given that rally that really was led by these housing stocks yesterday. Can it continue? Doesn't seem like it here today. But here's how your dashboard is looking like in China, where you see the CSI 300 lower by about 1/5%. The Hang Seng seeing bigger sort of losses of 0.8% after we rallied as much as 3% yesterday before ending the day around 2%. But foreign investors, at least yesterday, we saw the biggest sort of inflows net buying since July of 31st, so 5 weeks ago. So certainly that's a telling sign that maybe there's a bit more interest in this market. Chinese 10-year yields are slightly bid here this morning, but not really doing too much. But it really is 8 shares are lower by close to 1%. You're seeing HS Tech is driving things lower here, as well as we're watching the chips very much in focus, just given that Huawei story, that they were able to use some of these SMIC chips in that new phone, according to that teardown. So watching that very closely of how significant that is. Chinex is slightly lower here this morning, and we're watching, of course, very closely the next board here on Hong Kong and the other sectors, right? So the property market, we're watching everything from industrials to the property sector, consumption. It seems like most sectors in the red, on the exception of China developers, right? So that one is still looking a little bit good and resilient here in the face of all this right now. Hang Seng, we're just around 18,670 or so. MSCI China just below that 62 handle. And we're watching, of course, earnings. We're at the very tail end of the earnings season, but Trip.com did deliver some pretty solid results here. We saw a massive beat, but still the shares are down 1.3% in Hong Kong, surprisingly. Alibaba, there was about, they're eyeing some of these state firms and fundraising to talk about as well, the cloud unit, we should say, and Occitan. So the buyout talks seem to have broken down and have ended. So it looks like that deal is not happening. 27% lower. The market is surprised. And SMIC, it looks like, we were up about close to 9-10% yesterday out back of that Huawei story. Seems like we're coming off that now. We're lower by about just 1%. And of course, the developers still very much in focus. Country Garden, Evergrande, the like here, unchanged for Country Garden. We're back above $1 though for the stock, not a penny stock. We'll see how long that lasts. Evergrande, though, we're down up about 1.7%. Mixed picture across some of these developers here this morning, but mostly in the green. Let's bring in Charles Chang, country lead for Greater China Corporates at S&P Global Ratings. Of course, as we count down to whether Country Garden can convert this default or not. I mean, we had all this great news about housing policies that are finally coming through. In your eyes, can it actually spark a turnaround?
I think it will take time. These measures may not necessarily address the main issue with the market, which is that home buyers are afraid of not getting the home that they paid for. So the question is, how much incentive do you need to take that risk? And these incentives may not be enough. Confidence takes time to build.
The fact that we're seeing the rescue to the housing market at least widen a bit, do you get a sense that Beijing is ready to even rescue some of these private developers?
I think the government recognizes the significance of the Country Garden event. So if you think back to when the sector really, got knocked into crisis, it was 2 years ago around this time when Evergrande, fell into distress. And lo and behold, 2 years later, we're still here. And Country Garden is also a large developer. And the significance is that this year was supposed to be a turnaround year. And investors, home buyers, are just getting their confidence back on track. And all of a sudden, you have this big event happening. And I think the government recognized that they need to step in and try to boost the market a little bit.
There's a lot of talk about comparing those two, Evergrande and Country Garden. Can you chime in on this debate? Do you see parallels or more differences?
Well, the similarity is that both are very large developers. But when we say large, if you look at the ground floor area under construction, each of them take up about 1.4% of the entire market. So it's not particularly huge from a construction perspective. But the difference is that they're both very well-known developers, both very large. So there's a broadcast effect that impacts homebuyer confidence when they fall into distress. And this event, unfortunately, has had a negative impact on that. And homebuyers are going to take more time to get their confidence back to buy homes.
I mean, are you starting to map out these scenarios? If we do see a default of Country Garden, what would be the knock-on effects that you're going to see across the sector?
I think, unfortunately, the damage is probably already done, right? So the most important effect is home buyers' confidence being knocked down, and that's already happened with this event. In terms of follow-on effects, so obviously we may see a negative impact on home sales, and that has a knock-on on building materials, white goods, for example.
What's your view on their liquidity situation now, though, for Country Garden?
So I think for the company itself, won't get into a lot of details, but effectively what we're seeing is in the first half results that are coming out, a lot of developers' cash levels are low. So that means that ultimately their options are going to run out in a short amount of time. So they're going to go into restructuring. And from their perspective, it probably is something that they need to do to get it behind them and focus on operations again.
We've mostly seen ratings downgrades from S&P, also in China. S&P, you had 16 downgrades versus 9 upgrades. 11 of those downgrades are actually in the high yield. Is that mostly in the property space?
Most of that is. I think this is an event that is quite unprecedented, and as such, the reflection of the stress that these issuers are facing have been come out, faster than many. And we do have to keep on top of these developments. As you know, there are many that kind of unfolds on a daily basis. So we do need to take action to let investors know what's happening and what our views are.
Do you think, does it matter if there's a certain degree of government support, or even some state-backed sort of developers? Is there still that divergence that can continue in some ways, or are they also facing payment pressures as well?
I think the most important difference is that from the perspective of home buyers, when they go buy a home and they see a state-backed developer, perhaps there's less concern that they won't get the deliveries. So for most of these developers that are owned by the government, we don't actually give them credit for state support. But it does make a difference when it comes to sales, especially in crisis times like these.
Yeah. I don't want to just talk about bad things. I'm just wondering, overall, you look at the whole country, are there sectors that are still doing well in China?
I think the easy way to think about it is that, spending in China has shifted to the quality of life sectors, right? So travel and leisure, so hotels, travel, the casinos' incomes tripled this year. Delivery is doing well. Cinema is doing well, and mid-tier restaurants are doing well. So people are spending time to, essentially enjoy the quality of life, and their spending is going in that direction. Larger ticket item purchases are not doing so well, and that's being pushed off, perhaps extended until a later time. So right now, people are kind of focused on enjoying life.
Enjoying life, certainly. I'm just wondering, there's also this sort of discussion of setting up this private economy bureau. What's the significance of that? Are we likely to see more support, I guess, for the private sector?
Well, it's an important indication because there's always a perception in the West that the Chinese government is happy to run the whole economy with SOEs. And setting up this bureau basically indicates that the government recognizes the importance of the private sector. They understand that the dynamism that the private sector can offer. And they're setting up a bureau to deal with the issue of private sector being crowded out by the state sector. So it does reflect the importance that the government assigns to the private sector.
Charles, great to have you back. Charles Chang, country lead for Greater China Corporates at S&P Global Ratings. Coming up, we're talking about BYD setting its sights on Europe after dominating China's EV market. Our interview with their European managing director is next. This is Bloomberg.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
In China, the market development is not as strong as we expected a year ago, but I'm very optimistic that also the Chinese market will have a comeback. And therefore, it is important to prepare ourselves to be there.
The CEO of Volkswagen, Oliver Blume, speaking to Bloomberg's Oliver Crook in Munich. Well, Chinese EV maker BYD says it wants to enter the European market at a price point that it calls affordable. The firm's Europe managing director, Michael Hsu, spoke to us at the Munich Auto Show and told us BYD wants to build on the strategies it's used at home.
We've got a very good marketing performance in China in the past 2 or 3 years. And we found the market love BYD's technology and the product so well. And so we are trying our best to introduce those technologies and the products to overseas market. And definitely Europe is our strategic market.
So what markets will you be focusing on? What countries in Europe will you be starting in?
You know, Europe is a very big market, and following China, it's almost the biggest market for a new energy vehicle just following China. So we do think the customer here is more environment care and more technology care. And also German is the biggest market in Europe. And we generally don't have very focused market in Europe, but we want to communication with all the European, pan-Europe market.
And so how are the customers, how are they finding your cars? What are they liking about BYD that maybe some of the other cars don't offer?
Actually, BYD already invested in new energy vehicle technology for many years. And we invest not only the product itself, but also the key technology inside, the battery and the powertrain, the telematics, and we have full technology vertical contribute the product. And so that can bring our customer different experience, because with that, customer can get safety is our first priority, and with the technology based on the battery technology. And secondly, is the premier design of the car, but with accessible price.
And at a certain point, when you really want to build market share, you're going to have to build factories in Europe. Have you thought about what countries you'd be looking at to build manufacturing capacity?
Definitely, localization is one of the very important strategy of BYD's Europe strategy. And so we are considering, we're evaluating different locations in Europe and where we can build the cars. We hope we're targeting and we can have some announcement at the end of this year.
Michael Hsu there, BYD Europe Managing Director at the Munich Auto Show, speaking with Bloomberg's Oliver Crook. Checking some EVs here this morning, of course, as we hear more voices from the auto sector at the Munich Auto Show, talking about how they're going to really kind of fend off this competition with these EV makers in China. You're seeing a pretty much down day across most EV stocks here this morning with Leon Auto down some 2.6%. In terms of other movers that we're watching out for, it's still the property space. You're seeing a bit of nuance here of what you're seeing. Country Garden's pretty much flat after we were up close to 14-15% yesterday. You have the likes of Sunac China, though, a massive rally that we've seen the last 2 days, north of 60% or so in the last 2 days or so. We're seeing up 18% for Sunac China here this morning. ENN Energy Holdings, that's one of the biggest drags on the Hang Seng as well. We're down close to 7%. Natural gas, certainly a factor here. We did see those prices fall. L'Occitane, that's the big one as well. Those buyout talks ending as well. So we're down some 27%. We got plenty more ahead. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
The Mariah is just an unbelievable place. It's a cultural oasis. And I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
Caixin China PMI numbers coming out here. This is the services one that could be a bit of a disappointment for the market here. You're already seeing dollar China move on the back of this. 51.8 for August. So this is quite a miss from what the economists were expecting. They were thinking of a print of 53.5. So like just a little bit of a slowdown from what we saw from the previous month. But this is seems more material sort of slowdown here, and really reminiscent of what we saw in the official numbers just a few days ago about, you know, we are near contraction, or at least we're getting close to that. And just more further signs that maybe it is the property sector that is starting to drag down services, consumption, that story as well. Composite numbers also coming in. There's no survey for that one, but it is 51.7, so just slightly slower than what we saw in the previous month as well. Dollar China, you see a little bit of a spike there, 729 now on the back of that data here, suggesting maybe, yeah, that bad news is being priced in by these traders here on what this all means in terms of other stories that we're watching out for. Really, Russian President Vladimir Putin has rejected Turkey's efforts to restart a landmark deal which allow Ukraine to ship its grain through the Black Sea. Putin told Turkish President Recep Tayyip Erdogan that he won't consider reviving the deal unless the West removes obstacles to Moscow's own agricultural exports. Global wheat prices have remained volatile after Russia left the deal back in July. The U.S. says North Korean leader Kim Jong-un is expecting leader-level talks with Russia over providing weapons to support Moscow's war in Ukraine. The White House National Security Council is calling on Pyongyang to seize the arms negotiations, which they say are actively advancing. The New York Times has reported that Kim intends to meet with Putin later this month in Vladivostok to discuss weapons. China has criticized President Biden's strategy towards Beijing as being, quote, doomed to fail. In a WeChat post, the Ministry of State Security says the current American focus is no different from its previous approach of engagement and containment. The public criticism comes less than a week after U.S. Commerce Secretary Gina Raimondo visited Beijing in a bid to bolster business ties. So another key event we're watching out for this week is the G20 summit in New Delhi. It's a chance for the Modi government to showcase its push to become a key player in the global economy and geopolitics. And as China struggles with sluggish growth and tensions with the West, the timing may be just right. Bloomberg's Medha Doshi reports from Mumbai.
India, home to a now record 1.4 billion people. More than half under the age of 30. But that also includes the largest number of jobless youth anywhere in the world. The fastest growing large economy in the world, India has the third highest number of billionaires. But on per capita income, it ranks at the bottom. The widening gap between the richest 10% and the bottom 50% makes India one of the most unequal countries in the world. Democratic English-speaking India, with an army of software engineers, has sought to become a major economy since its economic liberalization in the 90s. But authoritarian China has made bolder moves to become 5 times bigger. So why might this be India's moment? One big reason: it isn't China. Policy making from Beijing nowadays remains hard to predict. Western countries are wary of China's growing economic and technological clout. International companies are seeking supply chain diversification, China plus one. To speed that along, India's government is spending record amounts on infrastructure and offering production incentives to key industries. Other reforms range from a unified national sales tax to a world-leading digital payments system. Bullish investors and stock market highs have burnished the India story in the year of its G20 presidency. That Prime Minister Narendra Modi hopes will set the stage for his re-election next year. It will also test whether most Indians are buying the India shining story or not.
All right, that was Megha Doshi in Mumbai for us as we preview the G20. Just want to mention here also in the last half an hour or so, we did get confirmation about President Biden. He will be attending the G20. He is set to head to New Delhi on September the 7th. He's going to have some bilateral meetings with the India Prime Minister Narendra Modi on the 8th, and then participate at the Leaders Summit on September 9th that weekend. Of course, key issues are going to be clean energy transition, climate change, Ukraine-Russian war, increasing the capacity of multilateral development banks. Of course, we've been also reporting that Xi Jinping, the president of China, will not be attending the G20 this year. In fact, the Premier Li Qiang will go as instead. But certainly, a lot to talk about here as we count down to that summit. In terms of the market moves, of course, it's pretty much a dire sort of risk-off day across global macro movers here today. You're seeing basically a sea of red across risk assets here this morning, as well as bonds. But Country Garden is still the key focus here, of course, with those dollar bonds. That grace period seems to be due today or tomorrow. Evergrande is the exception here, but we are now mostly lower when it comes to some of these big property developers. You take a look at how Aussie assets are doing as well. Of course, we still have an RBA decision later on, about 2.5 hours from now. It is Phil Lowe's last meeting, set to hold things pat, but certainly with inflation, it is cooling down in Australia. We'll see how long that lasts. Maybe Lowe will have some last words really here on what this all means, the inflation dynamics and what we're seeing across the world, because we just told you about the Korea inflation numbers. You're seeing the Philippines as well as even Thailand, where there is now that fear that energy prices are really coming back in a big way to add more price pressures out there across these markets, and as well as what we're looking at when it comes to China. So Shanghai doing relatively better, but we're still seeing downside about 0.6%. The Hang Seng MSCI China seeing weakness here of more than 1% here this morning. It's the tech gauge, HS Tech down 1.5%. And we're still watching the developers very closely here. Interestingly enough, though, you're still seeing commodity markets catching a bid. Shanghai crude, we're off some of the highs, but we're still seeing gains about 0.5%. Iron ore and dalian also slightly higher here this morning. And we're watching very closely, of course, overall, what this all means in terms of the policy sort of thing here. It doesn't seem like this, stimulus optimism that we saw yesterday is lasting here today. Dollar has been mixed, but we're seeing a bid here across greenback against most of its peers. You take a look at how the Korean won is doing, still seeing some weakness, but Aussie dollar still seeing some weakness as well. So dollar firmer for the most part this morning. Of course, we're going to count down to Phil Lowe's legacy as well as we mark his last meeting. Global macro movers, let's bring that to that as well, of just basically what we're seeing here, where really risk sentiment is pretty dire this morning, where you are seeing, stocks are selling off. Hong Kong seems to be driving that lower. Dollar is firmer. Commodities are deep in the red here. Take a look at how Shanghai aluminum is doing. So with the exception of iron ore, really we are seeing red across the board here. Bonds are also on offer here, with the exception of the Chinese 10-year yield. So we're still seeing Chinese bonds bucking that trend. Coming up the next hour, we get closer to the RBA rate decision. Barrenjoey's chief economist will give us their outlook for policy as Australia's central bank comes under new management. Plus, we're at Gas Tech in Singapore, speaking exclusively with PetroChina's global head of LNG. Has is on the ground there in Singapore. We got plenty more to come. This is Bloomberg.
This is Bloomberg Daybreak, Middle East and Africa. Our top stories this morning.
More evidence of a China slowdown as fresh data shows the services sector expanded at the slowest rate this year in August.
We get a rate decision out of Australia in 30 minutes. The last under Governor Philip Lowe. A hold is expected amid mounting signs that the tightening campaign is working.
Meanwhile, Israel's central bank keeps rates unchanged, breaking with the Fed's last decision to tighten policy, even after the shekel depreciated to a near three-year low.
And Qantas CEO Alan Joyce is bringing forward his retirement by 2 months as an ignominious exit of one of aviation's highest-profile leaders after claims the airline sold tickets for thousands of flights it had already cancelled.
It's just gone 8 a.m. across the Emirates, 6 a.m. if you're in Johannesburg. I'm Yusuf Gameneddin in Dubai.
And I'm Anis Crowley right alongside you. So the stock market is grappling this morning with various floors. Will the Chinese create a strong enough floor in the housing market? No, not for now. Chai-Shin, the data comes in weaker. The floor is lower on the macro side versus, let's say, the floors that the PBOC are trying to do with the mortgage market. That fibrillity in confidence is manifest in equities as we trick a little bit lower. Now, when it comes to what various people out there say, Chai-Shin services knocks the confidence in equities. Mittal Katecha says the U.S. stock market is complacent, worryingly complacent. Valuations are stretched. There's no more safety net. FOMO is in full swing. And he talks about the valuation differential between the U.S. and the rest of the world being stretched. He wants to be outside of the U.S. with a focus on Switzerland and underweight the U.S. But confidence this morning is definitely knocked by the Chai-Shin services coming in at 51.8. More from Everell in just a moment. Now, the consequence of the lack of a significant macro floor in China damages the Aussie dollar. In 30 minutes, we'll hear more from the RBA. But that services data has unsettled the Aussie this morning. Down she goes by nearly 0.5%. And there's a mirror image between Aussie and the ramp-up over the summer in the dollar. We expect them to stand pat and remain in this calibration phase from the RBA. But Goldman Sachs warn on this. There may be more tightening. There's a risk of another 25 basis points in November. That could take the Aussie up off the floor that it's at the moment. 65 in the next 3 months. We are underpricing the risk of a rate hike. And, of course, we had Standard Chartered with us yesterday talking about time to reenact your short dollars. This is the state of play on inflation in Australia. They have every reason to hold solid in the calibration phase as inflation goes to 4.9%, Yusuf, from a peak of 8.4% in December 2022 as we go to Lowe's last meeting.
Yeah, quite a few variables at play. I want to get to U.S. Treasuries. You're back online in terms of the cash trade. We're looking here at U.S. 2-year yields at 4.90, U.S. 10-year at 4.21. So price comes down, yield goes up. We've got 4 Fed speakers this week. In the data side of things, U.S. factory orders and trade. I want to get to a chart and give a little bit of context on where we are with some of the riskier tiers of junk-rated companies, because they have even more debt compared with their income now than they have for at least a decade. And this graphic reflects that. The credit quality for those borrowers has deteriorated substantially in the past 2 years. That's not been reflected in spreads. The returns on CCC bonds have thrashed the higher rated. Year to date, the triple C component of the Bloomberg Global High Yield Index has returned 13.8%. Compare that with less than 7% for B or double B bonds for that matter. And a new Barclays analysis, this is the most read story on the terminal, shows that natural capital is not reflected in bond prices. Water, air, and soil resources, they're seeing downgrades, growing credit risk for investors. Argentina, Brazil, and Indonesia front and center in that biodiversity risk paradigm. I want to get to the energy front as well. I'll give you a little bit of an indication of a Brent crude trade that is stabilizing around $89 a barrel. Goldman Sachs is out with a new note, and they make the case that the global oil market is facing a large deficit of 2.3 million barrels per day this quarter, following production cuts implemented by OPEC+. That includes a voluntary reduction by Saudi Arabia. Now, potentially a more aggressive OPEC target could mean that you get the moderately bullish risk to the 12-month Brent forecast of $93 a barrel. History does not suggest that the producer group is in a rush to boost production. So they did an in-house analysis of 135 OPEC decisions over many decades, and this is what the data is telling them. Manas?
Okay, well, let's parse the data a little bit more in China. Avril is with us, Avril Hong, in our Singapore studio. So let's talk about the stock market there, Avril. You've got China faring after yesterday's rally, a little bit shaken this morning.
Shaken indeed. I mean, if you take a look at yesterday and how it was really a property stimulus-driven rally, it's being unwound today, and even the gauge of property developers in the country is a bit weaker today. The major indices also in negative territory. Now, some of it is because of the services PMI, which came in weaker than expected. There is also that profit-taking going on, although sentiment might be improving a little bit given how Country Garden has told the bond holders, the dollar bond holders, that it's paid a dollar bond interest within the grace period. We're also seeing how the services numbers are affecting the yuan as well as the Aussie. We will also be keeping close watch on Philip Lowe's last meeting. So let's take a look at how the rest of Asia is also faring on that. As you see, the Aussie a bit weaker there. There's a concern about inflation flaring up again in Korea. It came in hotter than expected, so it should give that hawkish bias to the BOK when it meets next. But it wasn't just Korea. We also saw hotter than expected prints out of Thailand and the Philippines. So there is a chance that economists have been underestimating the impact that rising energy prices might have, and the worry is that this might play out globally. You can see also the region's gauge is lower today. Yusuf.
Yeah, clear need for reassessment by some economic analysts for sure. Avril, thank you for the roundup, but that's Avril Hong in Singapore. Let's get more on the China services data, which expanded at the slowest rate this year in August. Bloomberg's China economy editor Jill Deeses joins us now from Hong Kong. So, Jill, I mean, how do these numbers build on some of the conclusions we've been able to draw over the last 5 trading sessions?
Hey, Yusuf. Yes, I think pretty worrying numbers out of China today. Maybe not incredibly surprising, just because when we saw that official PMI gauge last Thursday, if you looked at the underlying services sub-index under that non-manufacturing gauge, we saw that slowing quite a bit more than we were expected. It was just barely in expansion territory. We're seeing a little bit of a repeat this time around with the Caixin Services PMI. Remember, this is the one that measures smaller companies. The survey size is smaller, but it's still hitting on that same theme, that idea that this major driver of growth for the economy this year is really losing, quite a bit of steam. I think that, this is a reflection in part of some issues within the property sector. A lot of property activity is counted within the services gauge, and so that's going to be reflected in there. I think, regardless of the latest Country Garden news on repaying that bond and meeting at least one deadline, we're still seeing a lot more trouble more broadly within the services sector, or within the property sector. I don't think Country Garden is out of the woods, certainly. And I think that what this ultimately also tells us is that households are still incredibly reluctant to spend in China. This has been a major issue going back all year, this idea of waning confidence, people saving money rather than spending it. And we're seeing that feed through even more through the services sector than we had earlier this year.
OK, well, the Country Garden story, whilst it's a relief, it's a bit of a sticking plaster, isn't it, on the dam that is China property development. Jill, thank you very much. Jill DeCease in Hong Kong. So you mentioned it, the Reserve Bank of Australia is set to keep interest rates unchanged in around 20 minutes' time. It will be Lowe's final meeting. Let's bring in Swati Pandey in Sydney. So here we go. It's the last hurrah for Lowe. Has he got enough evidence? Has the RBA got enough evidence to continue in this pause cycle, as I said at the top, the calibration phase?
Yes, that's right. There is enough evidence, but the RBA will maintain the tightening bias. So we are seeing a cooling down in inflationary pressures, and the job market remains resilient. So these are two things that the RBA actually wanted, because they want to engineer a soft landing. That was one of Philip Lowe's big desires, that he wanted to raise interest rates to a point that it cools inflation down without damaging the economy. And it looks like he is successful in achieving that. Too early to say, because we have seen a spike in inflation in other countries after some signs of cooling down. So we'll have to wait and see what happens in Australia. But so far, it looks like they can be on an extended pause, and we are near a peak, if not at peak.
I mean, it's been a smooth road down to 4.9%. That's down from a peak of 8.4% in December of 2022. As we begin to think beyond this particular rate decision, what is the post-Lowe era going to look like as far as some of the input that you've been hearing from sources?
Look, given that we are at a peak, or near a peak, if not at, the post-Lowe era will definitely see an easing cycle. So economists are predicting the easing cycle to start in 2024, sometime in the second half of the year. And in terms of what the RBA as an institution will look like, it's going to be pretty different from what it is now. So fewer interest rate meetings, 8 policy meetings instead of 11 now, and more press conferences, more communication, better communication. So the RBA does not do any conferences. And outside of the governor and the deputy governor, nobody else talks about interest rate policies. So we will likely see other board members talk about interest rates, talk about policy, give more interviews, and be more open to talk about other issues or debate around policy within the central bank, which does not happen at the moment. So definitely a big cultural shift, a big communication shift that is coming.
Swati, love the insights. Thanks for your time. That's Swati Pandey in Sydney. Let's stay with Australia and talk about the Qantas CEO, Alan Joyce, because he's bringing forward his retirement by 2 months, with Vanessa Hudson set to take over from Wednesday. Let's get out to Bloomberg's global business editor, Karen Lay. So, Karen, this is the end of an era, 15 years of rule. What's been going on in the final few months here of his tenure?
Well, this really is the end of an era, and it's come a couple of months before we expected. Joyce was supposed to step down in November, and he announced this out of the blue today. But if you've been following Qantas in recent months, they've had a very bumpy ride, and so has Joyce. He's been forced to defend Qantas's practices in front of a Senate hearing in recent weeks, where he had to defend everything, including his own pay packet, which went into the millions. Even as a lot of Australians are struggling to make ends meet, the ACCC, which is the Australian consumer regulator, has sued Qantas for its practices. It says it sold thousands of tickets on flights that had already been canceled without telling consumers about it. And all of this is happening, you have to remember, against a backdrop in Australia of a cost of living crisis that's been historic, of an inflation rise that's been historic, and people are really struggling. They're watching every dollar. And the fact that Qantas has been doing these things has fomented a lot of customer dissatisfaction and a lot of mistrust in a brand that's been one of Australia's most trusted for decades.
Yeah, well, a fairly brutal end to a long tenure. Karen, thank you very much. Karen Lee in Sydney on the Qantas story and Alan Joyce's early departure. Still ahead, we speak exclusively to the Chevron Midstream President Colin Parfitt, live from Gastech 2023 in Singapore.
But up next, the global market outlook with Amundi Institute as traders await more stimulus from China amid a housing debt crisis. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Markets are subdued this morning after we've had the private survey from China's services sector showing activity expanded at the slowest rate this year in August. That's adding concerns about whether a major engine of economic recovery is losing traction. Our guest this morning is Valentin Enuez, head of fixed income strategy at Amundi Institute. Valentin, thank you for being with us. Taking straight from your script, you're cautious on China. China is in a situation of deflation, and the monetary policy conducted by the central bank therefore remains very accommodating. However, it will probably have to be even more to stimulate domestic consumption. How much more robust does policy need to be? Does it need to be a huge lever of monetary policy, or does it need to be something more substantive on fiscal policy?
They will, of course, will have to do more on the fiscal side. But I think what it's important now to keep in mind is that the Chinese government wants to move from an economic model that is debt-driven to a more stable model that is consumption-driven. So definitely, we think that in terms of stimulus, the Chinese government will remain as cautious as it could. So we remain quite cautious regarding the Chinese economy in the short term, because we think that the real estate market will continue to weigh on economic activity for the coming quarter. So this is not a long-term, this is really a medium-term story. Consumptions will continue to be penalized by a very high level of saving rates. We should also keep in mind that we have a high level of unemployment rate among young people.
All right, let's break out some of the other views, Valentin, because I looked at your research and your views on the Fed are, well, let's say a little bit refreshing, because there's a growing consensus that the Fed is done. You're saying, well, the Fed might not be done, actually. If anything, it opens the door for a hawkish pause. How does that filter through to the yield curve over the next 3 months?
Regarding duration, we remain neutral. We have a steepening, but it's more a medium-term position. In the very short term, I think, yes, we should be cautious regarding the story that the Fed is done with a rate hike. The US economy is still very, very resilient in this environment of higher rates. So why it is resilient? I see 3 reasons. The first one is the US labor market that remains very strong. Real wages are now back into positive territory. The second point is that the fundamentals of the residential market are very good. We are not in the context of 2008. US households' balance sheets are solid, and the level of inventory on the US real estate market for residential is very low. And the last point, the most important one, the US government is still supporting the US economy. The US federal budget deficit is going to be 6% this year. This is something amazing in a context of low unemployment rate and a high level of inflation. So yes, I think that next step is a pause, but we should be cautious that the Fed is maybe not done with a rate hike.
Well, it's interesting that some people would say that the amount of supply to meet that deficit funding, etc., is already absorbed by the market. You talked about steepeners. We're looking at 2s, 10s, and an inflection point in 2s, 10s. And lots of the narrative is that 2s are a screaming buy from BlackRock. That was yesterday's narrative. When you look at steepeners, what do you make of this move in the 2s, 10s? Do you think that there's a further extensioning in that steepening given the consensus trade, or do you look to fade these steepeners given your slightly contrarian position?
I think that, okay, first step is that we wish to continue to have some pressure on the short end of the curve. But next step is the Fed will cut rate, and we could have some slowdown in 2024. And I think that the market maybe underestimate the impact of this higher interest rate environment and in the US. We have to keep in mind that so far, American companies have not really been impacted by this higher interest rate environment because they exited the COVID crisis with a lot of cash on their balance sheet and very low refinancing needs. But this story won't last. And at some point in 2024, the US economy will be really impacted by this higher interest rate environment.
Valentine, a clear message of caution there from your side. That's Valentine Aynous, head of fixed income strategy at Amundi Institute. I want to get you some breaking lines hitting the Bloomberg. These are the highly anticipated PMI numbers from 3 countries, Saudi Arabia, the UAE, and Egypt. But I want to start with Saudi Arabia. PMI coming in at 56.6. That compares to 57.7 in the month of July. The index is the lowest reading since September of 2022. Overall input prices were slightly higher. In fact, the highest reading since July of 2022. Maybe a bit of a tail on some of the cost pressures, and then output falling to the lowest level since January of 2022, Manus.
Well, in the UAE, we have just a very incremental slippage. PMI comes in at 55, down from 56 in July. You are looking at the lowest reading since the start of the year, February 2023. New orders still rising away, unemployment rising as well. So all is well in the UAE economy. Depends what scale of population growth you're going to get. And then just checking in on Egypt, 49.2. From July, Yusuf, on that. But the employment numbers look firm.
Yeah, so Egypt at 49.2 compared to 47.6. The employment number at 50.7, which is the highest reading since November of 2022. And they've reversed the contraction trend. The stocks of purchases rising to the highest reading since December of 2020. We have much more coming up. This is Bloomberg.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Gabon's new military ruler has called for a referendum on a new constitution and an overhaul of the OPEC member states' electoral code. That as General Brice Oligui Nguema was sworn in as the transitional president yesterday, less than a week after soldiers overthrew President Ali Bongo. Nguema pledged to restore civilian rule and an unspecified transition period and said he had the goal of giving everyone a reason to hope for a better life.
I want to cross over now to Israel, where we had a central bank decision. The Bank of Israel kept interest rates unchanged, 4.75% for a second consecutive meeting. That is in line with the forecast of almost all economists surveyed by Bloomberg. Shekel maintained some of the losses after the announcement and traded 0.4% weaker. The currency's drop is posing a risk for prices after the inflation slowdown. In extending the pause, the monetary authorities are opting to deviate from the direction taken by the Fed for the first time since embarking on an aggressive campaign early last year to tame inflation. Goldman Sachs says, you know what, as long as this is still in focus, the hawkish bias is likely to stay. The currency remains vulnerable, though, to some of the domestic political developments. We're going to be speaking to the central bank governor. I'll be catching up with Amir Yaron at 12:30 Dubai time today.
Well, the great debate for all central banks is whether there's a soft landing, no landing, or hard landing in the United States of America. Now, the probability, this is the Bloomberg probability at 60%. Yet Goldman Sachs have come out with their view that the probability of a recession is running at around 15% versus this 60% probability on the screen. They reckon that rate hikes are off the table in November. In September, I should say, and the hurdle to a November hike is significant. They're talking about real disposable incomes reaccelerating in 2024, and the drag from monetary policy will diminish before vanishing entirely in 2024. So building the case really for the easy, soft landing there.
Yeah, from the recession probabilities, I turn to some of the big stock moves in the Middle East and Africa, and this is Eastern, which is the largest tobacco company in Egypt, one of the largest in the region, trading as much as 15% higher in early trading in Egyptian stock exchange after the government announced that the UAE company bought a 30% stake for $625 million. Gave back some of that, though, 21.70. Much more ahead. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
Live pictures there of Sydney Harbour. We have got the RBA stands pat 4.1%. Yusuf, we are in the calibration phase. This is an economy which has experienced above trend growth. We know that 4.1%. So this is the latitude that Governor Lowe on his last meeting has, because inflation peaked at 8.4%, comes in at 4.9%, and the Aussie dips at the moment. So again, that unsettling China data that we had this morning from Caixin, just another reason perhaps for the RBA, with the lack of a surety on China, why try and sort of quash everything there. So 4.1%.
Yeah, so pretty much in line with all but one of the economists that had given their opinion to a Bloomberg survey. 11-year high borrowing costs, slowing demand. I mean, Lowe has criticized the policy in the past as a calibration phase. Some further lines coming through here. A high inflation is weighing on real incomes, and there's a degree of optionality that the governor is keeping for the future new head of the RBA. So some further tightening of monetary policy may be required, which is your second red headline. More tightening does depend on how the economy and how our risks evolve, which is similar to what we've seen in some of the other markets out there, with labor market conditions still very, very tight. The Aussie on the move, Manus.
Resolute in determination to return inflation to target. Again, that's very much along the lines that you're hearing from the Fed. Will do what's necessary to reach that inflation target. But inflation in Australia has passed its peak. As I say, 4.9% is the number that we have. So the Aussie holds its loss. By the way, Goldman Sachs still reckon that we are perhaps underpricing one more tightening to come. They see inflation at 2 to 3% in the range by late 2025. OK, let's get across to Everett. She's in Singapore with the very latest on, I suppose, that lack of confidence coming through from the Caixin, and that is impacting the equity rally from yesterday. Everett.
Certainly, Manus, we're seeing that rally from yesterday being reversed and investors are taking profit as well. And there's caution given the state of the Chinese economy and the recovery looking not so straightforward from here, especially with, as you say, the miss on the Tyson Services PMI despite it remaining in expansion territory. So the gauges in China are down today. We're also seeing some of the losses coming through in the Chinese currency against the greenback. Now, let's take a look at how the rest of Asia is faring. There is that negative sentiment bleeding through in the rest of the region as well. Also in South Korea, where it's worth noting we did get a hotter than expected inflation print. So it looks like inflation is resurging more than expected. Similar picture based on what we got out of Thailand and Philippines today as well. The worry is that economists have underestimated the impact of these higher energy prices for the month of August, and that is a scenario that could play out globally. So keeping investors on their toes with this macroeconomic data coming out of Asia today, guys.
I mean, I'll tell you what's keeping investors on edge, or has been for quite some time, is China's country garden and the prospect of it not being able to pay its important bondholders. Now it appears that they've dodged a default. Is that right?
Yeah, it's told some of these bondholders that it's paid the dollar bond interest within the grace period. But this is really just kicking the can down the road, allaying fears at the moment that there is some sense that it can make its payments and avert a default. But as our colleagues at Bloomberg Intelligence have pointed out, even this might not be enough to avoid the downward spiral on Country Garden, just because of the number of projects and the potential, the looming risk of construction halts from this distressed property developer. So still negative on some of these property-related stocks and even the gauge on the Hong Kong stocks on Chinese builders. Yusuf.
Everil, thank you for the highlights. That's Everil Hong in Singapore. I want to get back to this part of the world and talk about the PMI data from the region that came out within the last few minutes that showed a slight slowdown in the UAE and Saudi Arabia. Let's bring in Khadija Haq, the chief economist and head of research at Emirates NBD. Khadija, I want to start off with United Arab Emirates. Yes, the index, at 56.6 is pretty much what we had in July, marginally lower. What caught my eye were overall input prices. Those rose to 54.8, which is the highest reading since July of 2022, and tells us a bit of a story of cost pressures that are re-accelerating again.
Right. I think a lot of that is reflecting the increase in petrol prices that we've seen over the last couple of months. And we saw the same thing last year over the summer when we had that spike in the crude oil price, and that fed through to UAE petrol prices, which has not happened in the rest of the GCC. So I think going forward, as we expect oil prices to remain elevated and potentially rise further, this is going to be a recurring theme. But as you say, overall, the PMI still points to strong growth. We have seen a slowdown since the first quarter, though, in terms of the momentum of growth that the PMI show. And that's consistent with what we had expected in terms of a slowing growth in the non-oil sector this year.
It's interesting, as I was looking through your research, I was thinking really to waste time in revisions is somewhat to sort of cry over spilt milk, isn't it? But I applaud the research. I want to know from you, because I've had the economy minister who sort of wriggles around this 7% growth target that he has. Clear all that away. Don't worry about whether it's going to be 7%, because it's most unlikely. What kind of population growth does he need to really deliver the ambitious growth targets and hopes that he has? And he's very clear that these are aspirations. They're not absolute levels, but it's got to be driven by population growth.
Population growth and productivity growth, right? These are always the two main drivers for long-term growth in any economy. So yes, productivity growth is going to be important. We have seen the government try and focus on boosting technology investment, on trying to increase the amount of sort of value added in the economy, which should help to boost productivity as well. But of course, population growth is going to be the main driver for the UAE and probably the whole of the GCC over the medium term. And I think we've seen a lot of reforms from governments, not just in the UAE, to try and actually make the region more attractive to people to come and live in, to try and boost that population.
I mean, the other thing that could drive some level of new growth is the potential of adding casinos to the roster of UAE offerings. Is it going to make a meaningful impact, do you think, as we look to 2024 on GDP projections?
Yes, I think if we do see those casinos open, that would be a big draw for people that may not have otherwise considered the UAE as a destination for a holiday. We have seen a rebound in visitor numbers from China by about 300% in the first half of this year compared to H1 2022, but it's still around 50% of what it was pre-COVID. So I think anything that could potentially put Dubai and the UAE on the tourist map in a bigger way than it currently is, I think would be a big boost to the tourism industry and growth overall.
It's certainly going to be a big push. You've revised your growth numbers for this year and next year. So for this year, you're at 4%. Do you think we accelerate again? I mean, you just look at the momentum that there is here. And it's an overused word. It's much overused in other places, velocity. But there is a real momentum and velocity, just as I decide to leave. But, I mean, there is a real velocity. Maybe there's something in that.
There is. I think the slowdown this year, obviously, we've got high interest rates, which are weighing on investment in particular, not so much on consumption, because, of course, that population growth drives overall consumption. But certainly, I think as we see borrowing costs start to ease in 2024, that could provide a little bit of a boost to growth. But we'll have to wait and see whether the population growth we've seen over the last year is sustained at that same pace, right? So if we see a slowdown on that front, then, you know, we may end up at a similar growth rate to this year.
Can I get you to weigh in on the Saudi numbers as well? Because the index fell to the lowest level since September of 2022. Output is lower as well. There seems to be a bit of a normalization in Saudi Arabia after the spectacular last few months that we had.
Yes, I mean, again, we're talking about a slowdown off a really, really high base and a high growth rate evident in the PMIs in the first half of the year. So I think this is normalizing as well. Private sector credit growth in Saudi has slowed. Again, high borrowing costs, I think, are weighing on demand for credit, and that is going to potentially provide something of a break on overall growth. But we still expect very robust growth in the kingdom this year, around 5% in the non-oil sector, which is, I think, very similar to what we saw last year.
When you see what the UAE is doing in regards to gambling, and then you see what Saudi are doing in regards to sport, how important a moment is this in the reconstruction of social norms in Saudi Arabia, which ultimately play through to economy? Women being able to drive for the first time a number of years ago was actually an economic accelerator. It was a reconstruction of the employment market. What is it that you've seen that's most impressed you about the Saudi story recently? Because it's just sports story after sports story for us.
Yeah, I think overall it's just been the commitment to implementing these very significant changes in the Saudi society. So as you say, it's starting off with women being able to work and drive and effectively opening up the labor force significantly, and then building onto that, the development of the tourism and entertainment industries, the relaxation of visa requirements for visitors. So I think all of these are going to continue to drive growth over the medium term. We've only really seen the start of it. The sports events are, again, just another draw to bring people into the kingdom, as visitors and then potentially as residents later on. So I think this is not the end of the story at all. I think we're at the beginning of the Saudi change, if you like. And I think that's, again, going to pull the whole region with it.
Okay, Khatija, thank you very much. Everybody all on the one boat together, all rising tides. Khatija Haq, Chief Economist and Head of Research over at Emirates MBD, our guest this morning on Middle East markets here right on Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's SIBO, the exchange for the world stage.
Chevron LNG workers in Australia have threatened 2 weeks of 24-hour rolling strikes at two major export plants starting next week. Now, while negotiations continue, the threat of stoppages has roiled the natural gas markets, already edgy over Russia's invasion of Ukraine. Joining us now from the GasTech 2023 conference in Singapore is Colin Parfitt. Colin, thank you very much for joining us. So we have a partial strike beginning on the 7th. We go to full-blown strike on September the 14th. How confident are you and the management team that you can avert a strike at this juncture and deliver an off-ramp? Good morning.
Hey, good morning. Firstly, thank you for having me on today. So if I talk about the situation in Australia at the moment, look, we're committed to find a solution there, and we want to find a solution that's a win-win-win. We want to find it as a win for Chevron, a win for our employees, and a win for the gas markets.
Colin, let me follow up on that, just to give our global audience some perspective on how heated the rhetoric is. This is a quote from the Offshore Alliance when they made a statement. The log of claims will ultimately be claims which Chevron will agree to, but not before they lose a few $1 billion, judging by the form guide, which is okay, as Chevron clearly have plenty of loose change in the Chevron piggy bank. Do you have any timeline as to how quickly you're willing to resolve the standoff?
No, so I mean, if I go back and really just to kind of repeat what I said before, there are active conversation, there's active dialogue going on at the moment. So I'm really not going to comment on things that are around the edge, but to say that, look, we're really committed to find a solution here, and we want to find a solution, and we understand solutions. You have to get a space that's a win for various parties. So we understand that it has to be good for our employees, it has to be good for us, and all of that will be good in the LNG market. So really, that's what we're committed to do.
Well, the volatility that's being delivered in markets daily is quite immense. You're responsible for 7% of the global LNG market. So what is, and if you can define, I mean, I hear the win-win-win. I've got the message. We've got all the messages that you want to win, you want to deal. What is the most intractable point? If you can answer the point for the market, that would be crucial.
Yeah, look, so if I think about markets, look, maybe I'll just take you back a year ago where we had the Russia-Ukraine crisis start. And so we actually saw, big spikes in the gas market. And what was going on there? Well, Europe was buying 40% of its gas from Russia. That gas flow dropped to a trickle, and we saw kind of big spikes in markets, and markets adjusted as LNG started moving from places like the United States into Europe to fill that, I call it, energy gap that Europe had. So that was kind of a year ago. What's happened since then? Markets have gotten, I'll describe it, slightly softer since then. We had a mild winter in both Europe last year. We had a mild winter in Asia. That caused prices to come down. And if you look at the moment, and look at the LNG markets, they're much better supplied than they were a year ago.
Yeah.
Having said all of that, and maybe it was your point about markets, there's a chance of volatility in markets. Europe's got record high storage at the moment. It's a good thing, but we do set ourselves up this year, depending what winter's like, for more volatility.
So Chevron is playing a very important role in balancing global supplies. Are you looking at adding any more longer-term deals to help offset some of the tension that could build up within the next year? I mean, what else is in the pipeline?
Yes, look, if I think about Chevron and what we're really trying to do as a strategy is we have gas resources around the world, and one of the things we're looking at is how do you bring them, how do you move them from where they are to markets where they're needed. So look, I'll give you some for examples. The United States, big gas resources in the United States, in the Permian Basin. You've got gas demand in Europe, and I mean, I'm sitting here in Singapore. We've got big gas demand in Asia, and how do you connect that is through LNG plants. So last year we did deals with a couple of LNG operators in the United States that helps bring some of that gas to market. You talked earlier on about Australia. We've got big resource in Australia. that we can bring to market in Africa, in Angola, in Equatorial Guinea. We have resource, and we've got a position in the Eastern Mediterranean in Israel, and we're looking there at ways about how we can expand that. Those molecules currently flow into Israel and Jordan and Egypt, and we're looking at alternatives to say, how do you expand and could you make some of that LNG? So there are a number of things we're looking at, but essentially for us it's how do you get that resource to market to kind of fuel the energy that the world needs, and at a lower carbon intensity than some alternatives, particularly like coal.
I caught up with Meg O'Neill. We talked about the strike a couple of weeks ago. And obviously, we haven't had an answer from you on what the biggest sticking point is. You obviously are keen not to go down that road. How would you describe the fragility of the LNG market?
Well, I think, and maybe just going back to the last point is, if I think about the LNG market, it's not as fragile this year as it was a year ago, essentially because we've seen a degree of rebalancing post-Russia-Ukraine and with mild winters last year. So you go into this in a better state. I do think, though, until you probably have to go 2-3 years down the line from here to get more supply into the market. And these are both the LNG projects that are coming on in the US Gulf Coast, in Qatar. Those are probably the first sets of LNG that come to market, and they come to market from about 2026, 2027 onwards. So that's when you start to really see a shift to having more supply in the market. Until then, so you've probably got 2 or 3 years where you may still have volatility in the market because underlying supply has not come more to the market yet.
Colin, we'll have to leave it there. It'll be great to catch up again if and when you find a permanent solution to the strike threat. Colin Praffett there, the president of the midstream at Chevron. So much more to come on Daybreak Middle East and Africa. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
We think Africa can benefit and the Global South can benefit only if the carbon market grows. It's got to grow. You heard a mention of about 121 million. This market has to become a market in the billions in order to work effectively. And for that, we need to ensure the environmental integrity of this market.
The U.S. climate envoy John Kerry speaking at Africa's climate summit in Nairobi. Now, in the meantime, as Gulf oil wealth flows to all corners of the globe, moves by a key member of Abu Dhabi's ruling family have positioned him as one of the most powerful and influential deal makers. Over the past few months, Sheikh Tahnoon bin Zayed Al Nahyan has gained control of the largest sovereign wealth fund in the United Arab Emirates, expanding the assets he oversees to almost $1.5 trillion. He's proceeded to bankroll billions of dollars in deals via an expanded empire of private and state entities. Bloomberg's Farah Al-Bahrawi joins us now for more on the story. Farah, tell us a bit more then about him and this expanding of an asset base that's currently underway.
Yeah, good morning, Yusuf. It's a very interesting story that's just moved looking at Sheikh Tahnoon. Just briefly going over who he is. He's the brother to the president of the United Arab Emirates. He is also the national security advisor and one of 2 deputy rulers of Abu Dhabi. So Sheikh Tahnoon's empire has now amassed $1.5 trillion over many different assets and many different companies with ambitions such as looking into acquiring Standard Chartered and Lazard. So they're quite big. And on top of that, he has investments in TikTok's owner ByteDance, and he's drawn in titans of finance such as Ray Dalio, Rajiv Misra. So there's a lot of people now coming here in Abu Dhabi drawn by this key member of the royal family. His companies include G42. This is one of the companies that's working with Cerebras, which created one of the first of 9 AI supercomputers. Actually, is something is offering something other than what NVIDIA technology is offering at the moment. And we also have my favorite company, IHC. This is the biggest company on the Abu Dhabi Stock Exchange. And
it's your favorite.
It is my favorite.
It's
I
your
mean,
favorite,
you
Jackie.
have to cover the biggest company in Abu Dhabi, right? And they told us that they're actively looking at investments in emerging markets, and that the UAE being set to join BRICS is also a key game changer.
You begin to understand just the quantum of his power when you look at his control over ADIA and ADQ, and that gives him, what, 1.15 trillion. Now, that's relative to the PIF, which is what? I'm just looking at your story here. Actually, let's just go to the QIA, which is 450 billion. It's a minnow by comparison. So there's global soft power here as well. There's political power via the financial lever, isn't there?
Absolutely, and that's what bankers and lawyers are telling us. The investments that we're seeing coming out of Sheikh Tahnoon's companies, which again are amassing from the biggest bank in Abu Dhabi, 2 sovereign wealth funds, as you mentioned, ADQ, which owns this Abu Dhabi Stock Exchange. This is very massive. He has reached throughout the financial community in Abu Dhabi through and through. So we have bankers and lawyers telling us that while this, you know,
Do you think he makes them wait and queue up for a couple of hours at a time?
Not sure about that, but I do know that there is definitely a geopolitical thought process behind these investments, and we have different people telling us that there's now the UAE has realized that one of its most important statecrafts is the financial element, and Sheikh Tahnoon is the strategist behind that. And the key one to watch out for, though, is investments tied to China. We do know that the U.S. is, you know, having a lot more, you know, thoroughly checking investments by foreign investors that do have ties to China, and it seems that the UAE and China's ties are growing. So that's one to watch out for.
The full story, of course, on the terminal.
It's there.
Absolute must read.
Absolutely. Farah Al-Brahi with the very latest on soft power and the real power, the money, the flow of the money from Abu Dhabi around the world in the UAE. Okay, let's hop on and have a look at the Aussie dollar. This is what we've got, Yusuf. It is a hawkish hold, but it doesn't seem to have done anything to put a floor under the Aussie dollar. This is Governor Lowe's last meeting. We understand we're in the calibration phase. They warn that they may still need to tighten further, and inflation has passed the peak, but the labour market is still tight.
Yeah, so the Australian dollar holds the losses after the decision. It was almost next to zero chance of the governor saying anything about his tenure in today's statement. Much more ahead. This is Bloomberg.
A very good morning. Welcome to Daybreak Australia. I'm Heidi Stroud-Watts in Sydney. We're counting down to Asia's major market opens.
And I'm David Ingles in Hong Kong. Well, stocks across the region are set to face some headwinds today. In fact, futures are already pointing lower as I speak here. That comes amidst this U.S. holiday, of course. You have the RBA decision on deck today. The bank is expected to hold its key rate. It's Governor Phil Lowe's final meeting, of course. Now, on to China, the housing crisis there now threatening to engulf its surviving developers, with about 2/3 of the 50 major private builders in default. Plus, breaking news in the last hour or so, Alan Joyce is stepping down early as Qantas CEO after a horror few weeks here for the company amid public anger over a series of scandals. We'll get to that story a bit later on in the show. In the meantime, there's some breaking news. This is out of South Korea, some numbers coming through. I'll start with GDP numbers so we can get that out of the way. It's not important. It's important that the inflation numbers coming through. So prelim 2Q GDP year-on-year 0.9%. You adjust this, SA, Q and Q, it takes you to about 0.6%. That's the GDP story, in line with estimates, just to note that too. What's really coming in hot right now is this inflation print, which, to be completely honest, looks absolutely nasty on face value. We're up 1% on month-on-month. That's CPI, that's headline CPI. Year-on-year is at 3.4%, both beating estimates. Excluding food and energy, so you strip those two out and you get to the core, 3.3%. Now, I'm just checking my Bloomberg right now. 1%, and I'll correct myself if I'm wrong, but it seems to be that this 1% print on CPI is actually the... Wait, is that a correct number? Anyway, at 1%, that's actually the hottest inflation print going back not just a few years. You'd have to go all the way back to 2016 to get a 1% month-on-month increase in core consumer. There you go, boom. Oh, that's nasty. Anyway, we'll see what market reaction's like. I'm guessing the market will not like that one. Heidi.
Yeah, really outstripping those forecasts in August. Partly, of course, we have seen those higher energy costs, but, you know, food for thought when it comes to the BOK and where they go from here with this data, right? We've got a little bit of data coming out of Australia as well. These are PMI numbers, the Judo Bank Australia PMI composite number, the final reading for August coming in at 48, still well in contraction territory, a little bit better than the previous reading of 47.1, so marginal improvement. The services reading, the final reading for August, 47.8. Again, a little bit better than the previous reading, but still firmly within contraction territory. And this, of course, goes into RBA decision day. Belle, I mean, I think all but one economist that we've spoken to here at Bloomberg expect no major surprises for Phil Lowe's last meeting.
Yeah, that's right, Heidi, and I think it just really points to the issue that's facing the RBA, because you have seen that weakness coming through. You just saw it there in the PMI numbers. Businesses, households, very pessimistic on the outlook, even though you see that strength still coming through in the labour market. But the expectation for the RBA today is that we're going to stay on hold for a third straight meeting. The key rate at 4.1%, so we're at a near 11-year high now for borrowing costs in the country. But the question, of course, when you get a hold is what sort of messaging is going to come through in the RBA statement. So TD Securities has been mapping out the different scenarios here. They're saying there's a 60% chance that it comes in neutral today, but that remaining 40%, they see it split between two different scenarios. So we could see a hawkish bias, and then in that event, we'd see a firmer dollar coming through. We'd see bond yields as well inching higher. And then the reverse is that we see a dovish messaging, and that would be the dollar retreating, yields also going lower, trimming their advance. And so one of the risks, of course, that is presenting the RBA today is still China's economy and the malaise that we're continuing to monitor there. If you change on now, when you take a look at market sentiment today, equity futures looking a little bit mixed across the region, but certainly we are keeping a very close eye on China's property sector, because Country Garden, as we know, are facing a key debt test. They've got more than $22 million of interest payments due by Wednesday at the latest. So, David, with US markets shut, we've just got futures coming online, but certainly that is where investors are really concentrating a lot of their attention today in Asia.
Yeah, I mean, it's our first indication because of the long holiday, of course. And to your point, we started out today soft anyway. And then it looks to be, and obviously momentum coming through into today was positive. 9 out of the last 10 days, we should be going for day 10 of gains across equity markets right now. We're seeing some weakness coming through here early in the early goings in S&P futures. Bond futures are indicating that we might get yields pushing higher at the Japan Open today. What you want to watch, though, very closely, and I'm going to caveat this because New York crude's at 86. We're closing in on 90 on Brent, and that probably goes into this really nasty inflation print out of South Korea, where you have food and transport costs actually leading those gains there. We're up, let me just look at my screens here, 3% almost in food and almost 4% on transportation. That's month and month, and that's going to be painful. We'll see what market reaction is like. Heidi, we were thinking that skinny jeans would go away. It wasn't inflation that didn't. So skinny jeans stays this year, unfortunately. Inflation remains a problem, suffice to say.
What's uglier, Dave? You know, on the margins there, right? Let's get some more reaction from our next guest, who actually, you know, was saying that markets have been a little bit too pessimistic. Let's see what he makes of this. Shane Oliver joins us now. He's the head of investment strategy and chief economist at AMP. Shane, always great to chat with you. You know, when you take a look at this pretty shocking read on inflation from South Korea, is it just a reminder that there is still upside risk when it comes to central bank policy?
Look, it certainly is. If I'm not wrong, I think those figures were for August. We have seen a rebound in oil prices, gas prices we know of, some food prices, and that may have been a factor feeding in there. I note the estimate was for a high number to start with of 0.6, and of course it came in a lot worse than that at 1%, as we've just heard. So yes, it is a reminder that inflation is still a threat. But by the same token, you know, the broader picture is one of global slowing or cooling, labour market pressures starting to ease. We saw that again on Friday with the payroll numbers, earlier in the week in the US with job openings. And of course in Australia, I think there is a real risk here that the Reserve Bank has gone too far. And we do have a very high risk of recession in Australia. So if the economic conditions remain one of slowed down potential recessions, then that will take more pressure off inflation, even though it's not going to go in a straight line.
Shane, I have to say I felt a lot calmer reading your recent note saying that there is cause to err on the side of optimism, or at least if you're going to be pessimistic, you're probably going to get it wrong when it comes to timing low points in the market, right? So tell us about your strategy as we kind of enter this weird end cycle phase.
Well, I guess, I mean, what I'm talking about there in terms of optimism, the history for share markets, literally, in fact, I've got a book over there to the left, somewhere in my bookshelf here, called The Triumph of the Optimists. The history of share markets is literally the triumph of the optimists. The share markets trend up over time. Trying to get the timing right is often very difficult. Just in terms of that timing, bringing it back to the very short term, we are going through the August, September, October period. We've got August out of the way. It was a slight negative, not as bad as might have been at the middle of the month. But that seasonal weakness is still with us. And there's still a whole bunch of factors out there which could cause volatility in markets after the strong gains we particularly saw in the US and elsewhere going into July. So right now, I'm still feeling a little bit cautious about things. As we know, those inflation risks are still there. Central banks have eased their tightening bias, but they still have a tightening bias. That said, I don't think they're going to raise rates in September, whether it's the Reserve Bank or Europe or the US, but they still have a tightening bias. The recession risks are still there. And, of course, we've got government shutdown risks for the US later this month or particularly going into October. So I suspect the volatility will remain high at the very least. But if we do get a pullback, I would see that as a buying opportunity because the inflationary pressures globally are easing and that ultimately will take pressure off central banks.
Yeah, Shane, I'm just looking at that book, 101 Years of Global Investment Returns, the Triumph of the Optimists right now. If inflation does, well, it has returned past tense. If it remains elevated, what does that mean for returns these next 12, 24 months in the equity market? What's your view there?
Well, if it remains elevated around these sorts of levels or at least well above target, then obviously that's a constraint for equity market returns because you've got to face the fact here. We've gone through many decades up until the pandemic and into the pandemic where inflation and bond yields trended down and that supported equity markets, a high price to earnings multiples. And if inflation doesn't come back down again as markets are sort of pricing in, then obviously that would be a negative surprise for investment markets. So that's certainly a risk, although it's not my base case, but that's certainly a risk.
How are you viewing China right now?
Well, not as negatively as everyone else. I'm cautious on it. If I was going to worry about two scenarios,
that's not hard to do,
it goes
but yeah.
into collapse. That's right. Scenario one is where it goes into collapse. And, of course, a lot of the commentary lately has been worried about that. The other scenario is where they come into a more constrained environment, much like Japan did through the 90s and 2000s. And I'd probably be a little bit more concerned about that one. I can't see the Chinese authorities just sitting by and lying flat and letting their economy and property markets implode. That's not the way China does things. It doesn't want to go back to the bubble economy scenarios, just like Japan didn't in the 1990s. And that probably sees it err on the side of not acting enough into.
Yeah, I think.
All right.
Yeah, I think we just lost the audio there, Heidi.
Yeah. Shane Oliver there, head of investment strategy and chief economist at AMP. Hoping we can get Shane back, because I have a feeling he was going to say something that was, remarkably investable when it comes to China, right? Could use all the insight that we can get, Dave, at this point. As it really does feel like that the options for the Chinese leadership when it comes to what they can meaningfully do to boost the economy, to fix the property sector, are looking quite limited. But let's bring Shane back now. And Shane, we sort of lost your audio in the middle of what you telling us about China. And I suppose my next question is the implications for Australia too, right? How do you invest around that? Of course, it's RBA decision day, but these economies that have big exposure and companies that have big exposure to China, are you feeling, constructive on that?
Unfortunately, sorry there, my sound device went off, so it's just gone back to the iPad, which picks it up. But I am feeling fairly constructive here. My bottom line on China is, yes, there are longer-term concerns. Chinese growth longer-term slowing down, falling population, slowing workforce, slowing productivity growth. But I don't see them allowing things to collapse in the short term, and I think we're going to see more stimulus. That, in turn, if we get more stimulus coming out of China, is positive for Australian resources stocks and ultimately positive for the Australian dollar. It's not going to be a big bang scenario like we saw in 2008, 2008. But by the same token, I think it will be a positive scenario for Australian resources stocks.
Shane, thank you as always. And on that positive note, we'll leave it there. We'll talk again. We'll see whether or not you're correct. Head of investment strategy there and chief economist at AMP. Right. Just ahead, we ask why these new investments in large-scale solar and wind projects in Australia are falling, and actually take a look at some moves which actually could help turn the tide there. Plenty more ahead. This is Bloomberg.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
The clock is ticking for Country Garden to avoid what would be its first default. Now, the Chinese builder has until Wednesday at the latest to make interest payments on his dollar note we've been talking about really for weeks. It's the, of course, counting down to the end of this so-called, this sort of 30-day period. There's still some confusion whether or not it's actually today or tomorrow, but as we point out, of course, the window is closing and closing quite quickly. Charlie Ju's with us. He's our bureau chief in Shanghai to get us up to speed. So, Charlie, is there any indication they'll make this payment as this window closes?
Good question. As you said, the clock is ticking. The company has $22 million worth of dollar bond coupon due today and tomorrow. If the company defaults, it will be probably the worse than the one by Evergrande in 2021, given Country Garden has 4 times more projects than Evergrande. Will the company default? We don't know. But what we know is, the company has tried very hard to avert a public default. Just 2 days ago, the company has successfully extended the payment of a 3.9 billion yuan note, a local currency note, and yesterday it successfully wired ringgit-denominated bond coupon. So the company is trying very hard to avoid such a event. But bear in mind, the company is one of the world's most indebted. The company has a total of $187 billion something total liabilities, including a couple of $1 billion notes maturing this year. And just a couple of days ago, again, the company released its interim report, and it posted a record $7 billion loss for the first half of this year. And in the earnings statement, the company warned that if its financial performance continue to deteriorate, it may not be able to meet its financial obligations, and the company is also facing severe uncertainties that may make it hard to become an ongoing concern. That's exactly what he said. In the dollar bond market and the stock market, the company's securities are already traded at distressed level. Despite the sharp rally in the shares yesterday, thanks to good news about the mortgage easing announced over the weekend, the company still, shares are still trading like 60% below its peak, and the company's dollar bonds are mostly trading at 10 cents on the dollar.
That was Bloomberg's Charlie Zhu there with the latest on Country Garden. We'll be watching that, but of course also tracking some of the other corporate stories. At this point, Bloomberg has noted that Huawei and China's top chip maker, SMIC, have built an advanced 7-nanometer processor to power Huawei's latest smartphone. That's according to a teardown of the handset conducted for us by Tech Insights. The processor is the first to utilize SMIC's most advanced 7-nanometer technology. Still, much remains unknown about this progress, including whether it can be made in volume or at reasonable cost. Alibaba's cloud division is said to be weighing a private round to raise funds from Chinese state-owned enterprises ahead of its Hong Kong IPO. Sources say the tech giant is working with advisors on a potential cloud intelligence unit fundraising that could raise about $1.4 to $2.8 billion. Prospective investors include state-backed telecommunication companies. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can find that at DayBreak. It's also on the mobile in the Bloomberg Anywhere app. You can also customize your settings so you just get the news on the industries and assets that you care about. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
Qantas CEO Alan Joyce is bringing forward his retirement by 2 months, with Vanessa Hudson set to take over from Wednesday. Let's get more from Bloomberg Global Business editor Karen Lee here in Sydney. So a lot has been happening in his final few months.
Yeah, this has been a sudden morning, Heidi. People weren't expecting this for another couple of months. He was supposed to step down in November, and it came early. But the thing to remember is the period of months this has come after has been very tumultuous for Joyce personally and for Qantas. He's had to defend Qantas in front of a Senate hearing, defend its practices. He's had to defend his pay packet, which hit millions of dollars, even as most Australians are struggling. Qantas was sued by the ACCC, which is the consumer watchdog here, which accused Qantas of selling tickets on flights that had already been cancelled without consumers knowing about it. And all of this comes in the context of a cost of living crisis here that's seen record inflation, people struggling to make ends meet, and people are upset that this brand that they've been able to count on has potentially been gouging them on prices.
So Karen, suffice to say, these challenges don't go away because Alan Joyce steps down early. What's on deck then? What's next? What are the short-term hurdles that they need to get through to fix the optics first and foremost, I guess?
The big thing is restoring customer confidence, wanting people to fly Qantas again, wanting people to trust in the brand. And to that extent, all eyes from investors to consumers are going to be on Vanessa Hudson. She's the CFO, and she's going to be taking over for Joyce. The pressure will be on her. And when Joyce made his statement this morning announcing his abrupt early departure, he did say that he was doing it so that Qantas could focus on renewal. And I think that's going to be a big watchword going forward.
Karen, thank you so much. Karen Lee there, Global Business Editor, One Stock to Watch. Suffice to say, will be the airline in just over 30 minutes from now. Apart from that, just a brief look across markets right now. You know, it's quiet, and we're coming off a long weekend here, of course, there. Let's get to some of your top stories here out of the Munich Auto Show. Let's start things off with BYD here. Well, it's setting its sights on Europe after dominating the EV market domestically on the Chinese mainland. Their European managing director told Bloomberg that they are planning to announce a factory location in the region that's by the end of this year. Now, the EV giant also presented the first prototype of its future lineup at the Munich Motor Show.
We've got a very good marketing performance in China. Europe is our strategic market, and we want to try. We want to communicate with the customer here, and let's see. The IAA is a great opportunity, and to have this conversation. We love to be here, and to hope every customer in Europe can visit our booth in Munich.
Now, Renault says it will resume talks with potential investors for the planned listing of its EV unit Ampere. The CEO told Bloomberg that they have received very positive feedback during some 35 meetings before the summer. He adds that a separate listing will allow, of course, Ampere to reduce costs by, get this, as much as 40% in its next generation of EVs. Right, just to look at markets right now as promised. We'll start things off with, with what's not happening across the currency markets. First and foremost here, as we point out, we're coming off a long weekend, a thin trade, perhaps exacerbated moves, or lack of it at least. RBA decisions coming out. We've talked a lot about that as well. Some data coming through, PMIs out of Europe. We have some services print out of China in about just over 2 hours from now. That's the private survey. That's Caixin. That's for the month of August right now. In terms of the yen, just a couple of things to watch. There's a 10-year bond auction today. We'll get the results, what demand looks like. Things have been to cover, of course, in about, give or take, about 4 hours from now, around 11:30, just right after the markets come back online for the afternoon session. So that's a look at the macro moves right now. Equity markets, the story is this glide into where we are. Tuesday morning is 9 days of gains in the last 10. It looks like that's about it. Some weakness really coming through in this market right now, 0.25% to the downside. S&P futures are flat. We may get a bit across Nikkei. We'll see what happens with that. We should point out that volumes have been extremely thin globally, 20, 30 in some cases, depending on the benchmark, 40% lighter compared to, well, the 30-day average, as you can see. Now, one other thing to watch as we make our way into the trading session today, you might have missed it. We'll talk more about this Korean inflation print in just a moment. There is this nasty comeback in inflation, 1% month on month. We'll unpack that for you, and whether or not do we get any policy implications out of the Bank of Korea, which I think has held its rate unchanged, kept its rate unchanged for 3 or 4 meetings, I forget now. But they've always struck a tone. They've kept the door open for future a tightening, as has been most central banks, and I would imagine that would perhaps also be the case when we get the RBA, and the wording there, of course, keeping that inflation story alive in some ways and really predicated, on the threat of that counter, as they say. Anyway, we'll talk more about that. Markets are softer. Risk assets. A look at Japan. 30 minutes to the open. This is Bloomberg. Good morning.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
You're watching Daybreak Asia. I'm Annabelle Drawers with a check on markets here. We're counting down to the opens for Sydney, Seoul and Tokyo at the top of the next hour. But one key theme we're going to be watching today is what happens in China's property sector, because Country Garden, which is one of the biggest developers that is in the country, is facing a key debt deadline. So this chart really putting it into perspective here, because yesterday a lot of the story in the China property space was more signals of government support coming through and a little bit of optimism as well that Country Garden will be able to meet some key payment deadlines. The dollar note's very much in focus because we've got 2 coupon payments worth more than $22 million that are due by Wednesday at the latest. But ahead of that, we actually saw a tick up in shares of around 15%. And also, when you take a look at that bar at the bottom there, those lines in blue are showing that trading volume actually hit a record, so more than 1.7 million shares changing hands in Hong Kong. So that's one of the key focuses for us ahead of the trading open today. But when you take a look at what equity futures are doing as well, broadly, we are pointing to a fairly mixed session throughout the day. Hong Kong very much in focus. China, or the US rather, has been shut over the past session. We've got futures just coming online here, fairly steady as we get underway. Eco data, of course, is the other key watch for us, and we actually had inflation numbers. And Dave, you were just so shocked at the top of the hour, but those Korea inflation numbers rebounding past that 2% target for the Bank of Korea, coming in at 3.4% gains in consumer prices on the year versus 2.3% in the July reading. So that is a huge tick up. Energy prices leading into that perhaps, but certainly it really does complicate the path ahead for the BOK. Very concerned by high levels of household debt, but have been retaining that sort of hawkish tilt over the past few meetings. They haven't shifted their policy stance since January. So certainly those meetings ahead are going to be more closely watched. But Heidi, of course, not just the BOK, because it's also the RBA today as well.
Yeah, it is. And of course, it's Governor Bill Lowe's last meeting as head of the RBA in just a few hours' time. This tumultuous 7-year term drawing to a close. Bloomberg's Paul Allen takes a look back at Lowe's leadership through some extraordinary economic events.
Phil Lowe's 7 years as Reserve Bank of Australia governor could perhaps be characterised by one word: inflation. When he got the job in 2016, inflation in Australia was barely above 1%. In his first appearance in front of a parliamentary committee, he had to defend the bank's apparent obsession with how to stir it.
We've not been what some have called inflation nutters. We've had a more balanced perspective, recognising that some degree of variability in inflation from year to year is both inevitable and appropriate.
CPI didn't vary that much in the years that followed, barely touching the lower bound of the RBA's 2 to 3% target band, until the COVID-19 outbreak, when inflation briefly dipped below zero. The global pandemic was a black swan event none of Lowe's predecessors had to deal with. After slashing the cash rate to a record low 0.1%, he came to utter the words that would ultimately contribute to him losing his job.
We are likely to be at the current level of interest rates for an extended period of time.
In March 2021, he even put a date on it, saying the condition for an increase in the cash rate is unlikely to be met before 2024. Many Australians took him at his word, taking out ultra-cheap mortgages as the property market roared back to life, only to be wrong-footed. So much for 2024. By May 2022, inflation was running red hot, and to contain it, the RBA embarked on the fastest pace of rate increases in Australia's history, 400 basis points in 14 months, leading to some very awkward questions.
Do you accept that you did, in fact, induce Australians to take out mortgages on the basis that interest rates wouldn't rise until 2024? And do you think you owe those people an apology?
Well, I'm certainly sorry if people listened to what we'd said and then acted on that, what we'd said, and now regret what they had done. So that's regrettable, and I'm sorry that that happened.
Lowe's hopes of getting a 3-year extension as governor were effectively dashed. The responsibility for defeating inflation now passes to his deputy and incoming governor, Michelle Bullock, the first woman to lead Australia's central bank. Paul Allen, Bloomberg, Sydney.
The RBA set to keep rates unchanged later today at Governor Lowe's final meeting. Let's bring in our economics reporter, Swati Pandey. So does this look like the end of the tightening cycle? Does it look like we're at sort of the peak now?
Yes, we are very close to the peak, and the hurdle to raise interest rates from here is pretty high, and the onus is on the data to really surprise to the upside. Economists are expecting one more rate hike, so the peak rate of 4.35%, most likely in November after we have seen the third quarter inflation report. But if financial markets are to be believed, the RBA is done.
Yeah, and hopefully they're correct, for at least for the sake of people who've taken out their mortgage thinking that rates were not going to go up. What does a post-low era look like here for the RBA, Swati?
We are looking at a huge change at the RBA, even as an institution. So under Michelle Bullock, we will see an RBA which will do fewer interest rate meetings, so 8 instead of 11 now. There will be more regular press conferences, so after every single meeting there will be a press conference. Hopefully there will be more interviews and more speeches from other board members as well. There will be a separate monetary policy board and a separate governance board. So we are expecting some more appointments as well. There's going to be a deputy governor appointment as well because Michelle Bullock's spot is vacant now. There is a chief economist appointment that we are expecting. So a lot of changes and hopefully inflation will come back down and the RBA will not have to raise interest rates again. And the focus will then be on how to improve the culture and communication at the bank.
As we kind of still await, I guess, more transmission, how's the economy responded so far?
It's been pretty mixed. So if you look at the jobs market, it's pretty strong still. We had job vacancies numbers yesterday and it showed a second straight month of increase. Unemployment is still hovering between 3.5, 3.7% for the past year, which is the lowest it's been in 50 years now. And on the other hand, if we look at consumer spending, that's been pretty tepid. A lot of the spending probably is going towards international holidays, so it's not reflecting in Australian data, but retail sales have really suffered a lot, and that's the biggest thing. People who have mortgage debt are really hurting, and they are rethinking about their budgets.
Swati Pandey there, our economics reporter, ahead of the RBA in about, I'm getting my math correct, 5 hours from now? Anyway, as you approach that, and at about that same time, if I manage to get my math correctly, the blog starts on the Bloomberg terminal, TLIV Go. Check that out for our clients. That should be opening up just a few minutes ahead of that decision, 12:30 noon Hong Kong time. So I'm just sort of transcribing that into where I am right now. So check that out today. That's a key event. Another key event to watch is at least this week, is the G20 summit that is taking place in Delhi. It's really a chance for the Modi government to showcase its push to become a key player in the global economy and geopolitics, and certainly as China struggles with its sluggish growth and tensions with the West here, the timing might actually be right. Our colleague Manaka Doshi reports out of Mumbai.
India, home to a now record 1.4 billion people, more than half under the age of 30. But that also includes the largest number of jobless youth anywhere in the world. The fastest growing large economy in the world, India has the third highest number of billionaires. But on per capita income, it ranks at the bottom. The widening gap between the richest 10% and the bottom 50% makes India one of the most unequal countries in the world. Democratic English-speaking India, with an army of software engineers, has sought to become a major economy since its economic liberalization in the 90s. But authoritarian China has made bolder moves to become 5 times bigger. So why might this be India's moment? One big reason: it isn't China. Policy making from Beijing nowadays remains hard to predict. Western countries are wary of China's growing economic and technological clout. International companies are seeking supply chain diversification, China plus one. To speed that along, India's government is spending record amounts on infrastructure and offering production incentives to key industries. Other reforms range from a unified national sales tax to a world-leading digital payments system. Bullish investors and stock market highs had burnished the India story in the year of its G20 presidency. That Prime Minister Narendra Modi hopes will set the stage for his re-election next year. It will also test whether most Indians are buying the India shining story or not.
Bloomberg's Manaka Doshi there in Mumbai. Well, coming up next, Chinese solar manufacturer GCL Tech is closer to opening its first foreign factory after talks with Saudi Arabia. We'll be hearing exclusively from their co-CEO next. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
Well, fresh investments in large-scale solar and wind in Australia fell by 42% in the first half of the year, but increasing demand for corporate power purchase agreements may eventually help turn the tide when it comes to that trend. Let's bring in renewable energy analyst Tushna Antia here in Sydney. This is not the right direction that we should be trending in.
Correct, and good morning. And yes, you're absolutely right. In the first half of the year, we noticed that investments have been really slow. And this is despite seeing a lot more policy certainty, both from the federal and state governments. Now, the federal government is modelling that we'll hit 82% renewable energy penetration by 2030. And currently, we're at the 29% mark. Despite these ambitious targets, we are actually slowing down with our investments, and that's because market conditions are really challenging at the moment. The transmission build-out has been really slow in Australia, and this means that projects that are trying to connect to the grid are delayed. Additionally, inflationary pressures are pushing the cost of onshore wind and solar up, and this is creating a really hard environment for a lot of investors and developers in Australia. However, despite this, we're seeing pretty stable demand coming from a lot of corporates, and this is in the form of power purchase agreements. And this is reflected in the investment numbers that we saw in the last half. If we look to the last quarter 4 in 2022, investments hit $3 billion, which is actually a 3-year high.
What sort of corporations are we talking about in terms of procurement, and is it a meaningful impact that we're seeing?
Yeah, so Australia's power purchase market is very diverse, and we see a whole range of corporations and utilities, and a lot of them have set ambitious net zero targets or more specific renewable energy targets, and they need clean power to help get them there. Even though growth has sort of been stable, the key players that we are seeing are the utilities and energy retailers. These are the likes of AGL and Origin Energy, which are both publicly owned, as well as government-backed companies like Snowy Hydro. And these big utilities tend to offtake energy directly from the renewable projects and then on-sell it to smaller corporates. If we look at the corporate side of things, the big players in Australia are the likes of Microsoft and Telstra, and they have both publicly announced that they want to source 100% of energy from renewables. We also see big industrial players like Rio Tinto, and Rio Tinto has modelled that it needs 4 gigawatts of renewable energy capacity to power its aluminium assets in Queensland, but only has about 0.23 at the moment. So it has a long way to go.
Long way to go, but what does it look like when it comes to investment for Australian renewables going forward?
So as we inch closer to the 2030 targets, and actually even 2025, which now a lot of corporates are targeting to be fully electrified by, we think that investments will just naturally start to rebound as there is more demand for renewables in the market. And if we take a step back and look at the impact this would have on the broader energy transition, it's actually a really interesting trend. Research from Bloomberg NEF has found that Australia needs to invest about $8 billion a year on average from now out to 2050 if we are to stay on track for net zero. And this is a huge amount of investment for a country like Australia. And if we look historically, investment has sort of been around the $2 to $3 billion per year on average mark. So we're looking at a potential 4-fold increase in investment. So Australia does have a long way to go, and we think corporations have to work in collaboration with governments as well as renewable energy developers if we are to meet these ambitious targets.
Tushna, thank you so much. Fantastic work there. Our renewable energy analyst, Tushna Antia, there out of Bloomberg NEF. In fact, I got a lot of help, in fact, just going through the research as I did this next interview you're about to see right now. on top of needing to brush up on my Chinese, by the way. Anyway, we spoke with, and staying on green energy, in case that wasn't clear, GCL Tech, really one of the biggest makers of polysilicon here, is in fact in advanced talks with Saudi Arabia about opening its first overseas factory as the two nations aim to extend their energy ties beyond oil. Now, the company's joint CEO, Lian Tianshi, told me exclusively that operations could start as early as 2025 as demand for solar products continues to grow. Have a look.
Because of our cost advantage and quality stability, I think that in the future, the emerging technology manufacturing capacity could continue to increase the market share of granular silicon. And this revenue will continue to increase under stable conditions.
Before we talk about China, which is your main market, I want to ask you about what your outlook is for global demand, generally speaking, for solar products this year.
I'm very optimistic because as of August of this year, the entire PV market's manufacturing capacity and its utilization rate are quite high. From an optimistic perspective, this year's capacity will reach 450 gigawatts. Even a pessimistic estimate might reach 380 gigawatts.
Can I ask about competition in China, which is your main market? Do you think there are too many companies?
I think at this point, because last year and the year before, our PV company's yield was quite high, and the return on investment may also be very enviable among all manufacturing industries, so it is not surprising that capital, including investors, manufacturers, and their process of switching to diversification, will undoubtedly choose or hope to choose to enter the photovoltaic industry. It is green enough and the profitability is high enough. So this is not a surprising choice. But I think looking forward in the next 2 to 3 years, with the intensification of competition, the advantage of larger scales, and the differentiation regarding talent reserves, technical reserves, and R&D reserves, the concentration of companies in the photovoltaic industry may begin to converge in the future, and the number will go down.
The vast majority of your revenues and sales is China. That's your main market. Does China remain your future purely, or are you looking outside China to expand in terms of commercial and revenues?
From the current point of view, we've gone pretty far in the Middle East. Including me and our CTO, we've made several visits to Saudi Arabia and Qatar, places we want to speed up implementation. The good news is that Saudi Arabia has mature industrial manufacturing infrastructure and experience, and it can provide us with enough photovoltaic output, including electricity reserves. I think this is a good alternative.
Now, speaking of the Middle East, which you mentioned there, a few months ago when we spoke to you, you mentioned that you were considering or thinking about putting up your first plant outside of China. So can I ask if you've made any decision on that plant, and if so, what's the target capacity, and also what would be the target start date of any sort of operations there?
Now we have a team of about a dozen people, and we are communicating with Saudi Arabia's Riyadh and the Royal Commission. We've submitted our site selection and our feasibility study report. In the meantime, our company registration is also underway, but its progress is much slower than that in Asia, compared to China and Hong Kong. We very much hope that we can get the land and start some preparations at the end of the year, which is the winter of Saudi Arabia, because the summer is too hot in Saudi Arabia. The temperature can reach over 60 degrees Celsius during the day, and that would be too hot for construction. So we wanted to avoid the summer process and then start the project as quickly as possible.
And that was GCL Technology Joint CEO Lian Tianshi joining us exclusively, of course, a couple of days back. Now, speaking of this transition to clean energy, we'll be speaking with the industry leaders in the climate tech space from this year's Gas Tech Conference that's taking place in Singapore. Catch those interviews in the coming hours at the times that you see on your screens. Right. Now, meanwhile, LNG workers at Chevron Australia have threatened 2 weeks of non-stop outages at 2 major plants from September 14. Now, partial strikes could come as soon as Thursday. Now, workers have served notice to the energy giant after clashing with Chevron over pay, A 2-week shutdown could lower Australian output by over 1 million tons. So we'll keep an eye on that. And that story, of course, on top of other stories we're tracking ahead of the open of major markets in the region. Plenty more to come. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Let's get to some geopolitical stories making headlines now. And China has criticised President Biden's strategy towards Beijing as being, quote, doomed to fail. In a WeChat post, the Ministry of State Security says a current American focus is no different from its previous approach of engagement and containment. The public criticism comes less than a week after US Commerce Secretary Gina Raimondo visited Beijing in a bid to bolster business ties. Russian President Vladimir Putin has rejected Turkey's efforts to restart a landmark deal which would allow Ukraine to ship its grain through the Black Sea. Putin told Turkish President Recep Tayyip Erdogan that he won't consider the reviving of the deal unless the West removes obstacles to Moscow's own agricultural exports. Global wheat prices have remained volatile after Russia left the deal in July. The US says North Korean leader Kim Jong-un is expecting leader-level talks with Russia over providing weapons to support Moscow's war in Ukraine. The White House National Security Council is calling on Pyongyang to cease the arms negotiations, which they say are actively advancing. The New York Times has reported that Kim intends to meet with Putin later this month in Vladivostok to discuss weapons.
Right, now just ahead of the open of your major markets, so we thought, and actually we'll see if we're correct here, we thought the RBA was going to be top of sort of mind today with the rate decision, and then the Korea read on inflation came through about 60 minutes back, and maybe that gives us, I guess, food for thought that perhaps there are other big stories that we're sleeping on, and perhaps this is a dynamic we might see actually play out, right, globally, so keep an eye on that, because food and transport costs were actually the sole sources of why the inflation print surged. Now, not to say that's not a problem, but it's something that obviously applies to every other economy out there on top of what we're seeing in Korea. So watch out for this and how it shows up in terms of that across that market, right? That market opens up in the next hour. Of course, coming up too on this hour, at least the next hour of Daybreak Asia here, as earnings season's wrap up, we speak with Ken Wong out of East Spring. He takes us through his highlights there. And out of GasTech in Singapore, it's underway of 2023. Of course, we'll be speaking with Indonesia's upstream oil and gas regulator. Plus the market opens, so it's busy these next 60 minutes. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Good morning. This is Daybreak Asia, and as you can see, we are counting down to the opening bells of major markets across the Asia Pacific. Heidi.
Yeah, a lot to contend with. Of course, it's RBA decision day, Dave. We had that really super hot South Korean inflation print earlier as well. A lot of corporate headlines to watch for, these potential strikes in Australia over these talks with Chevron, as well as, of course, Qantas. Alan Joyce out 2 months earlier than expected, hoping for a clean slate. But, of course, much with Michelle Bullock taking over the RBA, a lot of legacy issues to contend with.
Yeah, Heidi, I think you just summed it up all there very nicely. I mean, we've got eco data coming out of Korea, Japan, corporate stories like Qantas, RBA decision day. You can add to that China's property sector, those concerns there as well. So that's really setting the stage. We've got markets coming online now for Japan, Korea and Australia. Now, at the start of the day, that focus coming in with the Nikkei here. We're a little bit higher as we get trading underway, but certainly the focus are fairly flat now. But essentially household spending, that's one of the big data sets we've been watching in the past half hour or so. We saw in July consumers in Japan really continuing to cut back their spending. So household spending down 5% on the year. That was far more than what economists had been predicting of 2.5%, that contraction. So certainly telling us here that persistent inflation that we've been seeing in Japan is really starting to erode purchasing power there. So it certainly is a further headache and conundrum for the BOJ as it pledges to stick with its easy policy settings, and still it sees more sustained signals that growth is really taking hold there. So that's the state of play as we get Japan coming online. Also note cash treasuries back online after a public holiday in the US on Monday. Not really much change there on the 10-year yield as we get underway. Let's change on, because in Korea today, as you said, it really is that focus on eco data, those inflation numbers out at the top of the last hour, really outstripping forecasts over the course of August. And that was coming in for 3.4%, and the estimate had been for 2.9%, a big rebound as well from the month prior when it was 2.3%. The BOK has been discussing this because, of course, it does really present yet another issue for that central bank, given it hasn't made any changes since January. But essentially, they're saying that CPI should be around 3% in the fourth quarter. They're seeing it at a similar level with August or higher into September. And this is a bank as well that hasn't hiked, as I said, since January of this year. What is the biggest uncertainty? They're saying that is international oil prices. So we'll be watching for any more details from the BOK, but it does really seem that that hawkish tilt perhaps could lead to a hike later this year. Let's take a look at what's happening in Australia as we get online today. As you said, Heidi, it really is that focus on the RBA today with its decision. This is going to be Governor Lowe's last decision at the helm. No changes expected, with the key rate seen on hold for a third straight month. But certainly household debt is one of the key metrics that they're watching there at the central bank. What else we're keeping an eye on is the corporate stories. Of course, you mentioned Qantas. It's Alan Joyce departing his role as CEO 2 months earlier than expected. But David, as we know, a lot of pressure on Australia's flagship carrier, and it's just been a bad PR story adding up one after the next.
Yeah, and let's see what the market makes of this. And certainly, it's the start of mending some of the optics and regaining the trust there of consumers. Let's take it back big picture. As Bell was just pointing out, there's certainly the weakness coming through today is quite a rarity, given the last 2 weeks has really been mostly about gains. You have consumer-facing names, you have industrials. A lot of the China proxies have done very well. We're also through the earnings season just about. I mean, you have a few holdouts still, but virtually every single one, 1,300 companies on the MSCI Asia Pacific have now reported earnings. And, well, what does it mean? Valuations, guidance, what does the market look like? Let's bring in Ken Wong for insights, our Asia equity portfolio specialist at Eastspring Investments. He's here with us in our studios. Yeah, takeaways. What do we know now that we didn't a few weeks ago?
Yeah, I think a lot of the sort of expectations were mostly in line. The fact is that if you look at in particular in China, we saw that new economy stocks in particular did better. Within the new economy stocks, what we saw was consumer-related names, especially the discretionary spend on a year-on-year basis did improve. In particular, also what was a bit surprising as well is that within the financial space, we saw strong gains from brokers as well as insurance-related companies. So what that meant specifically was that, more of the, savings that has been kind of pinned up has actually gone to some of the more traditional investments through brokers as well as insurance, which has really helped some of these companies in particular. Also, internet names did very well on a year-on-year basis, right? And that's widely expected. Certain areas which did not perform well, as also you would expect, material names, in particular real estate in China, and then also in particular we also saw some weakness coming from some of the more industrial-related names as well. But that's been widely expected. So I would say as a whole, first half of the year is widely expected in terms of, sort of where things are.
Okay, outside of China, any specific segment or market or sector? I mean, Taiwan, Korea come to mind.
Yeah, I mean, obviously, Taiwan,
weakness.
Yeah, I mean, that was widely expected as well, right? Okay. In Taiwan and Korea, that was widely expected when it comes to overall earnings growth weakness for this year, compared on a year-on-year basis. So despite, sort of this push around tech and everything else, the fact is that, it was very high hurdles for them to really sort of still perform very well on a year-on-year basis. India, we're still expecting to see fairly solid, robust earnings coming from India. So I think these are all, I would say right now, at least in the first 6 months of the year, there hasn't been a lot of, so I would say, extravagant surprises on the earnings front.
For ASEAN, which, second quarter kind of broadly a little bit weaker, though, there have been some bright spots, and Vietnam is one that you do like.
Yeah, the fact is that when we look at Vietnam, I think that's one of the sort of, markets that, we can still kind of call it an untapped market to some extent. The fact is that when we look at overall year-to-date performance, the Vietnam market has performed very well. In particular, when you look at it from a valuation perspective, it's still one standard deviation below its historical averages. When you look at it across the spectrum across Southeast Asian countries, the fact is that the Vietnam market is growing quite drastically over the past few years. We are definitely seeing more stocks going through the IPO processes, more investors going in to invest in the market. While still, yes, when we look at overall, emerging market or Asia regional funds are still, very underinvested in the country, being a frontier market at less than 1% of overall holdings. The fact is that with the various fiscal policies as well as very lenient monetary policies, we do see quite a bit of benefits coming through with Vietnam.
And you're not discounting, are we sort of running the risk of throwing out all China opportunities out with the bathwater at this point?
No, the fact is that we see this as a good opportunity for investors when it comes to, looking at China. We know that for a fact that in short term there is still going to be some volatility, but overall, we still expect to see GDP growth to come in roughly about 5%, for the year. We expect to see further stimulus to help really strengthen the economy. And overall, when we look at manufacturing activities, I think that's also going to be key, Heidi. The fact is that when we look at overall PMI, we see potentially an uptrend happening, but I think more importantly as well, we think that PPI has bottomed at that 4% level. So, with any modest increase in the PPI levels in China, we expect to see a pickup in manufacturing activities, which is going to be a very strong boost for the overall Chinese economy during the remainder of this year.
Would you touch property?
Selective. The fact is that right now you're going to be selective right now across the spectrum. The fact is that still we're in a very high interest rate environment, so regionally across the board you're going to be a bit more selective where you want to invest. In particular, in places like India, we're seeing more and more companies going through the IPO processes, and the fact is that it's still very much a growing market. India today is kind of like what China had with that boom, 15 years ago. And we do expect to see some similarities, and so there are pockets where real estate do still look interesting and worth investing in.
Okay, and when you say selective, is it selective regionally or is it
selective? Yeah, selective regionally, and within China.
So not all in China.
No, within China, you look at not necessarily property developers where potentially there still potentially could be sort of balance sheet issues, but property management related companies, those are still companies that are still looking very enticing. When you look at the overall, return on equity, when you look at the yields potentially these companies provide, very little pressure on their balance sheets, those are areas. So you have to be, more selective, not necessarily residential. You might want to go through some of the logistics related property or specifically healthcare related property names. There's a lot of those names within the A-share space. So that's why when we say selectively, yes, on a regional basis, but also within the property side, there are still a lot of industries which you can still look at.
Just to take it big picture again, the notion that the U.S. economy might have bought a soft landing, that the economy is doing well, is it a hard sell for you to sell Asian equities, for example, because that group of stocks just keeps outperforming and keeps delivering earnings?
Well, not necessarily. The fact is that when you look at overall valuation, and we know this, we've been talking about this quite a while now. The fact is that overall U.S. stock markets valuations are significantly higher than Asia. And, looking at where we are right now in that interest rate hike cycle and looking at Fed fund futures and so forth, expectations potentially is for the dollar to maybe start to weaken, especially if interest rates starts to lower, let's say, sometime next year. And if that's the case, you might actually see some of the capital, flowing out of the U.S. market into some of the markets here in Asia, which are definitely much more interesting from a valuation process.
Yeah, I know your market's got it on eco, but is it a good assumption to make that the Fed's done?
Oh, it's tough to say, right? I don't have that crystal ball to say whether or not, we have one more time, sort of in terms of an interest rate hike cycle. But I think we're closer to the top than ever before, I think. So I think from that standpoint, there are definitely opportunities, not necessarily maybe not for the remainder of this year, but we're close to 2024. And, if we do get that start, let's say, weakening of the U.S. dollar, that does potentially bode well for some of the Asian markets.
Okay, and always great to chat with you, Ken Wong, Asian equity portfolio specialist at East Spring Investments there. Let's get to Bell for some of the movers, and of course, very curious to see the investor reaction over the accelerated appointment of the new CEO, or I suppose taking over of the new CEO for Qantas.
Sooner than expected, really, because Vanessa Hudson, she is the CFO. We knew she was going to take over as CEO in November, but just this morning, Alan Joyce has pulled forward his retirement plans or his exit from the Australian airline, given just how much public backlash there has been over these bad PR stories. The latest one, of course, last week was Qantas being accused of selling seats on cancelled flights. So it does appear that at least Alan Joyce has really bowed to that public pressure to step away from the role, and he will be exiting early, so handing over the reins to Vanessa Hudson on September 6th. That's the state of play. We can see the stock there just about 1% higher. It is outpacing the broader ASX 200, which is just a little bit in the red as we get trading underway. Another group of stocks, if you change on now, that we're tracking this morning are some ones that are being added to the Nikkei 225. So it's carried out at semi-annual review, and these ones here, top three, are ones that are being added. So we have the chip equipment maker LaserTech. We've also got the e-commerce firm Macari here, and the Notori as well. That's a furniture retailer. So the top two being added to their high liquidity. Notori owing to sector adjustments. That's what the Nikkei local media in Japan is reporting. So those ones in focus for that reason. But as well, Daiwa Securities has upgraded its price target for Toyota, and they've now raised it to 2,700 yen. That's up from 2,300 a piece. They are saying that shares are currently trending flat, but over the longer term, they're saying that they look attractive. Let's change on. One last stock in Tokyo that we're watching this morning is SoftBank, because we've had the roadshow for ARM kicking off. This is the chip designer ARM that is preparing to list later this year. Could be a little bit of a dose of reality taking place for ARM, because we've had to perhaps lower the outlook, not only in terms of the valuation, but also the amount that could be raised for the company as well. So that stock just a little bit higher as we get trading underway, but broadly, so far we're looking fairly flat. Trading volumes as well, Heidi, just sticking in line with their 20-day moving average.
Well, coming up on Daybreak, we'll be speaking with industry leaders in the climate tech space from this year's Gas Tech Conference in Singapore. Catch our interview with Indonesia's upstream oil and gas regulator later this hour. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
The clock is ticking for Country Garden to avoid what would be its first default. Now, the Chinese builder has until Wednesday at the latest to make this interest payment on this dollar note. Let's bring in our colleague and our Bloomberg Opinion columnist, Julie Ren. She's written about how the company still actually has some options to get itself out of its debt crisis. Yeah, we're all yours. What are the options?
So I think what Country Garden should do at this point, I mean, at this point, it's pretty clear the Chinese government wants to rescue the real estate market. They have announced nationwide policies to ease down payments and the mortgage rates, right? And the benefit for Country Garden is not immediate, but what it could do is just to buy itself time and hope for the best. What that means is that Country Garden, to its advantage, it has like about $10 billion bonds outstanding, but none of them is due until next year. At the earliest. So what it should do is just to keep on paying the coupon bonds, and hopefully that it will not default and China's physical market will recover, and then that gets it into better shape. And in fact, you already see that with their onshore yuan bonds. They extended the last minute a 3.9 billion yuan bond. Well, only 56% of the creditors agreed, but at least they extended. So what Country Garden should just do is be current on the coupon payments and, try to extend the bonds if possible, especially onshore, and really hope for the best.
That's quite a set of options there. Shuli, Country Garden often compared to China Evergrande. You say they're completely different, though. What's the sort of different pressure points here?
I think Country Garden is actually, there is still some hope left for Country Garden. The two companies have similar asset sizes, but Country Garden's liability is only 60% of China Evergrande's. And for Country Garden, the biggest pressure point is to deliver unfinished homes. So those so-called pre-sale homes. Once you take that aside, the Country Garden's interest-bearing debt is tiny compared to Evergrande's. It has about $10 billion offshore bond, whereas Country Garden have 40 billion, right? So I think what Country Garden should do at this point is to negotiate with the home buyers and say, okay, I already sold you unfinished homes, but let me try to put you into another project that has been finished, that's in the better part of town. Try to not have so much construction cost, and I think that's what it could do to make it more operationally efficient.
Julie Ren, out of Bloomberg Opinion, thank you so much. Certainly want to watch, given the streak we've seen in both equities and sort of that part of the jump bond space here in Hong Kong. Biggest jump in Chinese property shares going back a couple of months. Second best day on Monday in 2023. The open is, an hour away? And there's plenty more ahead. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
Well, dose of reality is tempering the outlook for chip designer ARM's public listing as it begins its investor roadshow, lowering expectations for both its valuation and fundraising goal. Let's get more details from our tech reporter, Minjun Lee. Minjun, going into this highly anticipated, some of these valuation sort of, estimates were right up there. Have we come down to earth a bit?
Yes, the valuations, as you can see, are kind of coming down from the very lofty levels that were touted earlier. And one of the things is that previously there was a lot of hype surrounding who would participate in the IPO as so-called anchor investors, who kind of promised to put down a certain amount of money. And while these are expected to include the big names like Apple, Nvidia, Intel, the sum is estimated to be around $25 million to $100 million each, which is not very big, relatively speaking. And also, investors are probably reassessing the potential risks, including the uncertainty surrounding the China business and how that will impact earnings growth going forward. But of course, we'll have to see how the roadshow actually turns out and what happens next week.
Yeah, and Minjun, David here. What do we know now in terms of just the institutional support? Who has the company been able to sort of corner as some of the cornerstone investors here?
Right. In terms of, I don't think we've specifically spoken about cornerstone investors, but these big supporters, like strategic investors, however you want to call them, our latest report says that this will include companies like Apple, also Nvidia, Intel, Samsung, and Samsung Electronics, and a few more other big names. But we'll have to see who actually ends up putting down money and exactly how much they are willing to put down, which will actually signal how much there is actual support from these investors who are at the same time big clients to ARM's business. So there's still a lot to a lot of information to come out going forward.
Our technology reporter, Minjun Lee, there with the latest on that ARM IPO. Well, Volkswagen says it's focusing on design ahead of its upcoming electric car offering as it works to turn around a slide in sales in China, I should say. But this is Europe's biggest car maker, and it's not unveiling any new models at the Munich Auto Show. The CEO, Oliver Blume, told us what they're hoping to achieve at the event.
The Auto Show in Munich, the IAA, is a great opportunity, first of all, for the German automotive industry to show the progress in terms of technology. But we have guests, visitors from all over the world, and for us it's a good opportunity to share experiences, how we will develop the mobility of the future. In terms of Volkswagen Group, we have the opportunity to show the progress in Volkswagen Group. I'm in charge since 1 year, and yesterday on the Group Media Night we presented the progress of our 10-point plan, how we are, what priorities we are taking in terms of products, finance, regions like China and North America, software, technology, our platforms, mobility services, and sustainability. And so for us it's a huge opportunity also to show a glimpse what products our customers can expect in the future. Very promising, and I'm looking very much forward to it.
Right, and a year is a long time in the auto industry, particularly right now. A year from now, what will you be hoping, where do you expect Volkswagen to be, and what would you want to be speaking about at the Munich Auto Show then?
Yeah, we are updating our existing platforms in terms of electromobility. For example, the MEB in Volkswagen called MEB Plus. Yesterday we have shown a glimpse, we say iconic GTE brand, what customers can expect in the middle of this decade. Next year we will come with the new platform PPE, for Audi and for Porsche. In the background, we are showing the Audi Q6 and driving this car, testing this car. It's so promising and exciting what we bring there. And then developing fast our future unique platform, SSP, with a lot of stunning projects. And so I think there you can expect a lot from Volkswagen Group during the next years.
And what is the consumer changing? What are they demanding from you now, and how are you meeting that demand?
We are in the middle of the transformation, and it is about electrification, digitalization, connectivity, autonomous driving. And I think Volkswagen Group is well prepared. On the one hand side, we have traditional strengths in terms of driving abilities of our cars, the high quality level we do have. Then yesterday we announced that we move Volkswagen Group to a design-driven company. We are very strong in design, and that will be an important differentiating factor for the future. And combining this with new technologies, developing our platforms and combining this with partnered solutions in the different regions of the world, being able to offer the ecosystems our customers are expecting in the different regions of the world.
The boss there of Volkswagen, speaking of course with our colleague Oliver Crook there at a Munich Auto Show, a fantastic lineup of conversations that we've had there, and of course we'll be playing those out for you throughout the course of this morning. A look at equity markets right now. We're about 30 minutes into the cash markets in Seoul, in Sydney, and in Tokyo. Property so far, and within the property space, it's Tokyo real estate leading these gains. The rest of this equity market story is on weaker footing. A lot to get through today. We have a rate decision coming up out of Australia. A couple of earnings to tell you about. Trip.com reported the blowout set of numbers. One stock to watch later on. Anyway, plenty more ahead. This is Bloomberg. Good morning.
Company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
We do have some breaking data just crossing the Bloomberg. The Japan Jibun Bank PMI composite number, the final reading for August, we're seeing coming in line with the prior reading, 52.6, so comfortably above that 50 level, separating contraction from expansion. The PMI services final reading for the month of August as well, coming in at 54.3, again unchanged from that prior reading as well. This even as we see some signs of weakness. Japanese households in the most recent numbers seeing cutting back on spending in July. Of course, we have seen that reflationary effort seeing some effect in Japan, and that persistent inflation has been slowly eroding purchasing power. Some pressure, David, for the government to be able to ramp up some more aid.
Yeah, more PMI too, Heidi, on that note, and perhaps going the opposite way. So we have two. I'll start off with Hong Kong. Really, this is the second month in a row, although just a caveat that slightly better than estimates here, 49.8, but second month in a row that this is held beyond or below that 50 handle, which I guess theoretically separates optimists and pessimists. The Hong Kong dollar, as you can see, is on weaker footing today. It's worth noting, by the way, we're coming off, I think, the worst month for the Hong Kong dollar. That's back in August. It's 1985. Now, more PMI numbers coming out. This is in Vietnam, and we're looking at a number there, and this one is actually above 50, 50.5, also coming in better than the previous month. So, of course, well, direction of travel is good as far as these PMIs are concerned, Heidi.
Yeah, we're just talking about the, Vietnam and the investing opportunities there, right? Perhaps, one of the few untapped markets so far in Asia. It is a big eco day today within the Asia Pacific. More numbers set to be released later. The big one, of course, will be some more inflation numbers out of the Philippines, Thailand, as well as those Caixin PMI numbers out of China, whether that just continues to kind of paint a picture of steady deterioration for the Chinese economy and sentiment. And then, of course, when it comes to central bank action, the RBA is in focus. Governor Lowe delivering his final meeting, all but one economist here at Bloomberg that we've spoken to expecting a third straight meeting where they will hold. Well, the Gastech Summit also begins today in Singapore, bringing together top global leaders across the energy sector. Let's get over to the event. Our markets co-anchor Haslinda Amin is on the ground with our first guest, who's from Indonesia's upstream oil and gas regulator, Has.
Well, Heidi, this conference is happening at a time when crude is hovering close to $90 a barrel. Of course, Fed tightening, OPEC plus curbs, as well as China's economic malaise, all playing out in terms of those prices. Let's get insights from Nanang Abdul Manaf, SKK Miga's vice chairman. Of course, he's joining me here in the Lion City. Nanang, good to have you with us. First off, oil prices close to $90 a barrel. Is it heading higher or lower from here?
Yeah, I think depend on the global situation. Yeah, so many very dynamic situation, unexpected situation. So that's why the very difficult to forecast the oil price. But
what's your sense? Where is it headed?
Yeah, we hope that the oil price still in the range between the 80 up to 90. Yeah. Because for our country, Indonesia, because Indonesia is still importing from the other country, so looks like we'll suffer, yeah, because with the increasing the oil price, so more cost to be subsidy to the low-income community and something like that. So
we know that Indonesia raised oil prices because subsidies tripled. It can't afford that anymore. Do you see a need for Indonesia to raise prices again, given where oil prices are right now?
Yeah, I think the Indonesia struggle, yeah, to increase the oil production. Yeah, so many program, exploration, development, new discovery to fulfill our demand. So that's why we try to encourage and then invite the new investor come to Indonesia to do the exploration, especially to get the new reserve, yeah, especially oil to fulfill the demand. Even the gas, I think very good for the energy transition, because gas will play the important role for the future, even for now.
We know that Indonesia's LNG production missed estimates last year. What's the outlook looking at for 2023?
Yeah, because several projects in Tangguh here operating by the BP delay previously because the COVID pandemic, yeah, very suffer for the project. And then currently, several days after, we would like to first drop for the LNG. We still fine-tuning the equipment and then prepare for everything for the first drop.
So when will Tangguh start operating, start producing, and where is supply headed?
Yeah, I think after the Tangguh train 3 on stream, so we have the capability to fulfill the domestic, even for the export, yeah. And we have the shortfall for the several times, so we try to recover for the near future after the Tangguh train 3 on stream sometime this month. Yeah.
There's also the Adani gas project. We know that Shell made an exit. Inpex, Pertamina, Petronas have come into the fray. Yep. Can you give us an update on that?
Yes, after we got the good news, yeah, Shell, as you know, that the divest the PI around 35%, and then Petronas and Pertamina Hulu Energy come to the newcomer, and it's like they just starting to consolidate, between the impact and then new partners. So in SK Chemigas, we boost to accelerate the delay of the project, because the more than the 3 or 4 years delay, because the process of the divestment, share divestment.
Demand obviously is exceeding supply, and we expect consumption to surge by 2050. Given all these projects, will Indonesia be able to meet the needs of the people?
Yeah, we expect that the Abadi Masela operated by Inpex will on stream around the 2029, and then we have Abadi, we have the Genting, in Papua as well, and then we'll be on stream around the 27. And then we also have the IDD project, Indonesian Deepwater Development, Eastern Kalimantan offshore. And maybe you're aware that just now that the ENI take over from Chevron, ENI from the Italy, and looks like we'll accelerate the program to develop the IDD, because we have the existing LNG facilities in Balikpapan, in Bontang, So we expect that the additional production from the IDD will reactivate several LNG trains.
But Nanang, to unlock Indonesia's LNG potential, you need foreign investors. Where are you with that? Who are you in talks with right now?
Yeah, we talk with the several multinational company, to invest.
Such as?
Impact as well, and then ENI and Chevron, even the Total Energies, we invite them, to develop so many potential, especially in Eastern Indonesia, So you know that compared with the Western Indonesia, still less explored, So I guess that if we would like to find the giant field like in Abadi Masela, and then IDD, something like that, so we have to intensively exploring in Eastern Indonesia. We just accomplished the study, and so many potential there. Just who will intensively explore in that area.
Nanang Abdul Manaf, thank you so much for your time today. There you have it, Dave, Vice Chair of SK Chemigas. Of course, we're coming to you from Gastag at a time when, high oil prices are impacting the fight against inflation.
Absolutely. We just got a reminder of that with Korea inflation. I suspect will be getting a same reminder when Philippine inflation comes through in about an hour from now. Thank you so much. More of that conversation coming up, or more conversations coming out of Gastech 2023. Have a look at some of the other big names we'll be speaking with there on the ground with Haslinda. Check that all out on your screens at those times if you're watching, of course, out of Hong Kong and Singapore. Or Beijing, that is. Now, speaking of China here and staying on energy, China's solar manufacturer, GCL Tech, really one of the biggest there, is in advanced talks with Saudi Arabia about opening its first overseas factory. That's as the two nations aim to extend their energy ties beyond oil. Now, the company's joint CEO, Lan Tianshi, told me exclusively that operations could start as early as 2025.
Because of our cost advantage and quality stability, I think that in the future, the emerging technology manufacturing capacity could continue to increase the market share of granular silicon. And this revenue will continue to increase under stable conditions.
Before we talk about China, which is your main market, I want to ask you about what your outlook is for global demand, generally speaking, for solar products this year.
I'm very optimistic because as of August of this year, the entire PV market's manufacturing capacity and its utilization rate are quite high. From an optimistic perspective, this year's capacity will reach 450 gigawatts. Even a pessimistic estimate might reach 380 gigawatts.
Can I ask about competition in China, which is your main market? Do you think there are too many companies?
I think at this point, because last year and the year before, our PV company's yield was quite high, and the return on investment may also be very enviable among all manufacturing industries. So it is not surprising that capital, including investors, manufacturers, and their process of switching to diversification, will undoubtedly choose or hope to choose to enter the photovoltaic industry. It is green enough and the profitability is high enough. So this is not a surprising choice. But I think looking forward in the next 2 to 3 years, with the intensification of competition, the advantage of larger scales, and the differentiation regarding talent reserves, technical reserves, and R&D reserves, the concentration of companies in the photovoltaic industry may begin to converge in the future, and the number will go down.
The vast majority of your revenues and sales is China. That's your main market. Does China remain your future purely, or are you looking outside China to expand in terms of commercial and revenues?
From the current point of view, we've gone pretty far in the Middle East. Including me and our CTO, we've made several visits to Saudi Arabia and Qatar, places we want to speed up implementation. The good news is that Saudi Arabia has mature industrial manufacturing infrastructure and experience, and it can provide us with enough photovoltaic output, including electricity reserves. I think this is a good alternative.
Now, speaking of the Middle East, which you mentioned there, a few months ago when we spoke to you, you mentioned that you were considering or thinking about putting up your first plant outside of China. So can I ask if you've made any decision on that plant, and if so, what's the target capacity, and also what would be the target start date of any sort of operations there?
Now we have a team of about a dozen people, and we are communicating with Saudi Arabia's Riyadh and the Royal Commission. We've submitted our site selection and our feasibility study report. In the meantime, our company registration is also underway, but its progress is much slower than that in Asia, compared to China and Hong Kong. We very much hope that we can get the land and start some preparations at the end of the year, which is the winter of Saudi Arabia, because the summer is too hot in Saudi Arabia. The temperature can reach over 60 degrees Celsius during the day, and that would be too hot for construction. So we wanted to avoid the summer process and then start the project as quickly as possible.
And that was Nan Tianshi, the joint CEO of GCL Technologies. Right, plenty more ahead. We'll get you an update on markets next. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
This is Daybreak Asia. I'm Annabelle Drawers with a check on markets today, and the prevailing theme that we're watching this morning in markets is that peak rates narrative. That's what's really being tested this morning by key inflation data. For instance, in Korea, we saw consumer prices ticking up to 3.4% on the year. That was a rebound from 2.3% in the month prior, and a much faster pace of gains than had been expected by economists. So the BOK, it hasn't raised rates since January, but it has maintained a hawkish tilt. So the question is whether that translates into a hike later this year. Probably quite dependent on what happens with the Fed, of course, but certainly the BOK is watching this very closely, and they're saying that international oil prices, that's what's posing the biggest uncertainty. Now, it's not just that commodity price. Let's change on now, because we're watching soft commodities as well. And just a couple of lines dropping in the last 10, 15 minutes or so in Indonesia, because we do understand that Indonesia could import 250,000 tons of rice from Cambodia. That's coming from an official statement from the President Jokowi. Now, Indonesia, of course, we have seen really rice inflation there, gaining 13.76% in the latest reading, and that was the most that we've seen since 2012. So something as well that's really putting at risk that overall slowing trend, that's the line in orange, in consumer prices. So coming on the back of headline inflation, of course, in Indonesia, that did accelerate for the first time in 7 months in the latest reading. And if you change on now, that's really testing the broader emerging markets narrative generally, because we did see Citi's EM inflation surprise index, again, you can see at the end, rising for the first time since February. So Dave, certainly a lot of focus this week on upcoming inflation numbers from Thailand, the Philippines, Taiwan. They're all due this week. South Korea, of course, that one this morning, perhaps a leading indicator of more price pressures that are going to start building once again.
Yeah, correct. Absolutely spot on, Belle. In about 40 minutes, as you mentioned, the Philippines is due out next there. Belle in Sydney for us. Let's pivot to geopolitics and India. Also, leaders of the world's major economies are gathered there, of course, later this week for the G20 summit. And it's really a chance for the Modi government to showcase its push to become a key player in the global economy and geopolitics. Manaka Doshi reports out of Mumbai.
India, home to a now record 1.4 billion people, more than half under the age of 30. But that also includes the largest number of jobless youth anywhere in the world. The fastest growing large economy in the world, India has the third highest number of billionaires. But on per capita income, it ranks at the bottom. The widening gap between the richest 10% and the bottom 50% makes India one of the most unequal countries in the world. Democratic English-speaking India, with an army of software engineers, has sought to become a major economy since its economic liberalization in the 90s. But authoritarian China has made bolder moves to become 5 times bigger. So why might this be India's moment? One big reason: it isn't China. Policy making from Beijing nowadays remains hard to predict. Western countries are wary of China's growing economic and technological clout. International companies are seeking supply chain diversification, China plus one. To speed that along, India's government is spending record amounts on infrastructure and offering production incentives to key industries. Other reforms range from a unified national sales tax to a world-leading digital payments system. Bullish investors and stock market highs have burnished the India story in the year of its G20 presidency. That Prime Minister Narendra Modi hopes will set the stage for his re-election next year. It will also test whether most Indians are buying the India shining story or not.
Bloomberg's Manaka Doshi there in Mumbai. More ahead, this is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
One stock we'll be watching when these Hong Kong markets open up is Trip.com. A few hours back, reported just a massive beat in earnings, their second quarter numbers. Let's bring in Angela Hanley, our Bloomberg Intelligence senior research analyst. She's with us right now. She's poured through the numbers. Angela, you have a BI survey showing Chinese people are starting to travel domestically, not so much internationally. A good set of numbers. They don't seem to jive, though. But just put those two things together for us.
Yeah. So domestic travel has been very strong in China because of this pent-up demand. Yeah. But if you look into the outbound tourism number, obviously the T-com has been gaining market share. I guess it's mostly coming from two reasons. One is that the company is gaining scale because it is expanding into low-tier cities in China. And the other is that because the company has much better kind of better terms for travelers. So if you see, the company has been spending a lot of resources on penetrating into low-tier cities by, and also that people became much more tech-savvy during pandemic. They have to order food online. So like before in those small cities, people might be going to local travel agencies to book the flights and something, but now they might be doing more online. That's basically where T-com has become in gaining market share as well. And the other is more like if you compare those terms when you book hotels or accommodations, actually T-com's terms are better, in terms of cancellation stuff. So in that sense, I think the company has been gaining much more market share in the outbound tourism side.
I suppose the question is, how long does a reopening, pent-up demand situation last for?
Yeah, so it's I think in China, it has been the same maybe for other events as well. You see so many weddings in China too, because people all have to do something after 3 years of a lockdown. And also that's the reason why people are traveling more. So we are seeing that probably in that kind of pent-up demand is not as sustainable and might be peaking maybe in the October Golden Week. But good thing is that we have some more upside coming. Say in terms of the leisure travel, we are seeing that, there are much more concerts and live houses, those events going on. So those young people like to travel to other cities to watch their favorite singers singing. And the other side is that business travel has been kind of pretty weak so far in China, maybe because the economy has been weak. But what we see is that, usually it takes around 6 months to plan some kind of conferences. So think about it has been studied if they started planning in the early this year, we are going to see much more business events coming in the second half.
Still some more to come in the pipeline, potentially. Angela Han-Lee, Bloomberg Intelligence Senior Research Analyst there. Take a look at broader markets trading around the region and really watching, of course, Australian focus on RBA decision day. We're expecting a third consecutive meeting of a hold. It is Governor Lowe's last decision as well. So that's one to note. We're also watching Korean markets pretty closely with inflation in South Korea really outstripping forecasts in August on the back of those high energy costs. That's likely to be a real theme going forward as we have some other inflation readings, including from the Philippines later. That is it for Daybreak Asia. Our markets coverage continues. This is Bloomberg.
Opportunity.
People.
Things get done.
Before, I never did business in Georgia. I was amazed what kind of opportunities. There are many of them here.
Very little bureaucracy, simplicity of doing business.
You have access to markets, finance, and authorities.
It's perfectly located logistically. We have the biggest suppliers nearby.
EBRD has invested 4.6 billion euros in 270 projects, and I think that speaks for itself.
Georgia.
A pleasure
doing business.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. More fresh data trickles in as ECB officials ponder whether to hike or hold next week. Europe services data was weaker than forecast, while consumer inflation expectations inched up. Meanwhile, in China, disappointing data adds to concerns for the country's recovery. Bloomberg Economics says China may never overtake the U.S. as the world's biggest economy. And Goldman Sachs gaining confidence in the U.S. The bank now sees a 15% chance the U.S. will slide into recession, down from 20%. Welcome to Bloomberg Surveillance. You're watching the early edition. I am Danny Berger in London. Shonali Basak is in New York. Shonali, we've had a lot of European data trickle in this morning. More breaking just now. Euro area July producer prices fall 7.6% year over year. That is bang in line with estimates. However, the month over month figure is slightly less of a fall than expected. 0.5%. The estimate was for 0.6%. Yet another set of data that shows inflation maybe not coming down as much as expected, while there's still those growth concerns rife. But how's the U.S. looking, Shonali?
Yeah, when you take a look at those growth concerns, you see it in the market. Certainly, you're looking at the S&P starting the day lighter on the day. You're seeing a little bit of a risk-off tone here in the United States, Danny. S&P futures down about 0.2%, just under 0.3%. You're also watching a little bit of a tick up in yields. The 2-year yield up about 2 basis points at a 4.89 handle. That is about where we were a week ago. So a lift in yields, a little bit of a bond sell-off. That lifting yields feeding through to the dollar. King dollar, this is a level, the Bloomberg U.S. dollar index at the highest level since March of this year. Higher for longer despite the concerns about divergence among central bank policies. We will keep an eye on that dollar all week. And Brent crude, a little bit of softening now, down about 0.6%. This is an area where there has been a little bit of volatility. Earlier, we had seen about an 89 handle. But again, Brent crude down just a little bit on the day, Danny.
Yeah, it's pretty remarkable to look at the risk-off session that's taken hold of the global market, Shonali, because on the surface, it should be a good news day. We're going to get into all these things, but things like Country Garden paying down a U.S. dollar-denominated bond, things like Goldman Sachs upping their forecast for the U.S., you think that we'd have something of a risk rally. We're not getting that. As soon as the European session started well underway around 8 a.m. is when you saw this sell-off taking hold. Now, some of the data hasn't exactly helped. I mentioned the producer prices, the fall there basically in line, not as much when it comes to the month-over-month figure, but we also had services revised down. So what do you get? You get stocks down 0.5%. You get all the high beta currencies. They've been crushed so far this morning. Cable weaker by about 0.7%. The Aussie dollar, we did have an RBA decision. They don't do anything as expected, but this is falling with the likes of Brent, for example, Shonali, with the likes of the Kiwi, Aussie falling 1.33%. So some of that European data not necessarily showing up in the market action, but it does add to the gloom. To go through all of that, we did have consumer expectations for the euro area inflation inch up in July, still well above the ECB's 2% target. Let's get over to Bloomberg's European correspondent, Maria Tadeo. Maria, we're on countdown for the ECB decision. Talk us through the numbers. How's it stacking up?
Well, I know I am. Look, the European Central Bank is in a very difficult spot, and this decision coming up on September 14th will be a very difficult balancing act, because you yourself, when you're running through all the different data, you could see that the data points at times contradict each other, but also contradict some of the statements that the European Central Bank also made just today. You had Philip Lane, who said on the medium term he believes that core inflation will come down. He also said that there was now some evidence that goods inflation, services inflation is moving down. And then almost 2 hours later, you had that report that came out from the European consumer inflation expectations, which measures just really the pulse of the European consumer and where they see prices going. And you saw that on the 12-month basis, it was unchanged, but on the 3-year horizon, it actually picked up. So that is the wrong direction in terms of what the European Central Bank wants to see now for that monetary policy decision, which, as you say, could be a hold or a hike. What the European Central Bank wants to see is that inflation is moving on a sustainable path to 2%, but also, and this is key, and we've heard it repeatedly, that the transmission is strong enough, is operating well enough in the economy that it would lead to a pause if there was a pause coupled with the delicate state of the economy. If not, that rate hike in September would still be up for play. And some of that commentary echoed by the Belgian central banker, who today said perhaps a bit too early to rule out a hike, but again, it will hinge on the data. I think this is one of those decisions where we will really have to wait until that decision day to clarify those doubts. It's very hard to read the way they want to go.
Talk through some of the regional differences here, because we're looking at key data coming out of France, out of Germany. And are you seeing real differences in the way that the economies are heading into these key decisions?
Look, I think we used to see big differences between the services economies and the industrial economies. Obviously, we know that the German economy is in a very tough spot. We know that the Chinese downturn could really affect the German economy. We've seen for months now, this is, well, not a secret in terms of the implications of the energy crisis that it had in this economy, that the industry, the German industry, it is in contraction and it is in pain. What is changing now is that a lot of the services that used to offset that are also moving in the wrong direction. They're moving in contraction. I think if you look at the PMI's numbers, it reflects that. So not only you're seeing a weakness that is spreading, but also that perhaps shows services will not come to the rescue to that manufacturing downturn. So a lot of this painting a picture that would show, again, as the European Central Bank says, that there is weakness in the economy that could lead to more downside risks for the European economy in the back end of the year.
Yeah, it is also rare to get that revision down for so many different regions for services, that sort of trend. Maria, thank you so much.
Very
It's
good
Bloomberg's
point.
Maria Tadeo. All right, we're going to go from Europe to China. And also, thank you, Maria. Thanks for the compliment. I heard it. Europe to China. As Chinese developer Country Garden avoided its first default, it had a last-minute U.S. dollar coupon payment. Let's get over to Rebecca Chung-Wilkins, Bloomberg Asia government and politics correspondent. So there we go. Finally, avoiding default, at least for now. Rebecca, what's next?
Yeah, it has been this month of will they, won't they default for 30 days, but the firm there telling note holders apparently that they have paid within that grace period and therefore averted what would have been their first official default. Now, Country Garden isn't really out of the woods yet, and if you look at the bond pricing there, 13, 14, 15 cents on the dollar, you can see investors pricing in a very low rate of recovery, actually. There are 4 more bond maturities that Country Garden will need to deal with, and there is another coupon payment actually also due this month. So the firm still needs to raise about $500 million US. The fact that they struggled so much just to raise $22.5 million to avert default on these 2 dollar coupons doesn't necessarily bode well, does suggest there's still going to be some excitement around whether or not they can continue to pay. The other thing to watch next is September is going to be a very, very busy month for other private developers that, like Country Garden, have so far avoided default. It is a hefty maturity wall, $1.5 billion US that they need to pay in onshore and offshore debt just this month. It is the biggest maturity wall that these 16 developers that have so far avoided default will have to raise this year.
Speak more to the stresses in the property sector. Is there anything the government can be doing to stem more of that stress that's under the surface?
Well, we have seen this sort of raft of measures to try and support the property sector, including in some of China's bigger cities. Now, that was welcomed by investors. It has been called for, and some really have said it's really overdue. We are yet really to see some of that support actually showing through, for example, in data, services data, and so on. And for many property firms, the big concern is whether we see this stress that so far has been relatively contained, particularly when it comes to defaults in the private sector, whether that starts to sort of spread into the state sector. Now, we had a significant jump in the number of state firms, property firms, that said they might struggle or have warned of some kind of profit loss for the first half. Obviously, it still looks like it will persist into the second half because we haven't had any kind of real bazooka property stimulus so far. But the question is whether they can then move into a phase where they actually start consolidation. That's the ideal end goal for Beijing, is for these big state developers to come in and help support these smaller defaulters.
Well, I gotta say, Rebecca, it seems like all of those concerns are undoing the rally we saw yesterday. Rebecca Chung-Wilkins there, thank you so much for that. Now, from China to the U.S., Goldman Sachs now sees a 15% chance the U.S. will go into recession. That's down from 20% as a result of cooling inflation and resilient labor markets. Joining us now is Bloomberg Markets reporter Valerie Teitel. Valerie, Goldman typically has been a bit more optimistic than most economists out there, but this is starting to feel like a lot more optimistic.
Definitely. This is now the second time in just 2 months that they've revised down their chances of a U.S. recession in the next year, now down to 15%. And if we look at the Bloomberg consensus, it's 60%. So they are a lot more bullish than the consensus on the trajectory of the U.S. economy. And I think the difference there is that many other economists are citing these risks that the consumer is going to run into in the fall, especially when it comes to the fact that we have the student loan forgiveness done by the Biden administration. That rolled off on the 1st of December. So that's going to be a headwind for the consumer as we head into the third quarter. But the reasons why Goldman made this change to their forecast was based on last Friday's labor market print, that almost Goldilocks print that the Fed got. We are seeing this cooling in the labor market. It's not falling off a cliff, Danny. It's just cooling slightly. And we're seeing that progress on wage inflation, with average hourly earnings now running the lowest they have in over a year. So those are the reasons for the change in Goldman's call, but there still are some risks on the horizon as we head into the third quarter.
And before we have some key data to watch into next week, when we look at CPI and other key data points that will tell us the future of the U.S. interest rates, there's still a lot this week. Valerie, what are we looking forward to in terms of eco data and conversations coming out of the Federal Reserve?
Yeah, exactly, Sonali. There is a few things on the calendar this week. It is a light week when it comes to data. We do get ISM services tomorrow. We also get the Fed's beige book out tomorrow as well. But I think a lot of the attention is going to be on the Fed speak. We have the blackout period beginning on Saturday. So this is really the last chance for those Fed speakers, especially those voters, if they want to, change the narrative slightly in the market. This is their last chance to do it. A lot of the attention is going to be on whether we see a kind of echo of Powell's Jackson Hole speech, where he really said that they need to see some sort of economic weakness before trusting this deceleration in inflation. Do we see those same kind of comments from those 8 Fed speakers later this week? That is what the markets will be watching.
At least their last chance to do it on the record. Valerie, thank you very much. Bloomberg's Valerie Teitel. Okay, coming up later this hour, we're going to be catching up with Henrietta Pacamont, head of global fixed income at Allspring. But first, up next, Chevron LNG workers in Australia threatened to go on strike as early as Thursday. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London, alongside Sonali Basak in New York. Chevron liquefied natural gas workers are threatening to strike as soon as this week at 2 major export plants in an escalation of a dispute that threatens global fuel supply. Bloomberg TV spoke exclusively to Chevron's president of midstream about the risk of strikes.
We're committed to find a solution there, and we want to find a solution that's a win-win-win. We want to find it as a win for Chevron, a win for our employees, and a win for the gas markets.
Colin, let me follow up on that, just to give our global audience some perspective on how heated the rhetoric is. This is a quote from the Offshore Alliance when they made a statement. The log of claims will ultimately be claims which Chevron will agree to, but not before they lose a few $1 billion, judging by the form guide, which is okay, as Chevron clearly have plenty of loose change in the Chevron piggy bank. Do you have any timeline as to how quickly you're willing to resolve the standoff?
No, so I mean, if I go back and really just to repeat what I said before, there are active conversation, there's active dialogue going on at the moment. So I'm really not going to comment on things that are around the edge, but to say that, look, we're really committed to find a solution here, and we want to find a solution. And we understand solutions. You have to get a space that's a win for various parties. So we understand that it has to be good for our employees, it has to be good for us, and all of that will be good in the LNG market. So really, that's what we're committed to do.
Chevron's president of midstream speaking with Bloomberg's Manus Krani and Yusuf Gamal Din. Joining us now is Bloomberg MLive editor Eddie Vandervolt. Eddie, I was prepared to talk about nat gas. It's down. Brent is down. All the high beta stuff is down. I mean, those strikes don't seem to be what's moving things here. It's almost, what have we decided yesterday was just a make-believe day? It didn't count?
Yeah, absolutely. Look, there's a lot of negative news in the market at the moment. Those strikes, I think they won't matter for the near term for Europe. But I think if they drag on late into the winter, at the moment, Europe natural gas, supplies are very well stocked, something like 92% full at the moment. So but as we get late into the winter, if we can't replenish, then maybe some Australian gas will have to come in. As far as the high beta, the market generally turning much more sour. I think on the PMI numbers from Europe, those have come in significantly below expectations. Now, there is this sort of weird moment in the market where there is good news, bad news, or is it not? I think the fact that services in particular coming in below expectations, I think that really matters for people.
You're also seeing the bond sell-off really continue into the U.S. as well as the stock sell-off. Talk about what that data really means for the global risk-off story, especially when the real bid you're really only seeing is in the dollar.
Yeah, absolutely. The dollar is the big mover here, and I think that's been the case for the last year or so. When you see the dollar up, you generally see markets broadly down. What's interesting about the yield curve is that we are seeing more of that steepening at the moment, right? I think as long as it's steepening where we're seeing the long end lifting, so if you're seeing that kind of bear steepening, then I think that is actually really good for broader markets, because that means that we're not having a spillover, we're not seeing a recession that's forcing the Fed to cut rates at the front end. And I think, therefore, the steepening, particularly at the back end, probably helps the market more than anything else.
Believe it, though, Eddie? Aren't we about to get a bunch of corporate bond issuance? Are we not just trying to adjust for that?
Yeah, there is absolutely a risk that we reprice all of this. And this is what happens when you're in a data-dependent world, isn't it, right? If you're without forward guidance, that means that every new data piece that comes in has to move the market so much more. So I think when the Fed says data-dependent, it is also saying heightened volatility.
All right, Eddie, thank you so much. Always a pleasure to have you on. Eddie Vandervalt there with the Market Roundup. And for more excellent analysis from Eddie and the team, and Live Go is where you want to head on your terminal. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
This is Bloomberg Surveillance, the early edition. I'm Danny Berger in London, alongside Sonali Basak in New York. Now, some of the stories that we've got our eye on this morning with a little bit of deal flavor to them. Starting out with CVC. It's said to be nearing a deal to buy DIF Capital. It's an effort to grow its range of offerings ahead of a potential listing. Infrastructure manager DIF has around 16 billion euros of assets under management, according to its website. The deal announcement, Sonali, could come as soon as today.
We're going to stick with private equity because we have Thoma Bravo. It's said to be near a deal to buy NextGen Healthcare. The health record software firm NextGen had drawn interest from several other buyout firms before these talks advanced with Thoma Bravo, according to a Bloomberg source. The deal announcement could come as early as this week, Danny.
Now, over in Hong Kong, shares of skincare brand L'Occitane are falling by a record 28%. In the pre-market session after the chair ends talks on a potential deal to take the firm private. Now, the company said in a filing on Monday that the controlling shareholder has decided not to proceed with the transaction. But, Sonali, there was no reason specifically for that decision.
And over in the IPO world, remember that investment banks are working on ARM's IPO, and they're said to be sharing upwards of $100 million in fees from the listing. Bloomberg is learning that ARM Holdings will pay 2% of the $5 to $5.4 billion it's seeking to raise in the public offering to those banks. Now, long-awaited set of fees for a drought that has been the worst IPO drought, Danny, since 2009.
Yeah, and that makes me wonder, Sonali, just how much is at stake with this IPO? Finally, we're going to get the mega IPO coming back to the market. But is a flop, if it's a flop, does that just kind of cement then, Sonali, okay, maybe it's still not the time. We're still not yet in a place where you can exit via going public.
It's interesting because you have already seen valuations come down meaningfully. You had SoftBank set the floor by buying its ARM stake out of the SoftBank Vision Fund. Now you also have ARM lining up its biggest customer Apple, Nvidia, to be as strategic investors for this IPO, yet you're already seeing expectations starting to be a little bit muted relative to where we were a week ago. They are seeking to raise $5 to $7 billion, but that could end up in the range of 50 to 54 billion in valuation. Remember, SoftBank bought that stake at a $64 billion valuation. And so already, remember, super sensitive time in the market. You're watching CPI data ahead. You need to get these capital raises really in before you start to hit choppy markets potentially from that economic data and any adjustments here of rate expectations.
Yeah, that's the thing, right? SoftBank just had such lofty expectations for ARM. And we're in this moment where it's almost like the market is about to issue a verdict, and the verdict maybe doesn't look as lofty as it is. But Shonali, the thing that we can potentially hang our hat up on is that maybe we'll finally get some stability. Sure, maybe rates will be high, but I got to assume that if they do plateau, we're not in a volatile rates environment. That at least has to be a little bit more friendly for some of these markets, for bringing companies to market, for raising funds, that sort of thing.
And remember, investors are starved here for new deals when it comes to IPOs as well as bond issuance. You're also not only seeing the IPO market ready to come back in a little bit more force, you're also seeing bond issuance this week. We were talking about corporate bond issuance on the investment grade side coming back, and also leverage loans to the tune of about 15 billion. Now, that is not much compared to prior years, but it is certainly welcome for investors that are looking for some yield in this market that has been starved of deals.
I was going to say, today is the day historically when we get that bevy of corporate bond issuances. So something to look out for and something that might continue to hit duration. Speaking of which, coming up, we're going to be speaking to Henrietta Pacamont, head of global fixed income at Allspring. That's next. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
This is Bloomberg Surveillance Early Edition. Here's what you need to know for the day. More fresh data trickling in as the ECB officials ponder whether to hike or to hold next week. Europe's services data was weaker than forecast, and while consumer inflation expectations inched up. Meanwhile, over in China, disappointing data adds to concerns for the country's recovery. Bloomberg economics say China may never overtake the United States as the world's biggest economy. And Goldman Sachs gaining confidence in the United States. The bank now seeing a 15% chance the U.S. will slide into a recession. That's down from 20%. I'm Shonali Bassick in New York with Danny Berger in London. Danny, what is Europe looking like today?
Well, Shonali, you'd think that after rally yesterday, we could maybe keep it going. I mean, we had good news in terms of Country Garden repaying some of its dollar-denominated bonds. You had Goldman Sachs upgrading their view of the economy. However, with the U.S. online, it's decided that we can't make any decisions without it because all of that has been undone. Perhaps we decided that the China rally was too far overgone, that the Europe data was bad. So you have a drop of about 0.1% in European stocks. But all the high beta FX, this is where the action is really taking place today. Sterling, it's off some of its lows, but still moving lower about 0.6%. Euro also looking weak this morning off the back of services data that was revised down, and other places disappointed. Finally, Aussie dollar, that's down by 1.25%. This really exemplifying, Shonali, just the risk off high beta kind of move that we're seeing at the moment.
There's certainly more risk off over here in the United States as well. You're watching a little bit more of that sell-off taking steam in the U.S. You're watching the S&P futures down about 0.2%. That is a little bit better than what we saw earlier today, but we'll see how the market opens. The two-year yield, though, gaining some steam with that bond sell-off. We're now at 4.90, up about 2 basis points. We're looking at that two-year yield. We're also talking about the dollar because the dollar is really where the bid is in the market. That Bloomberg U.S. dollar index at the highest levels since March. Brent crude still facing a little bit of pressure there, down about 0.5%. Looking at an 88 handle there, $88.52, Danny.
Yeah. I mean, and I know, Shonali, that at the same time, you've also got your eyes on equities, a new call out from Mike Wilson's Morgan Stanley.
Yeah, absolutely. He's sticking with those late cycle winners like industrials and energy over consumer discretionary and small caps. He writes, quote, markets are now expecting a meaningful reacceleration in growth that he thinks is unlikely this year, especially for the consumer. To talk more about that, we're going to talk to Henrietta Pacamont. She's senior portfolio manager and head of global fixed income at Allspring Global Investments. Great day to talk about bonds. You're watching those worries about growth really filter through the market here, watching that bond sell-off continue into the United States. How much more pressure are you expecting?
So, yeah, we've still got this tussle between inflation and growth. I think we have had some weaker data, particularly out of certain geographies. I'd say Europe and China in particular. We saw the numbers today. But even in the US, with some of the employment numbers that came out on Friday. So I think that is a consideration for the market, particularly as risk assets have had a bit of a good run and are pricing in a sort of soft or no landing at this point. So I think it makes sense. On the rate side, well, inflation is still a thing. We're getting stickiness on the services side, and you are getting a bit of movement on the commodity side as well. So still something to look at.
It's certainly still a thing. Also, I love that phrase, by the way. It is absolutely a thing, Henrietta, especially in Europe. And it's this push and pull. At least you can kind of see it play out on the front end of the German curve, really stuck around 3%. Which is going to win out more, that inflation stuck in a range or growth that keeps coming out weaker? Where is the next breakout for the front end of the German curve going to be?
Well, I think the ECB is in a tricky spot at this point. Yes, we are sort of seeing this turn in terms of numbers from a growth perspective. But inflation is higher in Europe than it is in the US. So that does put it in a tricky situation. I mean, if you look at Christine Lagarde, she's at pains to say that they are data dependent. So it'll be really interesting to see what they do later on in September with the more information that they will have between now and then. I think it's very finely balanced as to what they do. 375, 4%. They're probably in the range that they want to be in at this point and not have to hike too much more from here.
Yeah, I would say she's almost at pains to say nothing. I feel like she seems very concerned about, showing her hand either way, whether it's hawkish or dovish. Does that mean that ECB speak, maybe we kind of put that to the side and it's all about the data that we need to be trading around?
I think you need to look at the data. I think you need to see what's coming in. I think it's not just the ECB, to be fair. I think it's the Fed as well. But the ECB is in a slightly trickier situation with maybe a little less flexibility than the Fed at this point.
Now, Henrietta, I want to talk to you about the Goldman Sachs call a little bit about the U.S. recession odds, down to 15% from 20%, because Jan Hatzius had argued the following, that real disposable income looks to reaccelerate in 2024 on the back of continued solid job growth and rising wages. And second, they still strongly disagree with the notion that a growing drag from the long and variable lags in monetary policy will push the economy toward a recession. Do you share his view, or are there risks that he's wrong?
Well, I think it's an optimistic view, but then you look at what's happened since the beginning of the year, the U.S. economy has surprised. The consumer has been a lot more resilient and a lot more willing as well to spend the sort of nest egg that they built up during COVID. We'll have to see if that continues. I do think that, yes, there are some after boosters, what Goldman Sachs mentioned, but also some of the investment packages that have come out in the U.S. I'm thinking of the IRA, for instance. So there are reasons for optimism. But, there is a lag. We have had a pretty aggressive rate hiking cycle, and that does leave traces. We are getting towards the end, maybe as well, of some of the COVID savings. There's the change as well in terms of student repayments. So it's not as clear-cut, maybe, as they think.
As far as the equity side goes, it's been very hard to kind of argue the bull case this year. But there are expectations that there are certain catalysts that could make the rest of this year somewhat choppy. How choppy do you think that this year could get?
I think that's right. Equities have come a long way, and also you have to remember that the bond world has come a long way in terms of yields. So it does have a place in the portfolio more so than it has in years gone by. So diversifying between bonds and equities at this point, we think makes sense. It gives you a bit of an option on the growth side, but if growth does disappoint, which is an option, you've got a bit more protection if you've got some bonds in your portfolio.
Henrietta, I'm not even ready for the rest of this year. I'm still trying to get through this week. I mean, this is the day, right, where we get all this corporate bond issuance. I think it was $35 billion on the Tuesday after Labor Day last year. What are you expecting this time around?
So there is a seasonal aspect to September. You do expect more bond issuance. We're certainly seeing that on the investment grade side. We're expecting that to hit on the high yield side as well, possibly on a relative basis more on the European side than on the US. So this has got a degree of normality. Maybe it's accelerated ahead of some potential volatility later in the month. That could be what we're seeing at the moment. But issuance went well last week. Books were well covered. There is some selectivity from investors, so different issuers are having to come with different new issue premiums, but so far so good. And there is cash to spend in the investment grade portfolios, in the high yield portfolios, in anticipation of this new issuance.
Does that mean some calls of high yield's demise are a bit too premature at this point?
High yield's an interesting one. Yes, if you are concerned about the economy, it's one to treat with care.
Right.
And what we've seen with investors so far is they've focused on yield, particularly on the short end. Maybe now it's an interesting one to sort of lengthen out, get a bit more protection from a duration perspective, and we need to keep an eye out in terms of the refinancings on the high yield side. A lot of short-dated bonds in high yield. Probably one of the highest ratios on the European side, between 1 and 3 year in terms of maturity. We need to see how that gets refinanced over the next little while.
Allspring's Henrietta Pakwan, we thank you so much for your time and your analysis. Coming up next, we're going to talk about big tech bracing for the European Union's biggest antitrust crackdown. We'll discuss that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Shanali Basak in New York. Big tech is bracing for the European Union's biggest ever clampdown on anti-competitive practices, which may invoke a new wave of legal battles between regulators and Silicon Valley. The announcement on which tech platforms are to be targeted under the EU's Digital Markets Act is due by tomorrow. For more on this, let's bring in Bloomberg's EU competition reporter Sam Stolten. Sam, I feel like I've been hearing about this for a while, and finally we're going to get something concrete from it. But catch everyone up. What exactly is the objective of these new rules?
Well, yes, indeed, it has been long in the works. The Digital Markets Act effectively aims to stop at source some of those anti-competitive practices that big tech has been accused of, particularly here in the EU over the past couple of decades. Now, the rules don't actually come into play until early 2024, but a really important development is happening tomorrow when the European Commission lays out a list of those services that will face the new restrictions.
Who will face the new restrictions, and what will they have to do to fight them?
Well, effectively, that's the announcement tomorrow. There are quantitative thresholds that certain core platform services, as they're called, have to meet in order to be designated. So we can have a general idea about the types of services that will come under the scope. A number of Apple services, for example, are expected to meet the thresholds required to come under the Digital Markets Act. And that will mean that, for example, in the future, iPhone users may be able to download apps from outside of the Apple App Store, and indeed they will be able to download them from other online platforms, such as potentially the Google Play Store on iPhones. Elsewhere, if Meta finds that some of its social networking services, like Facebook and Instagram, come under the scope of the new rules, then it will have to ask users before it combines user data before those types of before that will take place. So a lot of these services are still to be designated tomorrow, but that's really the list that we're waiting for.
Yeah, I mean, Apple has been such a gatekeeper there. It would feel like such a change for me to be able to log on to the store here and download something from Google. Look, Sam, before we get to any of the enforcement of these new rules, could there be any legal challenges?
Potentially, yes. And I mean, if any legal challenges do come or any form of legal wrangling over these new obligations and prohibitions, they're likely to come relatively soon, not too long after the designation process tomorrow. And it will really centre around what platform services some of those big tech gatekeepers believe should be designated, and maybe where the European Commission disagrees with those decisions. So, for example, one company that has been relatively robust in saying that it doesn't think some of its services should be designated is Microsoft. Microsoft says that Bing, for example, is too small a competitor to Google to be designated under the new rules, and that's despite Bing likely meeting some of those quantitative thresholds to be designated. So there's lots of legal wrangling potentially in storm in response to some of these new rules and restrictions. But on the other side of things, the parts where the platforms will comply with the new rules will require quite a lot of re-engineering of some of those core digital services that have become a concrete part of our everyday lives.
Yeah. Sam, thank you very much. That's Bloomberg's EU competition reporter Sam Stolten in Brussels. Now, over 3 years ago, millions of office workers were sent home at the start of the pandemic. Now companies are still struggling to get them to return. That's the focus of today's Big Take. A great piece. Joining us now is one of the authors on that, Bloomberg's Irina Engel. Irina, this is so fascinating because looking at some of the differences per country, I gotta say, it makes America seem so antisocial that Americans just do not want to return to the office and see people.
Well, it's right. Just as we have national dishes, now we seem to have different national flavors of returning to the office. The US is lagging Europe and Asia in the return to office push. Only half of Americans are back in the office compared to over 75% in Europe and in the Asia Pacific region.
Why the differences? Why is it that Americans don't want to be back?
Well, it's two things, actually. It's culture and the way cities are built. If you look at China, where you have very high rates of office attendance, that's also where you have the 996 culture, which involves working from 9 a.m. to 9 p.m. 6 days a week. Also, loyalty to employers is more steadfast in places like Japan and South Korea, say, than in the US. And workers in Europe and Asia are more concerned about missing out on social connections with coworkers than Americans are. And finally, it all comes down to your home setup and your commute. European cities are more walkable and office areas are connected to vibrant communities. By contrast, in the US, offices are more isolated and dictated by zoning laws.
So for places like the US, what does it mean for commercial real estate?
The picture is not looking great. McKinsey estimated that pandemic shifts could erase as much as $1.3 trillion of real estate values in big cities around the world by 2030. And now the value of being present in the office in different cultures is directly linked to property values. So landlords in countries where work from home is more popular are the hardest hit. Office-heavy areas of New York or San Francisco have suffered steeper declines in real estate demand alongside lower rates of office attendance. And that's compared with cities like Paris and Munich or Asian cities which value being in the office more.
Our thank you to Bloomberg's Irina Engel on a very widely read story today. Coming up, a look. Oh, actually, no, wait, Danny, I want to talk a little bit more about this story because this is
Shanali, we can't go yet.
post-Labor Day holiday in the United States here. Not only am I back, but something funny about the United States, about people coming back into work, is that you have the big banks saying, come in, everyone's needing to be back 5 days a week. Interestingly, though, their clients had to work from anywhere August. A lot of the big private asset managers, which means that today, right now, you and I are speaking to people that are being dragged back in, that have not been in New York, let alone the office, for 3-4 weeks.
Look, I kind of do feel for a lot of people because obviously, Chanel, you and I have been in the office for most of the pandemic too, let's be honest. But look, if you were someone whose work gave you that flexibility, and let's say you were in New York and then you say, hey, I'm going to go move out somewhere in Connecticut, somewhere that's a 2-hour commute, because work is letting me do that. For some of these firms that are changing and saying, actually, we want you back in, it's extremely difficult. You can see why some people are saying, if work asked me back in, I would not go back in. All those surveys show that in America, that problem is especially acute. And again, it gets me back to the thing that, again, in this big take, America literally comes off as the most antisocial country in the world.
Well, you and I are very social for what it's worth. And, you know, the thing is, it's your point that in the suburbs, rents are very high in the biggest cities. So people have moved to the suburbs. And, you know, there have been some companies that set up offices there, but not everybody. Anyways, coming up next, we're going to look back at the market. There are a lot of events to watch throughout the week, and it is going to be a busy week despite being a short week. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London with Sonali Basak in New York. A quick look at what's ahead. Get you set up for your trading week. If today's your first week in the office, like it is for Sonali, welcome back, everyone. So we're going to get several releases between now and Friday. That's going to be including U.S. ISM services, China trade data, and German industrial production. Then on Wednesday, it's the Bank of Canada. Officials will meet on interest rates, and we're also going to be getting the Federal Reserve Beige Book, and we're going to hear from Fed speakers throughout the week. That will include New York Fed President John Williams, who will participate in a moderated discussion at the Bloomberg Market Forum on Thursday. Sonali, this one's really important. Williams doesn't speak a lot, and when he does, he's very influential. He's very influential at the Fed, so I'm looking forward to this one.
Yeah, so am I before that blackout period. We're going to look at stocks as well in pre-market trading in the United States. I wanted to show you what VinFast was doing because we're talking about new issuance, SPAC sentiment ahead of the ARM IPO. You are finally watching some cooling in VinFast. This is a SPAC that had taken this electric vehicle related company public and shot it up so fast that it had gotten a market cap that was worth more than Ford, Danny. You are watching some of that excitement start to seep out of the market after Labor Day. It is down more than 9% on the day today so far, pre-market.
Yeah, I mean, our Oliver Crook was just over at the Munich Auto Show. There was so much excitement about Chinese automakers, and especially if you're competing in a region like Southeast Asia, like Vietnam. I mean, when BYD is pricing things really cheaply, it's hard to see how you can compete.
I want to focus on another area of global competition. Let's look at the chip makers. Let's look at the semiconductor industry. Let's look at NVIDIA, because after a big really rise in the stock, we've seen so much excitement. We are watching a little cooling this morning amid some global competition. You're looking at the stock down 0.8% pre-market.
Yeah, here's the good news, though, from Goldman Sachs. Peter Oppenheimer Shanali says that AI isn't a bubble and the rally can continue.
I also want to focus here on Blackstone because you're watching S&P inclusion for the biggest asset manager in private markets. Remember, they're going to join prior to trading on September 18th. You're watching Blackstone stock up more than 4% pre-market on the inclusion.
Shanali, I'm going to be honest. I just have thoughts about your next stock. So get to it. You go.
Okay, I'll be quick about it. It's Man U. We all chose this. We added another stock for you. It's Manchester United. Shares are dropping because there is a lot of concern that this deal is uncertain and that the Glazer family, might take the club off the market, according to a report by the Mail on Sunday. So you're watching that down more than 9%.
Yeah, so heartbreaking. And I just want to say, I do live in London. I'm very close to being a British citizen. I do watch football. And Man U had a crushing defeat from Arsenal on Sunday. They had the lead 2-1. It was declared offside. Then Arsenal comes back in the last few minutes and puts 2 in the goal to win 3-1. That is my football TED Talk for the day. Thank you for coming.
You know, I am with you for the next 2 weeks. Maybe I start watching more football with you and we make this a daily thing.
I love this idea. I love it.
Well, that does it for us for early edition surveillance this morning. And surveillance is ahead with Tom, John, and Lisa. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Danny Berger alongside Jennifer Zabazaja in London. And these are the stories that set your agenda. Fragile China. Fresh data show the services sector expanded at the slowest rate this year in August. Bloomberg Economics says China may never overtake the U.S. as the world's biggest economy. Lying low, Philip Lowe, the governor of the RBA, leaves interest rates unchanged at his final meeting, but warns some further tightening may be required. Plus, indebted Chinese developer Country Garden avoids what would be its first default with last-minute payments on dollar bonds. Good morning. Happy Tuesday, Jen. It's great to be back on the show. Great to be back on the show with you. What a joy this is.
It's great, Danny, and we've never anchored before.
I know.
So thank you for having me.
Our anchoring debut. No, you're a pro now. You had the reins yesterday. Everything was great. Nothing broke. But look, it should be a morning of relief. We have a U.S. dollar bond payment from Country Garden. We have Goldman seeing an even lower chance of a recession. Someone should probably tell the markets that, though, because it's not looking great out there.
Right. We're going to have to see whether or not the U.S. actually reflects that, right, when they're back from the Labor Day holiday. Danny, let's just take a look at the S&P futures at this point in time. As we mentioned, yesterday was the Labor Day holiday, and so we didn't see a lot of activity. But what we did see overnight was a dip from the S&P falling. There we have it, just over 0.1 of 1%, and they're a sea of red at this point in time after a relatively flat session. As I mentioned, the markets were closed for the Labor Day holiday on Monday, but after the boost that the markets got on Friday from the jobs report, we'll see whether or not the resumption of trading today after the long holiday weekend potentially gets things back in the green. At this point in time, though, not seeing that.
Yeah, again, maybe not surprising that we're giving back some of the gains we had from Friday, but still, I feel like there should be more optimism. That's just not really reflected. Maybe the bond market makes more sense in that regard. We are seeing treasuries, again, the first day trading of the week, open to losses. We're looking at yields just barely higher on the front, I should say. We're seeing more movement further out in duration, but we're up about 1.5 basis points. Maybe some of that is finally pricing out the cuts that are priced in. Goldman Sachs says that it's less likely we're going to get the amount of cuts that the market is pricing in, given what the economy is doing, Jen.
Yeah, Danny, let's get over to Avril Hong in Singapore now for how the Asian markets are faring. Of course, we're just waking up to that. Avril, you've been taking a look at this all day. Talk to us about what the equity picture is like where you are.
Yeah, taking a look at this all day, and it looks like the negative picture that we started off with in Asia has remained for much of the morning, and the Asia stocks are lower. A lot of the losses are coming in from the Hang Seng, and that is because of the unexpected decline in the Tyson Services PMI, despite it remaining in expansion territory. So that's raising those concerns about the Chinese economic recovery. Chinese property stocks are lower today as well, and that is despite Country Garden managing to avert a default, telling bondholders that it has made payment on a dollar bond interest, and that is a bit of a relief, but not quite solving the issues in the Chinese property sector. Now, we also have these Aussie stocks as well as the currency that are flat on the back of Philip Lowe keeping things unchanged at his last policy meeting. But it's not just these Tyson services numbers that we are watching very closely in Asia. We also got hotter than expected inflation prints out of South Korea, out of the Philippines and Thailand today. So that's raising concerns that economists have underestimated the impact of higher energy prices and what that might mean for the global picture. Is this a scenario that will play out around the world? So we're headed for a down day in Asia stocks.
Avril, thanks so much for that. Bloomberg's Avril Hong in Singapore. Look, a lot to go over. Some of it Avril mentioned. So let's get to our morning roundtable. This morning, we're joined by Jill Deesis, Lizzie Burden, and Valerie Teitel. Look, we got to start with where Avril left off. Chinese property developer Country Garden has told creditors it paid coupons on $2 bonds within the grace period. This avoids what would be its first default. Jill, let me bring this to you. I'm looking at a market that still looks pretty pessimistic in China. Country Garden shares still down about 2%. Is this crisis not over yet?
Hey, Danny. No, I think you're right. I think that it's too premature to call this crisis over, although obviously this is good news for Country Garden. So look, they've paid back the interest worth about combined $22.5 million on these two bonds, really coming in though under the wire there, Danny. I believe that the grace period ended basically overnight tonight. So they're really hitting that, avoids that potential default for now. But remember, Country Garden literally just last week reported, this major losses for the first half of the year. They also, still have several other repayments due before the end of the year. And then, you look at that Caixin Services PMI that Avril just pointed out. I mean, a contributor to that sector is obviously the property sector. And so when you're seeing some easing going on there, that does indicate to us that there's still some pretty big concerns for the property sector here, even if we have this reprieve right now.
So then, Jill, what is it that you're paying attention to for what is happening next? You mentioned another payment before the end of the year. What is it that you've got your eye on, though?
Sure. So I think obviously we've got, continued payments for Country Garden. Can they continue to weather, the storm that they're in? What do their earnings look like as they come around next time? Is there any kind of turning the tide there? What I'm looking at for ultimately, Danny, is that we just had a bunch of big support measures announced by China, particularly for the property sector. So you were looking at, reducing mortgage rates, lowering down payments in cities. I think that we're looking to see how much of that translates through to a change in sentiment for the property sector. We saw a little bit of good news over the weekend, actually. We saw some home sales pick up in the wake of some of that mortgage rate easing measures. So I think that at this point, it's really about looking at whether that indicates that there's a shift in sentiment for the property sector, how much that translates to, help for developers, and ultimately, I guess, whether we see any further easing on the part of the government, because it's, some little positive signs here and there, but there's still a long way to go.
Yeah, and as you mentioned, definitely down to the wire, so a lot to pay attention to. Bloomberg's Jill Deesis, thank you so much for your time, Jill, for joining us and updating us there. All right, Bloomberg Economics believes China is no longer set to eclipse the U.S. as the world's biggest economy soon. This is, of course, a difference than what we heard before. Let's bring in Lizzie Burden, who has more on this. Lizzie, what can you tell us?
Well, as Avril said, we've had that reminder of Chinese economic woes this morning in the shape of the Caixin Services PMI data, weaker than expected. Even if it's still in growth territory, it's the weakest growth of the year. Now, that's weighed on Asian equities this morning, but if you take a step back, as Bloomberg Economics has, this narrative that China inevitably is going to overtake the US comes into question. So actually, they say that that's not going to happen till the 2040s now. And even then, it's only by a marginal amount. Why? Well, of course, you've got the structural issues in China, exports tumbling, the property woes spreading across the economy. And last year, Jen, you saw that population in China actually dropped for the first time in 60 years. So what once seemed inevitable is now under question. But if you're an economist, of course, you can only work with the policy measures that are on the table at the moment. So you're betting that there isn't going to be a bazooka, which is a pretty big bet.
Yeah, and look, it's worrisome. It's not like the U.S. is growing gangbusters. What's going to pick up the mantle for global growth? Lizzie, Thanks so much. Let's stick with Asia now. The RBA has kept its rates unchanged at Governor Lowe's last meeting, but the central bank warns that further tightening may still be needed. Val, was this a snoozer of a last decision from Governor Lowe?
Yeah, it did very much go as expected, Danny. I think most of us were wondering what kind of optionality he'll keep on the table for the new governor, because he does step down in 2 weeks' time. He kept all the optionality on the table, said that the rate pause will give them time to assess the impacts of rate hikes, and that more tightening depends on how the economy does evolve. So a lot of optionality there for the new governor and the RBA. They do hold the cash rate at 4.1% and keep that, I guess, that threat of further tightening still on the table. There are still some economists out there that do see a risk of a economic acceleration in Australia in the later half of the year, tempting maybe one more hike from the RBA. But it's looking like they're pretty much on pause from here until the new governor takes over soon.
I feel like we've been ignoring the U.S. a little bit this morning, which is fine because they were off yesterday. They don't deserve attention because they got a holiday. But I just wanted to point out this comment from Jan Hatzius over at Goldman Sachs, because Goldman has been more optimistic about the economy than most. But I want to get your take on this, Valerie. So they've cut their odds of a U.S. recession in the next 12 months to 15%. Previously, it was 20%, saying that this change reflects continued encouraging inflation news, a favorable real income outlook, and the decline in the jobs worker gap to just above its pre-pandemic level. The Fed and its DM peers are set to cut rates less than what the market expects, both because the neutral rate should settle above the post-GFC norm and because activity remains resilient. The Bloomberg poll, though, is much higher than 15% right now for recession odds.
Much higher. The consensus for the year ahead recession probability as it stands on Bloomberg is 60%. So Goldman is very much more bullish than the consensus on the U.S. economy. And I think it comes at a time where many are expecting a slowdown in the consumer to really start to hit U.S. economic growth. And that's because from September 1st, we had that student loan forgiveness that starts to roll off. As these consumers start to repay their student loans, they're going to obviously be buying less goods and being less active spending money. So a lot of us, I guess, are expecting some sort of turn in the economy as we enter the fall because of those headwinds. Goldman, though, noting that the labor market report we got last Friday was a really good one for the Fed, and noting this progress on disinflation without any true labor market pain already really opens the door to avoid a recession, and that was the emphasis on their call.
Yeah, Val, a lot of students not looking forward to those repayments, myself included. Val, you're going to stick with us. Let's take a look at some of the events we are following today. At 9 a.m. UK time, we'll have the ECB's inflation expectation survey. At 10 a.m. UK time, we'll have Euro area PPI. I
got to say, the one I'm most looking forward to, Jen, is later this afternoon. We're going to be getting comments from ECB Executive Board member Isabel Schnabel. She'll be chairing a panel at a legal conference. And Valerie, the reason I'm most interested in this is it was Schnabel's comments last week that really shook things up. People interpreted them as more dovish, as more worrying about stagflation.
The one thing about that Schnabel speech last week is she drew a lot of attention to this ECB inflation expectation survey we do get today. So the market is going to be very focused on that at 9 a.m. It's almost the last data print before the ECB convenes next week. Now, we're not pricing in too much of an ECB hike next week. It's only 20%, let's say. But if we do get, let's say, a hotter than expected inflation expectations coming out in that survey, because Schnabel drove so much attention to it, it could really maybe tempt the market to price in a bit more for that meeting next week.
And there's a lot of room to do just that because they've priced out so much by this point. Val, thanks so much. That's Valerie Teitel. And you can get around to all the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DAYB Go on your terminal.
And coming up, we'll dive into markets, including what Australia's rate decision means for policy in the world's other big central banks. That is next, and this is Bloomberg.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Welcome back to Bloomberg Daybreak Europe. So the RBA, it's held its cash rate target at 4.1%. The central bank did, however, warn of further tightening that might be needed to hit its inflation goal. Joining us now is MLive strategist Mark Cranfield. Mark, I mean, this was expected. It is Governor Lowe's last meeting. Can I be a little bit controversial here? Can you tell me why we should care about an RBA meeting where they just did nothing as expected?
Well, you should care because it's a lovely template for other central banks who may want to do a pause of their own. I'm looking at you, Federal Reserve and European Central Bank. So he put all the arguments in place for a very neutral outlook. We're concerned about the data, but we've done a good job on inflation. We may need to hike again if the data tells us to do so. And all those kind of things all fit very neatly into a package of somebody who thinks they've done a lot of good work. They'd like to stay on hold for some time, let the economy catch up with the rate hikes they've already done. Doesn't that sound like the Fed and the ECB? So I think it's a pretty good message for the rest of the G10 that maybe we're just going to get a whole this month. It looks pretty exciting on the surface. Maybe by the time September's over with, all we've got is all the major central banks just staying on hold.
Yeah, Mark, let's talk about Country Garden, because we were talking to Jill earlier and she was saying they waited until the very last minute. And yet it was still big news for us this morning. Give us a sense of how markets from where you're sitting are reacting to this at all. I mean, is there excitement? Is this potentially a change in the outlook and the sentiment of Country Garden?
There's a certain amount of relief. I mean, it's better that they paid than they didn't pay. The amount itself is relatively small in the context of the size of their outstandings. 22 million when you've got 15 billion or so of debt is really not an enormous amount. And it's really the beginning of the process, but at least it buys them some time. Obviously, a worst case scenario is that they would have missed it. There would have been threats of default. They may have had to go into liquidation process. It would have been very, very messy and ugly. And there's a lot resting on the fact that Country Garden stays intact and gradually works through its problems. So it's good from that point of view, but there is a lot of work still to be done. They're a huge company, very important to the whole structure of the property market in China. And they're already asking for delays on their yuan bonds, the onshore bonds. Some have been delayed already. They're looking to extend several more bonds as well. They may come back and ask for something similar on their dollar payments as well. It's going to be a long process, but at least this is a positive step. And we may see a bit more relief in the equity markets in Asia this afternoon. But don't be mistaken. This is a very big problem, and it's not just Country Garden. There are other property developers in similar struggles, and there's a long way to go.
Yeah, again, the market just not reflecting any of that hope at this moment. Hopefully we do see that come through, Mark. We could use some good news. Look, before we let you go, I want to ask about the bond auctions we're going to get coming out of Japan this week, because I was just reading this Credit Agricole note saying that the BOJ likely won't exit yield curve control until 2025. I mean, who's still buying in this market? Who's still present at these auctions, Mark, when already the government owns so much of the Japanese JGB market?
Well, like in any major economy, you have a domestic base who really don't have a whole lot of choice. I mean, particularly if you're a life insurance company in Japan, you need to have long duration. You have a certain flow of money. You need to reinvest it somewhere. And if 10-year JGBs are all you've got, then that's where you have to put your money. But it's really what makes a difference to the market, of course, is the new money, the people that can choose between equities, between bonds, going overseas or staying at home. Those are the guys that make a difference. And certainly, although this auction went through without any big problems, if you look deeply at what happened, a lot of the bonds are issued at the lowest price. That's not a great sign for the auction. There's another 30-year coming up later in the week. That'll probably be more difficult. The tail end of the steepest part of the curve is not always very easy. There's less demand typically. So it's still going to be a tough week. You've got a Bank of Japan meeting coming up later in the month, which most people are considered to be a live meeting in the sense that they may well tweak policy again. And at the same time, we've got a very good macro view out today from our colleague Masaki in Tokyo saying that even the unpopularity or relative unpopularity of the Japanese government, even that may weigh on Bank of Japan policy as well. There's a whole lot in the mix, and Japanese bonds are going to have a pretty turbulent week.
Absolutely. All right. Thanks to Bloomberg MLive strategist Mark Cranfield for that update. All right, coming up, it could be a $1.3 trillion problem 3.5 years after COVID sent office workers home en masse. The commercial real estate market is counting the costs. We'll dig into that story next. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
India, home to a now record 1.4 billion people, more than half under the age of 30. But that also includes the largest number of jobless youth anywhere in the world. The fastest growing large economy in the world, India has the third highest number of billionaires. But on per capita income, it ranks at the bottom. The widening gap between the richest 10% and the bottom 50% makes India one of the most unequal countries in the world. Democratic English-speaking India, with an army of software engineers, has sought to become a major economy since its economic liberalization in the 90s. But authoritarian China has made bolder moves to become 5 times bigger. So why might this be India's moment? One big reason: it isn't China. Policy making from Beijing nowadays remains hard to predict. Western countries are wary of China's growing economic and technological clout. International companies are seeking supply chain diversification, China plus one. To speed that along, India's government is spending record amounts on infrastructure and offering production incentives to key industries. Other reforms range from a unified national sales tax to a world-leading digital payments system. Bullish investors and stock market highs have burnished the India story in the year of its G20 presidency. That Prime Minister Narendra Modi hopes will set the stage for his re-election next year. It will also test whether most Indians are buying the India shining story or not.
Bloomberg's Mike Kadoshi there in Mumbai. Jen, let's get a quick check on some of the commodity action because, I mean, I've been banging on about this all day. It feels like it should be a positive day, and it hasn't been. But look at what commodities are doing. It's a good day there. Look at iron ore Singapore. It's on a 5-day winning streak. Its biggest 5-day gain, almost 10% since December. That's where you're seeing some of the China optimism come through. But the MLive blog has a great piece basically saying this is just a downturn delayed, not denied.
Yeah, and we're also, Danny, taking a look at oil because it is holding their advance for the most part and still trading at the highest level since mid-November. What we saw this morning is at just about, there it is there, just about $89 a barrel after a 5-day surge. And we have WTI crude just about $85 right there. And we've seen oil really rally since June, since we heard those potential cuts from Saudi Arabia and potentially Russia. And then in the coming days, there's a lot of expectation that we might see more of that. So we could see, we need to pay attention to where this actually goes from here.
So one other thing, just before we go to break, Jen, I want to cover is the big take today, because I really liked this. It's the spotty return of the work from home everyone wants their employees, not everyone, but to come back into the office. My favorite thing about this is it makes Americans sound so antisocial. Well, it talks about that Americans say that they're more productive at home.
Yeah.
In Asia, everyone says they want to come back to the office for the socializing of it. And literally, survey after survey is basically like, no, Americans don't care.
I know, and it's really interesting because you don't really think about how different it is depending on which region you're in. I mean, I live in South Africa. I'm here in the UK right now, and I'm American, and so just seeing sort of the different variations of what people are doing. But what's going to be interesting, I think, is going to see what people actually do after Labor Day. As you know, this is the time where people sort of get back to a normalcy after the summer holidays. So I wonder whether or not that's actually going to work to get more people back into the office.
And there's a lot at stake. I mean, look at this. $1.3 trillion, according to McKinsey, could be the loss in real estate value by 2030. Here in London alone, JP Morgan says office buildings could lose a fifth of their value through the year through March.
Wow. And that's not something that people obviously want to see. But I think what's also interesting, Danny, is just the fact that, there's a lot of variations too in the kind of workers, right? Some workers don't even have the option of working from home. So it really depends on who you're looking at and what.
I mean, us, we don't have the option of working from home.
We don't. That's what I was talking about. But also, people who, have to be in the office, have to do hard labor and things like that. So there's a lot of different variations to pay attention to. All right, coming up, the RBA keeps rates unchanged at Governor Lowe's last meeting. We'll have all the headlines driving the markets this morning. Next, this is Bloomberg.
What we have observed is that larger asset management firms, but also private banks or just general financial institutions have established themselves here in ADGM.
We see that there's obviously a lot of capital here and there's a lot of potential for startups to grow.
Abu Dhabi gives us capital access, but it also gives us talent access and market access.
So we have access to the private sector, to the public sector, to the policy makers, and more importantly as well, to the innovators.
Good morning. This is Bloomberg Daybreak Europe. I'm Jennifer Zabasaja alongside Danny Berger in London. And these are the stories that set your agenda. Indebted Chinese developer Country Garden avoids what would be its first default with last-minute payments on $2 bonds. Fragile China. Fresh data shows the services sector expanded at the slowest rate this year in August. Bloomberg Economics says China may never overtake the U.S. as the world's biggest economy. And lying low. Governor Philip Lowe leaves Australia's interest rates unchanged at the final meeting, but warns some further tightening may be required. Good morning to you guys.
Good morning, Jen. Still waiting for any optimism to show up in this market.
You're really waiting, Danny.
I just want an optimistic day. The Americans are back. The stock market isn't even rallying. The futures, usually at least we get that maybe when the U.S. session opens. Even bonds are selling off. We don't even get any green there. Let me just take you straight to what the 10-year yield is doing, Jen, or the front end of the curve. I'm going to be honest, I'm not sure which one we have. There you go. The TV screen has decided. The 2-year yield is looking at gains, or rather the price is looking at losses. So higher by 1.5%. We saw a sell-off in the European session yesterday. It's this will they, won't they of the ECB next week. Inflation is bad, but the economy is also bad. So we've priced out rate hikes from both the ECB and the Fed. Perhaps a little bit of hedging, though, because it's not a sure thing at this moment, Jen.
Yeah, and Danny, I don't know if this news is going to make you happy or just...
What do you got for me, Jen? What do you got for me?
S&P futures, as you mentioned, still a little bit flat from Monday, but down at this point in time after we saw the flatness yesterday. And we did see Asian equities retreat for the first time in 7 sessions. As you mentioned, the Americans are back after a long holiday, and so markets were closed. But we did see last week the jobs report really give the boost to to the market over there. And so the question now is whether or not there's going to be a turnaround in the markets ahead of this week. And of course, we get a little bit of Fed speak. So maybe we'll see some green this week, but right now, not looking like that.
Yeah, I actually forgot about that because we're about to enter a Fed blackout period in Saturday. So this is kind of like the deluge. Get what you can out there for now before you can't speak. All right, let's check in how the Asia markets are doing and get over to Avril Hong in Singapore. Avril, what you got for us?
Well, we have a lot of negative sentiment in Asia-Pacific stock markets. The stocks are falling today. The MSCI Asia-Pacific could be headed for its first day of losses in 7 sessions. Now, a lot of these losses are being led by the Hang Seng on the back of Tyson Services PMI data, which disappointed despite remaining in expansion territory. And this is raising concerns about the Chinese economic recovery. But we don't just have our eyes on the numbers out of China. We also had inflation data out of South Korea, the Philippines, and Thailand, and they all came in hotter than expected, so raising concerns that economists have underestimated these rising energy prices and the impact that might have on inflation in these respective economies. What might that mean globally, as well as that scenario that is going to play out around the world? Case in point, we had the RBA Governor Philip Lowe saying that more tightening might be needed despite keeping things unchanged for now. So down day in Asia Pacific stocks.
Yeah, and Avril, we also have our eye, though, on Country Garden. Potentially, is that the outlier that changes things for the markets at this point in time?
It doesn't look like it, right? I mean, despite it managing to avert a default, telling bondholders that it has made payment on a dollar bond interest within the grace period, the sense is that this is just delaying the inevitable potentially. As Mark pointed out earlier, we have it paying $22 million, but that's really a drop in the bucket compared to the some $190 billion in liabilities that this distressed property developer out of China has. So at this point, even our colleagues at Bloomberg Intelligence believe that the making of the payment for now averts a default, but that's not going to help it avoid the downward spiral overall in Country Garden, because also it has a huge number of projects and there's a looming risk of construction halts on these projects. So overall, we're seeing losses in the property stocks out of China as well.
Yeah, thanks so much to Bloomberg's Avril Hong in Singapore for that update. Let's stick with Country Garden. We mentioned this. Once China's largest developer by sales has avoided what would be its first default, telling creditors it's paid coupons on $2 bonds within the grace period at the very last minute, as we've heard from our reporters today. So joining us now for more on this is Bloomberg Opinion's Shuli Ren in Hong Kong for us. Shuli, let's just start here. People are wondering whether or not Country Garden actually has enough leeway. We've talked about how this was really just at the very last minute and potentially not enough to, assuage concerns. But can Country Garden, based on your opinion, crawl out of its debt crisis? What does it need to do?
I think at this point, no one really knows. What Country Garden is doing, basically, is buying itself time and really hope for the best. So what happened was there was a very drastic shift in China, the Chinese government's attitude towards the housing sector last week. Before that, the Chinese government always said, oh, it's one country, one city, one policy, blah, blah, blah. And then all the easing measures were very, very minute. But last week, the government actually said that nationwide, it's lowering down the minimum down payment ratios and the mortgage ratios. And that is very significant. It's the first national policy change in like almost a decade, as far as I see. So maybe Country Garden is just hoping that the physical market will turn around and it will have a few months to recover.
Is that its only hope, Shuli, that the physical market recovers? Does it have any other options if it doesn't?
It really has no other options, unfortunately. The government, the Chinese government, doesn't seem to want to reopen the refinancing windows or pick up Country Garden's $200 billion liability bill. No, I think Country Garden's only hope is a pickup in the physical market.
Shuli, thank you so much for joining us. Shuli also has a great Bloomberg Opinion piece out now on this. Recommend everyone go out and read it. That's Bloomberg Opinion's Shuli Ren. Okay, let's turn now to nat gas. Chevron LNG workers in Australia have threatened 2 weeks of 24-hour rolling strikes at two major export plants that would start next week. Chevron's president of midstream, Colin Parfitt, spoke to Bloomberg exclusively from the Gas Tech conference in Singapore today.
We're committed to find a solution there, and we want to find a solution that's a win-win-win. We want to find it as a win for Chevron, a win for our employees, and a win for the gas markets.
Colin, let me follow up on that, just to give our global audience some perspective on how heated the rhetoric is. This is a quote from the Offshore Alliance when they made a statement. The log of claims will ultimately be claims which Chevron will agree to, but not before they lose a few $1 billion, judging by the form guide, which is okay, as Chevron clearly have plenty of loose change in the Chevron piggy bank. Do you have any timeline as to how quickly you're willing to resolve the standoff?
No, so I mean, if I go back and really just to kind of repeat what I said before, there are active conversation, there's active dialogue going on at the moment. So I'm really not going to comment on things that are around the edge, but to say that, look, we're really committed to find a solution here, and we want to find a solution. And we understand solutions. You have to get a space that's a win for various parties. So we understand that it has to be good for our employees, it has to be good for us, and all of that will be good in the LNG market. So really, that's what we're committed to do.
All right, Chevron's president for midstream, Colin Parfitt, speaking there. Let's turn now to the Ukraine situation. Wheat climbed after Russian President Vladimir Putin said he wouldn't revive a deal to safeguard the passage of Ukrainian grain through the Black Sea. Joining us now for more is Bloomberg's Europe correspondent, Maria Tadeo, who has been all over this. Maria, so no deal came out of this meeting, but did anything actually come out of this? There was a lot of hype around this potential breakthrough in this standoff.
Well, and look, there was a lot of hype because President Erdogan of Turkey is one of the few international leaders, as you know, that still gets FaceTime with Vladimir Putin. We've seen this isolation, certainly from the west, of the Russian leader, President Erdogan, going to Sochi. That marks a face-to-face meeting that are becoming unusual now for Vladimir Putin. And that is not to say that Erdogan can influence Vladimir Putin, but certainly maintains a level of clout. Now, this meeting, as I say, took place yesterday in Sochi. The expectation, the hope was that Erdogan would convince Vladimir Putin to reinstate that grain deal. The Black Sea Initiative, as you know, it has been credited for exporting more than 30 million tons of grain. The reality is there wasn't a lot of content out of this meeting in terms of the specifics of how to revive and reinstate the deal. Vladimir Putin still said that he is willing to talk and he is willing to listen to some solutions. President Erdogan also conceded that the United Nations will have to listen to some of Russia's demands, but not a lot has changed. Remember, the bottom line here is that Russia believes some of the sanctions that have been implemented on some of its food products, but also fertilizers, would have to be removed for the time being. It's not clear whether that would happen. The Russians also said they would give Turkey 1 million tons of grain. They also said Qatar could get involved in this, but again, it's nowhere near the size that the deal would get in terms of total tons out of the Black Sea. So yes, there was a lot of hope and hype, I would say, into this meeting, but in the specifics, well, not a lot.
Maria, as that's been going on, there's also been attacks on Ukraine's ports along the Danube. Where do we stand on the counteroffensive?
Yes, and you see that pressure still on Ukraine. And look, it has been a whirlwind of 24 hours for Ukraine. Clearly, we've seen the big changes that took place in the defense minister, a new minister coming in now. We've seen those changes in this counteroffensive. We've also seen some minor breakthroughs that are going on in the country, but certainly not to the speed or the extent the Western allies would hope to see for the time being. Yet, nonetheless, yesterday when we spoke to Hershkovka, who is an advisor to President Zelensky, he did say it takes time. It's not a Hollywood movie, but the results would be there. Let's take a look.
We are having another very important counteroffensive, which is going on as it goes on. I mean, this is not a Hollywood movie. You cannot do it within one day. But very important, this is going on. So the president is making his decision. He is absolutely right. He's chief military commander of the country. So we are hoping that the tempo of the counteroffensive will be increasing, and definitely Ukraine needs to achieve very significant results in the near soon.
And that was Ihor Shofko, an advisor to President Zelensky yesterday, talking to Bloomberg. He says he hopes, or the country hopes, that they will increase the tempo of the counteroffensive. And Danny, a lot of that has to do just purely because of the weather. We know that in a few months that winter effect will kick in. We know that it is difficult to move the front line, especially when we have difficult weather conditions. So, of course, Ukraine does feel this pressure to be able to shift that front line before the winter weather arrives.
Absolutely. Bloomberg's Maria Tadeo. Thanks so much for joining us. And great interview, Maria. All right, let's turn to Gabon now. Gabon's new military leader has called for a referendum on a new constitution and an overhaul of the OPEC member states' electoral code. That, as General Olugumi Nguema was sworn in as transitional president yesterday, less than a week after soldiers overthrew President Ali Bongo. Nguema pledged to restore civilian rule after an unspecified transition period and said he had the goal of giving, quote, everyone a reason to hope for a better life.
All right, coming up on the show, we're going to dive into the world of private markets. Bloomberg reveals CVC is nearing a deal to buy infrastructure partner DIF Capital Partners. We'll discuss the outlook for the entirety of the industry with Sunaina Sinha-Haldea of Raymond James. This is Bloomberg.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Welcome back to Bloomberg Daybreak Europe. So Bloomberg has learned that CVC is nearing a deal to buy infrastructure investor DIF Capital Partners. It has about 16 billion euros of assets under management. And we are expecting that the European private equity firm could announce a deal as soon as today. So is this the long-awaited return of private capital deal flows? Or is it just CVC, a giant, getting a deal here? Here to discuss the industry with us is Sunaina Sinha-Haldea, Global Head of Private Capital Advisory of Raymond James. Sunaina, first of all, so great to see you. Great to have you in the studio.
Thank you for having me. Great to be back.
Look, I feel like so many people, I mean, you and I were both at Super Return earlier this year, and I feel like everyone was like, post-summer, that's when the deal flow was coming back.
Yeah.
Is there any sign of this happening?
There are some green shoots, like the one you announced. Hopefully that deal comes through. I think the reality is, Danny, that private equity owners of companies that would want to go out and buy assets, do M&A, which is, by the way, somewhere between half and two-thirds of the entire M&A volume globally, have been on hold or on hiatus for quite some time, almost a year, and they cannot go off deployment for so long. At some point, they have to go back in and start buying companies and selling companies for that matter. Private equity runs on a clock, as you know. It's 4 years to buy and invest in companies, sometimes 5 years, and then 4 to 5 years to sell them on. And you can take a pause, but you can't go on hold.
And Sunaina, we're trying to see whether or not what the Fed is actually going to do next. And when we're talking about rate cuts potentially coming next year, I mean, what is it that companies need at this point in time to sustain sort of where the market is at this point in time?
For the longest while, Jenna, the market needed some stability because the debt underwriters, as you know, most of these deals require debt underwriting, whether it's a leveraged buyout, whether it's any kind of business that wants to get sold, needs to be able to show that the debt markets are functioning for the new buyer to be able to finance that acquisition. Those markets needed some kind of interest rate stability to underwrite debt. We had the news flow coming out of banks saying, I can't underwrite if I don't know what terminal rate is. Well, today we know where terminal rate is. It's somewhere close to where we are today, maybe a tiny bit higher, but not, not double. That's not where the signals are from the market today. So now we're seeing debt being underwritten on both sides of the continent, Europe and US. It's expensive, so you better buy an asset that's well outpacing the cost of your debt. But it's available to you, and that matters.
Yeah, okay, so that's maybe a little bit more stable. But in this world where the cycle isn't perhaps picking up where it should be, investors want money back. Is anyone in this world willing to commit new capital if already what they invested isn't coming back to them?
There are lots of people willing to invest capital. Actually, there's $3.7 trillion in private equity commitments, in all the various private equity commitments that have been raised around the world. Even so far, year to date in 2023, which has been a slow fundraising year, we can all agree to that, we're nearly at $800 billion raised. So if you think about the quantum of capital that comes into all types of private markets, it's still pretty high. It's not at its high watermark, but it's pretty high. If I had to pick 3 or 4 areas where investors are continuing to invest heavily in private markets, it's from private wealth. Right? Private wealth, as we can all agree, over the last decade has really come onto its own. Private wealth platforms have been burgeoning all over the world, and they're looking for diversification away from equities and fixed income and commodities and doing private markets that way. But we're also seeing that from Middle Eastern investors, from family offices, from insurance companies. All of them remain big investors in private equity.
So, Naina, we wanted to get your take on the economy. We were mentioning the Goldman chief economist was saying 15% chance that the U.S. will slide into a recession. That is down from the 20%. I mean, do you agree with that assessment, or do you think it's a little too premature to make that call?
Well, at least the probability is going down. Do you remember in March, guys, when we were talking about crash landing scenarios and so on? To think about the journey the markets have been on since January, it's really quite something. So I think now we're back to thinking about soft landings, potentially no landings. No matter what nomenclature you want to use, I think the picture looks a little bit stabler today for the short term than it did at any other point this year. If we'd all said to each other that the S&P would be up 17% earlier this year, we'd all be very happy and take that and run.
Yes.
But I think the point is on the economy, Jenna, we've got to wait and see what the long-term picture holds, because services-based inflation and goods inflation, it's hard to write that off completely, that we're fully in disinflation, especially when it comes to services driven by wages and labor. Labor has a lot of bargaining power these days. It's hard for me to think about, if you break down the components of inflation, how services inflation, it goes the other way. I feel it'll stabilize here, best case, but it's certainly not going to come down from here.
No, it is a really good point, and it would be so of these past few years for everyone just to get comfortable with inflation coming down to soft landing, just to see it all reaccelerate. Does that mean you look at, as you say, the equity market, a strong rally, continued appetite for risk assets, and kind of question that and say, hey, perhaps we haven't hedged enough at this point?
Yes, I think that there's a lot of, wanting to, creating your own reality, as we say, right? Like, let's hope that's the case and leg into it. And I think that's a lot of what the summer's been about. The Jackson Hole speech was supposed to put a dampener on the markets. There was nothing new in there. The markets took that as good news. So the party continues for now. That's absolutely fine. But the caution to the wind is, what does the long-term picture look like in terms of supply chain dynamics, but also in terms of services pressure, which is a huge component into inflation, both here in the UK and in the US.
All right, thanks so much for joining us, Sina Haldia, Global Head of Private Capital Advisory of Raymond James. Thanks so much for stopping by. All right, plenty more ahead. This is Bloomberg.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
All right, welcome back to Bloomberg Daybreak Europe. I'm Jennifer Zabasajja. Let's check in now on the markets with Valerie Teitel, who is back with us this morning. Valerie, what is on the mind of the markets this morning? What are you paying attention to?
Well, look, I know, Danny, you've mentioned all morning that the fact that we've gotten this Country Garden dollar bond payment has really failed to lift any risk sentiment. And given there was so much optimism about the Chinese property market yesterday, really lifted U.S. equity markets until around the close. I find it surprising we're not getting any reversal of this weakness we've seen so far this morning. But maybe markets are already looking ahead to what else we're expecting today. And for Europe, the key data print from that is going to be this ECB inflation's expectation survey. Now, normally it's not a huge print for the markets, but the fact that there was a specific hawkish member on the ECB Governing Council who drew attention to this survey, many are seeing this as the last big data print before the ECB convenes next week, perhaps maybe erasing that 6 basis points priced in for next week, or maybe adding to it if we do get some higher than expected inflation expectations.
Yeah, not that they've had the best track record, but I have talked to a lot of economists who don't buy a pause this meeting, just that 5 to 6% range inflation. How could they afford to wait? Today, though, is the first day where we have basically everyone online. The U.S. is back. Treasury cash markets will be up and trading. What fresh horrors awaits this market, Valerie?
Well, the beginning of September is one of the busiest months for corporate bond supply, not just in the U.S., but also here in Europe. And actually, the Tuesday after Labor Day is one of the busiest days, Danny. Last year, they saw $35 billion worth of investment-grade bond issuance. That might be a headwind for the Treasury market this week. And you can see a reason why these U.S. corporates might want to front load this supply in August to the beginning of the month. We have a Fed meeting later in September, and then in mid-September, we also have an inflation print. So perhaps there's going to be a lot of corporates out there trying to jump the gun, issuing debt this week, this early week in September, to try to get ahead of those volatility events. And we've already been seeing this steepening in the long end of the curve, this weakness in long end treasuries. Perhaps this could be another kicker to take that weakness a bit lower. So keep an eye out this morning when the U.S. does open for those big bond issuance announcements from U.S. corporates.
I was going to say, like, it feels like the market is already moving there. Duration is selling off more today. We're already getting some bear steepening coming into the market. So it feels very of the moment, Valerie. Yeah. Sorry, go ahead. What were you going to say?
Exactly. And we did see a lot of that happen after Friday's payroll print, right?
Yes.
There was a lot of head scratching over why we saw such a weakness in the bond market after such a Goldilocks print maybe for the Fed. Maybe a lot of that was traders already making room for this heavy bond supply. But again, expectations could be beaten today when we hear these issuance announcements at the U.S. Open.
Yeah, it seemed like a market-friendly report. I don't know. Valerie, thank you very much. Valerie Teitel there. Jen.
Yeah, and we want to tell you about an interview coming up at 9:30 a.m. We're going to speak to the Bank of Israel Governor Mir Yaron after the central bank kept its benchmark rate unchanged for the second time in a row. Don't miss that interview.
Well, that's it for Jen and me today. We'll do it again tomorrow. Up next, it's Markets Today. This is Bloomberg.
Welcome to Bloomberg Markets. I'm Tom McKenzie. Let's check in on your markets then. On Labor Day holiday, of course, in the US, with US futures pointing to some upside. And there is optimism here in Europe as well, halting 3 straight days of losses across European equities. China is certainly a theme today, with the concrete measures coming through, particularly in terms of real estate, property prices, and in terms of easing your ability to buy and purchase homes in major cities like Beijing and Shanghai. We saw the impact of that over the weekend, and that has lifted sentiment in Asia, and that feed-through crumbs across to the European session. Across the benchmark then, 459 on the European Stock 600, up 0.3%. And across your sectors, just flagging that travel and leisure's top of the list, gaining a full 1%. Bottom of the list, utilities down 0.4%. Futures, as I mentioned, in the US, of course, closed in terms of the market trading session today, but futures pointing to add to gains of last week. Last week, the best week for US stocks and US equities since June. S&P just pointing up futures by just 0.1%. Euro dollar 107, so the single currency getting 0.2%. The debate amongst senior officials amongst the ECB remains very prominent, and the divisions remain acute as well. We hear from the dovish Centeno, Mario Centeno, saying that we need to be aware of the risks of higher rates in this environment. The weakness, of course, of the Eurozone economy has been underscored in the last few weeks weeks, particularly with PMI out of countries like Germany. 107 on euro dollar. We look ahead, of course, to the ECB decision on September the 14th. Brent crude, really interesting to track oil prices, at least since the end of June, where you've seen a 20-plus rally for Brent. It's kind of sneaked up on us, this one, $88 a barrel, and expectations from traders that the Saudis will extend their cuts as part of OPEC Plus, of course, into October. So how that plays into the inflation debate as well remains consequential. So we keep an eye on the oil space. Let's get back to the markets, though, or stay on the markets and get more detail, more analysis with Bob Elliott, Unlimited Fund CEO and CIO, joining me now. And Bob, I just want to cast our eye back to the jobs data out of the US on Friday. One interpretation of it was this was a Goldilocks jobs print in terms of where the Fed is standing. You're starting to see cracks in a US labour market that has remained so resilient for so long. Talk to us about what stood out to you.
Well, I think if we look at the holistic set of labor market data that's out there, we're starting to see that moderation in a bunch of different places. Of course, the headline numbers have come down. We're adding only just over 100,000 jobs a month, particularly when you take into consideration revisions. But you're also starting to see weakness in other areas, leading areas like the Challenger Job Cut Survey, which showed, basically back to highs for the year. You also are seeing it in the JOLT survey, where basically every measure that you're looking at is starting to soften there. And in ADP, which was also a bit soft. And so you add that all up together, we definitely have a downward momentum that's beginning in the labor market. And the trouble is, once you start to get that downward momentum, that weakening, those are the sorts of things that are typically self-reinforcing. So we might be right at that turn. It's been a long 18 months of strength, but we might be starting to see the beginning of that weakness.
And maybe this is the tip of the iceberg when it comes to this jobs market. What is the read across then for the Fed, Bob? Is it enough in terms of the weakness that you've started to see and you've identified for the Fed to pause and have confidence in that pause?
Well, I think the Fed is going to pause pretty much no matter what. They've outlined that. They're waiting to see, given the magnitude of their hikes, how exactly that's flowing through. Now, just because they're pausing doesn't mean that it isn't an effective tightening, because priced into the markets in 2024 are a bunch of cuts. So to the extent that the Fed just takes it easy, stays level, and those cuts start getting priced out, that's actually an effective tightening that's going on. I think that's probably what we're going to see, a wait-and-see approach from the Fed, because while we are seeing some weakening in the labor market, it's still secularly strong, and those wages are still elevated, right? The wage inflation is still elevated, and that's a particular concern for the Fed when it comes to thinking about structural inflation pressures in the economy.
There was a line coming through from UBS's Mark Cafali on the prospects of a softish landing for the US economy. You're not in that camp, Bob. You think it's going to be slightly more painful for the US economy. Just expand on why the calls around a soft landing may be misconstrued at this point.
Well, I think if you look at the markets right now, the markets are all in on a soft landing. You have equities that are pricing at a 12% earnings growth next year. You've got modest cuts being priced in, expecting the Fed to ease in response to moderating inflation. And so markets are all in on soft landing. The reality is that it's very, very difficult to achieve a soft landing. Not impossible, but very difficult. And particularly when you start to get that downward momentum that's going on. And with a Fed, this dynamic today is very different than, cycles, earlier cycles where the Fed could cut immediately at the first sign of softening growth. Here, we've still got that inflation pressure. Wages are still growing at 5 to 6% on a matched basis. That's too high relative to productivity growth at 0. And so what's probably going to happen is, as we start to see this weakening of the economy, the Fed is not going to ease like many people expect. And so that's going to make it very hard to achieve that soft landing. Certainly harder than essentially the 100% probability of a soft landing that's currently priced in.
So where does this relative caution, Bob, take you in terms of positioning? Are you taking money out of the tech stocks, out of the NASDAQ? Are you positioning into safe havens? What is your positioning bias weighing up all this macro data?
Yeah, I think you've got to look particularly when you're going into the equity market. First of all, stocks, the S&P 500 is pricing in 12% earnings growth. The bond market is pricing in cuts. Those are inconsistent. Probably both are too elevated right now. Odds are we're going to see less earnings growth than what's priced into the equity market and fewer cuts that are priced into the short end of the market. But I think then when you go under the hood and look at the equity sectors, you've got to start to look at, what the pricing looks like relative to the responsiveness of a weakening economy. And you've got, high-flying tech stocks that are pricing in near perfection in terms of outcomes. Those are the sorts of areas that are probably going to be most sensitive to a bit of a weakening in the economy. We've started to see that a little bit. And then you compare that to other areas, for instance, in the commodity complex and oil-related stocks and materials-related stocks, where they're pricing in essentially a terrible outcome when those markets are starting to tighten up a little bit, and we're starting to see upward pressure in the materials complex and in oil. And that's further exacerbated by the fact that, if China comes online, that will be even further supportive to those stocks. So you've got real dispersion in terms of both the pricing and the underlying fundamental momentum.
Where is your regional focus, Bob, at this point?
I think it's got to be outside the U.S. There's no value left in the U.S. You're seeing stocks priced to perfection in a late cycle period with tightening and elevated inflation, and that almost always aligns with a weak outlook for stocks. You compare that to other areas of the world, particularly the emerging markets, which are already into easing cycles. Many emerging markets are into easing cycles, plus those economies that are closer to the U.S. are benefiting from the friendshoring dynamic or the nearshoring dynamic. And so those economies, those stock markets look more attractive, say Latin American stocks. And then even if you look at a place like China now, I think there's some ambiguity about whether or not this is the set of policies necessary to reopen the economy. But regardless, a terrible outcome is priced into Chinese equity markets. And so even a moderately good outcome and some stimulation from here is probably beneficial to those markets.
Really, really interesting. Yeah, there's been a lot of bad news priced into Chinese stocks. US stocks looking like they're priced to perfection, maybe looking to EM and LATAM as an opportunity. Bob Elliott, the calls there coming through from Unlimited Funds CEO and CIO. Really appreciate it. Go enjoy your Labour Day. Go and enjoy those hot dogs. Thank you for the analysis and the insight. Coming up, talking of oil heading steady and near its highest level since November. More on what's driving the bullish activity in the oil market. That is next. This is Bloomberg.
Opportunity.
People.
Things get done.
Before, I never did business in Georgia. I was amazed what kind of opportunities. There are many of them here.
Very little bureaucracy, simplicity of doing business.
You have access to markets, finance, and authorities.
It's perfectly located logistically. We have the biggest suppliers nearby.
EBRD has invested 4.6 billion euros in 270 projects, and I think that speaks for itself.
Georgia.
A pleasure.
Doing business.
Welcome back to Bloomberg Markets. I'm Tom Mackenzie here in London and European HQ. Oil, meanwhile, of course, steadying close to its highest level. Just checking in on Brent right now, trading at $88.59. Flat in the session so far. WTI at $85. This, of course, all since November on expectations that OPEC Plus leaders will keep tightening the market. We had the news, of course, last week around Russia and its extension of cuts. Bloomberg senior executive editor for energy and commodities, Will Kennedy, joins me now. Will, there is an expectation amongst traders within the oil space that the Saudis will also extend their output cuts until October. What is the thinking behind that? Why is there this confidence that the Saudis are going to go ahead with further restrictions in terms of output?
Because I think that OPEC Plus is determined to assert its control over the market, that they feel that there are reasons why there's been a little bit of concern about prices, uncertainty about the Chinese economy, more oil coming out of Iran, for example. So both on the demand and the supply stuff, there are reasons why they want to keep control of the market, and I think most traders expect that Saudi Arabia will want to probably do another month.
They say that they don't target a price, but we're closing on $90 a barrel. Is that the kind of level that would maybe compel, if it's held there or around that level for a sustained period of time, that would compel the Saudis to think about relaxing output? What is the level that gets the Saudis back into this market?
I'm not sure what the precise level is, and as you say, they don't tend to ever talk directly about price. I think that if you look at the Saudi budget, they probably want something closer to above $90 rather than below 70, but that's a fairly obvious thing to say. I think what they do want is to make sure that the market isn't oversupplied and that we get prices fall back from here. I think they want to feel confident that the market is better balanced and they can put those million barrels back into the market without seeing prices fall away.
Is all the headline negativity around China distracting from the fact that actually Chinese demand is holding up relatively well? How are you reading the Chinese demand?
Well, I think that's been very interesting because there's a big oil conference happening in Singapore this week. It's called APEC. It's where all Asia's oil traders get together to talk about the market, the year ahead, to do deals. And what we're seeing from there is people are saying, yes, so there are clearly issues in the Chinese economy, especially in the property sector. But from what we can see, demand for crude oil is holding up very well. And I think that reflects both the sort of different aspects of the Chinese economy, and that a lot of gasoline demand, for example, is consumer-led, and also that China has built a lot of refining capacity and is taking crude oil to refine it and export it. So there is a degree of perhaps slightly surprising optimism from people at the centre of the oil trade about the strength of Chinese demand.
The US and shale, is there any sense that shale, US shale, is going to be an increasing factor in the next 6 to 12 months as prices push slightly higher? Are we at more of a tipping point? They complain about labour shortages, but there is this lack of capex. Is that starting to change? Anything material when it comes to US shale?
Well, I mean, I think the story of this year is that people have said that the shale industry is tough and they're concentrated on returns and that it's not the business it used to be. But when all's said and done, output has continued to rise through the year and it has put more oil into the market. I think people will be interested to see how that develops, particularly, as you say, in a higher price environment when perhaps that will drive people to push production a little bit. But the key question is how much it slows and flattens off going into next year, which is what people would look like, because it's clearly been part of the supply story this year. People will want to know what sort of role it's going to play in 2024. OK, Will Kennedy, thank you very much indeed for breaking down the latest trends across these oil markets. Executive editor, of course, for Oil and Energy, currently trekking in on Brent, $86, $88.62, just a gain of 0.1%. WTI at $85 a barrel. Still ahead, Apple embraces new technology it did not want. The change will come with the new iPhone 15. The details are next. This is Bloomberg. Welcome back to Bloomberg Markets. We are about a week away from Apple's annual product upgrade event. It will unveil the iPhone 15, which is expected to use chargers compatible with billions of non-Apple devices. Bloomberg's Alex Webb joins me with the details. Alex, why are Apple doing this finally?
They're under a certain amount of duress. The European Union basically has said that there has to be a standard for charging, and they are forcing everyone, essentially, who makes electronic devices to convert to USB-C. That's the kind of, long, looks like a sort of lozenge, but, about half a centimetre across. Yeah. That is what Apple is going to adapt. That's ultimately also going to come to laptops, that all laptops will have to use USB-C. As I'm sure you have, any number of different cables to charge your mobile phones and smartwatches, whatever. That's obviously very wasteful. They're not transferable between different devices. That's what the European Union is trying to close. And finally, Apple then has clearly said, well, rather than trying to come up with different supply chains for different regions, let's just give it to everyone.
Do you have that? I've had that box at home, just full of cables. And
just the one
box?
box?
Like, just get rid of the box. Like, no, because we may need them, and I never need them. What else are you looking for from this event? What other product launches are Apple, or do Apple have up their sleeve?
Well, this is usually the time where they would show off a new Apple Watch. I think, look, as ever, the focus is always going to be concentrated on the phone, right? Because that is the big revenue driver. So it's going to be. They talk about travel in the Wanderlust in the release. Look, we're going to be keeping an eye out on our colleague Mark Gurman's reporting. He generally has very good previews and everything to expect. A little bit more in the phone. It's going to be a slightly thinner bevel, which, you know, it may get some people excited. Seems a little bit, you know, iterative in terms of innovation, but. Yeah, the main thing that people are talking about right now is the charging.
OK, I'm surprised you're not more excited by the thin bevel, Alex. Briefly on how the demand for smartphones is holding up, because we've seen this reflected in the chip space, the commodity chip providers at least. How badly affected is Apple, and are they seeing anything of a turnaround in terms of demand for their iPhones?
So the unit sales have not been brilliant. Apple doesn't actually break out unit sales anymore, but inferring from some of the data, it looks as though unit sales haven't been good. They have been obviously inching prices themselves higher. That's managed to not ensure that the declines aren't all as significant as they might otherwise be. But crucially, of course, they've got the services revenue, which is increasing. And the services revenue is two parts. Of course, it is a higher margin business on the whole, because it's basically software that they're selling or licensing. And secondly, it ties people to their devices, right? So it means then that even if the next iPhone and the one after that don't have significant upgrades, it is way harder to justify trading that device in for an Android.
So, I mean, I'm just going to interrupt to say, yeah, arguably, as you're kind of illustrating, it's the services component arguably is a little bit more interesting right now for Apple. Alex, thank you very much for the preview and the details around some of these functionality changes as well across Apple's products. And what to look ahead to around that event. Let's get to the auto sector now. So from smartphones and tech to the auto sector, and the two blend to some extent. Mercedes-Benz is taking on Tesla. It's unveiling an EV with a longer range than any Tesla model on the market. Speaking earlier with Bloomberg from the International Motor Show in Munich, the company's CEO spoke about the strategy.
Our goal is value over volume. So we're not pushing volume. We're very, very careful about how we go to market, our go-to-market strategy. And as you can see from the results for the first 6 months of this year, that has been working quite well for us. We're focused on value for the customer. I don't think the customer expects from a Mercedes a little bit of a roller coaster ride, but something that you can depend on. So we will continue with the value over volume strategy.
OK, Bloomberg's Craig Trudell joins us. Has been watching, of course, all the developments out of the auto show. There's been a lot, actually, on the docket, and a lot of focus on some of the Chinese automakers, with a big, of course, concentration of EV makers over in Germany and their plans to expand into the European market. Craig, let's start with the Mercedes challenge to Tesla, though. How significant is Musk going to be quaking in his boots at this development, or is it still part of a catch-up play for Mercedes?
Well, just to piggyback off of what Ola Kalenius, what we just heard from him, I mean, the importance of this CLA is that it's both value and volume for Mercedes, right? Where yes, they're going to price it at a point that's above the Model 3, especially where Model 3 has been trending. But they are going to do a lot of volume of that model relative to, some of the higher priced, bigger electric vehicles that they have brought to market already. And so it's a really important model. I do think if you're Musk, you're not necessarily quaking in your boots just yet, in the sense that it's not going to be to market until the first half of 2025. But certainly it's a compelling product and a lot of specifications that, if they can hit those numbers, absolutely make that product attractive relative to what Tesla has to offer.
Yeah, and it's a really good-looking car, and so we'll have to see. Maybe this is a step change for Mercedes in terms of how they compete with Tesla and others in the EV space. What is your take of the offering coming through from China with its EVs? How consequential is this? Can they really finally churn out and develop market share in Europe?
I think it's really interesting. We in our setup piece, thinking about the Munich show, we called this the least German car show, just because the amount of Chinese companies exhibiting this year, double what we saw 2 years ago when the show was last in Munich. And so, absolutely, we know that they're at the show in force this time around. In terms of volume, I think what we've been seeing is actually a reluctance on the part of most brands to come in with vehicles priced, in the same neighborhood of what they've been offering in China. And I think they are sensitive to the fact that, if they come in here and crack a lot of heads, that it's going to, really raise some eyebrows among regulators. And we know that this is a very sort of nationalistic industry, particularly here in Europe. And so we're seeing, the products that has managed to win market share to a significant degree in China, priced much higher to where, we'll see how much of an impact they have in the near term.
What else has stood out to you from this event?
I think BMW, the Neue Class concept that they have, it's a very similar story to what we saw out of Mercedes, a sort of entry-level sedan in the BMW lineup that's going to be really significant, similar to Mercedes, coming in 2025, so a bit off in terms of time frame, but that's going to be really important, and it's really sort of out there in terms of look. I don't know that it'll be for everybody, but it's certainly unique and different from what we've seen out of BMW. And I think in terms of the Germans, I think it's a bit of a disappointing show if you're VW. There's sort of warmed over concepts. The ID.7, to their credit, is headed to production, but we've seen that at CES. We saw it in Shanghai earlier this year. So not a whole lot on the VW stand to get excited about.
Despite their huge portfolio of products,
yes,
and brands and models. Okay, so nothing that really sizzled from VW. Thank you very much, Craig Tudell, walking through some of the key developments across the auto space. And of course, we've been speaking, Oliver Crook has been speaking to a number of the executives on the ground for us and bringing us the highlights from that event. Coming up, more from Germany's biggest auto show, Nikolai Setzer, the chief executive of tyres and auto parts company Continental. That's going to be interesting in terms of the inflation story and supply chains, and China as well in terms of demand for their products. That interview is coming up next. Just briefly checking in on European equities as we look at gains holding up at 0.3% across the European benchmark. Futures in the US, S&P E-minis pointing up to just a gain of about 0.1%. Nasdaq futures up 0.2%. Stay with us. This is Bloomberg. Welcome back to Bloomberg Markets. I'm Tom Mackenzie. Now, Germany's biggest car show is underway in Munich. Bloomberg's Oliver Crook is there with the CEO of tyres and auto parts company Continental. Ollie.
That's right, Tom Mackenzie. We're joined now by Nikolai Setzer. He is the CEO of Conti here at the Munich Auto Show, originally known for its tires, and now really sitting at the center of where hardware meets software. They have an announcement today of Google, with a partnership with Google. Tell me a little bit about that.
So, we are using artificial intelligence as well on the tire side since long, in product development, in production, in testing. And now we are bringing AI, generative AI, together with Google, with our high-performance compute into the car so that the consumer can interact intuitively with those functionalities which Google offers already today, as well outside of the car.
So in terms of concrete, because we talk about AI and it stays very abstract for a lot of people, how is it going to affect the car for me? If I buy a car, in 5 years, how is AI going to change my experience of that car?
You can talk to the car, you can ask every question, you get an answer, which might be on your travel, where I am, what can I do, what is the next trip, how are my tire pressure on the left side, is there any issue, where do I find what in my car? So you have the partner once you want it, and this partner learns over time. They learn how you speak, what you're doing, and as long as you want to share it, you can share it. So using the total environment of the car, as well as using the internet, you're always connected via the cloud, you're there. So you make it somehow your living room, or wherever you cruise, it's all combined and merged.
Right, and that's talking sort of further into the future of the auto industry. Right now, when we're talking about sort of how the outlook is looking, there's a lot of pressures on the auto sector and on the economy more broadly with rising interest rates. How are you seeing sort of order flows? How do you see the sort of moment for the next few months rather than the next few years?
I mean, still for this year, coming out of the pandemic, the global vehicle market is growing by 6%. So you would still say that is a solid growth coming from a certain level. However, we see right now with other technologies here, it's not so much anymore about the volume of the car, it's about the value which you deliver. So there is more and more technology, more value, more innovation coming into the car, which is needed for sustainability, smartness, and assisted driving. So the future is relatively technical.
And you touched on something, because there's really two transitions happening right now in the auto sector. There's the EV, the electrification. We tend to conflate that with also the digitalization of the car. But the EV, as we know, is a lot less complex. The car requires a lot fewer parts, something that really you stood in the center of. How are you adapting your business to that new simpler EV model?
It's simple on the powertrain side, yes. And we spun off our powertrain business, by the way, in 2021. If you look for other products in EV, it still has lots of hardware. 4 tires, for instance, which are getting more sustainable, which are getting more smart, and which are getting more technically. And software. Software increases independent of the powertrain, by the way, but electric cars offer as well opportunity. Electric brakes, for instance, brake-by-wire, which will come as well here. And in particular, the complexity there on the software of what the user functionality can use. This is growing day by day.
And when you look at the biggest sort of growth areas regionally, what are you seeing right now? What is the biggest sort of growth opportunity for Conti right now?
As I mentioned, there are some preconditions which everybody has to do, such as sustainability, making the world a better place. That's what we are striving for. And there it's in particular the smartness, assisted automated driving. So we offer there our sensor suites. We are going in cooperation with chip makers, and we're working further. And we announced, for instance, automated driving for level 4 trucks. Being in the US, having hub-to-hub trucking, which we can, together with our partner Aurora, automatically steer. So those are new growth opportunities, you might say, on the one hand. On the other hand, they're making the world better because it's much more efficient to drive 24/7 on those highways, steered operationally safe via our common system.
And you talked about the spin-off of the powertrain business. Conti Tech, you're looking at perhaps spinning that part of your business off. Explain to me sort of that and how that fits in your strategy.
I mean, first of all, we have reorganized Conti Tech, focusing on industry, and we have generated via that an own, basically, to be independent part of original equipment solutions within Conti Tech. What we will do later on with this is not decided yet. So we review best ownership. How can we develop it in the right way? Do we find partners if we need them? Like I just mentioned on the chip side or Aurora part, we are open in the ecosystem to find and make each piece of our company better. If we see that we are the best owner, of course, it stays with us, and we are more than happy to develop it further.
Alrighty, and one of the big themes here has been a lot of the Chinese automakers that are really making, in some ways, their debut in Europe, really trying to get in front of the European clients, and eventually, if they want to get serious about selling cars here, they will have to establish factories and manufacturing. How do you think Continental can capitalize on that as these Chinese automakers come into the European market?
In the meantime, we are since several decades in China, and our business with Chinese OEMs has grown over time, and more functionalities, products of us are getting into Chinese OEM vehicles. On the other hand, as you mentioned, we have a global footprint. We have a strong legacy in Europe and in the other markets. So if those are coming into those markets where we have legacy, where we have an offer, we are more than happy to serve them with our knowledge on the R&D side, homologation side, as well as with our footprint. So there might be an opportunity. Be our guest, we're here.
Right, and so I was reading a note that UBS put out on Friday, which really gave a sort of stark appraisal of legacy automakers, and said they would also affect the supplier side of it, really because a lot of these Chinese EV companies make a lot of their things in-house. Is that a concern that you think about? Where does that go into your thinking?
At the end, we are used competition. We have so many competitors in the market, and we are competing as well with in-house development, production, or whatever. If we offer more value, they will come to us, and we are more than happy to offer our products. If others can do it better, be it in-house or another competitor, then we have to get on our toes. We have to go into the fitness gym and come either with more competitive products or with more technologies and values to offer. So for us, it's just we are adapting to the new reality. Exactly.
And the future of the car, let's go a little bit more abstract, a little bit further out. You know, for me, from what I hear from all these executives and we see a lot of tech companies here, the future of the car seems to me it's closer to the iPhone mixed with your living room. Help us dream a little bit about what the future of mobility looks like.
I already mentioned the living room before. I cannot more than agree. And that was consumers want. They wanted to have it more comfortable. You see as well by far larger screens, so there's large displays, which you have the feeling it's an entertainment on the one side. On the other hand, it helps you with assisted driving, obviously, getting comfortable, safe to your area, more sustainable. So the car is becoming more an intuitive part. It's less going from A to B. Yes, you do this, but you do it in an environment which you enjoy, which is safe and sustainable.
And with that, do you think that there's going to be less car ownership, more of a sharing economy? Where do you think about that in terms of the future of automotive ownership?
We have seen during the pandemic that individual mobility and owning individual mobility was an important part for the individuals. How this goes further in the future, will it be more shared or not, remains to be seen. However, this period has proven that individuals, and this was across on the globe, really value having an own individual mobility device, still using as well others, so it might be a mixture. How it will be remains to be seen.
And I think we all remember when we got our driver's license, drove a car for the first time, the sense of freedom. I've been asking every CEO I've spoken to, what was their first car? What is the first car that you drove that you learned to drive on?
For me, it was a scooter, which I did first because I had not enough money and could afford another car. And then it was a smaller car, and I developed myself towards the upper side.
Okay, great. Well, that's the Conti CEO, Nikolai Zetzer, who's joining us here from the Munich Auto Show. Really ground zero for the battle of the BEV. I'll send it back to you.
Wait, hang on, Ollie. What was your first car?
My first car was a 1993 Volvo station wagon in fire engine red, and I will tell you, it is still running today.
Love it. Fire engine. That's a big car as well. Ollie Crook on the ground for us in Munich. Thank you very much indeed. Excellent coverage. We appreciate it. In the next hour, Polestar's CEO will be joining Ollie with another really interesting interview as well. An electric vehicle company, of course, owned by and part of the Volvo brand, owned by the Chinese company Geely. Coming up, ECB President Christine Lagarde says the euro area is in an environment of too high inflation. Well, we know that, but there's been a few more details from her speech, which lead up, of course, to that all-important announcement and decision from the ECB. And it's going to be very tough, that call, on September the 14th. We're going to have more as well from Jeanette Garrity of Robertson Stephens Wealth Management. That is next. This is Bloomberg.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
Welcome back to Bloomberg Markets. I'm Tom McKenzie. Let's get more analysis then on this global economy and start with the jobs picture. Let's bring in Jeanette Garrity, Chief Economist at Robertson Stephens Wealth Management, joining us now from San Francisco. Jeanette, thank you for joining us. As you pass the data that came through on Friday from the jobs picture stateside and look at how you tie that into your view in terms of 2024, how has it informed where you think the economics of the US will be in 2024 and the resiliency or fragility that's coming through now from this jobs market?
It's resilient, but it's pretty much doing, I think, what the Fed here in the United States wants it to do, which is to slow down some and come back into, in the famous words of Chairman Powell, better balance. That question about 2024 is an interesting one because the issue that we're looking at here is despite a very strong job market that is keeping personal income up and therefore fueling spending, there still seems to be a pattern of consumers consuming off of what we're calling excess savings, higher levels of savings in bank accounts. And most of us expect that that excess, such as it is that's there, will not be a factor going into 2024. It'll have disappeared. So it will be very much dependent on the job market and continuing to be strong in 2024. I think it will. What economists do is often when they don't see a recession when they expect it, they kick the can down the road. They say, well, it's coming, and it's going to be out there. A lot will depend on whether the U.S. economy can continue to weather, as it has thus far, these higher interest rates, because I do expect those interest rates to stay high well into 2024.
Well, in that environment of higher for longer rates, where do you expect the pain point to be most acute? Is it corporate balance sheets? Is it a need to reissue debt? Is it indeed the consumer? Is it the real estate market? Is there an area of this economy that you're particularly focused on in this higher for longer rates environment?
You kind of named them all. In particular, I think here, what we're all very focused on is commercial real estate, because there's a great deal of refinancing that needs to happen over the next couple of years. Having said that, a lot of that refinancing would be beyond 2024. So we're watching that carefully because also of the impact that that has on the banking system, on regional banks, which are holding a lot of those loans. So the big question there, housing continues to be of great interest. We're now at a definite pay point in terms of mortgages here in this country, and mortgage applications have fallen substantially, but home prices have held up. There's still tremendous demand there and a shortage of supply. I think my biggest concern is actually, kind of anything that is highly leveraged. So it's hard to pin that on one sector. Whether it be a consumer or in a business sector, it's kind of everywhere you look. Companies or individuals that have positioned themselves to be extremely dependent on debt, it's going to be tough. It already is tough. So the growth that we're seeing and the employment growth we're seeing right now in the United States is happening despite the fact that there are already those pain points out there. I just think they're not going to go away.
Jeanette, when you switch focus to Europe, and of course the dollar plays a role in this, and we've had some lines crossing from the ECB President Christine Lagarde just in the last few minutes talking about the inflationary impacts across the Eurozone, saying the ECB will achieve a timely, and of course question marks over what timely means, a timely return of inflation to 2%, that the Euro area is in an environment of too high inflation. When you think about the European Union and this apparent determination from Christine Lagarde and certainly others on the ECB Governing Council to continue with higher for longer in the euro area, how concerned are you about the health of the Eurozone economy? We're seeing the fragilities come through from Germany.
Yeah, and it's interesting that you mentioned Germany, because Germany, I think it's both the weakness in the domestic market, but also what's going on in China, and we should talk about that at some point. But Europe is in a similar but different place than the United States. So I do have, I guess, some concerns. We still see the same pattern of actually very strong consumer spending in certain areas, but overall the growth rate is clearly lower than what we're seeing in the United States. And the fact that inflation is still high, and then you have an economy like in Britain, which has its own set of issues which are dramatically different than a lot of other places, with great economic weakness and great concerns on the inflation side. It's going to be in a bit of a different place in the United States. No surprise in what Christine Lagarde said. Very strong coordination among central bankers to fight inflation.
Just briefly, before we let you go, Jeanette, that take then on China, and there have been a flurry of measures in the last few weeks. Are you becoming more convinced that maybe China as a growth driver will come back in the fourth quarter of this year?
They're not posting per se negative numbers. It's just their version of a recession, which is not meeting their expectations. The growth is there, but I actually think that this slowdown, this what they would call stagnation, these economic problems domestically are going to continue, because I do not think that the Bank of China or the government is really going to do much about this situation. If they were, it would have happened already. So I think this is a new environment for China and for the world, a much slower growth rate, a higher domestic unemployment, and problems in getting domestic demand up. I think that's going to be with us for a while.
Well, I think isolating the short term from the longer term is really important, and you put your finger on what many people now think about China and the trajectory of growth there and the challenges. Jeanette Garrity, Chief Economist at Robertson Stephens Wealth Management, thank you very much indeed for the analysis and the take on the US economy, the Eurozone, and of course the input coming through from China. We're going to get you live pictures now of the President Biden, of course, as he marks Labor Day
guess what?
We can listen in briefly. He's there in Philadelphia.
America has the best workers
celebrating
in the
Labor
world.
Day.
That's a fact.
And as you can hear, honouring
You guys ought to
America's
talk
workers.
about it more. It can take 4 to 5 years to train as an apprentice. It's like going back to college. The jobs are constantly changing. The technology evolves. You have to keep stepping up. You have to get more training. You can't, so you can't be the worst in the world. You're the best in the world. No, I really mean it. You know, like the sheet metal workers who used to use hand-drawn blueprints to design ductwork in buildings. Now use sophisticated computer-aided design systems so the entire project can be laid out in 3D. It ain't your father's sheet metal workers. This is a different world, man. You do the job right and you do it on time, and it costs less for the guy you're doing it for.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
Welcome back to Bloomberg Markets and to geopolitics now. In Ukraine, President Volodymyr Zelensky has announced his most significant wartime cabinet shake-up yet, replacing the country's defense minister, Oleksiy Reznikov. It comes as Kyiv ramps up an anti-corruption crackdown and continues its counter-offensive. Bloomberg's Maria Tiddo spoke with Zelensky's chief diplomatic advisor about the cabinet moves earlier today.
Minister Reznikov has done a very good job for about more than 500 days of the wartime. You see that Ukraine is now gaining the arms, it's gaining the support, it's gaining the ammunition. This was not happening, unfortunately, before the open aggression of Ukraine, and immediately after the open aggression of Russia to Ukraine. Only after several months, we started to receive in numerous amounts this what we are receiving now, and that's what allows us to have made already several major counteroffensives, and now, right you are, we are having another very important counteroffensive, which is going on as it goes on. I mean, this is not a Hollywood movie. You cannot do it within one day. But very important, this is going on. So the president is making his decision. He is absolutely right. He's chief military commander of the country. So we are hoping that the tempo of the counteroffensive will be increasing, and definitely Ukraine needs to achieve very significant results in the near soon.
And Mr. Shovko, just to end on this subject, of course, a counteroffensive, the defense ministry is important for a lot of the contracts and supplies, but it really is the generals that handle the operation on the front line. Is this going to have any impact on the counteroffensive, do you believe? And I wonder, too, your foreign minister, Mr. Kuleba, last week, he was very open about what he believes is too much criticism, everyday commentary on how this counteroffensive is going on. And he said, again, it doesn't play on Twitter time, it's happening in real life, and critics will be proven wrong. Do you feel perhaps there's too much negativity about this counteroffensive?
Well, again, like you said in the beginning, I'm not directly involved in the planning of the counteroffensive. That's up to the military people and the generals you mentioned. I don't think there will be any significant changes in the relations on the military field, on the military field amongst the military commandment. Criticism is always at place. Ukraine is a democratic country, and you're a journalist yourself. You know how journalists like to go into any single detail to criticize, sometimes for the slow pace, sometimes that something is not happening. Let's leave the pieces and the particularity of the counteroffensive to the people, to the professionals. When the result will be in place, and the result will be definitely in place, we will be first to see and command and to commemorate the victory of Ukraine.
OK, Bloomberg's Maria Tadeo there, speaking with Ihor Jovka, the chief diplomatic advisor to Ukraine's President Volodymyr Zelensky, on the operation on the ground, of course, the counteroffensive by Ukrainian forces and that decision by the Ukrainian president to replace his chief military head. Checking in on these markets, European markets are currently holding on to the gains of the day this Monday, gaining 0.3%, so still on course to snap 3 days of losses for European stocks. The sentiment, positive sentiment coming through from Asia and from China in terms of the stimulus response measures, and also increasingly an expectation that maybe the Fed is positioned to pause at its next meeting, lifting European sentiment. US futures pointing higher by about 0.1% on the S&P futures. Labor Day holiday, of course, closed. Markets reopening on Tuesday. Euro dollar at 107 and Brent gaining 0.3% at close to $89 a barrel. Coming up, Catherine Avery, CEO and President of Catherine Avery Investment Management, joins us with analysis.
It seems more and more high-stakes decisions are ending up in my hands. While still at the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
Welcome to Bloomberg Markets. I'm Tom Mackenzie here in London. Let's check in on these markets then. European stocks holding on to gains for the Monday, currently up 0.3% across your sectors. Top of the list, technology gaining close to 1% in terms of sectors. At the bottom of the list, insurance currently down 0.4%. So that's the benchmark move, higher by 0.3% across Europe, on hopes that stimulus may be starting to have an effect now coming through from China and the policymakers in Beijing, and an expectation that maybe the Fed has the room to pause at its next meeting. US futures currently at 4,526 on the S&P E-minis, pointing to just modest gains of about 0.1% after the best week last week since June. Euro dollar at 107, a gain there of 0.1% for the single currency. Yields, by the way, in terms of Eurozone sovereign debt moving higher in the session. The debate continues, of course, amongst ECB officials leading up to that September the 14th decision. And Brent crude, close to $89 a barrel, again, a 0.4%. Worth noting as well that for the context, you've seen upside of plus 20% since the end of June for oil. That's a brief check in the markets. Let's get more analysis now then from Sophia Horta-Acosta from our Markets Today team and Noor Al-Ali from Bloomberg MLive joining me now. Great to have you both for the take on this. And Sophia, obviously you bring that expertise on China. I want to start with that because there has been this sentiment across equity markets today. You saw it pronounced, of course, in Asia, and then the follow-through to Europe, that maybe some of these granular piecemeal measures that come through in the last few days and weeks are starting to have an impact, and there is a bit of optimism. Talk us through whether you think that's going to be sustained.
Yeah, and Tom, why this optimism today versus Friday when the measures were actually announced? It's the evidence that we got over the weekend in China that people were actually rushing out to buy homes. I just want to bring you this just to show how busy it was for property brokers in Beijing. Existing home transactions doubled on Saturday from the prior week. And in Shanghai, the number of new home transactions in one day was equal to all of those in August. So essentially, state media propping this up, really highlighting this. And Tom, you know that when Chinese state media highlights this, then it's something that clearly local authorities want to highlight. You know, this is working. People are actually going into the property market, not just new homes, but also existing homes. And really, there seems to be a little bit of a sentiment shift, because if this really does happen, then there's a fall through across the consumer sector. So we will get consumer spending again. There's a sense that retail sales may actually not be as bad. And then, you know, China's economy will actually kick into gear. So Is this the time to finally believe in the stimulus measures and that they're working through China's economy? Markets seem to think so too.
And I think you highlight a really interesting point, which is of all the policy measures, it's the first time the rhetoric, the policy measures being announced, it's the first time we've seen material behavioural change on the ground. So the next point then is, are we watching, in terms of to maintain this and sustain this, what do you think is going to be more important? Is it the data that comes through or additional policy measures?
I do think we need to see hard data, and you saw, Tom, the impact that those PMIs that were better than expected, even though it was on the manufacturing side, not services side, that really started the conversation last week. You know, when you and I were talking on the show that, you know, actually China's economy may be better than feared, and if we do see a kind of follow through, see these policies work, I think that will really kind of change, that could really change sentiment. But I think markets still want more. I think markets are constantly calling for more stimulus from China, especially kind of outside the region when there is a little bit of a misunderstanding. Why does China kind of not just throw more stimulus at the economy if it has all these levers it can pull? I think you make a really good point that it's just using the kind of old lever of the property market again, which is not the most sustainable way to grow your economy. But again, it's what markets might want to see. You're seeing that feed through to the commodities market. It's good, obviously, for the UK stock market, given its dependence on China. And I just think it feeds into that mood that actually the global economy will be fine, and and we'll get those central bank pauses after all. So yes, it's a good start to September.
And you tee up Noor Al-Ali very, very nicely indeed. Noor, let's bring you in at this point then on the question about central banks, on the question of central banks. Do you think are markets right to be kind of sidelining another Fed hike, at least for now? Have Fed officials seen enough to be able to have the confidence to pause at the next meeting?
I mean, that's an excellent question, Tom, right? Because we are starting to see signs that, in fact, the labor backdrop appears to be cooling. And that really adds to the discussion here and the calls that we've seen recently from bigwigs, from BlackRock to PIMCO, really talking about now is the time to really jump in on those short end yields. But I mean, I take you back to what Powell said at Jackson Hole. They are on a meeting by meeting approach. They are data dependent. And so they're going to need to see a bit more consistency in this data, especially after the summer seasonal data or the seasonal hype goes away. Unfortunately, we won't get that before September. We know that the Fed is going into its blackout period next weekend. And so I think this gives the markets room to run with that momentum that we're seeing. And though I do point to you as well that although, it is a U.S. market today, I'm looking at Treasury note futures, and those are trading today, and you are seeing, those prices really falling through, though, or, following in line with the footsteps with the European debt or the European sovereign debt market. So I do anticipate yields to push higher in the session tomorrow to at least catch up with those European bonds in the run-up to the blackout period.
Noor, do you expect that to be a relatively short-term move? I have to give a hat tip to Mark Cudmore from our MLive team on his call last week that you want to be buying the 2-year US Treasury at this point. He thinks that yields have probably peaked. And then, of course, we have BlackRock, as you mentioned, coming out with their call that maybe there's a screaming buy at the front end of the yield curve. Do you kind of align with that view? Is there next level in the sand? Are we looking at 4.5? What are you looking at in terms of the yield curve?
Well, look, it's an excellent question. And you bring Mark Cudmore, I'm in that team and we've had these discussions. And you also, I want to point out that Venram is on the other side of that spectrum as well. So it's a live debate, right? And when those lively debates come in, especially with the markets coming after the summers, that's really going to shape the narrative for the rest of the year. Now, I'm of the opinion that, the Fed's, if you look at the real policy rate, it could potentially be sufficiently restrictive for them to maintain or hold rates at where they are. I don't anticipate cuts to come in as soon as possible. And I also want to point, actually, we've had some notes as well from JPM, the equity analysts there, talking about the complacency that we're starting to see in the stock market as well. And if you compare it with real yields and the valuations that you're starting to see in the U.S. stock market, you'll see that they're quite lofty. So it's either that real yields are meant to follow through those valuations, which is not really likely, or that we're about to start seeing valuations being downgraded as well. It really depends. We've seen the U.S. market really maintain itself strength and quite resilience throughout the year. Now you're starting to see the labor market just starting to show some normalization. So I do anticipate that you really can't go against the momentum trade as we've seen throughout the summer. But at the same time, if the data starts pointing towards something else, that's not going to stop the Fed from continuing on its path to fighting inflation, which is what they've repeatedly said.
Yeah, the risks of finding that momentum trade, as you say, and maybe concerns around complacency in the equity market. Sophia, let's bring you back in and tie in the geopolitical line on this. And there's been some fantastic reporting from our tech team over in Asia on Huawei, where they actually serviced, or at least got a company of investigators to break apart the latest Huawei phone. And I think the top line being that these US sanctions, and of course Huawei was one of the first targets in this, have been maybe less effective than maybe US officials would have hoped. What's your kind of takeaway in terms of the ability for China to adjust to these restrictions, and what the Huawei story tells us in terms of the geopolitics between these two nations?
This is a fascinating story, Tom.
Yeah.
I mean, I think the fact that SMIC, so that's the chip maker that's powering these Huawei phones, both Chinese companies, of course, both restricted in some way by the US. The fact that they can produce advanced chips, a lot more advanced than perhaps the US had anticipated, so soon after those sanctions were imposed, for me, this suggests that actually people are underestimating China's capability to catch up to technologies. Again, this is not the most advanced technologies that the US has access to, so that China is still in some ways behind, but it's taken a lot less time to catch up. So the fact that the US is trying, there's kind of leading a global campaign, it's not just the US, it's also its allies, to kind of cut off China from the most advanced technologies. Will that even work if China can make these technologies within China? So we don't know how advanced these are, how cheap they can be made, and at what kind of scale and volume. But we do know that at least this smartphone is a lot more sophisticated than people had perhaps anticipated. It's selling quite well. It will sell quite well in China, and it's powered by a Chinese chip. So
and suggestions that maybe that window has closed to around 5 years in terms of the most cutting-edge part of these chips and that sector. Thank you, Sophia Horto-Acosta, with the context, of course, on the measures that come through from China, the implications for these markets. And Nora Ali, of course, from our Bloomberg MLive team on this rates environment and the next steps for these central banks. Coming up, we're going to have more on the markets with Catherine Avery, the CEO and President of Catherine Avery Investment Management. That is next. This is Bloomberg.
Trust is probably not the word I would use. We need to see action. And until we see action, there can be no trust.
OK, that was US Commerce Secretary speaking, of course, Gina Raimondo, about her visit to China in an interview on CBS's Face the Nation yesterday. For more, let's bring Catherine Avery, CEO and President of Catherine Avery Investment Management. Catherine, thank you for joining us. What really stood out for me from Gina Raimondo's visit was this line and her warning to her Chinese counterparts that China was becoming uninvestable in the eyes of some US executives. I wonder how you think about the geopolitics and the risks around China as you position in the months and years ahead.
Well, I think the real question for us and what it really means to the U.S. equity markets is China's ability to get back on its feet economically. As you mentioned before, it looks like we're seeing some good improvements in the Chinese housing market, and that's good, I think, on all fronts for us here in the U.S. Because, China doing much better gives us much more confidence here. And that China has a lot of exposure and a lot of U.S. multinationals. It's good for U.S. profits here as well, for our companies in the U.S.
Yeah, indeed. So the importance, of course, of seeing China enact those policy measures, and certainly Europe is very exposed as well, of course, to what happens in China. Back in the US, though, or at least switching focus back to the US, Catherine, are you concerned there's been some warnings again about the complacency in these markets? US equities, of course, had a bit of a rough August, but last week was a pretty decent week for US stocks. Are US markets looking through some of the concerns, some of the risks, and is there complacency?
Complacency I would say yes. When you take a look at the valuations on the market, yes, at about 20 times this year's forward earnings, yes, there seems to be a little bit of complacency. As you mentioned, we came off of a very tough August. People were concerned about Jackson Hole. They were concerned about China. But coming into September, we got some decent numbers from the JOLTS. We got a nice employment number, which was all good news, for the doves out there. But, our expectation is about that these numbers are not going to be a smooth sailing going forward. You're going to see a lot of discrepancies where we have pockets of strength in the economy, pockets of weakness, whether or not the inflation numbers continue on that downward trend. So far, it's looking like that. But I will caution, in July and in August, we did see an uptick in energy prices. And now if China does come online with that strength, we're going to probably continue to see energy prices rise. However, with that, I think that there are some places in the market that you can really take a look at to either that have to catch up or to help ride you through those waves, because what we've come through has been an earnings recession, I believe. Okay, we do think that consumer will probably hang in there. We're not going to see negative GDP numbers, but we had that in the earnings numbers in the past. But as those inflation numbers start to come down, they're going to start working themselves into the profit margins of companies and into better earnings into next year. But where the caution comes is that, go ahead, Tom.
No, the warning on the earnings recession is really pertinent, of course. And so that leads me to the follow-up question, which is which parts of this equity market are most vulnerable to that earnings recession, and where are you finding resilience and companies able to maintain margins?
Right. Consumer is definitely one of those areas that we would be very cautious on. We would stick to sectors where there's opportunity for the profit margin expansion, like in what we would call staple technology that works within the overall ecosystem of the growth sectors, but you're not paying up for the stock prices. For example, like a Broadcom or an Oracle, where they're trading at 50% discounts to the overall sector, but you need the chips from Broadcom and you need the software support from Oracle to be able to create that AI ecosystem. And you're getting a dividend, and you're getting strong dividend increases. So cash flow is really important. It's going to be all about, valuation, cash flow, dividends, and quality.
So that is the rationale for being overweight staple tech, and a lot of those characteristics, Catherine, will be reflected and are reflected in the energy sector. We've been dissecting the moves higher in oil on the show today. When you look at the energy sector, are you seeing some of the similar characteristics? Is that another area where you may want to lean into in the weeks and months ahead?
That's another area. Yeah, that's another area that we are overweight in at this point in time. And given the fact that energy prices have increased in July and in August, we haven't really seen that reflected in the stock prices. Chevron's a great example of that. Where we're seeing inventories are starting to draw down. We haven't replaced the strategic reserves. China, if we can continue with the good news that we're hearing out of China, you're going to start to see energy prices continue to rise. I mean, they're already at a high for this year, but have not yet hit the highs that we've seen over the 52 weeks. So continued upside surprises in the price of oil will be good for these companies and stocks that have not participated in the overall market run that we've seen so far this year.
Okay, Catherine Avery, CEO and President of Catherine Avery Investment Management. Have a fantastic Labor Day, and making the case there for how to position in a more volatile environment with a preference for energy and staple tech. We really appreciate your insights and taking some time out of your holiday. Still ahead, we are going to head to Germany's biggest auto show, back to that auto show where the Polestar CEO Thomas Ingenlath joins us next on their latest lineup. Stay with us. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Okay, welcome back to Bloomberg Markets. The other story we are watching, thousands have been left stranded in the remote Nevada desert after heavy rains turned the Burning Man festival into a mud pit. Festival goers were told to shelter in place and to conserve food and water. The Music and Arts Festival, taking place more than 100 miles from the nearest major city, festival goers who usually only have to battle dust storms were left wading through ankle-deep mud and facing contamination from failing toilet facilities, with some opting to make the 7-mile hike out of the festival by foot. One death has been reported. However, police have not confirmed whether it was weather-related. Right, let's turn now to our coverage of the IAA, the auto show in Munich. Bloomberg's Oliver Crook is standing by with the CEO of electric car maker Polestar. Ollie, take it away.
That's right, Tom. Thank you so much. Thanks for joining us on Bloomberg TV. We have the CEO of Polestar with us right now. You had really spectacular growth last year, almost doubled your volume, some 80%. What are you seeing for this year? Can you keep that kind of rate up?
Well, look, our prediction for this year with deliveries around 60 to 70,000. Of course, that's still great growth. But clearly, 2024, 2 new cars in our portfolio coming. Of course, that will be an even bigger potential for us to grow. Yes, that's a great story.
And then in terms of the sort of macro headwinds, we've seen a lot of questions around rising rates, about demand slowing in China. How are you seeing that affecting the demand picture?
Well, there are 2 elements in that. On one hand, generally, the switch to electrification. I mean, whatever you see in nuances, there's a very clear path ahead over the next years. So, I mean, the midterm, long-term, us just participating in that swap, I think it's that great story. Now, thank God Polestar is actually set up as a company in 27 markets. And that, of course, being set up in 27 markets helps us a lot to balance out. Yeah, you always have locals up and down, certain legislation in one country coming in, coming out. I mean, there's an inconsistency in what kind of, support electrification gets. And we can, of course, through this broad footprint, level it out to a great extent.
And we've seen a lot of new competitors to Europe, a lot coming from China. Do you think the field is getting a little bit too crowded?
Well, not as a surprise. I mean, obviously, it was always clear that there will be, the competition will catch up. There will be as well the OEMs coming with electrification of their fleet. And back to your question before as well, we have our very clear setting of knowing that we will be that premium luxury brand, and that is the focus that we have. And yeah, there might be lots of brands coming, but a lot of them are just simply addressing complete different markets. For us, the competition is clear. We have there a company, Porsche, which we want to, be an electric alternative, and that premium luxury segment is not that much conquered yet.
And how helpful is it that you come from sort of Volvo, an established European brand? A lot of these companies are showing up and trying to just get attention for the very first time.
Well, again, there's one thing about just trustworthiness. Of course, being a child of Volvo gives us a lot of credibility, and customers knowing that safe product is as well valid for Polestar. On the other hand, is as well the knowledge about what you have to do to be successful in the market. It's not that easy. It's not just simply, popping up and opening a shop. The depths of understanding, especially here in Europe, of the European market, where each and every country has their own legislation, and they have very different needs of customers for financial options. That is something that I think we managed in the last years very much to invest into.
Well, Thomas Engelent, the CEO of Polestar, talking about the challenges of expansion into the EV race. We're here at ground zero of the Battle of the BEV in Munich.
Ollie on the ground for us in Munich. Thank you very much indeed. Fantastic work. Now, we're going to have more from the Auto Show with the head of the European division of Chinese automaker NIO. That's coming up. European markets currently pairing some of their earlier gains, just up 0.1%. Nasdaq futures up 0.2. Stay with us. This is Bloomberg.
The more my company grows, the more hats I need to wear. Aon brings their whole team to the table, giving me access to the great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
Welcome back to Bloomberg Markets. I'm Tom Mackenzie here at European HQ in London, checking in on your European markets. And the optimism that had pervaded at the start of the trading session has faded. And it looks like we will be ending the session either flat or possibly in the red for European stocks. The benchmark currently flat, as you can see, at 458. There had been early optimism given the handover from Asia. A very solid print coming through from the Asian session. The MSCI Asia Pacific Index ended up a little over 1%, and it was a strong session in Hong Kong as well on the back of stimulus measures coming through from Beijing. But the optimism, as I mentioned, has faded here in Europe. Yields also ticking slightly higher across the yield curve over in Germany. 3% on your 2-year. That's a move higher by 2 basis points. Slightly more pronounced over in Italy. BTP's yields up 4 basis points on the front end at 3.72 on the 2-year. Euro dollar currently trading at 107, just a gain of about 0.1%. $88, close to $89 a barrel on oil. Prices remain elevated. You've seen a gain of about 22% since the end of June on Russia cuts, of course, and expectations from traders that Saudis will extend their cuts into October. Currently, Brent trading at $89 a barrel, just gaining 0.3%. And US futures flat on the S&P E-minis as you look ahead to the restarting of trade on Tuesday, given the Labor Day holiday stateside. Nasdaq futures looking slightly healthier, pointing to a gain of 0.2%. Across your sectors, worth flagging here in Europe, travel and leisure at the top of the list, gaining 0.7%. Technology is also in the green, gaining 0.6% within that sector. Bottom of the list, utilities down 0.7%. Insurance is also off by around 0.6%. That's the sector breakdown then, again, on a slightly more muted view now, and optimism that has faded, as I said, across the European session. Worth flagging as well what's happening in the commodity space. We touched on oil, but copper and iron ore, prices now coming off for both of those commodities, despite the impetus coming through from China. And you saw a pickup in home sales in cities like Beijing on some of those cuts to the requirements around down payments and mortgage interest rates. Let's get back to what's happening on the ground in Munich now. Our coverage of the IAA car show, which has been comprehensive, led by Oliver Crook of Bloomberg, who's standing by with another important executive, Chris Chen, head of EV maker NIO and the European division. Ollie.
That's right, Tom. We're very pleased to be speaking to Chris Chen here, who's the head of NIO here in Europe, which is one of the car makers that's really pushing into this European market and really trying to establish itself. So you've launched in Denmark, you've launched in Germany, Netherlands, Sweden. What have you learned most about the European consumers and what they sort of are asking for the EVs?
Yeah, the European consumer is a little bit different from China, but not that many different from Chinese users. Actually, they care about the vehicle quality and also durability. They care about the vehicle performances in terms of the dynamic and driving. And but they there are less concerned about the digital or the space of the car. So actually, we see a little bit differences. And also, when we get to this market, actually, there are a lot of the regulation stuff we need to take care of. Like if you want to introduce the digital companion in the car, just know me, you need to care about the data privacy. So this is also something that European users will care about.
I see. And there's also the question of building brand awareness. For a lot of the companies coming into Europe, maybe not as familiar. How do you build more brand awareness in Europe to really get that volume up?
Yeah, we actually we are doing businesses different from the other brands. Okay, first we're doing the direct sales business. Okay, we don't use the dealers or distributors. All right, we do everything by our own. And the second is that we try to introduce the ecosystem to Europe. This ecosystem includes the car, the end-to-end services, and also the digital systems, and also the beyond the car lifestyle part. So actually, we introduced our chargeable, swappable, and upgradable power system into Europe. Meantime, we also built a lot of the neo houses. It's fancy with the galleries, with the clubs. People can enjoy a good time in the neo houses. We bring all of the elements to the Europe. Okay, we try to do this, to build up, to shape our brand a little bit.
And what kind of volume would you like to be doing in Europe, in a year or 2 years? How many cars would you like to be selling in Europe?
Yeah, actually, the first year we launched in Norway, which is September 2021, and we sold over 1,000 cars in Norway, just one model, which is the ES8. Okay, large ES8 and 6 and 7 seaters SUV, and this is a very good result. Actually, we're ranking number 2 in terms of the segment share. And we're launching another 3 cars in Europe, in Germany, Netherlands, Sweden, and also Denmark, including Norway as well. And because you know that we're introducing the high premium product, okay, our product starts from the 60k euros in Europe. So we're not looking for a fancy, a great number of the deliveries, but we try to be the maybe top 4, top 5 premium brand in the market.
And do you think that manufacturing in China can service that delivery, or have you started to think about maybe where you would begin to produce cars here in Europe?
That's a good one. Yeah, actually, you always need to look at the economy model for the local manufacturing, right? For now, we import the cars from China. We have enough capacity in the factories in China, and we import the cars. We pay like 10% of the import tax. But in the future, if we can deliver more cars, like maybe 5,000 or 6,000 cars a month, then we can reach to the economy level to build up some local plant, like SKD plant or the purely local manufacturing. But that's going to be in the future.
And then I also want to talk to you about your home market over in China and really the price war that's underway there. Do you think that will spill over into Europe? How do you see that affecting the market for EVs?
I don't see too much price pressure. Actually, people always pay for the good product and good services. We build up our cars based on our smart platforms, and this platform is scalable, upgradable. And we also provide the good services, the worry-free charging services, and also worry-free after-sale services. So people is willing to pay this much to get that value. So I don't see a lot of fierce competition in terms of pricing, just as we see in China market. Actually, I feel so far comfortable about that.
And so one of the big complaints about EVs, generally speaking, is how expensive they are. Not your EVs in particular, but it's certainly a concern in Europe and around the world, particularly for so the higher end vehicles. You have an interesting sort of subscription model, and you can also sell the batteries sold separately to a large degree, where you rent the battery and you own the car. How's the European audience finding that?
You know what? There's one figure because we choose to sell the chassis and the batteries separately. You just need to buy the chassis, and then you can also subscribe to the batteries. That can use a lot of worries from the users. Whatever. In the future, that battery is got updated according to the new technologies. Then I still stick with the current batteries, right? So there are a lot of benefits. The current figure, we call it the BOSS, battery as a service. The take rate is over 98%. So almost all the users choose to purchase or subscribe the car from the bus.
Interesting. So almost all of your sales, so-called, are basically the batteries sold separately. And so that's interesting. So you think as the battery density, for example, improves, then you're not wed to a single car with a single range. Actually, you're going to be able to boost the range on your car as that technology improves.
That's right. Actually, we are managing like two batteries capacities right now, 75, 100. You can always subscribe to a 75. Right, it's lower priced, and whenever you want to go for a long trip, then of course you can subscribe for 100 for just 1 month. Yeah, this is flexibility.
And in terms of building the infrastructure for the battery swap, because this is another quality that really differentiates NIO from other EVs, you can swap out the battery, so recharge time, it's none of that sort of long waiting around. How is building that network out, and how's the European audience found that?
We have already built 26 power swapping stations in Europe. And actually, I actually drove from Amsterdam to Munich
really?
On Saturday. Actually, I stopped at the 3 power swapping stations. Just try to test the trial, the new swapping technologies. Then it just takes like 5 minutes for a battery swap. So you really save you a lot of time. Time is precious. So we're going to build more power swapping stations. Imagine the future, okay, the highways, okay. I think the total mileage for the highways in Europe is only like 43,000 kilometers. So if we arrange like every 200 or 250 kilometers of power swapping stations, can really ease the worry from the people to take a long journey, right?
Thank you so much, Chris Chen. You're the CEO of NEO here in Europe, or the managing director running the operations here. Really one of the other Chinese competitors really coming in, trying to build their awareness here and really changing with a slightly different model from many of the others here in Europe.
Okay, Bloomberg's Oliver Crook on the ground for us in Munich from the IAA Mobility Car Show, of course, in that German city. Coming up, oil prices steady. They're around $88 a barrel now on Brent after rallying in the past week. Following Russia's announcement, it will extend export curbs. Nadia Martin-Wigan of Svealand Capital joins us next with her take on these oil markets. Stay with us. This is Bloomberg.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
Welcome back. We are seeing signs of strength in the oil market and momentum as OPEC Plus leaders plan supply cuts. Let's get the forward-looking analysis then with Nadia Martin-Wigan, director at Svealand Capital. Nadia, we appreciate your time today. Get us your view then on where and what the drivers are for this oil market. Are we looking back? Are we looking now towards the end of this year, possibly at reinvigorating, reviving that forecast around $100 oil?
It's possible. You know, the market has been super negative on oil, and we've had net longs, you know, going into the summer when we look at speculative positioning, super negative. And now we've seen things start to change, but especially in that physical market, right? That's where we're seeing tightness. That's where we're seeing the bullishness expressed. Having said that, when we look on the speculative side of things, we see very little investment having come in yet. So that means that we're at, you know, almost $89 a barrel, and the bulls aren't in yet. So if they see signals that they need to get in, we can absolutely see those kinds of numbers. However, you know, we're still waiting to hear what Saudi Arabia is going to do for October. Are they going to extend their cuts, their voluntary cuts of 1 million barrels per day, or not? And how do they see the demand picture? So we need to see what's happening with this very next leg first before we can talk about year end in terms of an official forecast.
Okay, well, there's a lot to unpack there, Nadia. If you had to take a guess now and throw a dart at the dartboard, where would that land in terms of that decision by the Saudis?
We see space for additional barrels to come back in right now. However, the market is expecting them to extend the cuts, right? So I think right now the balance is towards them maintaining the 1 million barrel per day extra cut. If they don't do that, I think the oil price will come off a few bucks, but it provides an opportunity to see if demand is really there and if inventories are drawing, and how the export quotas, for example, out of China, you know, we expect exports of refined products to go higher, how that actually plays out versus the entire macro picture. However, I think right now the Saudis are more likely to continue to hold the course for the next month.
And you talked about that industry-wide capex drought. What changes that? Is it a price level? Is it regulation? Is it the inflationary dynamics, wages, labour? What is the trigger that's going to get more investment in terms of capex for this industry?
Well, I think in the Q2 reporting, actually on the shale side, we've actually seen that production guidance is going higher. So whereas it kept being flat or expectations kept going lower, I think we've hit that kind of price level where there's a little more confidence on the shale side in the very short term of the cycle because the market expects OPEC to continue to toe the line alongside Russia and maintain a very tight market. So as this starts to come up in terms of higher expectations on U.S. production, I expect that, forecasts are going to rise 300,000 barrels per day by year end on U.S. production. We might start to see some questioning on the side of OPEC. OPEC, of course, is investing in the sector already, in terms of rigs and all of that sort of things. It's the rest of the world that has been lagging behind that. So we are at a bit of an inflection point in the U.S. now, I think.
And what are you looking at in terms of China and its demand? Is it the refiners or is it that domestic demand? Is it travel? Is it airlines? Or is it the refiners that's going to be so consequential in the quarters ahead in terms of getting a clearer picture, a clearer drive in terms of China's demand?
In the very short term, refiners, of course, make a difference. And we have seen increased buying by some of the Chinese refiners. Having said that, when the announcement came on Friday that they're going to be higher export quotas, and it was 12 million tons of additional quotas were issued. 10 million was the expectations. We didn't see tanker rates rally. We didn't see the market reaction that we saw last year. So that suggests there's a little bit of hesitation in terms of what is actually needed and where the internal demand is sitting right now. In general, I think the market continues to be quite bearish on China in the general macro picture. So it's all viewed with skepticism when it comes to domestic demand.
Well, is that bearishness, is it justified when we look at iron ore, Nadia? I know you have a view on this as well. 115 is the price right now, and I'm looking at basic resources as a sector just in today's session here in Europe, up 0.5%. Can we expect that the demand for iron ore picks up as some of these measures are pushed through for China's real estate market?
Yes, we can, but again, I think we have to think about where the market is positioned right now. We see a lot of analysts calling for much lower prices on iron ore. Right? And that is where we see a bit of a floor at 100, because that's when we see production cuts coming in. So we think we're in a healthy range. There is absolutely upside to come. But when we set it against the negative demand picture on China, oil prices, iron ore prices, and copper prices are all extremely strong, and they're in a comfortable range. So there's not a reason to be alarmist.
OK, Nadia, smart analysis. Thank you for breaking down some of the dynamics in this oil industry and oil market, and a look there as well in terms of iron ore and how it ties into some of these policy measures coming out of Beijing. Nadia Martin-Wing, Director at Svealand Capital. We appreciate it. Coming up, it has been a tough year for the UK property market, but Morgan Stanley, well, they're a little bit more optimistic. We'll have more on their call around UK property. That is coming up. This is Bloomberg.
What we have observed is that larger asset management firms, but also private banks or just general financial institutions have established themselves here in ADGM.
Abu Dhabi gives us capital access, but it also gives us talent access and market access.
So we have access to the private sector, to the public sector, to the policy makers.
You're watching Bloomberg Markets. Welcome back. Morgan Stanley analysts are calling UK property stocks a value play. Analysts said, quote, "We are alive to the fact that broader UK exposure and offices as a subsector are out of favour. But at current valuation, the risk-reward is compelling." Well, let's bring in at this point then Kit Rees from our equities team. Kit, talk to us about some of the pressures on the UK property sector. How have those property sector stocks, how have they performed year to date, and what are some of the challenges that the sector has faced?
Sure. It's been a really, really tough sector to be in this year. They've really underperformed the UK property stocks. So the FTSE 350 Retail Investment Trust Index is down 8% versus the FTSE 350, which is about flat on the year. There's been some very negative data points. We had the nationwide report saying that UK house prices fell the most in 14 years. The Bank of England saying there's been a fall in mortgage approval. So it's been really bad. It's not been great. mainly due to the high interest rates, as we all know about this, getting people hesitant into buying a new property, but also putting pressure on refinancing, maybe on companies going to pursue these big projects, and also on the debt that they currently have to service. So it's been a sort of a mix of lots of issues which has really put pressure on these companies.
Is that, as you say, that multi-pronged impact of rates, whether it's the domestic, the buyer of residential properties, whether it's homeowners looking to refinance, or the companies themselves with those debt loads. What is Morgan Stanley's rationale then for turning positive on this sector? What are they seeing that maybe some in the markets are not?
So, in a broader view of their broader view on UK stocks, they're saying that they're looking kind of like a value play now. So the valuations have got so low that maybe it's time to take a look at them. They also say on the UK specifically that they're positive on the fact that these companies don't have such high debt levels as maybe some of their European peers. And they also said that the balance sheets are adequately capitalised. So this is all really positive, especially for some sectors such as office real estate, which has really been struggling with things like work from home dynamic, the push-pull between workers and employers trying to get them back in, and also just these companies wondering to do with these tower blocks that might be standing empty. So it's quite an interesting, maybe slightly contrarian view for Morgan Stanley on this topic. But yeah, there seem to be a few positives now for the UK at least.
Yeah, and as you rightly point out, the balance sheet line from them, and that's consequential not just for the sector but more broadly for the UK economy as well. That the relative resilience of real estate sector or real estate company balance sheets here in the UK, as at least analysed by Morgan Stanley. What are some of the other catalysts that you're looking at then? Is it all about the BOE and where the central bank goes with rates, or are there other factors at play to focus on in the months and quarters ahead?
I mean, I definitely do think that it's all about the BOE. Yeah. And we've got the meeting later this month where people will be watching that, and the inflation report just before on the 20th of September. So these are going to be super important. We've seen the sector react really strongly in the past, when in July there was a slightly softer reading. The sector went up a lot. And then I think investors want to see whether these trends can be sustained. Are we seeing inflation easing a bit, or is it still going to come in hot? And then will we see more interest rate hikes? So this is going to be super, super crucial for the sector going forward.
What is your sense of where the views land, whether it's Morgan Stanley or others, in terms of residential property versus commercial and office? How divergent are those two paths now?
So that's a really interesting question, because I've seen, over the course of our coverage, analysts being mainly quite bearish on the sector overall. So we had HSBC, I think it was back in July, they cut 11 stocks. Because they basically see, all these issues persisting. There's also questions over, net asset values falling, those kind of issues. There's been a little bit of kind of talk over certain areas of office, maybe in the West End, looking a bit brighter. But overall, it seems a kind of, broad-based negativity. But, the stocks have fallen so much. We've got British Land, the likes of Derwent London, down over 20% the year. So maybe, some investors will see a bit of value and a bit of opportunity.
Kit Rees, thank you very much indeed. Really excellent. And you can read that, of course, on the terminal and on Bloomberg.com. The valuation opportunity, that's the Morgan Stanley call, at least, around UK real estate. Briefly checking in on your markets right now. We've given up the gains leading up to the close here in Europe that had been posted earlier on in the session. You're flat across the Stock 600, the European benchmark. US futures, S&P E-minis pointing down by about 0.1% for when trading restarts on Tuesday after the Labour Day holiday. Euro-dollar at 107. Easing off on the gains we'd seen earlier in the session for the single currency. Brent at $88 a barrel, sniffing 89, up 0.4%. And across your sectors, travel and leisure is leading the charge in terms of the upside you're seeing across European equities as a sector up 0.7%. Bottom of the list, insurance down 0.7. But again, broadly across these European markets, it looks like we're going to be closing out a fourth straight day of losses. Stay with us. This is Bloomberg.
Let's get back to work. Live from New York City this morning. Good morning. Good morning. Your equity market's slightly negative on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, economic data keeping Chair Powell on the sidelines. Goldman Sachs cutting recession chances to just 15%. And President Biden making his Labor Day pitch. We begin with the big issue. Goodbye, August. Hello, September.
We're heading into September.
A seasonally weak September.
There is a seasonal aspect to September.
The seasonal trends tend to be negative.
September's the worst month of the year.
The weakest month of the year.
We could see continued volatility.
We have the return of student loan payments.
That very important Fed meeting.
We're heading into September with very strong positive economic momentum.
We got a nice employment number.
Pretty good report.
You're seeing the kind of Goldilocks scenario that the Fed wants.
The Fed that is likely to press the pause button on the rate hiking cycle.
That's a pretty good backdrop for risk assets.
The economy in general is on decent footing.
We are on a wait and see.
More patience is warranted.
Kicking off the show with Citigroup's Stuart Kaiser, Jim Bianco of Bianco Research. Jim, great to catch up with you as well, Stuart. Jim, I want to start here on the Federal Reserve. Rate hikes on ice. Is that what they're going to say?
I think so. I think that they're going to probably pause at the September meeting because the market is giving you less than a 10% odds. But the question will become the November meeting because those are a lot closer to 50-50, and we'll have to see how the data plays out from there.
Stu, is that the Citi view as well?
Yeah, Jonathan, good morning. I think the base case is just that. They'll pause in September, but they're going to want to keep November in play, just because they're going to want to respect the fact that they don't know how data is going to come in, and I think they want the market to just not price them as completely done with the cycle. So, yeah, pause in September and keep November kind of on the table just in case.
Bond market yields higher this morning, 10-year up by 4 basis points right now, 4.22, 2-year up by a couple of basis points to about 4.89 or so. Jim, I'm struggling with the consensus view coming into September in this bond market at the moment. What is that consensus view now?
I think the consensus view is bullish. A lot of people are looking for a recession. They think that the inflation problem has been vanquished. They're looking at the data and they're seeing in the futures market a big short position, but that's probably a basis trade. And once you've taken that out, you look at positioning or you look at economist opinions, they're all kind of looking for rates to fall. And the contrarian play would be a further rate hike, or further rate rise, excuse me.
So sticky inflation, no cuts, stronger growth. Contributing to that, Jim, maybe this headline, just dropping across the Bloomberg. Excusing me for being distracted. Saudi to extend voluntary cuts of 1 million barrels a day until December, the end of December 2023. Looking at the oil market right now, 5-day rally coming into today. Crude with a pop, 89.64, just short of 90 here on Brent crude, up by 0.75%. Jim, a word on crude. Is that a reflection of a better demand backdrop, or is that just the supply story playing out?
Well, I think it's more of a demand story because you got to keep in mind since late June, crude oil prices are up more than 27% right now. Gasoline prices haven't caught up with it, and they probably will. When you see a big move like that, and yes, I know the Saudis have been voluntarily cutting. They've extended their cuts, but those have been in place for months. It's more consistent with a strong Atlanta Fed GDP and strong data and downgrading the probabilities of a recession because people are consuming energy because the economy is moving forward. I think that that will continue to be the case. In other words, crude oil and gasoline prices might be a market-based measure of economic demand, and right now they're both very strong.
New highs for the year on crude right now, just short of 90. It's the South rally, Stuart Kaiser, hardly anybody's talking about. What do you make of it?
Look, I think our view here is essentially what Jim described, which is economic data continues to come in strong, and that's pushed cyclical assets, higher and also pushed yields higher. I think the big risk here, as we've talked about in the past, Jonathan, is that expectations have gotten a little bit more stretched, and the reaction function of equity markets to that data and actually to the rise in yields have become a little bit more troublesome. So, as a base case here, we're still relatively positive on the markets. Strong labor market, easing inflation, but there's definitely some fraying around the edges that I think you need to respect.
Well, Stuart, to build on that, this was a rally so far year to date that has been built on top of upside surprises, economic data coming in better than expectations. Can you make the same argument that we can build a rally on a series of downside surprises?
That would not be our view. I mean, look, we believe equities are a nominal growth asset, and I think if you start to see disappointing economic data, you don't want to step in front of that. You want to let that weakness happen, and you want to buy at a lower level. So I think from my perspective, I agree with you. I think positive economic growth surprises was driven the market higher this year, and that works in both directions. And if the nominal growth starts to weaken, I don't think that's something that you want to trade to the upside from an equity perspective.
Here's another headline, two in the last couple of minutes. If you are just tuning in, let's get up to speed together on the commodity market at the moment. The first headline from the Saudis to extend voluntary cuts of 1 million barrels a day until the end of December 2023. The second headline, this one from Russia to expend a 300,000 barrel a day oil export cuts through December. They're trying to support the crude market. Jim, I'm going to throw in iron ore as well. So crude at new highs for the year. Iron ore at highs we haven't seen since maybe April. This all happening with a slowdown developing in China. Jim, what's the signal you take from that?
Look, I think when you look at the broad commodity markets as they move higher, especially in the industrial metals where iron ore is and in energy, the takeaway is that the economic strength or the nominal growth in the economy globally is stronger than people think. Yes, China is slowing down, but it seems like the rest of the world, even though we keep talking about recession and slowdown, seems to be compensating for that, and that's why you're seeing higher commodity prices. And if we are seeing higher commodity prices, eventually that should translate into higher yields. Again, as we talked about earlier, at the same time when everybody's positioning themselves for a fall in interest rates.
Well, right now it's fueling higher crude prices through 90 on Brent. Brent crude at $90 a barrel, up by more than 1% on a session. WTI crude just short of 87 here at 86.99. Turns through 87 briefly, up by 1.8%. Jim, let's stay on top of this oil story. Have we seen enough from China? Enough from China, from your perspective, to suggest they can put a floor under this growth risk now?
Not yet. I think that the Chinese have really got problems with their property market, and they've got other issues they have to deal with before we start to say that there's a floor there. Now, maybe it's priced in their financial markets might bottom, but their economy won't. And let's keep in mind what extraordinarily is happening there. They reopened after zero COVID in January, and yet it might wind up being that this year is the same growth or worse than the year that they were welding people into their houses last year, which is an incredible statement to say on its own. And it underlies the big problems that the Chinese economy has, which is why I don't think I've seen enough to say that they've got a handle on it. And it isn't just that they need a couple of more basis points cut from the central bank in order to spur growth. It's much more structural than that.
Stuart, how does what happens in China shape your view of what happens here?
Look, it definitely matters. I think the narrative around China and the impact on U.S. equities has shifted over the last month. Initially it was China's exporting deflation, and that's going to be positive. It's going to help the Fed. I think that discussion has frankly shifted to something that's more about a negative growth impulse and potential event risk coming out of China. So I think it does create a headwind from a growth perspective. Obviously also impacts European equities, particularly German exporters and luxury good manufacturers. So there's definitely an impact, and I think the narrative around it has shifted much more negative over the course of the last month or so.
It's certainly amazing to see growth in China disappoint, coming much lower than expected in 2023 relative to expectations of 9 months or so ago at the start of this year, and see crude back with a 90 handle on Brent. That's the latest for you this morning. Two headlines, one from Saudi, one from Russia. Saudi Arabia to extend voluntary cuts of 1 million barrels a day until the end of December 2023. Throw in Russia to extend 300 barrels a day oil export cuts through December. And you've got the recipe for a higher oil price right here, through 90 for the first time since November. That is a new high for 2023. Crude right now, Brent up by 1.3%. WTI up by 1.9%. To Jim Bianco's point on the bond market, fueling maybe some upside in yields here. Treasuries down, yields up by 5 basis points on a 10-year 4.22. Levels we've seen through much of this morning, up by 2 basis points on a 2-year, up to about 4.90 on a 2-year yield right now. Jim and Stuart are going to be sticking with us. Let's get you some movers elsewhere, with equity futures still just about negative by 0.1%. Here's Simone Foxman.
Yeah, John, equity futures may be looking negative, but Airbnb shares are rallying after it was announced that it would be included in the S&P 500 index as of September 18th, that along with Blackstone. And this really highlights the importance of passive index funds because as we speak, the local law 18 in New York City is going into effect, and that severely limits the company's operations. But we see shares still up over 6% in the pre-market. Also watching shares of Nikola. There were local news reports of a semi-truck fire at Arizona lithium facility in Tempe last night. There were no injuries reported, but there have been a lot of concerns about the possibility that there are battery problems that cause fires in Nikola's electric trucks. We're also closely watching Warner Brothers Discovery. We're not seeing a big movement at the moment right now, but we're the company guiding lower adjusted EBITDA for the full year after a $300 to $500 million hit from the impact of these strikes. That despite the fact that Barbie has become the best grossing movie worldwide this year, John.
More from Simone around the opening bell. That opening bell about 20 minutes away. The latest in the oil market, 6-day rally on Brent crude. Up another 1% today, briefly through 90, just about there right now. $90 a barrel for the first time since November as the Saudis and the Russians keep pulling back. Coming up, President Biden making his Labor Day pitch.
You know, there are a lot of politicians in this country who don't know how to say the word union. They talk about labor, they don't say union. It's union. I'm one of them. I'm proud to say union.
Latest from Anne-Marie up next.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
You know, there are a lot of politicians in this country who don't know how to say the word union. They talk about labor, they don't say union. It's union. I'm one of them. I'm proud to say union. I'm proud to be the most pro-union president according to the experts about in American history. And by the way, I make no bones about that.
The President attempted to shore up ties with labour unions in Pennsylvania, downplaying the threat of a potential auto strike, telling reporters, quote, "I don't think it's going to happen." The contentious negotiations leaving an opening for Republican frontrunner Donald Trump.
What's happening to our auto workers is an absolute disgrace and an outrage beyond belief. Both the UAW bosses and the big three auto executives should be screaming at the top of their lungs. They should be ashamed of themselves, demanding that Joe Biden cancel his brutal electric vehicle mandate before it destroys the entire U.S. auto sector. To every auto worker, I stand in total solidarity with you in your fight against Joe Biden's job-killing Green New Deal insanity.
Donald Trump on the offensive as voters overwhelmingly think President Biden is too old to run for re-election and giving him low marks for his handling of the economy, according to a new Wall Street Journal poll out in the last couple of days. Bloomberg's AMH joined us from Washington, D.C. Anne-Marie, who's going to win that battle for those unions?
Well, for the UAW, Jonathan, at the moment, it's still up for grabs in the sense that they have not come out and endorsed anyone. And they've said that people in Washington need to take note about what is going on. If they want our endorsement, they need to be there for us. So that is something you see the former president, Donald Trump, try to tap into. He was out with a Truth Social post yesterday about this, saying there's an EV glut and UAW should not be backing the Biden administration. We should note the UAW did back Biden in the last round. They likely will lean towards the Democrats, but they're probably just using this endorsement as leverage at the moment, the same way they're using a strike as leverage at the moment, as they are up against the three big auto companies. And Jonathan, that contract expires September 14th. And when you heard from President Biden yesterday, is that when he said he didn't think there would be a strike, Sean Fain, the UAW president, came out and said he must have more information than we do.
AMH, the president says he's the most pro-union president ever in the history of the United States. I have no idea what that means. Isn't this the most easy time to be the most pro-union president of the United States, given where union membership is relative to where it was decades ago?
That is true. Relative to decades ago, if you look at the 1970s, an organization like UAW had more than 1 million workers. Right now, it's a few 100,000. But at the same time, the president does want to make sure that he is talking about labor unions. He talks about the fact that he's a son of Scranton. This is where he was talking on Labor Day in Pennsylvania. This is something he wants to lead into. His biggest issue, though, Jonathan, is one of the biggest gripes the UAW has is with the electric vehicles. When you see this administration come out and talk about loans or subsidies or grants for companies to build battery plants, the UAW, they do not have kind words for this administration.
His biggest issue this morning is in the oil market. Anne-Marie, let's go there. Two headlines in the last 10 minutes or so. One from Saudi Arabia, one from Russia. The message pretty clear. We're not going to stop pulling back anytime soon. How do you think this White House responds to that?
Well, Jonathan, this kind of goes to their industrial policy of wanting to electrify the grid. They wouldn't have to worry as much about what Saudi Arabia was doing. What we're seeing from the Saudis is that it's prolonged this cut. We didn't think it was going to be this long, and that's why you see Brent prices spiking above $90 a barrel. The administration was already concerned with gasoline prices. They're nowhere near they were last summer when they hit above $5 a gallon, but they are trending towards $4 a gallon. That will be very difficult for this administration that is still dealing with inflation. Yes, the rate of inflation is slowing, but they're still dealing with inflation. This continues to show up in polls, and it's why the Americans give the Biden administration poor marks on the economy.
$90 Brent right now on the screen at 1.5%. AMH, thank you. Anne-Marie with the latest down in Washington, D.C. Some final thoughts from Stuart Kaiser, Jim Bianco. Jim, let's pick up on that crude story. Crude right now at 1.5%. September 20th, the Federal Reserve. We can work backwards. September 13th is CPI. Jim, some upside risk to the inflation story into year-end from your perspective?
Yeah, I think on two levels. On first level is that September of last year was a small number. It was 0.2. We're looking for somewhere between 0.6 and 0.8 for this month. In other words, a base effect that could push year-over-year inflation up to 3.7 or 3.8. And if you extend that through the rest of the year, it really does look like year-over-year inflation bottomed at 3% in June, and it's going to probably start drifting towards 4%. Now, that's not catastrophic, but it's certainly not the type of number that's going to get the Fed to be talking about 4 rate cuts next year if we end the year at 4% inflation.
Stuart, how would you expect equities to trade around that kind of story? If Jim's right, what kind of price action would you be looking for?
Yeah, I mean, our view is pretty similar, is that you probably saw the two weakest prints you're going to see this year over the summer, and, potentially, A, some upside risk, and B, you're probably just also going to tick higher relative to those very low numbers. My view here is as long as inflation volatility remains relatively well contained and you're kind of in a slowly easing or grinding lower type inflation environment, equities should be okay. I mean, if you saw something like 0.6, 0.8 and inflation actually hooked higher, obviously the market would have to price that risk a little bit. But big picture, inflation volatility's come down. The rate of inflation has sort of stabilized a bit. And I think, what equity markets want is clarity and certainty. So if you have sort of stable inflation, stable jobs, I think equity markets can handle that pretty well.
Stuart, over the weekend, I was reading through it. You gave a base case, a tactical view, and a contingency plan. Stuart, can you go through that for us now?
Yeah, sure. I mean, our base case, as I mentioned, is, job market remains pretty solid. Inflation is easing, but a little bit sticky. And I think, that allows equity markets to work, probably with, not the type of velocity we saw earlier this year. Tactically, we do like hedging markets. There is the chance here that inflation does take higher. You're running to the show, mentioned seasonality a few times, so that's obviously a risk in the background. China, higher rates, market technicals, options flows. There's a lot of tactical reasons, I think, to be a little bit careful, and we do like hedging through till the end of the quarter. The contingency, though, I think is the key thing here, and it's what could really disrupt this rally. And we've put three things out there, but number one on that list is U.S. labor markets. And I do think if you see U.S. labor markets continue to start to weaken, meaningfully, then you are going to see equity markets trade lower. Our view is you don't want to step in front of that. You don't want to buy the first sign of weakness. You kind of want to let that weakness play out. So the contingency for the markets here is the strength we saw in the labor market on Friday, doesn't get repeated. Labor market and services sector comes under pressure, and I think that's your bigger downside risk. Hedging-wise, we would focus on U.S. retailers as a way to play that story.
In other words, Stuart, bad news is just bad news.
Always. Well, they wouldn't call it bad otherwise, right? They would call it good if it was good.
Jim, you on the same page?
Yeah, I am. I think that definitely on the page that, bad news might wind up becoming bad news as we move forward from here. But I think that when you look at the labor market, I want to go back to what you and Anne-Marie were talking about. The labor situation, especially among unions, which is only 6% of the labor force, is getting to be very substantial. I think one of the things the UAW is looking at is a 32-hour work week, a 4-day work week. They want to go hybrid like everybody else does. And these are intractable problems. So the labor market could give us quite a bit of volatility as we move forward, unless there is some kind of a deal. And then you've got potentially a transit worker strike in New York City coming right after that for the same reasons.
Sign me up, Jim, not for the strike, but for the 32-hour work week. Now, Jim, you mentioned the union membership and how low it is, particularly relative to where it was several decades ago. You can make the argument that maybe these negotiations are meaningless for the overall labour market. Do you think there's a signal effect here, though, Jim, that we all see those headlines, we get to year-end and we say, you know what, I'll have some of that as well?
Oh, yeah, I think it all started with the UPS workers getting $170,000 a year to deliver packages, that is reverberating through not only the West Coast port, but, the UAW and the transit workers and everybody else is saying, I want to get some. And yeah, you're right. 94% of the workforce is not unionized, but that 6% is. If they walk out on strike, like the Hollywood writers' strike, another one, it can be very disruptive for the economy as we go forward.
I'll form a union for the three of us, guys. 32-hour work weeks coming up. Jim Bianco, Stuart Kaiser, to the both of you. Thank you, guys. Going into the opening bell, about 7-8 minutes away. Equity futures here on the S&P 500, slightly negative through most of this morning. On the S&P at the moment, we're down by 0.15%. This big move in the commodity market over the last couple of weeks. This is day 6, a 6th day of gains for Brent crude, through 90 for the first time since November. So we have a new high for 2023, $90 and about 60 cents, up by 1.8% off the back of these headlines that Russia, Saudi Arabia are going to keep on pulling back. Just keep on pulling back. The latest headlines from Saudi to extend the voluntary cut of 1 million barrels a day until the end of December 2023. And right at the same time, Russia to expend the 300,000 barrel a day oil export cuts through the end of the year as well. Crude up this morning by 1.76%. Coming up in the morning calls and later, Goldman Sachs growing more confident about a soft landing in the US. We'll have that conversation with PIMCO's Tiffany Wilding.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
This is where we've been all morning in equities, just a little bit softer on the S&P, down by about 0.1%. That's the price action. Let's get used to morning calls. First up, RBC upgrading American Express to outperform, pointing to manageable credit trends and the company's double-digit revenue growth outlook. The stock is up by 1%. BNP downgrading General Mills to neutral, expecting cautious consumers to spend less on premium pet foods. That stock is down by 0.8%. And finally, Bernstein upgrading Lowe's to outperform, seeing a favourable setup with multiple catalysts on the horizon. That stock is up by 0.6%. Coming up on this programme, we speak to PIMCO's Tiffany Wilding on what she calls a Goldilocks jobs report. That conversation up next. Your opening bell just around the corner. 25 seconds away from the opening bell, coming off the back of the best week of gains on the S&P 500 since the middle of June. Futures right now negative by 0.1%. On the Nasdaq, down about 0.2%, with Fed rate hikes seemingly on ice. More data still to come before we get to the 20th. The 13th is your next CPI report. There's your opening bell. Switch to the board and get to the bond market. Yields look like this to the Treasury market right now. Yields higher by 4 basis points. $4.22 stronger. The euro down to 107.45. We're negative by 0.5%. The lowest, the weakest euro, going back to about June. The rally in the commodity market getting everybody's attention. It is day 6 for Brent crude. It is day 8 for WTI. Brent crude is up by a couple of percentage points and through 90 for the first time going back to November. For WTI, longest winning streak going back to the start of this year. WTI crude, $87 and about 20 cents. We're high here by 2%. That's the cross-asset price action at the moment. We need to look at one thing, ARM, one of the most anticipated stock listings of the year so far, downsizing its IPO and now planning to raise as much as $4.87 billion in what would still be the biggest IPO of 2023. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. According to the Form F1, ARM will offer $95.5 million shares, 955.5 million shares in the form of American Depository Receipts, or ADRs, priced currently in a range of $47 to $51 each. As you said, that would see them raise $4.87 billion. Even at the bottom end of that range, if they price at $47 a share, it would still make this the biggest IPO globally of the year, surpassing Johnson & Johnson's consumer health spin-off of Kenvue. You'll remember that came in raising $4.37 billion. A lot of interest here, partly because we see it as a kind of starting gun for the IPO window for technology companies. There are a number waiting in the wings, as you know. Previously, we believed that ARM wanted to raise between $8 and $10 billion at a much higher valuation, say $60 to $70 billion. But what happened or transpired was SoftBank acquired the 25% stake of ARM that the Vision Fund held. And we know that all told after the transaction, SoftBank will still control 90% of the shares, which is an interesting dynamic given the kind of big-name cornerstone or anchor investors that are on this deal, which include Apple, Nvidia, AMD, Alphabet, Intel, among others that Bloomberg's reported. But certainly one that we're watching very closely.
Ed, let's make it really simple. So they're going to raise potentially half of what they hoped to raise only a few weeks ago. In terms of the valuation, it might be in the 50s. They were hoping it would be closer to 70, at least in the 60s. Ed, is that a SoftBank problem or a broader market story?
I think a mechanical problem. You know, it's by virtue of the transaction that SoftBank's done. I think, like, even based on the math that Bloomberg's done, at the top end of the range, $51 a share, it will have a valuation of $54.5 billion. You know, part of the psychology of this whole IPO situation and ARM going first is a lot of names that are waiting in the wings, want to see how it's going. But ARM, like everyone else, and SoftBank, by virtue of holding 90% of the company, wants to leave a little room for upside. That's what I keep hearing from bankers and sources that I speak to in the tech industry. And remember, ARM aside, a lot of these companies went through painful down rounds over the last 18 months, but with the longer-term goal of going public and having some potential upside out of that being the motivating factor.
Just set the bar a little bit lower. And thanks for the update.
Exactly,
Thank you, buddy. 3 minutes into the session right now. Negative 0.1% on the S&P, pulling back just a touch on the Nasdaq by 0.4. Let's stick with the tech sector. Barclays upgrading Oracle to overweight with a street-high price target. The analyst writing this: we see a multi-year opportunity for solid growth at high margins, partly fueled by emerging AI workloads, which will be the key to the overall story. Isabel Lee has more. Hey, Isabel.
Hey, John, and that price target is now one of the highest in the street, from 150 to 150 from 124, and 150 is a 24% increase from Friday's close. Barclays sees scope for strong growth at high margins, and that's supported by Oracle's software as a service and its cloud infrastructure, both of which it said can outweigh lower growth parts of the business. And just last week, UBS also upgraded Oracle to 140. UBS is also citing the cloud infrastructure as well as the GPU capacity of Oracle. AI really seems to be the theme of the year, John. And recall in March, NVIDIA extended its collaboration with Oracle, also in relation with its cloud infrastructure. And as UBS said, the AI story still has a lot of room to play out. Oracle is now up some 50% year to date, John.
And up about 0.4% this morning. Isabel, thanks for the update. Thank you. I want to turn to some new names potentially on the S&P 500. Both Blackstone and Airbnb will join the index prior to the opening bell on September 18th, replacing Lincoln National and Newell Brands. Simone Foxman on top of that one. Hey, Simone.
Yeah, this is a long time coming for both of these names, which have multiple share classes, and that was something that wasn't able to be allowed. You couldn't be in the S&P 500 index if you had multiple share classes until the S&P Dow Jones repealed this rule back in April. So just to recap, to qualify, you have to be a highly liquid U.S. firm, you have to have a market cap of at least $14.5 billion, and you have to meet certain metrics of profitability, liquidity, and share float standards. Now, Blackstone will become the first alternative asset manager to ever be included in the S&P 500 index. This despite the fact that it went public back in 2007. But after they dropped the rule, both Airbnb and Blackstone seen as benefiting here. And of course, this despite some unfavorable rules that come into effect for Airbnb today. We can see the impact on the shares, rallying 3%, over 3% for Blackstone, over 7% for Airbnb. John.
Simone, thank you. 5 or 6 minutes into the session, your update right now, negative 0.2% on the S&P. No drama there. On the Nasdaq, down by 0.4. Now, I'm not sure what would make you more miserable, being a Manchester United fan over the weekend or holding the stock this morning. I'm looking at my floor manager right now, who is a Manchester United fan. Stick with me. The stock is down by about 11.4%, 5 minutes into the session, as Man United may be taken off the market after the Daily Mail reported that the Glazer family isn't getting offers matching their asking price, writing, quote, "The Glazers are thick-skinned and won't be influenced by any negative fan reactions." Katie has more. Hey, Katie.
Hey, John. Yeah, you take a look at shares this morning, currently off by 11.5% after the report in the Daily Mail over the weekend. According to sources, the Glazer family, that thick-skinned family, they originally hoped to attract multiple serious bidders here, but only ended up with two. We're talking about Sheikh Jassim of Qatar and Jim Ratcliffe. Now, the Glazer family reportedly taking the team off the market. They're going to try again in 2025 when hopefully improved conditions will attract more bidders. And the Glazer family is looking to sell the team for between 7 to 10 billion euros at that time. Again, according to Daily Mail sources, as of Friday's close, you look at the market, Manchester United valued at $3.9 billion or about 3.6 billion euro. Now, it's worth noting here that when contacted by Bloomberg, a team spokesperson declined to comment on, quote, rumors and speculation. But even still, you can see the drama playing out in the stock market. Shares now off by 11.7%. If that holds, John, it'll be the worst day since February.
Did they comment on the Arsenal game? Kelly, that's what we all want to know.
I barely know what we're talking about here, John, but I'm not sure.
We appreciate your honesty. Katie, thank you. On top of the stock, more than the game over the weekend. Would you like to talk about? No, don't want to talk about the Arsenal. No? OK. Goldman Sachs cutting its US recession odds down to 15% from 20, writing this. Real disposable income looks set to reaccelerate next year on the back of continued solid job growth and rising real wages. We still strongly disagree with the notion that the long and variable lags of monetary policy will push this economy towards recession. PIMCO's Tiffany Wilding offering her own assessment after Friday's payrolls data, writing the following. This was a Goldilocks report for the Fed. Labour markets are cooling but not falling off a cliff, and the slowing is likely to continue as the economy faces various headwinds in the second half of 2023. I'm pleased to say that PIMCO's Tiffany Wilding joins us now for more. Tiffany, let's start there. The kind of slowing that you're expecting into year end for some really phenomenal numbers we're seeing in the third quarter.
Yeah, well, certainly consumption has been the standout this year. The consumer's been very strong, and that's pretty aberrant from historical hiking cycles. You do tend to see more moderation in consumption as labor markets slow. We're just really not seeing that. Consumption in the third quarter looks like it's running above 2.5. Obviously, GDP tracking reports also look like they're closer to 3. So this is an economy that just doesn't seem to want to quit. Now, nevertheless, though, we are seeing indicators, higher frequency indicators that would suggest that things are slowing. So we have student loan repayments that are starting. Treasury daily data suggests that people are actually prepaying that. And at the same time, they're spending less. So high frequency data from credit cards suggests that we are seeing consumers that are start to pull back. Add to that, that you have seen much less credit creation overall for the economy this year, and that is a recipe for slowing. Now whether it actually pulls us into a recession or not, I think that's more of a question mark here, just because of the ongoing resilience in the U.S. economy.
Well, do you see us on a path towards returning inflation to 2%? Are you confident we're on that path, Tiffany?
Yeah, well, we're certainly going to get some good news on the inflation front in the back half of this year. But really that good news is centered around some of the pandemic-related effects just fading. Of course, things in China have been much weaker than expected. They are, as a result, exporting some disinflation. That's going to help U.S. retail goods prices going into the holiday season, which many consumers will be happy about. But nevertheless, other measures of inflation, wages, for example, in the United States, they still look sticky. This super core measure that the Fed loves, services ex shelter within the PCE inflation measure, also still looks relatively elevated. So one of the things that we've been noting, and this is consistent with the Fed's forecast, is that you do need to see some labor market cooling in order to get that down. And I think it's a question on whether we'll see some labor market cooling just because the economy's been so strong.
That's the labor market, throw in housing as well. Tiffany, we could look at commodities too. Can I just get a comment, Tiffany, potentially from you on whether this commodity market move complicates the Fed's effort with Brent, WTI back in and around $90 a barrel?
Yeah, well, certainly, headline inflation matters. It matters for how consumers think about future inflation and inflation expectations. But on the other side of that, it also matters because higher gas prices will affect consumers' ability to spend on other discretionary items. So it's a little bit of a mixed bag in terms of how it affects the economy. We still, in terms of the underlying inflationary pressures, we like to look at core inflation. And again, that's going to look a lot better in the second half of this year, with some risk, though, that maybe it reaccelerates if the economy doesn't cool.
So, Tiffany, when we get forecasts next up from the Federal Reserve, how do you think they'll compare to the last set of forecasts we got earlier this summer?
Yeah, so they're going to be a bit of a mixed bag in terms of their implications for the rate path. So we do think Federal Reserve officials will have to revise down their core PCE inflation forecast, at least for the end of this year. But at the same time, they're probably going to be revising up their growth forecasts. And there's been some good news on the labor market front. They could have to revise down their unemployment rate forecast. So all of that, sort of suggests, maybe they keep that rate hike in the back half of this year. Maybe they don't. But this is coming up in September. We would also argue there's a lot more data between now and the end of this year for them to think about. And I guess overall, just looking out to 2024, if the economy is not cooling, if we are still running at above trend growth, if the labor market, the unemployment rate is still at these levels, kind of 3.5 to 3.8, it's possible the Fed, might even have to do more. So, I think that's something that, that we're grappling with, not our base case, certainly, but
sure,
something that's the risk that's out there.
Well, let's take it one step further. Let's play what if for 2024. Tiffany, are you still of the opinion that, let's say inflation is 2 point something, that they won't be willing to do anything about it? They won't be willing to crush the economy or the labour market. They'll just tolerate 2 point something.
Yeah, certainly. I think if it's a 2 handle, that's probably good for the Fed. But I do think there's questions around if the labor market remains this tight. It could stay around 3, which is a little bit more cuspy. Yeah, but overall, I think there is a question around if you get it down to 2.5, let's say, and you continue to forecast it moving lower over the next few years, then maybe that is all you need to do. And that would be very similar to what the Fed did in the 90s with their opportunistic disinflationary strategy. And I would say if you look at economic performance in the 90s, it was pretty good. And overall, 2 is really not, it's not a magic number, if you will. I mean, it's, 2% inflation, that there's not a lot of cost benefit analysis around 2 versus 3 versus, price stability in terms of their target. Nevertheless, though, as Chair Powell said, they're probably not going to change their inflation target, but they could alter their strategy within that target, to let it go a little bit above for a period of time.
Tiffany, thanks for the update. As always, one of the best. Tiffany Wilding there at PIMCO on the look ahead for 2023 and 2024 as well. This just in from Anne-Marie. AMH wants you all to know that Man U goal was offside over the weekend, for whatever that's worth. 14 minutes into the session, your equity market slightly negative on the S&P. Coming up, China's big breakthrough.
China has been catching up over the past several years, pouring lots and lots of state subsidies into its industry. So the second prong of the strategy, holding China back, has taken on more prominence in recent years.
AMH and Ed Ludlow, your team coverage up next.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
China has been catching up over the past several years, pouring lots and lots of state subsidies into its industry. And that's why the US, Japan, and the Netherlands in particular have tightened up their export controls on chip-making tools, which now can no longer be transferred to China to help China produce cutting-edge chips. And so this second prong of the strategy, holding China back, has taken on more prominence in recent years.
Chris Miller there of Tufts University weighing in on China's chip race as the US-China tech war heats up. A major breakthrough in the last week, a teardown of Huawei's newest smartphone, revealing an advanced 7-nanometer processor, a sign Beijing is making progress in a nationwide push to circumvent US sanctions. Your team coverage starts right now with Bloomberg's Anne-Marie and Ed Ludlow. Ed, just how big of a breakthrough was this for China?
Well, in layman's terms, this is the best ever made in China chip. That's the easiest way to understand it. 7-nanometer nodes are, for China, where they're at in chip manufacturing. You'll remember on the show a week ago, Jonathan, there were local media reports and speculation that the processor in the Mate 60 Pro might be 5-nanometer. And that was very surprising because broadly the industry does not think China has got to that stage. What the teardown that you're looking at right now, and actually any second you will see the processor known as the Kirin 9000S processor confirms, is that it is 7-nanometer. That is 2 generations removed from the cutting edge, which is 3-nanometer. But what's so important is that Semiconductor Manufacturing International, and you're looking at the Kirin right now, that is the processor. But what is so important about Semiconductor Manufacturing International, or SMIC as it's known, it's China's leading chip maker, but the US technology curbs apply to their supply chain. So we asked the Commerce Department, hey, this 7-nanometer, is it bound by the existing curbs? And they haven't responded. It's fascinating.
Interesting. AMH, if this is a massive win for China, how big a loss is it for this White House?
Well, Jonathan, just look at the timing all of this, this Huawei new phone came out at the same time as you had Gina Raimondo leaving China. She was there to try to put some more formal engagement in the dialogue between Washington and Beijing that really has deteriorated in the last few years. And now a big question, I think, facing this administration is that are these sanctions, these export controls to try to stem China away from that high advanced U.S. technology, are they effective? Are they adequate? That is something this administration will be asking. But it was a triumphant in China when you have the Global Daily Times putting out a political cartoon where Huawei is seen as a vehicle, car on the road, busting through a blockade, trying to stop cars from coming in and saying that they are basically free from these U.S. sanctions controls and export controls. So this topic is certainly not going to be going anywhere anytime soon. But I would say it's up to the viewers to decide whether or not they thought it was a coincidence that this phone was released as the Commerce Secretary, the agency that is in charge of these sanctions, she was on her way out.
Well, AMH, I'd go one step further. The unveiling was so quiet, and it came at a time when they had someone from the outside preaching to them about why their economy may well be, quote, uninvestable. Isn't that somewhat embarrassing now for the Commerce Secretary to be preaching things like that at a time when they've been able to unveil something like this?
Well, what the Commerce Secretary was talking about is what U.S. companies are saying about China. What we've seen in China, and Reuters reported this weekend about their fund, they're putting another $40 billion into it so that they have their own domestic production of these chips to make sure that they still are remaining competitive with the United States.
Quite a breakthrough in the last week. Ed Ludlow, AMH, thank you to the both of you. About 22 minutes into the session, we look like this. We're down by 0.36% on the S&P. On the Nasdaq, we're down by 0.38. No drama. Let's get you some sector price action. Here's Simone Foxman.
Yeah, just about every sector in the red this morning, with the exception of energy. Industrials, the weakest today, led by losses in part in airlines. Airlines have had a terrible August, down 9.5% last month. Transportation companies as well feeling the pain. But September tends to be the weakest month of the year over the past 30 years. Seen an average change of down 0.7% in the month, so not setting us up well. We are looking at communication services trying to eke out some gains there. Where we are seeing some upside is the energy sector. Saudis prolonging voluntary oil production cuts for 3 months. It was anticipated that they would prolong these cuts, but 3 months is quite a long time. Russia joining in, and we're seeing the benefit to the major international energy companies, Exxon, ConocoPhillips, even Chevron, which is dealing with some labor concerns in Australia around potential strikes, up now more than 1% in today's trading. John?
Simone, thank you. If you are just tuning in, that has been the news of the last hour or so, the last 50 minutes, the developments with Saudi Arabia and Russia. That move on Brent crude up by 1.3%, $90 a barrel for the first time since November. On WTI crude, about 87, up by 1.9% this morning. That's the crude action. Coming up, your trading diary.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
25 minutes into the session, starting the week a little bit lower, soft and negative, down by, let's call it a third of 1% on the S&P 500. Underperformance on the Russell, the small caps down here by 1.8%. That's equities. Let's take a look at bonds. The bond market right now shaping up as follows. 2-year, 10-year, 30-year yields creeping higher off the back of another rally in crude this morning. We're up by 6 basis points on a 10-year, back to about 424 on a 30-year, further out along the curve, up by basis points to about 4.36, which incidentally was the high of the year for the 10-year yield in the last couple of weeks. That's the price action. Let's get to the trading diary. The week ahead looks like this. US factory orders and durable goods coming at the top of the hour. The Fed releasing the beige book on Wednesday, plus Fed speak, Collins, Logan, followed by Williams, Bostic and Harker on Thursday. Another round of jobless claims on Thursday as well. And we round out the week all coming ahead of the G20 summit kicking off on Saturday. From New York, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Tuesday, the 5th of September, European stocks drift lower. The Chinese PMI data has been a drag all day, to be honest. One sector that stands out on the upside, we'll talk about what is driving it, is the energy sector. Crude is higher. We'll talk about why in just a moment. That's the picture in Europe. The details today really matter. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
European stocks drifting lower a little bit. Since the get-go this morning, the Chinese PMI data, the weakness we've seen there, certainly acting as a little bit of a brake on any forward momentum this market may have. So we're down by around 0.2%. The Chinese data represented here by Kering, down by 2.25%. The luxury sector, anything with significant exposure to China, particularly on the services side, particularly on the consumer side, has been weaker today. The area that has seen some strength has been energy. Unsurprising. Look at what is happening with Brent. We're up by 0.9%. We're trading around 90. Went through it a little bit earlier on. The Russians and the Saudis are going to continue their cuts, not for a month, but until the end of the year, Alex.
Honestly, I'm surprised the market was surprised that was going to happen. But anyway, to your point, S&P 500 is just off by 1/10. But I did want to point out S&P Energy Index. We had seen a much more powerful rally earlier when those headlines crossed. We were fading it a little bit, yet still eking out a gain of 0.6. Hey, we'll take it. It's one of the only sectors up in the green today in the S&P. What is really interesting that's evolving here is that persistently stronger dollar. The Bloomberg Dollar Index at the highest level since March. So just that persistent stronger dollar. Is it a U.S. economy? Where are we in that smile? We'll talk about that in just a moment. 10-year yield popping about 7 basis points. Is that good value now? If we have questions about, say, the economy, recession, wage price spiral, higher oil prices leading to more inflation, a kick back up, tough comps, I mean, are we appropriately priced along the curve, Guy?
It's a tricky question. ECB next week, Fed goes into a quiet period this week. The data are going to matter. It's really tricky at this point to call what is going to happen next. Let's talk about what is happening in Munich right now as well. I want to talk about what is going on with the car sector here in Europe. Today we're seeing strength in the energy sector, but for a long time now we've seen significant weakness in the European auto sector. And we talk about this at a time when the global auto industry is gathered in Munich for the conference that is taking place there, the show that is taking place there. And it's really interesting. The Chinese are there and in scale and in size. And it feels like the Europeans are very much on the back foot. And you can see that represented in what we're seeing in the valuations with this car sector at the moment. The European car sector actually this year hasn't been too bad. But this sector is so cheap right now. Versus not only the European market, but the US market as well, that it really is eye-watering. As somebody wrote this morning, Michael Masika, on the Bloomberg terminal, these stocks are priced to fail. They are priced to go out of business. Is that really going to happen? Car makers are the cheapest sector in Europe, and it's been basically going on for 2 years right now, Alex. What is going to change that? Is the situation going to get any easier? The US car makers are protected by Joe Biden's IRA. The Europeans don't have that benefit.
No, they don't. I mean, on the flip side, though, you definitely have the downsides to the IRA, which is what we're seeing with the potential auto strike in the next few weeks. But to your point, China automaker BYD was also at the auto show. The company's managing director for Europe, Michael Schuh, spoke with Bloomberg's Oliver Crook at the IAA Mobility Show earlier in Munich.
We've got a very good marketing performance in China. Europe is our strategic market, and we want to try. We want to communicate with the customer here, and let's see. The IAA is a great opportunity, and to have this conversation. We love to be here, and to hope every customer in Europe can visit our booth in Munich.
Takes us to our question of the day. Why is the auto sector, from an investment point of view, running on empty right now? What could potentially change that? Joining us from the conference, from the IAA in Munich, is Bloomberg's Oliver Crook. Our Detroit bureau chief, David Wells, joining us on the US side of this story, the labor strike story, and what is going to happen there. Ollie, I'm going to turn to you first of all in Munich. The Chinese are there, and they are there in scale. The Europeans feel really exposed right now to that threat in the way that the US car makers are not. How seriously concerned are they about that threat that is coming from China? I remember talking, and I talked about this in the last hour, to Sergio Marchionne. He told me the biggest mistake that Europe ever made was letting the Koreans in. Are we going to see the same threat being posed by the Chinese?
Well, Guy, listen, let me try to describe a scene to you, because I think this is really the allegory for what's going on. And it's going to do a lot better than me telling you all of the details. In the center of Munich right now, which is basically the motor city of Germany that has surrendered itself to the IAA, you have stands all over the place. You have a huge spread for Volkswagen sitting there. Right across from them is BYD with a huge stand, right? This is the company, BYD, that has toppled Volkswagen in China, and it is now coming for the international market and really showing itself out there. You see the ads running there. They literally say, we're BYD, you've probably never heard of us, but we're one of the biggest new energy vehicle companies in the world. So the question has been, they've conquered the Chinese market. When are they going international? What's so interesting is it's right now. I spoke to so many executives, Chinese executives, some of them whose cars are on their way literally right now to Europe.
Yeah, well, hence the valuation. Well, help me understand this, David, because here I feel like the U.S. automakers worry about Tesla all the time instead, and price cutting on Tesla, not necessarily about China.
That's right. No one really sees the U.S. market as low-hanging fruit for the Chinese. They could certainly come here. BYD is always an offshore threat who could come to the U.S. But if you're going to sell electric vehicles here, because of the Inflation Reduction Act, you have to build them here. You have to build the batteries here. That's a lot of capital investment. And if you're going to export them, Trump had started a trade war with the Chinese. Tariffs are much higher. So there's no easy, quick, cheap way into this market for the Chinese. They probably would, honestly. The way things are now with IRA, they'd have to invest a lot of money to build plants, build battery factories, get their minerals from trade partners besides China. It's just a lot of heavy lifting for them to get to this market.
David, there is a rest of the world, though. Is the U.S. car market big enough to support the U.S. car makers? Because the rest of the world is going to be open season, and the Chinese are coming for the rest of the world. They're coming for Europe. They're coming for the rest of the world. Can the U.S. car makers survive on the U.S. car market alone? And isn't there a danger that if they're not competitive in the rest of the world, that's all they're going to get?
There is, and you're already kind of seeing it. Ford doesn't do very well in China, and they really never have. General Motors has been shrinking there. The only place GM is really strong, besides the U.S., is South America, and that's not a very high profit market for them. They're actually great in South America. They're huge in Brazil, but it's a couple $100 million a year there. It's not a big profit center for them. They're going to have to try to hold on to China, which I think is going to be very difficult. The upside, or I guess the good side of that story, is because they own the truck and SUV markets in the United States, Ford, GM, and to a degree Stellantis, they just print money in this market. Stellantis is kind of more exposed because they're big in Europe as well, because it's really like a multinational 8-9 brand company now.
Yeah.
They're the ones who are going to have to fight against Chinese brands on multiple fronts.
So this is what we were trying to get at in the last hour, too, guys, is sort of, do you buy these stocks now? Oliver, obviously there are different issues with different auto companies, but it's like, how cheap can these guys really get in Europe? Like, or do you catch a falling knife?
Yeah, well, Listen, I don't know. I don't want to give any recommendations on buying this up. What I will say is, looking at the valuations, you really see a lot about what investors are thinking about in terms of these car companies. I mean, Volkswagen sold what, 8.2 million cars last year. That is, I think, the second biggest on the planet. They are worth less than so many of the other companies. They're worth less than Mercedes, than Porsche, which is part of them, BYD. And what's interesting, you look at Ferrari, right? Ferrari sells 13,000 cars every single year. This isn't obviously a perfect comparison, but you're within less than $5 billion of market cap, Ferrari and Volkswagen.
This is really interesting. Ollie, there are two different types of car companies in Europe. There are the luxury car makers, Porsche, Ferrari, Mercedes, etc., that compete well in China. And then there's the mass market guys. Two different, completely different models. Is there a danger that the European authorities are basically not taking action like we're seeing with the United States to protect the car industry? If you want to build EVs, if you want to sell EVs here, you have to make them here. The Europeans aren't doing that because they're too worried about Porsche and these companies in China, and therefore they're not going to protect their domestic market. Are the Europeans caught between these two markets effectively?
To a certain degree, but really what we have to think about is actually these Chinese players and the guys I've talked to here, they're going to build their own manufacturing capacity here. So even if you throw up these barriers at some point, they're going to start building that capacity here if they want to get serious about this market. I mean, listen, as far as investors are concerned, they're still rewarding luxury. They're still rewarding the very high end. I mean, I think one of the biggest takeaways for the audience here at the Munich Auto Show of the reveals, you know, BMW had a concept car. So too did Mercedes. The thing people really seem to care about was the new G-Wagon from Mercedes, the Mini G, the Baby G, like Kaleni has kind of teased to us here. So really that high end is still holding up, but really this is the concern. And for Volkswagen, listen, the hint is in the name. It's a car for the people. Getting that mass market for EVs is a huge challenge.
Yeah. Olaf Scholz, the pirate, was at the show saying that we shouldn't be afraid of the Chinese. A, have you seen the eye patch? B, what are people saying at it? And C, is he right?
Listen, I think that the eye patch has made obviously quite a stir. It kind of shocked everyone on social media, but I have to say he really dealt with it with a lot of humor. Came out and posted a picture of himself, kind of very professional shot with the eye patch on. And there's also this sort of minor party here in Germany, the Pirate Party, which obviously found this quite funny. But yeah, I mean, they shouldn't be afraid. I mean, everyone I've spoke to, and I asked all the European CEOs, and they say, listen, we need to embrace competition, and this isn't new, et cetera, et cetera. But you go to this auto show, you see the number of brands there. There is not enough space, I don't think, for every single one of these to succeed. There are a lot of brands that I had never heard of before and a lot of startups. And even on Friday, UBS put out a note that was read kind of like a eulogy for the legacy automakers. I asked Renault about it. However, the Renault CEO, he had a good amount of humor about it. He said that the rumors of his death had been far greatly exaggerated.
Makes you feel good to be a U.S. auto company that's just dealing with potential auto worker strike? I don't know. Guys, thanks a lot. Really appreciate it. I also didn't know that he literally was wearing an eye patch. I just got this in this moment. Oliver Crook, thank you. Joining us in Munich, and Detroit Bureau Chief David Welch. Now I know why you were calling him a pirate this whole time, Guy. I literally had no idea.
Yeah, so the whole weekend on social media, there's been all kinds of jokes and things like that. Basically, Olaf Scholz with a parrot on his shoulder, and various other kind of Johnny Depp type memes going around.
This implies the guy was on social media.
He handles it well. Yeah, okay, I see these things. I don't have to respond to them, but I see them. Anyway, we're going to go back to our question of the day. Why is the auto sector running on empty? Ursula Marchioni, appropriately named from BlackRock, joining us next.
So it's really, really hard to gauge what the labor dynamics are going to be over the longer run. We know that wages have been high and sticky. We haven't really seen a precipitous rise in wages. But broadly speaking, a combination of both higher oil prices as well as pressure on the labor markets, a very tight labor force, is going to continue to put some pressure on inflation.
Yep. Subhadra Rajappa, SocGen's head of US rate strategy, speaking to us, Alex and me, in the last hour. She was answering the question around the auto sector. Why is the sector running on empty? I'm going to come at this from a different angle now. the European auto sector in so many ways is emblematic of European stocks more broadly. Cheap for a long time, certainly versus the US, but cheap for a reason and good value. Key questions that I think still to be answered. Ursula Marchioni, BlackRock EMEA Head of Markets and Portfolio Solutions, joins us now. Ursula, European stocks have been cheap for a long time relative to their US peers. That valuation gap has got more and more stretched. The auto sector, I think, is kind of really emblematic of that. From what you see in terms of the flows that you watch, is there any suggestion that money might start flowing from the United States back into Europe, from the United States back into the rest of the world?
Great to be here, Guy. Thank you for the question. And yes, I think what you're pointing towards, I think, is a trend that we've been living in throughout 2023 as we adapt to the new macro regime, so higher velocity in sectorial and industrial rotation. We've been looking at ETP flows throughout the year, and I think you've seen two very clear phases. The January to April, I would say, where cyclicals were in favor. We saw a lot of money flowing into Europe, to your question, into Japan. And so again, that element crystallized. And then moving into May up to July, exactly, to what you're pointing towards, the trend reversed. We all went back from a global ETP perspective into sectorial, secular trends. So a lot of US equity buying, selling of Europe, to move into August, which I call a buyer strike. So beyond the summer lull, we've seen really people pulling back. And I think it was a bit of a muscle memory of 2022, equity and bonds correlation breaking down, going back to a situation where bonds don't provide ballast in a portfolio. And so to your question, going into year end, where to? I think it's an optimal time.
So where to then, Ursula? Is cheap good enough, or are there good enough reasons to say with safety?
Key question, Alex. So I think that I'll put out there a slightly different framework for us to think about the last 3 months and then preparing for 2024, and is one that relates to mega forces. So, trends such AI, aging demographic, the new banking world, and again, transition, geopolitical fragmentation. We've been used to these paradigm shifts, and we've been used about thinking how to capture them in the midterm. I think a lot of what we've seen this year is a proof in the pudding that many are starting to impact trading activity in the shorter term. So we just wrapped up earnings season. If you think about tech, if you think about European banks, the winners, I think they connect with some of those mega forces. And so as we move into year end, I think developed markets with a connection with AI will be an interesting cut to look at. And again, do you look at it as a region? Do you look at it as a sector question? But it's definitely a slightly different way to build portfolios and deliver alpha.
Are you confident that the trends that are in place now are going to be the trends that continue throughout the rest of the year?
Yes, I think these 5 elements are there and will play out, will continue to play out.
Right.
Again, other trends that we're observing that I believe will continue emerging markets. So from an exchange traded products perspective, again, despite the August buyer strike that I refer to, we've seen over 20 billion going in at global level into emerging market equities. And this year, of the 8 months that we've seen, 5 had inflows above 10 billion. So again, on a relative term, brighter growth prospects, a completely different rate cycle, I think points to the fact that this has legs to continue. And so going into year end, these 2 for me on the equity side would be areas to watch. And then obviously we can move into fixed income, which has been another big chapter as rates have reset.
Yep.
Ursula, how much do you think that this is fundamentally driven or sentiment driven? Like, how important does sentiment then become?
So, good question. So the other point that I would make in terms of what investors have been doing here today is there's been a lot of tactical trading, Alex, and I think that's where the sentiment really comes through. The big change at strategic asset allocation level in terms of adapting to a new rate regime, adapting to some of the big tectonic shifts that I refer to is yet to occur. And I think that, again, if you look at different components of money in motion, you will see the 2 playing out. In my opinion, going into year end and into 2024, we will see the strategic part becoming predominant. And so I would focus on the fundamentals, to your question, on the elements that are actually going to drive value and performance in the mid to long term.
All right, Ursula, thanks a lot. Really appreciate it. Ursula Marchioni of BlackRock. We appreciate your time. All right, coming up to the other story of the day is oil prices. Saudis and Russia prolonging their unilateral oil supply curbs by another 3 months. Oil rallies, no surprise there. We're going to break down the details next in the feed through to inflation. This is Bloomberg.
Roller coaster prices, supply chain glitches, political unease. Aon has expert points of view on volatility from around the world, paired with local insights that help me get back on solid ground. Better decisions. Aon.
So Brent, briefly going through 90 earlier on in the session, the reason for that, basically Saudi Arabia and Russia announcing they are going to extend their supply curbs to the end of the year, another 3 months. Alex Steele is surprised that anybody's surprised. Bloomberg's Will Kennedy, I'm sure, is totally unsurprised by this. He is the man you go to for the pulse of what is happening in the oil market. Surprised? I guess this is a shock.
There is a surprise here. Everyone expected Saudi Arabia to extend by a month.
A month, yeah.
The surprise here that they're doing it until the end of the year, and the Saudi oil minister Prince Abdulaziz bin Salman likes to keep the market guessing, and I think he did that today. People weren't expecting this 3-month extension. It shows the seriousness of their intent, and I think it's important that he's bringing Russia along with him, because although Russia's contribution is fairly modest, it shows that the OPEC Plus coalition remains strong politically, and that Riyadh and Moscow are working together to keep a grip of the oil market in the face of the challenges that they have.
Right, and obviously, I mean, yeah, 100%. I guess I'm surprised, again, why people were so surprised. And I'm wondering if the Saudis called the White House and said, hey, look, just so you know, like, we're going to be doing this, because there is literally, I don't see any lever the U.S. can pull to help out President Biden right now.
Well, I mean, as we've written recently, of course, the White House has denied this, but I think there are a lot of people in the oil market that suspect that the US has gone a little easy on Iranian sanctions and has been quite content to see this flow of Iranian crude into the market, which is one of the reasons why prices failed to get much traction over the summer. And the Saudis have countered. They have said, well, no, we are going to keep control of the market, and we're going to do what we need to do to keep the market stable and to maintain our focus on making sure that inventories stay under control and the inventories continue to decline. So will the White House be happy about today's move? Almost certainly not. It will ultimately probably lead to slightly higher pump prices, which is particularly damaging at any time, but particularly so as we go into an election year. But I think the Saudis would argue that it's a fair response to other things that have happened.
Okay, so how much higher? Because I want to take this into the inflation conversation. This is going to start bleeding into the inflation data we're going to start seeing fairly soon. Higher gas prices are a significant component. Is it higher for longer now? Is that what we should expect at the US pump?
I'm not going to forecast the price.
No.
It's not. Can we expect
if the Saudis stick to it?
I mean, we're in a more bullish situation today than we were this morning. And talking to people in the market, of course, when Saudi Arabia makes a move like this, one argument might be, well, it's actually a sign that they see something in the market that they don't like, that there's some demand weakness that they think they need to get ahead of. But people look fairly confident about demand. We've had senior oil traders in Singapore this week in their annual get-together of parties and dealing, and they've been saying, obviously China has a property problem, but actually demand looks fairly solid there in the rest of the world. So this doesn't look like a response to weakness. This looks like a move to assert more control and to tighten the market.
Well, Kennedy, great stuff. Thank you, as ever. Will, as ever, taking a more measured approach than maybe Alex Steele does. Alex isn't surprised. Will sees the surprise element here from the Saudis. The Saudis, to be fair, Alex, the Saudis are going to need all the money they can lay their hands on, because they're going to need to continue to pump it into the Premier League, where certainly their money is having an impact. And it's interesting, Manchester United shares today getting smashed lower. The Mail on Sunday saying that the Glazer family apparently could be considering taking the club off the market. That's the impact on the share price, as you can see. Closes next. This is Bloomberg.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
To be honest, I was hoping for a little bit more excitement on my first day back. European equities at a headline level going nowhere in a hurry. What has basically happened is that the Chinese data overnight has acted as a little bit of a brake on any go forward. But it's not been a big enough break to really kind of pull the market back. So the market's just kind of gone sideways today. Within that, there are some interesting sector stories. But basically, broadly, DAX is down by 0.3%, CAC's down by 0.3%, the FTSE's down by 0.2%. None of this is particularly exciting. It's not kind of telling us much about what September is going to deliver for us. Let's talk a little bit about what is happening with the session. You can kind of see the China effect first thing, the gap lower. We kind of climb a little bit, try and get out of that, but actually, to be honest, just drifting lower in the afternoon. I think the effect here is, there's a bunch of factors here. The oil story is a kind of macro headwind, and I think that probably has been representing it, but it's not been a big enough headwind. So basically, the market's just kind of gone nowhere, down by 0.2%. If that's what we get in the whole of September, that will be a result. Like historically, that's not what September normally delivers. Q4 is usually better, but September not so much. This is the picture in terms of the single stocks. Let me just run you through a few names. Orsted's been under pressure. There's been a downgrade from a ratings agency on the back of what we've seen today. So Orsted is down by 8.28. I think we've also seen a sell side down note on that stock as well. Kering is down on the China news. The luxury, anything with exposure to China today has been under pressure. So Kering's been down by 2.13. And Sectra. This is a company that does kind of healthcare imaging and cybersecurity, which seems like an odd combination, but there's a margin hit here that the market hasn't liked, and that stock's been marked down quite aggressively. We're going to get a drip, drip, drip. There's still companies reporting. It's kind of a drip, drip, drip over the next few days. Talking of the day ahead, let's talk about what is happening and show you what the picture looks like. Andrew Bailey is going to be testifying. We'll get his take on what is happening with the economy. The UK economy is a complete mystery. Absolute mystery at the moment. The data revisions that we're getting are so epic that, to be honest, my head is spinning and I really can't figure out what is happening here. I suspect the governor of the Bank of England is going to have to try and address that issue tomorrow. We get German factory orders as well. Keep an eye on what is happening there. Barratt Developments, what is happening in the UK housing market is interesting at the moment. The rates transmission story, I think, is fascinating. It's certainly biting. And you are going to see that, I think, reflected in Barratt. But the different house builders are actually performing differently at the moment, which is interesting because they've been traded as a block. And then I think we get to what is the main event tomorrow, actually, in some ways. The Digital Markets Act deadline is going to come through. We know what the gatekeeper companies are that are going to be affected by this. We just don't understand exactly which parts of their business. We're talking about big US companies like Apple, which parts of their business are going to be affected, Alex. And I think this is going to be really fascinating. As ever, the US provides the innovation and the Europeans then regulate it. Seems to be the model. Does it work?
Yep. That's a great perspective there. We do the innovation, you guys do the regulating. See, there's stuff happening. He makes it seem so boring. Let's get more on what to expect from the EU taking on big tech. Joining us now, Bloomberg's EU competition reporter, Sam Stolten. Sam, this time tomorrow, what are we going to know? What are we going to learn?
Hello there from Brussels. And I think the idea, actually, just to respond to some of those earlier comments from the EU, is to regulate in order to innovate. At least that's what they would argue. But yes, indeed, tomorrow we are expecting the European Commission to publish a list of so-called core platform services, things like potentially Apple App Store, Apple iOS, Microsoft's LinkedIn, Microsoft's operating system, Google Search, etc., that will come under the scope of these landmark new digital antitrust rules known as the Digital Markets Act. And now what these actually do is present so-called ex-ante rules for the digital economy, a series of do's and don'ts for some of those big tech giants.
Are they going to push back, Sam? Are we going to see significant pushback from these big US companies?
Well, if you look at the history of sort of antitrust regulation from a Brussels perspective, there has been quite a combative dynamic between some of those big tech players and the European Union's antitrust regulators. Apple for one, Google for another, have been two companies that have obviously faced off against the Commission regulators and the legal services in the European Court. So yes, indeed, there are likely to be legal challenges against some of these rules coming ahead. And the first step of that would be against some of these designation decisions that the Commission will announce tomorrow.
I love how you put the whole regulate to innovate versus maybe the U.S., which is innovate and then maybe sometimes regulate. And you can definitely see that in terms of the energy transition, too. And I'm wondering, like, what a win would be here for the EU, that they regulate these big guys and then, like, a bunch of smaller companies start up and do some cool stuff. Like, what's the goal here?
Well, ultimately, that's what they want to see. They constantly use these two terms, fairness and contestability. And in the sort of economic world, the term fairness is quite a contentious one because no one actually agrees on what it means. But what the EU really wants to see, I suppose, widespread across the European economy is the emergence of a new front of European tech players that could actually one day compete on the global stage with some of those giants from Silicon Valley.
What can we extrapolate forwards to how the EU is going to deal with AI?
Well, the AI Act is obviously going through the interinstitutional process here in Brussels. There are heavy potential regulations in place there. A lot of them will target perhaps the areas that we've known the EU to focus on before, like privacy, data protection, things like that. Now, that doesn't really come into tomorrow's announcement, but of course, in the future, should AI tech become more prevalent in our lives, we could see some of those next generation artificial intelligence technologies included on the list that will face new restrictions, for example, on data sharing or on the extent to which they can access gatekeeper services.
Sam, great to catch up. Thank you very much indeed. Sam Stolten joining us out of Brussels on what we're going to learn tomorrow. European stocks done for the day. To be honest, not really very much action. I think people are drifting back clearly off holiday. Kids are going back. Maybe we'll see some more action tomorrow. The oil price story, I think, has been the real takeaway. Early action, early doors, driven by China. The afternoon session, I think, largely driven by this move that we're seeing in the oil price. The Chinese, the Russians and the Saudis supporting that price. So those are the numbers. That's where we've closed. Not much action. We're going to see volume, I suspect, picking up as the rest of the week progresses as well. Coming up, global economic weakness certainly driving investors towards the US dollar. The US dollar at a 5-month high. The buck certainly doesn't seem to have stopped just yet. Elsa Lignos, RBC Capital Markets Global Head of FX Strategy, joining Alex and me next. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
This is Bloomberg Markets. You're looking live at the principal room. Coming up, Jeremy Grantham, GMO co-founder and long-term investment strategist. He's going to be on Bloomberg Wealth with David Rubenstein, Tuesday, 9 p.m. in New York. This is Bloomberg. So the Bloomberg Dollar Index hitting its highest mark in 5 months, thanks to weakness that we're seeing in the rest of the world. Joining us now to figure out whether or not the buck has actually stopped or whether it's got legs. Can we see further moves? Elsa Lignos, RBC Capital Markets Global Head of FX Strategy. Elsa, you've been quite positive on the dollar throughout this year, but can we really see further gains from here?
I think some modest further gains are certainly possible. In my mind, there are two things that are really driving the US dollar at the moment. The first is a very simple cyclical story. The US, in relative terms, still looks like it's doing better than the rest of the world, whether that's China and the weakness we saw overnight in PMIs or the euro area, and we've seen a lot of weakness in the data there. And then the second thing is the joint twin bond equity sell-off we're seeing at the moment. And when you see yields moving higher and equities moving lower at the same time, it always tends to support the US dollar.
So based on that, I'm wondering where the cracks will form. Obviously, I'm going to look at dollar yuan and what's happening in the offshore market and sort of the implications then of a stickier, stronger dollar.
Right, and I think that's certainly been on a lot of people's radar because you've had that pressure in CNH funding, that squeeze in funding in the offshore market. The PBOC has very much set out its intent with those fixes, much lower than expected fixes in dollar CNY. I think for me, though, the more interesting one to watch is dollar yen. I mean, that's been one of our key calls this year, dollar yen topside. And the market has been very much wrong-footed there. A lot of people were looking for dollar yen lower. And even though I think positioning is a bit more neutral now, there's still a lot of people thinking it kind of should be topping out around here. And if that does break high, I think that's where more pain is to come.
Okay, let's talk about the extent of that pain. The dollar is a wrecking ball that kind of works its way around the world. Where do you think, if we carry on even at this level, Elsa, where does the pain get felt?
So you can feel it in a number of different ways. You know, you should be looking to certain emerging markets in particular. Chile is an interesting one. They did have relatively high rates. They've started cutting quite aggressively. Now, if you get to a situation where rates in Chile are at or below the Fed, why hold the Chilean peso when you can hold the US dollar? And I think that will be where you see a lot of the pain. When you think about the yield on offer in the US dollar, it'll be in some of those lower yielding emerging markets where most pain could come.
So, so then what's the trickle down for that? Like, I appreciate that emerging markets might not have a lot of stuff to do to support their currency, but if we just take a look into the yen, for example, like supporting the yen, dealing with capital outflows like the UN, selling treasuries, like, are we going to see that sort of second, third round effect, or have we already seen it?
That's been a really interesting question. I think it was an argument being put forward earlier in the summer for potential weakness in the treasury market, the idea that central banks would be selling their reserve holdings in order to intervene and support their currencies. But I think a lot of that perhaps is somewhat overstated, that the duration of the bonds held in order to support the currency is actually a lot shorter, that central bank reserve managers do have pools of liquidity to access. They're not necessarily going to be selling, you know, their 10-year bonds in size in order to support. And at the same time, this isn't a huge dollar move. I mean, it's been a kind of steady grind higher all year. It's definitely caught some people out because there was this expectation that 2023 was going to be the year that the dollar would roll over and start trending lower. But at the same time, you know, I'm not calling for huge gains for the US dollar from here. It's more a kind of a grind higher. But those hopes for dollar bears are just slipping away into the night as they come around to this idea the US is still that relative cyclical outperformer.
Elsa, in an environment where all of the major central banks are done hiking rates, how does that shake out into the FX market?
You know, I think that's the point where we need to start thinking about the role of the level of yields, not just the yield dynamic. So when you think about an environment where central banks are going to be cutting at some point, but perhaps not as quickly as people initially thought, we're then left with the role of carry, and not just carry EM versus G10 or even EM versus EM, but we're actually seeing carry on offer within G10. And I think that's what we keep coming back to. You know, it's not just a source of support for the US dollar, but even things like the Kiwi dollar, which have been pretty unloved this year, can actually do reasonably well against the lower yielders in G10, the likes of the Swedish krona or even the Japanese yen.
Going to Europe for a second. Why isn't the euro lower, considering all the growth implications that we've seen from the hikes that have already happened? And I appreciate that there's still hawks on the ECB, but highlighting the growth issues versus the inflation issues over the last couple of weeks. Why aren't we lower here?
It's a good question. I mean, we have come down a fair bit, right? It's not that long ago we were well above 110, kind of pushing up towards that 113 level, and now back at 107. So it's been a fairly sizable move. And, you know, the fact that we're not lower is in part because there's definitely been that negative bias. The market is already biased short euro dollar. And there's still some question marks around whether the ECB could deliver one more hike. Now, you may question whether that's really a good thing for the currency in the face of, as you said, you know, those growth concerns. But I think FX traders tend to look at things in quite a simple way. And, you know, higher yields tends to be positive for the currency, even if longer term you may really question that.
Elsa, how do you trade the UK when the economic data is being revised as aggressively as it is at the moment?
I feared you might ask that. And honestly, I think people have altogether given up on the pound this year. You know, there was a big buy earlier in the year. We were also in that camp. It hasn't really worked. And I think people are just steering clear of it at the moment because it's just very difficult. You know that the higher rates are biting. They're starting to bite, and you can see that feeding through in some of the data. But it's just very difficult trying to trade that in the currency. So it's probably one I'd steer clear of.
All right, Elsa, thanks a lot. Really good to see you. Elsa Linios of RBC Capital Markets. Thank you very much. Guy, did you do okay on your exchange rate on vacation?
Yeah, the pound's actually done relatively well this year. So relative to, it's been, you were getting 1-for-1 for a while, euro to sterling, and that really hurts. So it's not quite as bad as that. But yeah, no, the pound has been stronger in my memory.
Okay.
So yeah, it still feels quite tough. But yeah, no, it's better than it has been.
Okay.
I'll take it as it is.
Your flights were bad, but at least the exchange rate was okay. Fair enough. All right, this is Bloomberg. A very good morning. Welcome to Daybreak Australia. I'm Heidi Stroud-Watts in Sydney. We're counting down to Asia's major market opens.
Good morning. I'm David Ingles in Hong Kong. The top stories this hour: a subdued open ahead for Asia after the U.S. holiday. Australia's Reserve Bank is expected to hold its key rates at Governor Phil Lowe's final meeting.
China's housing crisis threatening to engulf its surviving developers, with about 2/3 of 50 major private builders in default.
And Chevron begins mediation with workers at its Aussie LNG plant as unions threaten strikes as soon as this week. Yep, lots to watch as we get underway today. In terms of just the market action, the lack of it at least here, just keep in mind we're coming off a U.S. holiday. That being said, maybe the early indicators suggest that it could be, as we did point out earlier on a few seconds ago, a subdued open. U.S. futures are coming online as we speak. Among this, of course, we're focused in on what's been happening in the oil market. And yep, we're at 86, thereabouts there, the most active contract on U.S. crude. And that being said, though, perhaps also a proxy of risk appetite overnight, perhaps not completely all the way, given that volumes were extremely thin, was over in Europe, where we closed essentially flat to lower. But certainly, make no mistake, in terms of the market action, the price action did suggest that we basically cascaded down in terms of price, erasing most, if not all, gains just about across the board here. Euro's trading just under the 108 handle, and we're moving into a session, Heidi, where we have subdued open, and of course some earnings coming through as well.
Yeah, Trip.com, second quarter adjusted earnings per ADS beating estimates. That second quarter, those earnings at 5 yuan 11. The estimate was for 3 yuan 64, so that is a beat. The revenue for the second quarter at 11.2 billion yuan. The estimate was 10.78 billion yuan. So, you know, one to watch in terms of just being obviously a big bellwether for that reopening story out of China, the domestic
as well as overseas travel recovery story that we continue to watch. We see really across the board a bit more strength than expected. Accommodation reservations were much higher year on year and also beating estimates. Transport ticketing also pretty robust there as well. A slight beat on estimates. We're also seeing some improvement when it comes to package tour revenue and corporate travel as well, seeing a little bit of a gain there. Let's take a look at our Asian markets and shaping up. And of course, front and centre today will be the RBA decision. As you mentioned, Dave, at the top, this is the last after the outgoing governor, Phil Lowe, of course, as he hands over the reins to the new RBA governor, Michelle Bullock. We are expecting a hold for a third straight decision. This is, of course, borrowing costs in Australia. Rates are still sitting at, about an 11-year high at the moment. And there's quite a bit of political pressure as well in terms of the cost of living crisis. So watching the communication out of that, we had the inflation gauge rising to a 4-month high in August as well. So really giving the RBA potentially a little bit more of the impetus to hold there as well. The Aussie dollar holding pretty steady at 64.63 at the moment. The Kiwi stocks are really not doing much of anything, and dollar yen holding at 146. So let's get some more when it comes to what we're watching on the Reserve Bank of Australia. So inflation is still well outside the RBA's target. There is an argument for kind of waiting and seeing.
That does seem to be the prevailing view. Inflation is trending in the right direction. The July read for CPI, 4.9%. That was a lot lower than was anticipated. We get the third quarter read, which is the one we really watch at the end of October. But there's been this lagging impact of 400 basis points of tightening since the end of the pandemic, and it seems to be doing the job. And those increases so far are another reason to sort of sit back and wait, because Australian households have a lot of debts, property's expensive, mortgages are really big, consumer confidence is weak, and the RBA is quite keen to lock in the job strength that we've seen as well. So what's going to be next under the new incoming governor, Michelle Bullock? Well, as you say, a tightening bias. She was saying this week we may need to raise rates again. Money markets say that's it, we're done for 2024. Economists see maybe one more towards the end of the year.
Paul, it's the end, of course, of this 7-year term for Phil Lowe. I mean, many years from now, as we lay in our beds, how will we remember the RBA governor?
Well, I guess you could say inflation, a two-part story. When he got the job back in 2016, there was none, and during the pandemic, there was even less. And here we are at the end of 7 years, and the RBA is still battling to get the whole thing under control. But his legacy was punctuated, unfortunately, by a few communications missteps. We had that situation where the market effectively strong-armed the RBA into ending it or abandoning its 3-year yield target. But then the worst of all, when Phil Lowe said in 2021 that we wouldn't be seeing interest rate rises until 2024. And then just a few months later, we embarked on the fastest tightening cycle that Australia had ever seen. That led to a media pile-on, people complaining about mortgage stress, and it really became untenable politically for the government to give him the 3-year extension that his two predecessors got.
There we go. Paul Allen in Sydney for us. Let's get to your top geopolitical stories that we're tracking as we get underway this Tuesday in the Asia Pacific. China has criticized President Biden's strategy toward Beijing as being doomed to fail. In a WeChat post, the Ministry of State Security says that the current American focus is no different from its previous approach of engagement and containment. Now, the public criticism comes less than a week after U.S. Commerce Secretary Gina Raimondo visited Beijing in a bid to bolster business ties. Now, Russian President Vladimir Putin has rejected Turkey's efforts to restart a landmark deal which allowed Ukraine to ship its grain through the Black Sea. Putin told Turkish President Recep Tayyip Erdogan that he won't consider reviving the deal unless the West removes obstacles to Moscow's own agricultural exports. Global wheat prices have remained quite volatile after, of course, Russia left the deal that was back in July. Now, the U.S. says North Korean leader Kim Jong-un is expecting leader-level talks with Russia over providing weapons to support Moscow's war in Ukraine. The White House National Security Council is calling on Pyongyang to seize the arms negotiations, which they say are actively advancing. The New York Times has reported that Kim intends to meet with Putin later this month in Vladivostok to discuss, Heidi, those weapons. Heidi.
Well, Dave, let's get more on one of our top stories that we're following and so key for market sentiment. Chinese property developer Country Garden is facing what could be its first default. The builder has until Wednesday at the latest to make interest payments on a dollar note. And Annabelle's tracking these developments out of Sydney. So, Belle, the clock is ticking.
Yeah, I mean, Heidi, we're pretty much coming down to the wire on this. But going through the details, so it's two different coupon payments. When you combine them together, we're looking at interest payments of $22.5 million. Now, you say Wednesday at the latest, and that is true, but actually, even that has been very opaque from the company because we know, for instance, there's been a little bit of confusion whether it was due on September 5 or September 6, and the ambiguity coming from different interpretations of what is pretty standard wording in the offering memorandum. So this is the state of play, but the question, of course, is how likely is Country Garden to be making these payments? And the analysts that we've spoken to, including those at Credit Insights or Credit Sites, saying that Country Garden is going to be really incentivized here to make this payment because what they could be looking to try and avoid is the risk of cross default. So it means that if Country Garden does default on its dollar-denominated debt, then it could be automatically considered to be in default on other debt as well. And so that's a situation it wants to try and avoid. There is also that breathing room that the company has earned in the last couple of days. So, for instance, we saw it making payments, we were reporting that it made payments on a ringgit-denominated bond, and then as well it was able to stretch out the debt deadline for yuan-denominated debt as well. So that's some of the indications. For instance, we know that this company is really incentivized to make these payments, but sources have told us that as of Sunday, they were yet to make these repayments. So certainly one we're going to be watching very closely. And as we know, the risk of default here is even greater than, for instance, Evergrande that defaulted back in 2021. And that's because Country Garden just has so many more projects in the pipeline.
It is worth pointing out, Bella, as you perhaps are just alluded to there, that while we talk about Country Garden this way, it is one of the few Chinese developers, at least of this scale, that actually has not officially defaulted on debt.
Yeah, absolutely. I mean, when you look at this category, so just think about the private builders in China and you take a look at the top 50, for instance, 2/3 of those have already defaulted. And Country Garden, yeah, it's just one of 16 out of 50 that have still been able to honour all of their debt obligations to date. But it is a group that is really facing a lot of payment pressures over the coming few months. So if you take a look at a graphic here, it can show you that there are essentially 16 of them, and just this month alone they're facing about $1.5 billion of bond payments. So that's the highest amount until we hit January of next year. Country Garden, of course, we've been speaking about that, but there are other ones that our Bloomberg intelligence team is highlighting as well, and that's Season, Agile. These are stocks that are down in the double digits over the course of this year. Other ones that we've been speaking about, so in that group of 16, some of them do have a little bit of state backing, so they're considered to be a little bit more secure. But certainly, Davis, yes, as you say, we really have seen a lot of defaults, in Country Garden so far has been able to avoid that to date.
Brett Bell and Sydney Forrest there, and certainly one to watch as we make our way into the open today. But it's worth pointing out that Chinese equities, the property stocks, did have the best day, just about his second best day, to be more specific, this year so far. Watch out for that. Just ahead here, and shows more on the RBA's policy path, with Commonwealth Bank, who expects the cash rate to stay on hold through 2023 before easing begins, in their view, first quarter of next year. But ahead of that, Pepperstone Group tells us why they're seeing this positive backdrop for perhaps more gains in the equity market. Chris Weston joins us in a couple of minutes to unpack that thesis. Plenty more ahead. This is Bloomberg. Good morning.
Thursday. Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
All right, this is a picture when it comes to US futures. Of course, this Labor Day long weekend, no trading there in the US when it comes to the stock market. We are seeing futures sitting a little bit low. We had JP Morgan, of course, saying that US stock investors have gotten so confident that there's a complacency in sentiment that is evidence with the VIX near a record low, positioning has increased. So we'll see how that sort of reopening post-long weekend goes for US equities when we get there. Sydney stocks looking pretty muted, a bit of caution today going into that RBA decision, but of course they're widely expected, seen holding interest rates unchanged for the final meeting for Governor Lowe. This will be the third straight meeting where they leave policy untouched, with that key rate sitting at 4.1%, about an 11-year high there. But watching for any communications as to whether the incoming Governor Bullock will be perhaps a little bit more biased towards further tightening. Inflation, of course, still out of that target range, but trending in the right direction. Kiwi stocks are seeing a little bit of optimism there in Chicago. Nikkei futures up by just about 0.4%. We're watching JGB markets as well, with the government set to test their demand when it comes to the bond market. We're seeing upcoming auctions in the key 10 and 30-year maturities this week. We had, if you recall, investors really bulking at the yields that were on offer last month. Let's get some views from our next guest, who says that while he sees some exhaustion among buyers in equity markets, there's still a positive backdrop for equity appreciation. Chris Weston is the head of research at Pepperstone Group, and he joins us now from Melbourne. Chris, great to have you. Happy RBA Day. Where do you see the pockets of opportunities then, given that, you know, I was just mentioning this JP Morgan view, valuations are just so stretched across a lot of developed markets now?
Yeah, I mean, I think valuations is something that a lot of theoretical strategists will point to. As I think positioning is probably the more important one for me. And positioning is definitely rich, but I think momentum favours the bold at the moment. And I think a bit more buying in growth and tech, and I think you're going to see new highs coming through in the Nasdaq. I like the way the Qs are trading. I think Nvidia still looks pretty strong into $500. Apple, I mean, it still needs to close the gap that we've been seeing as we go into next week's release of the iPhone 15 and various factors there, the big Wonderlust event. So that still looks like it's trading firm. I think tech and growth still has some good bearing. Obviously, there's real risks that positioning is incredibly rich. The flows have been substantial, and I think that if we were to see a big move up again in real rates, then obviously that would put that trade into question. But I think that's where we're still seeing the movement, and I think strength breeds strength from this market. I think momentum strategies are where you want to be in the equity market.
Yeah, and so you would expect that momentum to continue when it comes to the broader AI narrative. It's interesting that you picked out NVIDIA. Of course, it's a darling, but I was actually pretty surprised by the lack of reaction or positive reaction from the markets, even with a pretty stellar set of results.
Yeah, I think that's a lot of people taking that one out. In fact, if you go broadly across the S&P, taking out away from the AI space, and names that have beaten expectations, actually pretty flat on the day of actually earnings. And that's not something that we've been seeing over prior earnings seasons. Is generally speaking, when companies beat by some way, you tend to see this outperformance, not just on the day, but this ensuing outperformance playing through. And so that may be a sign of fatigue creeping into the markets, that good earnings should be outperforming. That's not necessarily happening to this extent. But I still think in this world where we're looking at labour markets, for me, which is the key trigger for a general sort of deleveraging risk-off move to play through, that the labour markets that we're getting from the JOLTS report, from the payrolls numbers, are going to keep bond yields fairly well contained, real rates fairly well contained at these levels, and we're probably late to trade in a sideways trading range for the moment. And I think that you go into the end of the quarter and you're going to see people looking to chase returns at this point. So I think that's going to happen in the AI names, in the mega cap tech names. I think that's where you're going to be looking for that end of quarter chase goes on as we're going through to September there.
Chris, we've just got some breaking news when it comes to Qantas. Of course, this is a company that has been really not far from headlines recently, at least here in Australia. There's been an announcement made when it comes to the succession. Alan Joyce will bring forward his retirement by 2 months. Of course, we knew that he was already leaving, coming to the end of his tenure. We are seeing that Vanessa Hudson, of course, the CEO designate, will become Managing Director and Group CEO on September 6th. So bringing forward his retirement by 2 months. And of course, perhaps, this is a little bit of a surprise surprise in terms of the timing, but when you take a look at the backdrop of all of the pressure that's come under Qantas, including allegations by the ACCC in terms of selling flights on cancelled or selling seats on cancelled flights, there's pursued for a record penalty for the allegation of these, so-called bogus seat sales, not to mention some of the further criticism on the pricing of flights and availability of crisis. This country in so many ways is undergoing this cost of living crisis. So Qantas now announcing that the CEO designate Vanessa Hudson will assume the role of Group CEO by the 6th of September, Dave. So I guess, Qantas, the board, they're really hoping that we'll see a bit of a fresh start, but clearly a lot of the same regulatory and legal problems will now be Vanessa Hudson's responsibility to try and resolve.
Yeah, and we'll see what the market makes of that when this market opens up. And, as you alluded to, it's been terrible of late, and certainly the stock price itself has reflected that. We've broken through the 580 handle, which basically takes us back to levels, interestingly enough, going back to the midst of that reopening rally, amidst that reopening in China, of course, and obviously Qantas may be perhaps one of the proxies for that, of course, as a sort of global benchmark there. Let's bring back Chris Weston. He's still with us. He's been patient waiting as we broke that news. Chris, just to pivot away from that, what do you think the pain trade is at the moment?
Well, I think it's down, given that positioning is so rich. And I think, a lot of the hedging flows have come out of the market. I mean, if you look at skew, normalised skew in S&P, 1 month skew, that's come back a little bit. So people have reduced some of those hedges playing through in the market. And I think people have just been questioning what is going to cause a lasting bout of volatility, which would need us to sort of look at hedges, whether that's looking for something like the retailers as an XRT hedge, gold as a hedge, and just looking for those catalysts. It's not immediately apparent that it's going to come anytime soon. I think we need to see a trend in the labour market data to really ramp us up those hedges. So, I think that if you look at the skew at the moment, I think there's real risks that we go into new all-time highs in the NASDAQ, as I talked about there. But I think the way that the positioning is at the moment, if we did see a 5-10% drawdown, I think you could see a lot of people scrambling for that, and that would be where the pain trade lies.
Chris, I love the emphasis on positioning. You started out with that as well. You just mentioned it just a couple of seconds ago. You favor the U.S. dollar right now. Is that also a function of positioning, and against what and why?
Yeah, I mean, whether you're looking at that on a leverage funds, or asset managers, real money accounts, or even retail, which of course is where we focus more on. I certainly think retail at the moment is looking precariously short on US dollars. The market generally is pretty long of US dollars if you're looking at real money, and I think that's probably the right position right now. It probably would need a bigger to get the US dollar pumping again. I think you're going to need to see the US dollar come into its own once again as the preeminent hedge against drawdown, given its significant negative correlation against the S&P. You'd need to see a general increase in the distribution and a belief that we are going to get that 5% move down to see people wading back into the US dollar to see it break through those 104.50 levels in the Dixie. But position is pretty rich. Certainly against the euro, where people have been trading this one against down into the March uptrend. But I think if you want to see the dollar push into that sort of trend and that momentum again, you're going to need to see a general belief that we're going to get that 5% drawdown and the US dollar come into its own as that hedging mechanism again.
Chris, thank you. As always, sir, have a great rest of your Tuesday. Chris Weston, the head of research at Pepperstone Group. Futures are just pointing lower and turning lower as we just speak. They're breaking news out of Qantas, of course, with Alan Joyce bringing forward his retirement by 2 months. More on that, plus plenty more ahead. This is Bloomberg. Welcome back. Let's get to some of your top stories out of the Munich Motor Show. Let's start things out with BYD here. So it is, in fact, setting its sights on Europe after dominating the EV market in China. Their Europe managing director told Bloomberg that they are actually planning to announce a factory location in the region by the end of this year. The EV giant also presented the first prototype of its future lineup there at the Munich Motor Show.
We've got a very good marketing performance in China. Europe is our strategic market, and we want to try. We want to communicate with the customer here, and let's see. The IAA is a great opportunity, and to have this conversation. We love to be here, and to hope every customer in Europe can visit our booth in Munich.
Now, Renault says that it will resume talks with potential investors for the planned listing of its EV unit Ampere. Now, the CEO, Luca De Meo, told Bloomberg that they have received very positive feedback during some 35 meetings before the summer. He adds that a separate listing will allow, of course, the company to reduce costs by as much as 40% in its next generation of EVs. Heidi.
Yeah, Dave, let's get to some of the other corporate stories that we're tracking this hour. Bloomberg has learnt that Huawei and China's top chipmaker, SMIC, have built an advanced 7-nanometer processor to power Huawei's latest smartphone. That's according to the teardown of the handset, conducted for us by Tech Insights. The processor is the first to utilize SMIC's most advanced 7-nanometer technology. Still, much remains unknown about SMIC and Huawei's progress, including whether they can make chips in volume or at reasonable cost. Alibaba's cloud division is said to be weighing a private round to raise funds from Chinese state-owned enterprises ahead of its Hong Kong IPO. Sources say the tech giant is working with advisors on a potential cloud intelligence unit, fundraising that could raise about $1.4 to $2.8 billion. Prospective investors include state-backed telecommunication companies. Coming up next, live after low, we get Commonwealth Bank's outlook for RBA policy as the current government prepares to lead his final meeting in charge. This is Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. Whilst I love the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
Welcome back. You're watching Daybreak Australia. Lots to focus on in the next few minutes or so. So, life after low and also life after Joyce. Two big stories out of Australia this morning. We'll unpack in the next few minutes or so. To get you a sense of what's ahead, of course, the final policy meeting of the year, Phil Lowe, of course, is today. The RBA is set to keep its rates unchanged amid this mounting signs that its most aggressive tightening cycle in decades really has slowed inflation without any serious economic repercussions. Well, so far, let's see. PMI numbers for August are also due out the next hour or so. Now, tomorrow, we look ahead to some growth numbers coming through second quarter GDP, which is likely at least to show modest growth momentum, largely driven by exports. Now, speaking of exports, trade numbers are out the day after that. That's on Thursday. And also on that day, Lowe will also give his last speech as the governor of the RBA before he steps down of September 17th.
Yep, and that last meeting for Phil Lowe happening in just a few hours' time. It has been, David, a tumultuous 7-year term drawing to a close. And as we look ahead, and of course we're expecting Michelle Bullock to take the helm, Bloomberg's Paul Allen takes a look at Lowe's leadership through some extraordinary moments.
Phil Lowe's 7 years as Reserve Bank of Australia governor could perhaps be characterised by one word: inflation. When he got the job in 2016, inflation in Australia was barely above 1%. In his first appearance in front of a parliamentary committee, he had to defend the bank's apparent obsession with how to stir it.
We've not been what some have called inflation nutters. We've had a more balanced perspective, recognising that some degree of variability in inflation from year to year is both inevitable and appropriate.
CPI didn't vary that much in the years that followed, barely touching the lower bound of the RBA's 2 to 3% target band, until the COVID-19 outbreak, when inflation briefly dipped below zero. The global pandemic was a black swan event none of Lowe's predecessors had to deal with. After slashing the cash rate to a record low 0.1%, he came to utter the words that would ultimately contribute to him losing his job.
We are likely to be at the current level of interest rates for an extended period of time.
In March 2021, he even put a date on it, saying the condition for an increase in the cash rate is unlikely to be met before 2024. Many Australians took him at his word, taking out ultra-cheap mortgages as the property market roared back to life, only to be wrong-footed. So much for 2024. By May 2022, inflation was running red hot, and to contain it, the RBA embarked on the fastest pace of rate increases in Australia's history, 400 basis points in 14 months, leading to some very awkward questions.
Do you accept that you did, in fact, induce Australians to take out mortgages on the basis that interest rates wouldn't rise until 2024? And do you think you owe those people an apology?
Well, I'm certainly sorry if people listened to what we'd said and then acted on that, what we'd said, and now regret what they had done. So that's regrettable, and I'm sorry that that happened.
Lowe's hopes of getting a 3-year extension as governor were effectively dashed. The responsibility for defeating inflation now passes to his deputy and incoming governor, Michelle Bullock, the first woman to lead Australia's central bank. Paul Allen, Bloomberg, Sydney.
Well, as we await that changing of the guard at the RBA, and our guest expects the central bank to keep its cash rate on hold for the rest of this year. Let's bring in Belinda Allen, who's the senior economist at the Commonwealth Bank of Australia. Belinda, great to have you with us. And let me just throw up this chart to kind of set the scene. We are expecting that third straight meeting to be a hold for the RBA. Rates are already sitting at an 11-year high. Inflation is trending in the right direction, but of course still well outside the target band. Is there a good rationale for you in terms of just waiting and seeing how transmission plays out, or is there a risk that we see it get out of control again?
All signs are pointing to inflation coming down. That's certainly the experience we've seen offshore in Australia's peer economies as well. So we are confident that inflation will get closer to the Reserve Bank's target band over the course of the next year. Certainly, we've started to see a loosening in the labour market. Consumers are winding back spending. So all of that's working in favour of inflation coming back down. I think the risk, if any, is we do see, though, that sticky services inflation keep the RBA on edge for the rest of this year.
What are some of the elements that could kind of confuse the outlook, right? We have seen things like, extreme weather, for example, protectionist policies when it comes to soft commodities. Are those elements that you're watching for, I guess, in the more of the medium and long term that could complicate the inflation outlook?
Definitely in the medium term, climate change, transition to a lower carbon future are things we're looking over the medium term. In terms of the next 12 months, it really will be wages growth and services inflation that keeps the Reserve Bank on edge over inflation. The third quarter wages print will pick up that higher than expected lift in minimum and award wages that was handed down from the 1st of July. So the risk is a resilient labour market could see further upward pressure in wages growth that would push inflation higher. I think the other key risk that we need to also talk about is a recovery in home prices that we've seen in Australia, and whether or not that keeps the Reserve Bank on edge and we see a more resilient consumer as a result of the wealth effect. That's not our base case, but that's where the risks lie.
What then, Belinda, David here, by the way, what then is your base case on both the labour market, the resilience, yes, you point out, and also the housing market?
So we expect the labour market to continue to loosen from here. So the latest print we got for the unemployment rate was 3.7%. We have it above 4% by the end of this year. then around 4.5% by mid next year. So that's a faster deterioration in the labour market than what the Reserve Bank is currently expecting. We have a huge lift in the labour supply here in Australia through very strong population growth. On the home price side, we expect home prices to lift by 7% this year and another 5% next year. That will take home prices about 3% above the levels they reached back in 2021. So once again, supply and demand fundamentals here in Australia are very poor at the moment. We have large population growth, very limited supply of housing on the market. So that should push up home prices. If anything, the risk is for a stronger lift, given we have the Reserve Bank of Australia actually cutting the cash rate next year.
Belinda, the other big unknown is what happens with China. And I guess my question there is, what if China recovers? What's that transmission effect? How does that affect policy dynamics in Australia?
It's a good question. We've obviously seen the impact on the slowdown from China, both on commodity prices here, and that's dragged the Australian dollar lower. So if we do see a large stimulus announcement, that's obviously going to boost commodity prices. That poses upside risk for the Australian dollar. And then also what it does is it continues to boost revenue flowing through to the Australian economy. So the government budget then looks better. It's already in a pretty good position at the moment. And we also continue to see big trade surpluses be printed as well. And we get the data today on the current account surplus. That still looks large. We're still seeing average trade balances each month of around $10 billion. So it just continues to bolster both Australia's external position, but also Australia's government budget position as well. And that's certainly showing Australia in a much better position than some of our peer economies offshore.
Belinda, great to have you with us. Belinda Allen, Senior Economist at Commonwealth Bank of Australia. You can also get more on your Bloomberg on this. TLR Vigo is the commentary and analysis from our team of expert editors as we get into Phil Lowe's last meeting today. Well, Qantas CEO Alan Joyce is bringing forward his retirement by 2 months. Vanessa Hudson set to take over from Wednesday this week. Let's get the details from Bloomberg's global business editor Karen Lee here in Sydney. And so we knew obviously he was on the way out, but is this a case of, reputationally, shareholders love him, the general public not so much? Is this going to kind of give them a new start, if you will?
Yeah, well, Heidi, this has been a bumpy period of weeks for Joyce. He was supposed to step down in November and hand off to CFO. But he's decided to leave a bit early. He's been grilled by the Senate recently over what people see as inflated prices, as Qantas selling thousands of tickets for flights that had already canceled. And he's faced a lot of customer blowback. This is a period in Australia where people are facing a really inflated cost of living. They're worried about money. And you have this very storied brand and this man who's been quite respected. And suddenly people are upset about how much they're having to pay for tickets. And this has been a really rocky road for him the last few months.
Yeah, Karen, this headline a few days ago out of the Sydney Morning Herald, Joyce gets $10 million as Qantas faces fine, maybe underscores that the optics here. What do we know about Vanessa Hudson, Karen?
The optics aren't great. And when Joyce stepped down, he said in the statement that was released this morning that he's stepping back to allow the company to focus on its renewal. And I think Vanessa Hudson's going to be a huge part of that. She's going to have to turn around the public sentiment towards this company that people had revered for so long, and it's really come down in the last few months. There's going to be a lot of pressure on her and a lot of people watching Qantas to see if it's going to reclaim its former status here.
Karen, thank you so much. Karen Lee there, our global business editor. As you can see, analysts are still largely bullish on the stock price. That's the chart that you just flashed there on your screens for you guys there. Right, just ahead and back to markets. We're talking EM here. EM debt, to be more specific. BNY Mellon joins us in a couple of minutes. Hear why they think investors may be stuck on the wrong foot for the next few months and what they mean exactly by that. Bob Savage joins us in a couple of minutes. Keep it here. You're watching Bloomberg.
It seems more and more high-stakes decisions are ending up in my hands. Aon's advanced analytics and expert insights put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
Right, I'm glancing at the currency markets to my right. As you can see, we're coming off, well, the dollar weakness for 2 days. I had to caveat, though, by saying, of course, the U.S., the long weekend there is certainly exacerbating some price moves given thin liquidity. I mean, look at the equity markets as an example. Extremely thin volumes there. We're going into today, I think we've talked a lot about the RBA today. We have some numbers coming out of China, too, the Taishin PMI numbers, and we get into the thick of Europe where we have things like, I think, factory orders out of the U.S. And also we have a slew of PMI numbers out of Europe. That said, from DM back to EM right now, where you have central banks joining their DM peers in terms of just pushing back on expectations here, just rapid switch from hiking to hold to maybe cutting interest rates, souring the outlook for bonds, at least over the last month or so. Let's bring on Asia FX and rates reporter Matt Burgess to talk us through the story. Yep, it's been painful if you've been long at these local currency bonds, Matt. Isn't that the case?
It certainly was a painful August, there's no doubt about that. And a lot of it was really driven by the sell-off that we saw in US Treasuries and this higher for longer mantra. You know, we had a lot of Fed speakers come out, especially the rhetoric coming out of Jackson Hole from the developed market central banks. They were certainly not putting cuts on the table anytime soon. And then you started to see the emerging central banks follow suit, right? Hungary Central Bank, for example, said don't expect rate cuts to be on automatic. Indonesia Central Bank, they're allowing short-term yields to steadily rise just because of the narrow spread that we're seeing between Indo-GBs and US Treasuries. So they need to try and attract a lot of the foreign inflows to keep the rupiah stable. They're also issuing new securities as well. So from that, you know, we saw a lot of the rate cuts, you know, that were expected in Asia for the next 12 months. They've been priced out. You're starting to see LATAM cuts starting to be priced out again over, or at least bets on that trimmed over the next 12 months, and similar in Central Europe as well. So it's been a pretty painful, it was certainly a pretty painful August, and I guess we'll see how September goes when everyone comes back from the summer holidays.
Yeah, Matt, I suppose the question really is it a little bit of pain, or is it going to be an extended period of pain? What would you be watching?
This is, I mean, that's literally the million-dollar question for every fund manager and trader, really. You know, you at the moment, we really need to see a very clear picture on the Fed's rhetoric and where Fed rates really stabilize. But we've also got another looming risk that's been mentioned quite a lot over the next 6 to 12 months, and that's El Nino. That's stoking a lot of food price inflation as well, particularly in Asia. Now, we're already seeing that even before the full brunt of El Nino comes into effect. We've got, you know, rice prices in Asia hitting almost a 15-year high. In Peru, for example, inflation's not slowing down as fast enough. Their lime prices jumped up 70%, so that means the local people there can't, you know, they can't make their national food, the ceviche. A lot of that food price, food shock still has to make its way through the system, and that's going to keep a lot of central banks, specifically, especially in Asia, that have, you know, high CPI baskets that are towards that food area. I mean, that's going to keep them on their toes quite a lot, even after, you know, the Fed gives us a more clearer picture.
Matt, thank you so much. Yeah, with that thought in mind, ceviche inflation there, Matt Burgess there, also makes tequila shots more expensive if you're in the lime side of the conversation here. Let's bring on our next guest, who says investors may continue to be wrong-footed over the next 3 to 6 months, just continuing that theme there on EMs. Bob Savage is with us, head of market strategy and insights at BNY Mellon. Bob, I'll skip the tequila question for you. I'll ask you what you mean by 3 to 6 months. What's the pain trade for EM debt right now?
Well, I think there's three factors going on when it comes to emerging markets. First is the view that the Fed being higher for longer puts some pressure on central banks that might want to cut rates are going to be looking at their currency, and that might be a throttle that shuts off some of those cuts. I also think that the easy money of buying some of these bonds, particularly in Latin America, where there was a tremendous carry trade, once the carry trade starts getting volatile, that ends some of that bond holding hunger. And I think what we're seeing in the next 3 to 6 months is unfortunate continuation of U.S. Exceptionalism, for want of a better phrase. It's very hard to see the U.S. going into a recession. It's the no landing story probably is too optimistic. The soft landing or a mild recession in 2024 seems the most likely outcome. And there's still going to be a risk in the next 3 to 6 months of the Fed raising 25 basis points should things just continue to surprise to the upside when it comes to growth.
Right. Bob, does your note of caution also apply to hard currency debt, dollar bonds, for example?
Yeah, I think the other part of the puzzle, which I've been waiting for since March, and the U.S. banking, regional banking crisis should have really had a larger effect on credit than what we saw. And some of that is interesting, but I think hard dollar EM debt is still going to suffer from the same problem, which is people are waiting for a shoe to drop when it comes to credit. And I do think that the emerging market and the developed markets have one new shared commonality, which is too much debt. Not all of emerging markets are the same and should be brushed with the same stroke, but those that are on the edge where current accounts aren't just awash with surpluses, those that are troubled with debt to GDP ratios that aren't overwhelmingly attractive. That's a stability factor that I'm paying attention to, and I think that's one of the cautionary tales ahead, which is that credit in the U.S. is probably coming back as a concern. Let's list the 3 things that we're watching in September. We have the United Auto Workers potentially striking. We have the return of student loan payments, and we have a potential U.S. government shutdown, all of which is not going to be great for growth in the U.S. or friendly for credit. And that's part of the story that I think bleeds into emerging markets over the next 3 to 6 months.
China's obviously the other big part of the story. You see these gains across Asian equities really being pegged to the China exposure over the past sort of 10 days or so. Are EMs and Asian, markets more broadly still so strongly anchored to the fate of the Chinese economy and what happens to the yuan, or do you think there's a decoupling there as well?
So, well, maybe it's de-risking, but maybe the decoupling extends from that de-risking. Certainly places like South Korea are probably the litmus test for whether it's de-risking or decoupling. I also think that the China actions over the last week might have gotten to the point where the market is priced maximum pessimism over this China recovery. I find it probably overdone, and I'm more optimistic because of that for certainly Asian ex-China equities. The problem with the bond markets are that they are likely to be nervous about the currency. I don't see the currency strengthening as much as some on the street, and I think APEC is likely as a whole the central banks to remain higher for longer, like the Fed, which isn't great for their bond markets.
Bob, really great to have you with us. Bob Savage, Head of Market Strategy and Insights at BNY Mellon. More to come here on Daybreak. This is Bloomberg.
We'll be tracking the nat gas markets very closely today, Heidi, especially as we move into the European session with certainly all the news coming through here out of, again, potential strikes and now perhaps more warning here coming out of workers here, Chevron Australia. Talking about how, well, for one, partial strikes possible on the 7th of September, so that's 2 days from now. We get into the thick of things. September 14 is when they are threatening or planning full stoppages from that day, Heidi.
Yeah, and it's quite interesting because you talked about the fact that we're obviously watching European nat gas prices, but that Monday session price momentum was really quite fascinating. We saw that slide because it seems like at this point that lower demand outlook actually is outweighing even the strike risk, right? These lingering strike risks in Australia, even curb supplies out of Norway as well. We saw benchmark Dutch futures settling almost 6% lower, even as we get into, you know, these sort of mediation talks, but that is certainly something that we're watching. 2 weeks of 24-hour rolling outages is what's at stake here. 2 major export plants from mid-September that could be affected. It really is quite an escalation. And of course, you know, we talk about the sort of downside for the markets, but this is a market that is still really on edge after the Russian invasion of Ukraine last year, really curbing supply. Prices are soaring to unprecedented heights there. In terms of the market makeup, Dave, these two facilities that could be affected, Gorgon and Wheatstone, about 7% of global LNG supply last year.
Yeah, our BNF colleagues have estimated 1.1 million tons could be affected there. Of course, that's the Gorgon and Wheatstone facilities. Plenty more ahead. We'll leave you to look at the markets right now, and we'll unpack more in just a moment. This is Bloomberg.
I mean, lots for investors to digest, including the trade data out of China that's coming out this week. Unlikely to be impressive, likely to disappoint. I mean, you take a look at the overall stimulus so far for China. Is that enough?
Yeah, it's definitely disappointing at the moment still, Haslinda. So I think your colleague from Bloomberg News put it really well just now when she said there's a lack of confidence in the economy. And you can see that from the consumers, from firms, and from exporters as well. So we think we probably need something more dramatic to try and turn confidence around. And the clear source of that drama would be the central government. We think they have the balance sheet to loosen fiscal policy and give a real jolt to the economy. But so far, they haven't been willing to do that.
And unlikely to be willing, that's the sense you're getting. Is there a risk of a full-blown crisis in China?
So we don't think we'll have like a Lehman's moment in China at all, because the banks are well positioned. But we are worried about we'll have this chronic lack of demand continuing, which could cause China to fall into a longer-term deflationary trap. We should remember, though, if you remember last year, sentiment was also very negative on China. Then we had a 180-degree turn on the lockdown policy, and things really rebounded quickly. So we shouldn't rule out a change in heart either by the central government here.
When you take a look at how Chinese assets have been trading, are they fully reflecting the weakness in the economy? Take the yuan, for example, has been supported very much by the PBOC, stronger fix since mid-June. Is that already reflecting the worst of the Chinese economy?
Yeah, there's lots of bad news, both in the equity markets, property markets, as well as the currency as well. The worry for investors is, has all the bad news been priced in? And if there's any catalysts, will the catalysts be enough to turn around this pretty bearish sentiment? We saw from today's rallies that any good news obviously is helping. We probably need broader news on the economy to really change sentiment and bring back confidence into the economy.
Mansoor, I mean, we talk about the fixings of the yuan. Constantly they're trying to essentially stop it falling too far too fast. Is it a real kind of, is there a line in the sand, do you think, as to what level they would defend with all their might? Or is it some policy of, not benign, but certainly a bit of neglect when it comes to they don't mind having a weaker currency because of it acts as a stimulus for their manufacturing?
Yeah, I think the authorities don't want the yuan to slide too quickly. So their policy of changing the fixings, or what we saw on Friday to reduce the FX reserve requirements, I think that's really just to try and slow down the weakness that we've seen so far, Rishabh. There's nothing really here which would signal that the authorities want to push up the currency. They could do that easily by raising interest rates, but of course the domestic economy won't allow them to do that. So really it's a policy of just trying to keep the yuan relatively weak, but not let it slide too rapidly from here.
What's the read-through then for other countries in this part of the world from that?
I mean, if you think about the strength of the economy in China, it's really important for the whole region here. You can see that whenever China turns around, as you saw at the end of last year, it benefits every economy, and you can see from Australia up to Japan, you're going to get rebounding markets. This is why we all need to follow China's market very closely at the moment. I think the sentiment is clearly very negative, so if we do get a stronger catalyst from the authorities in terms of fiscal policy in particular, that will benefit all of Asia Pacific and the global economy in particular.
There is concern we may see a Japan-like deflation in China. Is that a possibility?
So there's lots of similarities between China and Japan, but we don't think it's our central case here. The authorities in China can restore growth and confidence through stronger fiscal policy. And China and Japan are at very different levels of development as well. A more worrying concern here is that we just get inertia for months and months, and that will then obviously cause confidence to stay very weak. But for a deflationary trap to really occur, you need demand to be weak for years and years, and we think the authorities will respond to that.
We've seen a lot of economists downgrading their forecast for the year for GDP in China. I mean, might we see a further downgrade if we don't see the stimulus from the government?
Yeah, sure. It's a very good question, Haslinda. So we've thought that this year growth would be about 5.4%, but we recognise now that if we don't get that fiscal stimulus, then the authorities will struggle to meet their target, which is growth around 5%.
Is it that clear-cut? There is a sense that we're seeing the end of the tightening, but if you take a look at sentiment and projections out there, 48% of investors still see a chance of a 25 hike by November.
Yeah, it's definitely not clear-cut, Haslinda. We think that the Fed have finished the rate tightening cycle. There's a very clear risk that if the inflation numbers stay sticky, the Fed may have to come back to the table. Probably not at this month's meeting in September, but either in November or December. So at the moment, the markets are worried about that risk. So any data that's slightly stronger than expected gets a reaction in the dollar in the Treasury market.
Interesting to note that you say only a recession would take inflation back to 2%. Powell says there is no such thing, no recession expected.
Yeah, so we're very much against this view that you can get just a soft landing, a benign scenario that allows inflation to get back to 2%. The labour market's too tight in our view, and our worry is that core inflation just gets stuck between 3 and 4%. So the Fed really does need to engineer a much greater slowdown to get inflation back to 2%. It doesn't need to be a deep downturn like we had after 2008. Definitely, we think recession likely rather than just a soft landing.
So Mansour, I mean, the thing is that the dangers are that, inflation remains sticky, which it may well do, and there's an anticipation that things will go back to what they were in the era of free money. That's not going to happen. Isn't the Fed going to be relatively comfortable with the interest rates where, I guess over the last 50 years, this is a sort of mean level that we're at the moment?
Yeah, that's very true, Richard. We definitely think that the Fed want to keep interest rates higher for longer now. So let's say they don't raise interest rates anymore, but they keep the Fed funds rate between 5.25%, 5.5%. That's high by the standards of the last 15, 20 years. And I think that's going to surprise investors if they see that the Fed have kept rates at this level all the way through until maybe as late as June next year. And they're likely to have to do that if they want inflation to get down. We think that will eventually hurt growth, probably tip the economy into recession by doing so.
Well, absolutely. So, I mean, does the dollar then stay higher for longer as well with regard to that? And with a European economy which is showing huge signs of creaking, does that play into that narrative?
Yeah, the dollar's getting supported for a couple of reasons. One is that the Fed are being more hawkish. And then the data, say, in Europe, but also, as you discussed earlier, in China, is clearly weaker. That's also helping the dollar as well. We think that a lot of good news is priced into the dollar here. Our worry is that if the Fed keep rates very high for longer and the US economy starts to slow more appreciatively, then the markets will shift to start pricing in again rate cuts, and that'll push the dollar down. So we don't want to be buyers of dollars at these levels now, Richard.
Mansour, take a look at oil surging ever closer to $90 a barrel. What would that mean for that inflation fight?
Yeah, it definitely complicates things because we all look at the price of oil, how much we have to put into our car. So if oil can stay supported, then it'll just make the Fed have to keep interest rates higher for longer. That will then push growth down again over time.
Rate cuts in Asia at least?
Yeah, it's possible that the regional central banks here, they were ahead of the big G7 central banks, so they could be ahead in terms of cutting rates. But I don't think we'll get that anytime soon. I think they'll want to see what the Fed is doing first. When the Fed signal that they really have finished their rate hikes, then the regional central banks can think about cutting rates.
Mansour, one final word on Japan. It do look like with the latest nominal GDP numbers, etc., that we may be leaving these lost decades behind. What's your view? And tell me about the yen in that whole kind of mix.
Yeah, it's really interesting because for the last 30 years, Japan's economy has really stagnated. So if you look at just nominal GDP, it's basically gone sideways for the last 3 decades. But now, finally, it's breaking out again. The Q2 number was a lot stronger than expected. Yeah, nominal GDP growth was about 6% on an annualized basis. This is really strong. Now, we think that's going to continue, Richard, because the Bank of Japan has learned its lessons of the past and is staying dovish to try and entrench inflation around its 2% goal. That's really spurring confidence within the economy, but also from foreign investors. Now, the yen, as we know, is very weak at the moment, but if we start to get further inflows, both from portfolio investors, from foreign direct investment, and also from tourism as well, to take advantage of cheap currency, then the yen should start to strengthen again. We think it's not going to happen immediately, but we do think that next year the BOJ will raise interest rates, Fed will get around to cutting rates, so the yen should be back at 120, 125 in a year's time, Richard.
This is Bloomberg Daybreak, Middle East and Africa. Our top stories this morning. Chinese property stocks surge as the nation rolls out further measures of support, including lower down payments for home buyers and looser mortgage rules in major cities. Meanwhile, traders digest the U.S. jobs data that support optimism. The Fed is close to the end of its tightening cycle. Oil hits its highest level since November on expectations that supply cuts by OPEC Plus leaders will tighten the market. And Saudi Arabia's sovereign wealth fund is set to create a new national steel giant with the acquisition of the metals and chemicals maker SABIC for the enterprise value of $3.3 billion. A very good morning. It's just gone 8 a.m. across the Emirates. Warm welcome to the show. I'm Manus Cranny in Dubai. If you want to really understand what's happening at the short end of the curve, it is a true belief that we are near the end of the Fed hiking cycle. Down went the 2 years last week by over 20 basis points at one juncture. It is Labor Day. The cash market is closed, hence the reason why we have the 5-year for you. But it is a screaming buy, according to Rosenberg over at BlackRock. Why? Because if the Fed is done and inflation is topping up, by the way, the ISM numbers on prices paid would suggest you may be heading towards stagflation, but that's a whole other story. So this is where we were at the close of business, and we have the futures prices now. Futures prices down. Yields are pipping higher this morning on this Labor Day. Larry Summers says it would be a mistake to judge this one set of non-farm payrolls, but he does think that the the road to a soft landing is coming along. Now, when it comes to that narrative, 20 basis points lower at the short end in the space of 5 days, what did it do to stocks? We managed to eke out the best week since June. The jobs report adding the fewest jobs since the end of 2020 is the fissure that the market is interested in. Let's roll it over and have a look at the stocks market, because therein lies the narrative for today. Yes, it is Labour Day. You are seeing Europe up 0.3%. I can tell you that Dell managed to put on 21% on a better outlook for the hardware market. However, that benign jobs report, according to Bank of America, is something which is a strong tell on the labour market for Michael Hartnett and the team there. It is the last piece of the Goldilocks jigsaw. Sell the last rate hike. Dell is up 21%. Tech funds seeing 10 straight weeks of inflows. $5 billion went in last week, the largest since May. So the train of money coming into the stock market still continues. What is a soft landing? That is what we need to define. Roll it over, have a look at the oil market, and you begin to understand what is happening there. You have managed to put on 7% in the past week. So this is not just a belief that the supply cuts from OPEC Plus are working, but a reality. Russia set to extend their export curbs. Saudi Arabia will probably follow through as well. Their production is at a 2-year low as Iran hits a 5-year high. But this is the momentum up for the 8th session in a row, breaking $85 a barrel in WTI. You can see the Brent price there sniffing out the $90 watermark. Those are the markets, but we are banging along in Hong Kong and in China, and it's all to do with the mortgage market. Avril has that. Avril Hong is in Singapore. So we've reopened after the typhoon, and investors are reacting to this property support measures that have been announced. Avril.
Yeah, Manus, as you say, they are banging along, and we're seeing how these China builders in Hong Kong are actually rising and outperforming the market today. And this is a lot to do with those property support measures. And that has lifted sentiment in the market as traders get their first chance to react, as markets were closed on Friday due to a typhoon. Now, that's not all that's lifting the market sentiment. We also had China's major cities showing home sales that surged over the weekend, and this is according to local media. So our colleagues at MLive point out that this is a step in the right direction, given how it shows that buyers are returning to the market. We are also seeing Country Gardens still being able to avoid that default. So positive moves overall in the property space in China. So let's take a look at how that is affecting trade in the rest of the Asia Pacific, because the benchmarks are rising mostly, and the region's benchmark MXAP, the MSCI Asia Pacific, is also in positive territory. A lot of it's got to do with this optimism about China, as well as how it seems the Federal Reserve is nearing the end of its tightening cycle. We're looking ahead to some of the trade and inflation data out of China this week. But so far, so good, Manus.
Yep, well, it seems to be a coalescing for the bulls. Is that narrative, peak Fed and bottom China. Avril, we'll see you through the morning in Singapore. So the latest jobs data, what have we got? It shows a labour market that's undergoing controlled cooling, illustrated by solid hiring, slower earnings growth, and more people returning to the labour force. Let's get to Ven Ram. He joins me now. So this is the last piece of the Goldilocks narrative, according to Michael Hartnett over at Bank of America. Talk me through the bull and the bear scenario in this data. Ven, good morning.
Morning, Manus. I mean, definitely the numbers were broadly in the direction that the Fed would have liked. We saw an increase in the jobless rate of 3.8%. It's the first reading that's been as high since the Fed started raising rates in this cycle. So it's significant. But, however, one swallow does not a summer make. And the Fed reckons that the jobless rate needs to reach 4.5% for the jobs market to come into alignment with aggregate supply. So this is a tentative first step. There is still a long way to go. What does it mean for bulls and bears? I think it's a bit too early to say, buy the front end of treasuries. I would be cautious in looking at the front end. The long end definitely holds more promise. You want to build into duration, as the Fed is likely to pivot in the first half of 2024. So that's where I think the bulls and the bears, the balance stands at the moment. Manus?
Then, thank you. And let's talk about some of those biggest bond investors in the world. They are betting that this cycle is finished. I'll leave you. I think the best line that I've heard around me lately is the producer of this show says, I need to buy some 10-year treasuries. They'll see me out. So what do PIMCO have to say about the bond market?
Well, I definitely think that, whatever your colleague said is spot on. I do think that you want to scale into longs in this market because, as you know, it is very clear that the Fed is approaching the end of its cycle, or even if it's not already at the end of its cycle, and you want to be scaling into duration. And I think that you want to be scaling into it because there is still a chance that it may go slightly higher by 20, 30 basis points from here. But definitely we are near the top of the range in terms of the yield. So I think this is a good trade to be scaling into at this point.
Ven, thank you very much, Ven Ram. We appreciate you stepping in this morning on the markets. Ven Ram there with the very latest from the MLive team. So China will establish a new department under its National Economic Planning Agency to help private businesses grow. The announcement coming after President Xi Jinping said the country would continue to open up while pursuing its own development path. What does that mean? Let's get to Jenny Ma. She's in Hong Kong. She tells us more about this new department. These announcements coming hard and fast after Raimondo's visit, but striking a China first policy, a hint of that in terms of the rhetoric. Good morning.
Hi, morning. Yeah, absolutely. So I think, this is another sign of how seriously the government is taking the doldrums that the private sector is in at the moment. Last month, the Communist Party and the State Council issued this sort of rare joint statement where they put forward a 31-step plan to sort of reinvigorate the sector. And I think the formation of this new agency sort of is coming good on that. The agency is tasked with building regular communication channels with the private sector, identifying sort of pain points for them, and then drafting policies. And one of the pledges in that rare statement last month was that the government would talk to the businesses more before sort of charging ahead with policies. So I think it's really sort of another step to try and reassure private businesses that China is a place they can do business and that it's not uninvestable, as Gina Raimondo did say last week.
OK, Jenny, let's see what other policies come to pass. They're certainly throwing everything at the wall at the moment. Jenny Marsh in Hong Kong. Still ahead on the show, setting the agenda for you for the week. We're going to hear from the US Treasury Secretary Larry Summers and what he thought about the latest jobs report. It is a step down the road to a soft landing. But up next, we'll talk market strategy with Standard Chartered's Eric Robertson. As bond traders bet the Fed hiking is over, is it time to short the dollar? The big call from Robertson.
There's a place where global markets are always open, where you can explore and discover innovative new offerings and hundreds of trading products right at your fingertips. That's CBOE, the exchange for the world stage.
Roller coaster prices, supply chain glitches, political unease. They do their best to wreck my business plans. With so many unknowns, how do I know I'm making the right decisions? Aon helps me stay on top of things. They have expert points of view on volatility from around the world, paired with local insight that helps me get back on solid ground. Better decisions. Aon.
If you average the last 3 months, it's about 150,000 jobs each month being created. This is the transition from the breakneck speed of the fast recovery we saw initially.
The unemployment rate, finally, that stubbornly low unemployment rate finally ticking up, I think is good news, but you have to be careful, right? The labor market can be a real slippery slope.
I think the Fed should be done. I certainly think given this number, unless you got something very significant on CPI, I think they're not going in September.
You're seeing the kind of Goldilocks scenario that the Fed wants. I think it'd be really unlikely that they're going to move in at the next meeting.
This was the report that the market was looking for.
We're on track for a soft landing and the economy that still chugs along. That kind of fall to a technical recession doesn't look likely as of now.
The Bloomberg TV guests reacting to the August jobs numbers out on Friday. Now, the data show the labour market undergoing a controlled cooling, supporting the optimism that the Fed is nearing the end of its tightening cycle. Asian shares trading higher this morning, driven by the rally in China after fresh property stimulus. US markets are shut for Labour Day. Eric Robertson is the Global Head of Research and Chief Strategist at Standard Chartered. He joins me now. Eric, good to have you with me. I mean, those are the first flush of reactions. We've had time to react to this. Yes, good news, the unemployment rate ticks up. Is it a soft landing? Is the Fed done?
We certainly think the Fed is done. For us, the most interesting aspect of Friday's report was this idea that the U.S. labor force is growing at about 250,000 per month on average. And when you see payrolls growing meaningfully less than that, that means that you're starting to see some capacity build in the labor force. In other words, some excess capacity. And as you say, it's controlled. It's not a collapse. It's not a hard landing. But that excess capacity is what the Fed is looking for.
Our reporter, just before you sat down in the seat, talked about in the system, in the models, you're going to need 4.5% unemployment before you really tame the tiger of inflation. Now, 4.5% is a hell of a leg up from 3.8%. To get there, they've got to fracture something. I don't want to use the word break, but something's got to fracture to get to 4.5%.
Look, the first point I would make is that the recovery in the U.S. economy post-COVID, and with all of the stimulus that we've seen, both monetary and fiscal, suggests to us that a lot of the traditional models about how much the unemployment rate needs to go up need to be taken with a grain of salt. The reality is we don't know. And neither does the Fed.
How very dare you, Eric Robertson, a grain of salt?
The Fed knows that it needs to inject excess capacity into the economy. It needs to get the demand side of the equation under control. And when the demand side of the equation is softer, then demand for wages comes down, price levels come down, but we don't know what the specific unemployment rate is.
No, and I don't think anybody really knows what the real new neutral rate is. Let's listen to Mohammed Al-Erin. He sets the scene about financial fragility.
A lot of these things are refinanced over time. They don't fall immediately, unless, like we saw in March, depositors or someone else worry. But commercial real estate happens over time. Corporate refinancing happens over time. The problem is that if the markets don't fully understand that, and then you get the drip, 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 and then suddenly there's a critical mass. But I think we have time, but the reality is that central banks are just catching up to the fragilities in the non-banks. They understand the banks relatively well. It's the non-banks that they're having problems with.
I think it's a nice context, Eric, about the fragility, the drip, drip, drip in commercial property, in shadow banking, etc. That drip, drip, drip will have an impact on markets. So let's translate that. Do you believe we're in a drip, drip, drip scenario? And what are the financial ramifications of that in terms of rates?
Look, the first point I would make, and I agree 100% with Mohammed on this point, is that the shock to the system that we saw back in March with the various banks led people to assume that there would be an imminent collapse in the broader economy. And what we've learned is that a lot of those elephants in the room, whether it's commercial real estate, private credit, etc., those take time to play out and come through the pipeline in the system. Is it a year? Is it 18 months? Is it 2 years? We're not sure. But what we do know is that over time, as those inputs into the economy start to work their way through, combined with maybe a higher unemployment rate, reduced demand from the consumer, those will start to react to the tighter financial conditions, and that should ultimately start to bring U.S. rates down towards the end of this year.
And that takes you, the corollary of that is to a weaker dollar. There are people who are going to take the other side of your trade. You call not an end to U.S. exceptionalism, but to dollar exceptionalism. This rally that we've had in August is misplaced. Why?
Well, look, the first thing I would say is, why did the dollar rally? Higher U.S. rates, higher risk aversion, fears about the sort of deceleration in China's economy, all coming together in a perfect storm. Now, we're starting to see a more aggressive policy response in China. At a minimum, we think that should stabilize RMB. We're starting to see some of the softer data come through in the U.S., as we've been discussing. That should take some of the upside pressure on U.S. rates. Now, the key final factor is when you decide to sell the dollar, what do you buy against it? And this has been the big question mark over the course of the year. So far, it's been exclusively LATAM and Eastern Europe. Yes. We think that spreads to some parts of Asia. Korea is starting to see some recovery in its currency and some of its financial assets. Indonesia looks like a reasonably good domestic growth story to us. India is doing very well economically. So there are a handful of stories that we think could bring some investor capital out of the dollar into other EM.
So if I think about that, that's like almost like a 180 sort of move from LATAM right the way across to Asia. But you'd go further than the 180, and you would say that the Aussie is a vicarious trade on that stability. Maybe I'm paraphrasing.
Yep. No, that's right.
But the Aussie is a high beta vicarious trade on the China stabilization.
Within G10, I much prefer Aussie over Euro. We think Europe has some economic challenges that are coming through the pipeline. Australia is interesting because we actually think the domestic story is still reasonably constructive, but the currency's been hit quite hard by China pessimism. Now, if China's policy stimulus starts to work its way back into the system, some of that pessimism should perhaps move back to neutral, and that should support Aussie.
I'm going to ask a very dumb question. You see so many darts being thrown at the China board at the moment by the PBOC. I don't have a PhD, so how would I know whether it's effective or not? But when you see this myriad of darts in such quick succession hitting the board, as an economist, as somebody that does have greater insight than I do, are there enough darts hitting the board now to call a potential bottoming in China? Are you more assured now than you have been about China hitting a bottom and they've got a grip of it?
One of the challenges that we've seen over the last few months is that China's policymakers have been very reluctant to throw demand-side stimulus into the economy, which is a really fancy way of saying putting money in the consumer's pocket. They've never wanted to do that. But you don't need a PhD to realize that the big problem in China's economy right now is on the demand side. Consumer appetite is very low. Consumer confidence is low. The income prospects are poor. So how do you get China's consumers and small businesses spending and investing again? You have to ease some of the financial conditions that have been so tight, whether it's in the mortgage market, on the investment side, etc. So you're starting to see it's moving from a drip feed to something more of a trickle, right? It is starting to pick up pace, but the question is, where do you get that inflection point?
Yep. Well, there's many unknowns and imprecisions to debate. Eric, thank you very much for setting the agenda this Monday morning. That is Eric Robertson, Global Head of Research and Chief Strategist at Standard Chartered. My guest this morning, setting the tone for markets on Daybreak Middle East and Africa, right here on Bloomberg. Good morning.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's where I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
The former U.S. Treasury Secretary Larry Summers says the latest jobs numbers are strong. But he also told us that the path to a soft landing could still be out of reach.
The economy still looks strong with reasonably robust employment growth, slightly greater than expected. Hours per week ticked up, which is another favorable indicator. Yes, the unemployment rate went up, but it was driven by the fact that more people want to be working and have been pulled into the labor force. And that all happened with wage growth slightly less than was expected. So I think it's a mistake to make definite judgments based on one number, but this is certainly a favorable set of numbers, which should please policymakers both on Constitution Avenue and on Pennsylvania Avenue. I still think the road to a soft landing is a very difficult one, but this was a step down that road.
So let me pick up an analogy you've used on this program before about trying to land the plane. Given these numbers, does at least it look like that we're on the right glide path? I'm not saying we'll succeed, but we're at least on the right path.
These numbers are consistent with very optimistic scenarios. I don't think they determine that they're in a very optimistic scenario, but there are all sorts of things that could have been alarm bells in today's numbers that didn't ring. And that alarm bell that didn't ring, like Sherlock Holmes' proverbial dog that didn't bark, is a meaningful sign that should be recognized.
Larry Summers there on the road to a soft landing. Come in gaming is the latest line. That's what we're going to hear in Dubai. We have a new regulator being established, the Commercial Gaming Regulator. It is the General Commercial Gaming Regulator. There is a new framework to be set up for a national lottery. Commercial gaming is going to be led by Kevin Mullally. He has been appointed as the CEO. He's got 30 years experience in national and international gaming regulation. So this is a big step forward for the UAE. And just take you back to a little bit earlier in the summer, we had the casino giant Wynn Resorts. They are building, they expect to get their gaming license in Ras Al Khaimah. This is the northern part of the UAE, raising hopes that we're possibly going to see an expansion of this. That's a $4 billion gaming resort underway in Ras Al Khaimah. So that's the sort of the backdrop to this. They've often talked about there's a massive project towards the southern part of Dubai, which is Blue Waters, where you have Caesar's Palace and a whole host of developments. So we are one step closer to potentially seeing gaming, technically offshore, possibly on blue water, but nonetheless, perhaps an expansion. Let's see where it goes. Let me just show you the state of play on the oil market. It's important to check. We just had a conversation with Eric Robertson. He wants to be long the Aussie dollar on the China story, but the oil markets believe both in cuts and maybe in the bottom of China, both WTI and Brent, both rallying. Let me just show you the divergence in production, because this is the underbelly of what's happening. This is the drop in Saudi production in your white line and the ramp higher in US pumping more oil into the market. Saudi is now about 3/4 of what the US is pumping. So this is geopolitics live for you in one shot in the oil market. Good morning.
The more my company grows, the harder it is to stay focused on our core product. I need to master DE&I, ESG, M&A, even how to adapt to hybrid working. The more hats I wear, the more I need Aon. They bring their whole team to the table and give me access to great minds in each discipline. So as my business grows, my knowledge expands, and I see things more clearly. Better decisions. Aon.
The Mariah is just an unbelievable place. It's a cultural oasis, and I've been given an incredible opportunity to pursue my dreams here as the head chef inside its world-renowned restaurant. Get the dessert out. I mean, people travel from all over to experience my food. It's a place for fine dining, arts, and events. And it's my home, a reflection of Saudi's culture and beauty.
This is Bloomberg Daybreak, Middle East and Africa. Our top stories this morning. Chinese property stocks surge as the nation rolls out further support measures including lower down payments for home buyers and looser mortgage rules for major cities. Meanwhile, traders digest the jobs data that support optimism the Fed is close to the end of its tightening cycle. Oil hits the highest level since November on expectations supply cuts by OPEC Plus leaders will tighten the market. Saudi Arabia's sovereign wealth fund is set to create a new national steel champion with the acquisition of the metals unit of chemicals maker SABIC for an enterprise value of $3.3 billion. Good morning. It could be the end of the Fed hiking cycle on the fact that the unemployment rate ticked up. Yes, the jobs numbers beat, but the bottom line is the unemployment numbers, the cycle. Where are you in the cycle? That is ticking higher. Yes, you may need to get to an unemployment rate of 4.5% before you break the back of real inflation and get to the 2% level. But the bond market is prescient and indeed ahead of the game. Short end of the curve down by 20 basis points in 5 trading days. Cash is closed. It's Labor Day. Happy Labor Day in the United States of America. BlackRock and PIMCO said that the Fed hiking cycle is over. But don't presume that you're on the road to a soft landing. These are futures prices down. Yields are ticking very, very slightly higher this morning. 30 years were unchanged. So there's a shift in the shape of the curve on this steepener that you have. The repercussions of a drop in the very short end of the curve is the bountifulness for the equity market. Adding the fewest jobs since the end of 2020 builds the narrative that it's a benign jobs reporting according to Bank of America and that the Fed will pause. Now, what you've got this morning is light volumes, probably. Dell's at the bottom of your screen. I thought it's interesting to bring that to you. They ramp higher by 20% on better revenue from the PC world. So the hard product from Dell seems to be seeing a little bit of a better future. Europe is up on the stack, even though we've got stagflation issues, as Eric Robertson from Standard Chartered just laid out for us. And you have the Nasdaq up a 1/10% this morning. You are seeing Monty flows in. Tech funds, the 10th straight week of inflows of over $5 billion, the largest since May. It is the dominant sector. It still carries the inflows. Europe, however, week 25 of the outflows on the stagflation concern. Roll it over, have a look at the oil market. I showed you the divergence between Saudi production and US production, but we put on 7% last week alone, the highest since November. The production cuts are cutting through. Saudi is expected to extend its unilateral cut of 1 million barrels a day, as Russia has already done so. Brent knocking on the door, knocking on heaven's door of $90, $88.58. Somebody stand up and take it up to 90. Take out the text. Let's get to Avril Hong. She's in Singapore in covering the very latest China support measures affecting sentiment in the housing market. Avril.
Indeed, Manus. The sentiment there is positive. We're seeing the investors also reacting to those latest support measures for the real estate sector in China. And the Hong Kong property shares are really leading the way today, also boosting the Hang Seng. And this is not just because traders are playing catch-up in Hong Kong as the markets were closed on Friday because of the typhoon. We also had some pretty optimistic signs coming out from home sales transactions in the major Chinese cities. And this is, as our MLive colleagues say, a good sign, a step in the right direction because it shows buyers returning to the market as they loosen those mortgage rules in China. And then we also had Country Garden managing still to avert default. Now, this is helping to lift the sentiment in the rest of the Asia Pacific. So if you take a look at how some of these markets are faring, as you know, they say rising tide lifts all boats. It's a lot of green that we're seeing in the region, and the MXAP is also headed for its 6th straight session of gains. Manus.
Avril, thank you very much. Avril in Hong Kong there. Well, Saudi Arabia's sovereign wealth fund is set to create a new national steel giant with the acquisition of the metals unit of the chemical maker SABIC. Bloomberg's Christine Burke joins me from Riyadh. So a $3.3 billion deal. This is about building for the future, isn't it? Good morning.
Good morning, Manus. And yes, you are right. This is about building for the future. So let's first talk about this deal because there are two key pieces of information that we need here. So as you said, the public investment fund that is Saudi Arabia's sovereign wealth fund has agreed to acquire Saudi Iron and Steel Company from SABIC for an enterprise value of $3.3 billion. Then we also got an announcement yesterday that this Saudi Iron and Steel Company would also acquire Al Raji Steel, which is another one of the country's top steel producers. So effectively, what is happening here? The Public Investment Fund has taken two of the country's top steel players and brought them together under one roof to create what it is calling a, quote, national champion. And as you said, Menace, this really just speaks to the emerging strategy that we are seeing at the kingdom in the moment to invest in metals and mining more globally in order to prepare for further diversification of the economy and also for the transition to the clean energy future.
Okay, well, let's see. I know that, well, if the SABIC comms team are watching, they've already got the WhatsApp, so feel free to respond. We'd like to speak to the CEO. The oil market, I've been hitting this through the morning, the highest since November. Is this a hope that Saudi extends its unilateral cut in combination with Russia? What do you think is driving the gains?
Yeah, I do think, Manus, that is largely what is at play here. We are seeing tighter market conditions, and then on top of that, you have this expectation, this wide expectation in the market that we will see an extension of these OPEC plus supply cuts. So let's talk about these gains a little bit more because they're significant. We saw WTI rally 7% last week. We saw Brent rise almost 5%. We're now seeing both contracts trading above $85 a barrel for the first time this year. CIBC has called this $85 a barrel level a crucial psychological level for the market. I guess the question now, Manus, and to your point is, are these gains sustainable? What do we see in the days ahead? The market is clearly expecting that we will see a further extension of supply cuts. Saudi Arabia is expected to announce at any moment that it will extend its output cut of 1 million barrels a day into the month of October. We may also hear from other OPEC members. So that is clearly what is on the mind of the market this morning and as we move further into this week.
The sweet smell of additional equity from Aramco is tantalizing. This is a journal story about the possibility of Aramco selling more shares. Of course, we had our gorgeous story about the trading unit potentially IPOing earlier in the year. Where does this one stand up?
So let me first just say that there has been speculation for a long time out there about whether or not Aramco would pursue another share sale. We reported back in May that Aramco was holding discussions about this share sale and that we could possibly see a decision taken in the months ahead. Fast forward to where we stand today, and the Wall Street Journal has reported that, yes, those discussions are still happening and that the kingdom, or rather that Aramco could raise $50 billion through this offering. Now, the reporters at the Wall Street Journal have also said that there has been no final decision taken, but that if we do see action, an offering will be held locally on the Riyadh exchange. So I guess let's see where we get.
Yep, let's see if there's more equity for everybody, and that means bigger dividend payouts. Christine, thank you very much. Christine Burke there in Riyadh. Plenty more ahead on your Monday edition of Daybreak Middle East and Africa right here on Bloomberg. Good morning.
Although there has been some progress, inflation remains too high, and the FOMC is committed to moving inflation down to 2%. The monetary policy questions are whether the current level of the Fed funds rate is sufficiently restrictive and how long policy will need to remain restrictive to keep inflation moving down in a sustainable and timely way to our goal of 2%.
Cleveland Fed President Loretta Mester with her thoughts on inflation and the fight against it.
The leaders are gathering at the Africa Climate Summit in Nairobi. That's ahead of November's COP28 in Dubai. It is the first such summit in Africa. It's going to focus on how to save the continent from climate catastrophe and uplift its people from poverty. Our reporter is on the ground. It is Bloomberg's Anthony Squazine in Nairobi. Anthony, thank you for joining me. So what are the top climate issues that Africa has at the moment?
Well, I think what the summit will try and achieve is to get some sort of a consensual opinion from African leaders to take to COP in a couple of months' time. And the big issue, as it always seems to be, is climate finance. So there'll be a lot of talk about that, about how Africa needs more finance, how certain promises made before need to be honored. But at the same time, there has been a shift as well. There's a strong emphasis in draft documents that we've seen on actually offering a solution to global warming. South Africa has huge renewable energy potential. They're talking that up a lot. Obviously, you need finance to develop that. And then also a lot of talk about Africa's carbon sinks, which are the forests and jungles that absorb carbon and how they can be protected.
Those are the active solutions, aren't they? And they're going to build. But loss and damage is the issue for the global south and for emerging markets. Let's pivot to Gabon. The president there, Ali Bongo, is scheduled to speak at the summit, but he's under house arrest since the military coup last week. And you have a new leader being sworn in today. So how does that square?
Well, I think it's a bit of a problem. Gabon is a pretty prominent voice, especially in terms of forest protection and trying to change the way carbon credits are actually worked out and forested nations are compensated for keeping their forests intact. He's had a very ambitious green agenda. Almost 30% of the country is under protected areas. They recently concluded a pretty landmark $500 million debt for nature swap. Obviously, with him being pushed out of power, all of that's up in the air, and we don't really know where we stand.
OK, Anthony, do well. Chase them around, break some news there. That's Anthony Squazine in Nairobi, tracking the latest African conference ahead of COP28. Roubini Macro Associates Chairman and CEO Nouriel Roubini says that global stocks could drop as much as 10% in the second half if the economy does not pick up and inflation remains high. He told us exclusively that there are still doubts on whether the global economy can achieve a soft landing.
Compared to 6 months ago, where there was a serious risk of a real hard landing for the global economy, those risks are reduced right now. No. That's the good news. But I think that there's still an open discussion on whether the global economy is going to achieve a soft landing as opposed to a bumpy landing. For a bumpy landing will be a short and shallow recession. That short and shallow recession has already started in the Eurozone. The UK, with very high inflation, is probably headed towards that recession as well. In China, there is a sharp slowdown of growth. It's not just cyclical, it's more structural. United States, still the jury's out on whether will achieve a soft landing or whether there's going to be a short and shallow recession. So it's a mixed bag.
But that depends on what? So in the U.S., is it Fed policy or is it just the tight labor market that could suddenly collapse?
Well, in the U.S., paradoxically, so far, in spite of Fed hiking rates above 5%, the economy has grown recently above potential. Tight labor market, tight goods market. That's good news in terms of achieving a soft landing, but it's actually bad news for the Fed because it implies that the Fed is not done yet. They may have to hike once more, maybe twice more. Eventually, the Fed funds rate might have a 6 handle rather than a 5 one. And the more that happens, the more the risk that eventually there might be at least a short and shallow recession. But the economic data recently have been reasonably strong, even if it's slowing.
What do you make of China right now, and what are markets most misunderstanding about the world economy and actually how equities and bonds should behave?
Well, China, the reduction in growth is not cyclical, it's structural. It has to do with aging of population, debt and leverage, housing overhang, state capitalism, a backlash against the private sector that depresses the sentiment of household and the corporate, geopolitical depression, the policies that are effectively Marxist-Leninist of Xi Jinping and so on. So I think that potential growth used to be 10, went to 5. I think it's at best 3 to 4%, and that's not going to change because it's emphasizing security control over opening up and reform. That's the main thing.
Yep.
I would say on markets, in my view, if the global economy is going to weaken, if there is still a meaningful chance of at least a bumpy landing, probably markets have rallied too much today. And that's maybe going to lead to a correction in the second half of the year. If the economic data are still weak and if central banks have to hike a little bit more as a way of essentially fighting inflation, and that's going to lead to a nominal and real rates rising as well. And that means that probably bond yields may go higher rather than lower while inflation is still high and central banks are still fighting inflation.
But a correction, what, a 10% correction in equity markets, or is that too high?
Well, a 10% correction is not totally unlikely. If the economy starts to soften up globally, and if you have still inflation that is above essentially target, with core being still high in US, UK, Europe, central banks hiking somehow more, I would not be surprised if in the second half of the year you get a 10% correction in global equity markets.
So what would you do if you were Bank of England governor?
Well, Bank of England is facing a dilemma. On one side, growth is lower, and is lower also because of a self-inflicted goal that was the Brexit decision by the UK to reduce potential growth and increase cost of production. So it's the most likely case of stagflation. On one side, the economy is headed towards a sharp slowdown, potential recession. On the other side, core inflation is still too high, and therefore you face a dilemma, or a trilemma in the case of the Bank of England, because you want to have lower inflation, but that's going to cause a recession, and higher interest rates are going to imply eventually financial instability, because private and public debts are high, and debt servicing ratio are going to rise as interest rates go higher. So you might have actually a perfect storm in the case of the UK.
Is there anything that actually fiscal policy or just government policy can do to try and mitigate that?
Well, fiscal policies are also in a dilemma, because if you want to maintain growth, you should have expansionary fiscal policy, but now fiscal policy cross purposes with monetary policy. If you have too much essential inflation, it's because there was too much demand. That implies that cyclically, structurally, fiscal policy should be retrenching. The opposite is happening, and that's make the goal of central banks of achieving price stability harder rather than easier.
Rabini Macro Associates Chairman and CEO Nouriel Rabini with Francine Acquah on the at the Chinobia gathering there. Plenty more ahead this Monday morning on Daybreak Middle East and Africa on Bloomberg. Good morning.
My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expertise helps keep me up to speed and ready for my next move. Better decisions. Aon.
Mercedes has unveiled an electric concept car with a longer range than any Tesla model on the market. The German luxury brand is using the Munich Auto Show to ramp up its challenge to Elon Musk's EV market leader. Bloomberg's Oliver Crook is on the trail. He's been doing some window shopping for us. Ollie, good to see you this morning. So this is all about taking the fight to Elon. The Chinese are arriving en masse. I just want to talk about the baby G-Wagon, but maybe we can do that in a moment. Good morning.
We'll get to that in a moment, Menace. We're here. We're at ground zero at the Battle of the BEV, the battery electric vehicle here in Munich. And for the European automakers, BMW and Mercedes, as you mentioned, both launching concept electric cars that are really a little while away from production, 2025, but really trying to prove to the world that they've still got it, that they can still lead this automotive sector that they've led for so long in this age of electrification. But they're not the only ones here, Manus. You have BYD, you have a lot of the Chinese automakers, twice as many as have ever displayed here before. And really, their goal here is to introduce themselves to the European market. They've dominated in China. Now they're trying to move internationally. And of course, Manus, don't forget about Tesla. Friday, kicking things off, cutting prices again. The Model 3 revamp. It's all kicking off here in Munich.
Yeah, I mean, they've had a monster set of price cuts. Get you with your new acronym, BEV. Battle of the EV. You're getting good. You're getting good at this whole gig. Now, you did catch up with the Mercedes-Benz CEO, red carpet behind you, resplendent shot. How much is a baby G-Wagon? Do you think I'd be able to afford one? I'd be in the money then, wouldn't I?
Listen,
how much are they?
They're not disclosing a lot on pricing. They're not discussing a lot on pricing of the baby G-Wagon or even the CLA concept car that that they just launched. What I will say about pricing is the beautiful Mercedes-AMG GT63, which I saw there, unfortunately a bit out of range, probably closer to 180,000 euros. In any event, I spoke to him about that, yes, but pricing about the cars, but also how are markets holding up. So let's hear from Ola Kalenius.
Our goal is value over volume. So we're not pushing volume. We're very, very careful about how we go to market, our go-to-market strategy. And as you can see from the results for the first 6 months of this year, that has been working quite well for us.
And can you continue to ignore Tesla's price cuts even on the higher end, which are more in competition with Mercedes products?
We're focused on value for the customer. I don't think the customer expects from a Mercedes a little bit of a roller coaster ride, but something that you can depend on. So we will continue with the value over volume strategy.
And there's huge concern about the state of the Chinese economy. What is Mercedes' experience of the Chinese economy right now? Is it affecting demand?
I think we have to take a little bit of a cautious stance on that and see how things develop and not expect rapid growth as far as the economy is concerned in the short term.
This car show will also be marked by a lot of Chinese automakers bringing their cars to the market, introducing them maybe for the first time to many people. How do you view that in your home turf here in Germany?
The auto industry is in transformation. I think almost a disruption. It's natural that new players are going to come in, and we respect both the established competition as well as new players that are trying their luck in the business. But that's not our focus. Our focus is on the Mercedes customer, to give that customer the perfect blend between technology and desirability.
And that customer loves the G-Wagon, and I have to ask now about, is this a lowercase g? What can we expect from your announcement today?
The G-Wagon is an icon. I mean, it's almost impossible to get one, actually. It's sold out. But yes, tonight we are announcing for all the G fans out there, there will be a little G. So a son or daughter of the iconic big G. We have not announced timing yet, but if you wait for something good, it will be worth the wait.
So Mercedes really doubling down on their mantra, which is basically quality over mass market, over volume. And really, you can sort of understand that, Menace. Would you be thrilled if you had bought a Tesla early in the year for $120,000 and you could get it for, $80,000 today? Probably not. I think that for the bigger questions for the mass market players who are not as positioned like Mercedes, such as VW, how do they deal with the threats that are coming down the pipeline?
Yeah, I mean, I'm always a bit suspicious when I hear auto CEOs, we're going for value over volume. Buddy, it takes volume to make the margins. I mean, those G-Wagons, those monster G-Wagons, part of the royal narrative here is the number plate on the G-Wagons. The higher the number plate, the closer you are to the leadership. The leadership here love those G-Wagons. So maybe at $139,000, I don't know, Ollie. We've got a Crook and Cranny Roadshow coming up in the baby G-Wagon.
You'll get there.
Do you think I'll get there, Ollie? Good. I'm glad I got your vote. Enjoy the week. I know you got some crack. Absolutely. I know that you've got some good interviews coming up, so we'll stay tuned for that. Oliver Crook in Munich, riding into the sunset on an Autobahn near you in a baby G. Speaking of G, let's show you a G chart. You can pick them all up every day in your GTV. So our 2-year yields are screaming by. That's what BlackRock are saying to you in terms of Mr. Rosenberg. Now, the consequence of this shift at the short end with a phlegmatic longer end is a shift in the yield curve. Is it time to consider 2s10 as a steepener, as a Burr steepener? That is the question. BlackRock and PIMCO said that the Fed hiking cycle is overdone. We have wage growth at the slowest pace since last year. We're going into a smooth glide path to a soft landing. So say the bulls. Let's have a look at the equity market. It is September the 4th. I've been given some sartorial elegance advice for fashion. Apparently you're not allowed to wear white after Labor Day in the hallowed Hamptons in America. Here we go. Flat is where we are. The Nasdaq is up 0.1%. You're looking at a benign August jobs reporting according to Bank of America. It's the last piece of the Goldilocks jigsaw. Sell the last hike. That's what we heard from Hartnett on August the 31st. Do you believe that? VIX has dropped for the 6th consecutive day. That's your state of play on the markets this morning. We'll see you and do it all over again tomorrow on Bloomberg.
part of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, ARM kicks off its IPO roadshow, seeking nearly $5 billion. But we'll break down why the offering could be significantly smaller than previously targeted.
Plus, we'll take a look inside Huawei's new phone, which holds the most advanced chip made in China yet. This as the country seeks to raise a $40 billion fund to bankroll investments in domestic chip making and research.
And how digital regulation in the EU is impacting America's tech giants amid the forthcoming Digital Markets Act. We'll bring you the details of what is going to be unveiled in terms of those gatekeepers as soon as tomorrow. But first, let's check in on these markets and some of the big US players not managing to lift the Nasdaq all that much today. We're actually down by about 0.1%. Look, it's the back-to-school feeling, but we're also getting our reality check on what is a macro picture that is pretty ugly over in China, is pretty ugly over in Europe. When you look at the PMI data, the 10-year yield just rising after, of course, a day of rest and play that we had on Monday in the U.S. trading action. We may be perhaps picking up a little bit as we see more investment-grade bonds coming to the market. Of course, that back-to-school feeling means we're going to get a ton of issuance. I'm looking at the Bloomberg Dollar Index, though. This is really the asset class to be watching at the moment. Dollar pressured higher at the moment. Is this just trying to find some sort of, well, more safety in the current macro picture? Is this also that the Federal Reserve is going to be keeping higher rates for longer vis-a-vis the rest of the world when the U.S. economy just manages to navigate a downturn for the rest of the world? We look at what's happening in terms of Bitcoin, therefore, on the lower side, when you see the dollar outperform, we're just down by about 0.33% overall. 25,700 is where we traded. But get into the nitty-gritty, the individual movers.
Yeah, you and I were talking this morning about how there's not that much action in the technology sector. There are a few individual names. Airbnb up 6.7%. Best performer on the Nasdaq 100. Why? News that it's going to be included in the S&P 500, that driving that single name higher. We teased Huawei. We're going to bring you something fascinating, an official teardown of the Mate 60 Pro. One mover to the downside is the ADRs of Xiaomi, the theory being that if Huawei gains market share in the domestic smartphone market, it'll be at Xiaomi's expense. And Nvidia, a little bit lower. Moving to the downside, we're going to have a really interesting conversation, you and I, Caroline, about Nvidia's valuation, and one voice who says it's getting a little bit extreme and overdone. The main story, I would say, in Tuesday's morning, remember we're coming off a long weekend, is ARM's IPO. We got that F1 filing, and here are the numbers. On the low end, $47 a share. At the high end, $51 a share, raising $4.87 billion in terms of proceeds from an IPO. This is the early stages, but these are much lower numbers than have been reported out there. Let's bring in Bloomberg's Liana Baker, who leads our deals coverage out of New York. And Liana, walk us through the numbers and what we've learned in this kind of opening foray of the roadshow week.
The numbers, as you mentioned, came in a little below what had earlier been reported. ARM had been looking to raise, at one point, we had reported $8 to $10 billion. That has been scaled back a bit. You mentioned that we could still see it go up. The roadshow is just starting. There could be great demand for all we know for these shares, and we could see them raise the range. That's definitely possible. That said, SoftBank has kind of scaled back the amount that they want to sell. Masayoshi Son, the CEO and founder of SoftBank, is very bullish on ARM. He doesn't want to get rid of the whole thing. They're only selling 10% in the IPO. So that's one of the reasons why the company is not looking to raise as much as they had thought. And because they're not looking to raise as much, the valuation is a little lower. It's still a behemoth, though. This is a company, according to the filing, that'll be valued at, close to $55 billion. So it's definitely sort of the first big elephant out of the gate to get the IPO markets moving again.
Yeah, boy, we are excited on it. So too are perhaps some of the ARM's own customers that are coming in as integral investors in the IPO. But if there are going to be any flies in the ointment, what are they? What are all the questions on the roadshow going to be about?
There's definitely questions about ARM's path forward. They've changed their business model a bit. They're trying to get into the more lucrative data center and computing, not fully away from mobile. Mobile is their roots, and they're ubiquitous with all their customers, many of whom you mentioned are participating in the IPO, like Apple and AMD and others. But will the company be able to fully change its business model to spark growth? That's the question. investors will want to see, especially the ones who had invested when it got taken private in 2016? Will they be back, and what's the path forward?
We got someone to talk about those key questions with. Liana Baker, great setup. She's got some busy weeks coming up. Meanwhile, let's extend this conversation. Pierre Ferragu is with us, analyst over at New Street Research. And it feels to me, Pierre, that a key question on everyone's lips is exposure to China, particularly when we have the macro data coming in thick and fast that's on the weaker side.
Yes, as a rule of thumb, the semiconductor industry is exposed 20-25% to domestic China. And guess what? That is really almost everywhere. Semiconductors is exposed about the same to China. So 20-25% of revenues. People talk a lot about it because the setup is very specific for ARM. They have like a subsidiary in China they don't control, and that's their only Chinese client. So all companies in China who want to use ARM technology, license their technology, their IP, have a copyright licensing on their instruction set, have to go through this local ARM company. It has created some difficulties in the past because there is lack of control, lack of auditing of the company, but it's relatively minor in my view. At the end of the day, as long as China wants to use ARM and needs ARM, ARM's business in China is going to look good. But of course, you know what the situation is. China wants to grow more independent from the West, and that's going to be a headwind for ARM. In my view, very slow, very limited impact on how you think about the valuation of the business today.
Okay, so tell us how you're thinking about the valuation. What sort of number are you looking at? What vindicates it?
Yeah, so ARM is an interesting business model. They spend a lot of money on research and development. They come up with great architectures. That's also a standard. The whole industry is using it. So that's really the architectures everybody wants to use. And then clients pay a license fee to ARM to get the right to start working on their IP. And then they pay royalties once they produce chips that contain ARM's technology. And so these royalties really, to me, today, they are not all profits because ARM has been over-investing in their operations to build this base of IP. But going forward, royalties are pure profits. So I like to look at ARM, and that's what I've been doing, when the stock was listed before 2016, as a multiple on royalties. You see that over time, it's a very relevant metric, very stable. It reflects very well the growth outlook of the company. And it has historically, like just before the acquisition by SoftBank, it was trading on 6 turns higher than the stocks. And so that's the kind of valuation I'm looking at today. So I'm looking at 2027 revenues for ARM as we model them, and I look at 27 times that. So that gives me like an $82 billion valuation as you enter into 2026. So I find the valuation range today, 50 to 54 billion, very attractive. It gives you like an opportunity to see 20% per annum return on up to 20% per annum return on the name between now and the beginning of 2026.
2026. It's interesting because I'm fascinated by the mechanics of this. You write in your notes that the range $47 to $51 is attractive to investors, new investors taking advantage of the IPO. But all told, SoftBank's going to hold on to 90% of this company. Why?
Well, because, so two reasons. The first one, SoftBank sees in the name probably even more upside than I see. Massa is very, very bullish on ARM's future. So for SoftBank, really, it's not a matter of getting rid of ARM, of like making a profit on ARM. It's more a matter of, after 5 years as a private company, the company has tried a lot of things, have made a lot of investments. Some of them have worked well, some of them have worked less well. And now ARM is at a point in time where becoming a listed company again makes a lot of sense for the company in terms of, being successful, attracting talent, creating the right, like governance setup and management setup. Being a listed company brings a lot of advantages to ARM. And I think it's a very good timing to do that. And then for SoftBank, the idea is not in my understanding, to exit ARM, but more to have ARM as an additional very liquid asset, and an asset on which SoftBank can leverage to actually raise money for further investments. So that's really the way I think about it. So I don't expect, SoftBank to lower their share, significantly lower their stake in ARM anytime soon.
Pierre, the great fun of a traditional IPO is that it gives the company an opportunity to tell a story about themselves, right, to the world. And the story that ARM wants to tell is that they are relevant for AI. They are going to do great with all of the R&D and CapEx going into AI. Do you buy that story?
Yes, I do. But you have to be very careful to understand it well. I like to qualify that as like an AI diversification. Yes, almost everything that is going to grow ARM's revenues, royalty revenues over the next 5 years is going to be related to AI. So from that perspective, I do agree with your statement. But interestingly, all the AI ARM is going to get exposed to is not like the AI clusters that we see being rolled out today, like the NVIDIA or TPU-based AI clusters. In that part of AI, ARM has actually very, very little, if any, exposure. But in your mobile phone, you need larger chips. You need chips with better IP so that the chip can better deal with AI models and with all these services that are built on AI. And ARM is actually bringing to the market a lot of innovation that is very relevant to that. And in particular, the number one driver of pricing power for ARM over the next 5 years is the rollout of their V9 architecture. So that's a 9th iteration of their instruction set. And the number one innovation that this V9 brings to the market is actually AI-specific instructions. So the next generation of ARM chip are going to do a much better job dealing with AI workloads. And so from that perspective, it's really an AI play, but totally uncorrelated to what's happening today, like the crazy increase in spending on AI clusters, because in a GPU, in an AI accelerator, ARM is between a minimal contributor and not a contributor at all.
Yes. Pierre Ferragu, analyst over at New Street Research, joining us, Caro, straight after publishing his reaction note to that F1 filing. Just great timing having you on the show. Thank you so much. Now, coming up here on Bloomberg Technology, we're going to take a look inside Huawei's new phone, and I mean literally inside, because it holds the most advanced chip made in China yet. We're going to bring you those details next. This is Bloomberg Technology. You're looking at Huawei's Mate 60 Pro, going through a teardown by Tech Insights. Bloomberg News asked the research firm to lift the lid on China's latest domestic smartphone. What we learned, that is an advanced 7-nanometer chip, which was made by China's top chip maker, SMIC, or Semi-Manufacturing International Corp. It makes a sign that there's some early progress in Beijing's push to beat out US technology export curbs. Joining me here on set is Bloomberg's Ian King. The speculation and the rumor was that it was 5 nanometer. It's not. It's 7 nanometer, SMIC or SMIC made. Tell us what we know from that teardown.
Yeah, you got to remember, like, 3 is better than 5, which is better than 7. 3 would be sort of the state of the art in terms of manufacturing capabilities that somebody like Apple would try to be accessing at this point. So 7 sounds like a long way behind, maybe 2-3 years behind, but you can still do a lot with that level of manufacturing technology. Underpinning this, though, is should they actually be doing this? Is this representing a circumvention of what the US is trying to do, which is to get Huawei away from access to technology?
And to that point, Caroline, we should say that Bloomberg went to the US Commerce Department and asked if this 7-nanometer tech is caught within the bounds of curbs. and I don't believe the US Commerce Department replied.
Yeah, thus far it does shine a light, though, really a question mark on what has been the US spearheading this, Ian, of a global clampdown on basically China's access to this sort of technology. Do you think it does ring question marks?
No, there are absolutely questions. To be fair to Commerce, though, they're not going to comment about individual actions that they take against a specific company. That's kind of their policy. So we tend to sort of find that out when it gets announced, and they have actually sort of, when these stories crop up, they have taken action. So we'll see what happens there. There's definitely an onus on them to take some action, but we wouldn't expect them to talk about it right now.
We did learn about where China's at in its technology competence, right? You know, there's this idea that it's 7 nanometer, but they sold out of the handset very quickly. And that indicates to us, even though it's 2 generations removed from the cutting edge, that they're not making 7 nanometer at volume yet or at scale.
Yeah, I mean, this is a conversation that we had last week. Remember, you can make a few of these things on the bench, right? That's great, well done, you're good at the technology, but the real art is to make millions, tens of millions, hundreds of millions of these things. We really need to see whether they can do that or not, and do that on an economic basis. If they can, then this is definitely, you know, a red flag, warning symbols, whatever you want to describe it with. If they can't, then maybe this is a symbolic thing just to poke the Secretary of Commerce from the US, who was in China last week.
I mean, some great reports, for example, the Jeffries team putting out, you know, the myths and the facts about this particular Mate 60. I'm interested more broadly on the impact on competition, though. What has been reality is the share price reaction from Xiaomi. Ian, does this put Huawei back on the map, even if only in China?
Well, you have to remember that they basically got out of the handset business. They essentially spun it off because they were in such a difficult position because of these sanctions. This as a symbolic thing, as something to market around, it's absolutely sensational. Look at the attention it's getting. We're talking about it on the other side of the world, right? So, yes, of course, it really helps. But again, we'll need to see that volume. As Ed and I just discussed, we'll need to see that volume.
Absolutely brilliant throughout, Ian King. Thank you so much, getting us up to speed on the teardown. Meanwhile, let's get a teardown of what we're likely to be hearing from the EU. Set to unveil its gatekeepers list tomorrow under the EU's forthcoming Digital Markets Act. Of course, we've been long anticipating which platforms are currently going to be at risk to much stricter regulations. You guessed, likely these big players. From New York, from San Francisco, this is Bloomberg Technology.
It seems more and more high-stakes decisions are ending up in my hands. While still of the challenge, I worry some decisions might not get the attention they deserve. Working with Aon means I've got their whole team in my corner, with advanced analytics and expert insights that put things in the right context. It's the gut check I need to stay on top of it all. Better decisions. Aon.
Time now for Talking Tech. First up, advertising sales at X, of course formerly known as Twitter, they're down some 60%. And Elon Musk is pointing the blame at the Anti-Defamation League. Now, Musk is actually accusing that the not-for-profit is having a personal vendetta against him since he purchased the platform. The ADL has previously reported that harassment and extremist content on the platform has spiked since Musk's takeover. Meanwhile, let's turn our attention to Sam Altman, who is now the first person to get an Indonesian golden visa. It's the new visa that allows foreigners to make substantial investments in the country to remain for between 5 and 10 years. It's part of a new initiative to boost economic development in the region. And plus, TikTok is hiring UK security firm NCC Group to help audit, well, its data, its controls, the protections in Europe in particular. It's all part of what is called Project Clover. It's similar to a program right here in the US to reassure Europeans that the Chinese government can't access their data. TikTok currently runs a data centre in Dublin and is building another one in Ireland, and indeed in Norway too, Ed.
Yeah, let's stick in that region. Big tech is bracing for the European Union's biggest ever clampdown on anti-competitive practices, which may provoke a new wave of legal battles between regulators and here in Silicon Valley. The announcement on which tech platforms are to be targeted under the EU's Digital Markets Act is due tomorrow. For more, let's bring in Bloomberg's Gillian Deutsch, who joins us out in Brussels. Caroline and I are so used to covering the kind of antitrust case, you know, the battle that played out in court. Now the story in the EU is moving to legislation and rulemaking. Explain what's about to happen.
Yeah, so tomorrow is a big day for the European Commission. This is when they come out and say which companies, major tech companies, are considered gatekeepers, and those are companies that are considered dominant in their space. And then they're going to lay out which of those products from those companies are considered core platform services. And those are the products that these companies are going to have to redesign to comply with a whole bunch of new rules set by the European Commission. And to your point, Ed, I mean, I want to back up a little bit. We've seen lots of these antitrust cases from the European Commission for years now, for almost over a decade. And really what the European Commission is trying to do is say, okay, these cases have often dragged out in the courts for years. They have often been unsuccessful as well. So instead of dragging companies to court after they've done something they deem anti-competitive, the Commission's saying, let's let out those rules from the get-go. And so really going to see some of those big rules come to fruition tomorrow.
Of course, this sort of follows on from the Digital Services Act. Now it's the Digital Markets Act. And it always ends up to be fines that are either instilled or indeed warned about. Is that really what the stick is here? Are there any carrots that persuade the big companies to fall in line?
Well, I do think one carrot as well. Do you want to operate on one of the biggest markets? And so we actually have seen some companies say, actually, maybe not, because there's too much regulation. One prominent example is that Meta actually has not rolled out Threads in the European Union. We've seen it across the channel in the UK and obviously in the United States, but we don't have it here because what Meta says is that we don't know how these kinds of rules under the Digital Markets Act are actually going to be enforced. And one of those rules is that companies can't combine personal data across platforms. So Meta's saying, I'd rather be safe than sorry, so maybe we shouldn't even roll out in the EU. But we also are seeing lots of those threats of fines that companies won't be able to operate in the EU if they break these rules repeatedly. So this kind of two-tier track, the DMA and, like you mentioned, Caroline, the DSA, there really are this new wave of regulation. And so the European Commission is trying to work with companies and say, look, we're trying to make this work for you guys too. But there are definitely lots of court cases and fines on the horizon if they don't.
You know, it is often a two-way street. I reflect on my own time in Brussels, Gilly. I mean, what do the companies have to say about it? Are they trying to meet them halfway?
To some extent. So I covered the DSA, which, I mean, the DMA is more focused on antitrust, anti-competitive behaviors. The DSA is focused on, harmful, illegal content we see in digital marketplaces or on social media platforms. And with the DSA, we've seen companies like TikTok and Meta, they've really redesigned some of their products to be more transparent, to flag illegal content. So they're definitely laying out those things, saying, look, we're paying attention, we're caring about this regulation. But we also see lots of potential court cases on the horizon. The DSA, we already saw two companies, Amazon and Zalando, sue over those rules, and we're almost certain we're going to see more now that the DMA is going into effect.
The people who always win, it's the lawyers, it seems. Bloomberg's Gillian Deutsch. Great to have you on the show. Thank you. We look ahead, of course, that big unveil tomorrow. Meanwhile, coming up, let's talk about Goldman Sachs and the here and the now. It's saying that the AI bubble views are maybe overblown. We're going to tell you why the firm is saying that AI valuations are actually less extreme. From New York and San Francisco and Brussels, this is Bloomberg Technology.
Welcome back to Bloomberg Technology. I'm Ed Ludlow in San Francisco.
And I'm Caroline Hyde in New York. Let's get a quick check on these markets because a bit of a lackluster start to this month as we currently see the Nasdaq 100 up, what about 0.1% after our Monday rest day? We're just seeing a switch into perhaps a buying mode as we carry on the day's trade, but ultimately people slow, cautious to get back to the buying as we see this new start of September that usually unearths a lot of bond selling, particularly in the investment grade in the corporate world. Two-year yield is up some 6 basis points. This is where some of the big moves are happening, and largely many are thinking it's because the supply is going to be rich when it comes to investment grade bonds coming to the market and putting some pressure on the overall US Treasuries. We're also, though, got a myriad of macro data, which looks pretty ugly over in China. It looks ugly in Europe. We're seeing the dollar, therefore, outperform as maybe a place of safety and ultimately where rates are likely to have to be higher for longer as the US economy outperforms. Bitcoin on the downside vis-a-vis the US dollar. Let's move it on into individual players, though, because as I mentioned, perhaps some of the China macro data not looking so pretty. Some news that came out on Monday while we're all having on Labor Day off was Tesla up some 4% on perhaps some good numbers coming out of China. We understand perhaps sales picking up in the month of August as they price cut their way. Oracle on the upside up 2.7%. Barclays out with the notes going overweight, seeing this growth trajectory looking good for the next few years for Oracle. And I'm looking at Illumina down some 5%. It's the worst performer on the NASDAQ 100, in fact. And this, as we understand, they're naming, of course, a new CEO. We knew that Francis de Souza sort of abruptly left a couple of months ago. Agilent Technologies, Jacob Dayson's going to be taking the reins of the DNA sequencing giant. But boy, have they got some issues on their hands, of course. Issues about maybe having to cut back on their overall growth trajectory that they originally thought, of course, having those proxy battles with billionaire activist Carl Icahn, to name but a few, but a company that is currently looking for a change of leadership. Ed.
Caroline, let's stick with markets. Check this one out. A note from Goldman Sachs saying AI valuations are not excessive. They write, given the valuations of the dominant incumbent companies are high but not excessive, we believe we are still generally in the first phase of a typical technology wave. Now, that is not a uniformly held position, Caro, but it kind of goes to what Jensen Huang was talking about on the NVIDIA earnings call. They see two trends, the move to generative AI and accelerated computing, but he thinks they're in the early innings, and Goldman out saying, yeah, we see that too.
And actually, Goldman put together a nice basket of some of the smaller stocks that could really benefit in terms of profitability stakes from the uplift of AI, from the productivity that's likely to be granted. Therefore, seeing maybe even a 70% run rate for some of these stocks on the back of that. I'm interested, though, on who the naysayers have been. And Ed, it has been the likes of Bank of America saying this is a baby bubble, as originally what they seem to be terming it, but worries about the valuations and where they've already run to. And Ed, also, Morgan Stanley, I mean, we know that they're generally a bearish take, often coming from Mike Wilson and the team, but they too have been a little bit worried about ultimately how far we've already run and whether tech, Ed, can withstand higher rates, higher borrowing costs.
Yeah, I think that there's one or two soft pieces of data that I'm going to look at, and we've got the perfect person to ask next. But how much are people spending now on R&D proportionately to their operating expenses or their revenue, and then the CapEx commitments from those that want to benefit from AI? Because that investment drives later growth. And I think that's a really interesting place to focus.
Yeah, exactly. Whether or not you have the patience, Mandeep Singh always does. He's here with us from Bloomberg Intelligence. And these sorts of, whether we're too enthusiastic, whether we've got a bubble or not, are going to come thick and fast. To your mind's eye, the valuations that we're already trading at?
Well, so you have to be selective in this environment, given the run-up we have seen and the upward revisions we have seen for the likes of NVIDIA. You have to ask yourself, are there any other companies that could see upward revisions like that? And it's too early to say that companies are able to, unpack new revenue opportunities, especially on the software side or on the services side, because right now they're all buying these chips, they're investing, trying to figure out a new product that they can monetize. Copilots is one way that Microsoft has said, okay, we could monetize this based on, the enterprise base we have. We can sell them an additional product in the form of a Copilot. For others, it's not so clear whether there are customers that are willing to pay for generative AI. And frankly speaking, we may not be at a point where the technology is there in terms of, being product ready.
Yes.
And so that's
revenue generating.
Revenue generating, and that's where it adds to the R&D expense, because you have to buy these chips, you have to invest in hiring engineers to develop a product. But when it will be product ready is the question, and you could see, in fact, a margin hit for some of the companies that are investing in generative AI right now.
And what's so interesting, Ed, is it's not just sell-side notes that we're getting. We're getting big takes from buyers, admittedly, players more in the value space. But I thought the Rob Arnott note in particular was an interesting one, Ed.
Yeah, Rob Arnott, the so-called bubble hunter of research affiliates. Mandeep, he makes 2 points, and I'll run them past you. The first is that he calls it big market delusion, the idea that the valuation of NVIDIA right now reflects that they won't be displaced by another player, that they basically remain the incumbent, and that, second of all, the current market cap of NVIDIA, its size, makes it a really safe bet. What do you make of those 2 points? Its position in the market, but also its current size.
I agree, I think, with that comment, simply because the companies that are investing right now in generative AI are your hyperscale cloud vendors, and they are the ones who are actually buying these chips, in bulk. That's what drove that 100% upside revisions for NVIDIA. I mean, had it been your fragmented enterprise IT base, they wouldn't be making those sort of commitments, even though everyone agrees with the disruptive impact of generative AI. The fact that you're seeing that kind of a big lift in hardware and semiconductor spending is because of the concentrated nature of the buyers, which in this case is the hyperscale cloud players. And you have to ask yourself, if everyone is able to develop that technology over time, then it does get commoditized. And I go back to the revenue generation aspects of how you're going to monetize it in software or services that you can layer. And it's not very clear. We're still at a very early stage in terms of unpacking the monetization opportunities on the software side.
During the earnings season, particularly Jensen Huang, NVIDIA's earnings call, he talked about the 2 big trends, accelerated computing and then the demand for specific generative AI tools, but also capital expenditures. He said, look at the commitments on the R&D side and the CapEx side of those they care about. Are those data points that you track as well at Bloomberg Intelligence to kind of see how far we have left to go on this technology wave?
I think, look, everyone right now is spending their R&D dollars on generative AI. The key question to me is, the proprietary data that is available to be fed into a large language model. At the end of the day, the foundational model, the billions of parameters in the model, it's based on large amounts of data. You can't build a large language model on a small data set. And where do you get that data from, given every company has become so conscious about their data, whether it's Reddit, Twitter, all the open internet data? And that is where I think the heart of how this technology will evolve lives is where you have access to data.
You are singing from a hymn sheet that I've heard Kathy Wood sing from a little bit as well, all about the proprietary data. And ultimately, Kathy was early in her call that NVIDIA was just too far, too fast. Get into other names that are being overlooked here. What are other names that are being overlooked from BI's perspective?
Well, so from our perspective, internet companies have an advantage here. Whether it's the social media companies, search companies, they own the proprietary data within their walled gardens. Software companies, on the other hand, they don't have their proprietary data. They have customer data. They can't build large language models on top of that. So clearly, internet platforms are the ones that are coming up with the large language models right now, and they have an advantage in terms of redoing their next version because they have access to that data, whereas software companies like Microsoft partnered with OpenAI. And OpenAI actually built their large language model on open internet data from Reddit and Twitter, and they'll have a hard time finding the next iteration of it because everyone is limiting the use of the open internet data. So I do think internet platforms have an advantage in this cycle.
And for a longer term discussion on just how much this changes the world of the internet and how much more closed it becomes. Mandeep Singh, absolutely brilliant from Bloomberg Intelligence. We always love him on the show. Meanwhile, coming up, look, from public markets to what's happening in the private world. We're going to take the pulse of VC, in particular fintech. Fiat Ventures partner Drew Glover, he's over here in New York and from San Francisco today. This is Bloomberg Technology.
time for VC Roundup. And first up, Theta Ray, a startup that uses artificial intelligence to detect money laundering and other financial crimes in international transactions, has raised $57 million in a recent investment round. The investment comes as financial institutions record a sharp rise in fraud, much of it actually boosted by new AI tools. And next-gen healthcare rose 13% after Bloomberg reported that Thoma Bravo is in advanced talks to buy the health records software company. That's according to sources who also say that the private equity firm could announce a deal as soon as this week. Plus, four-time NBA champion and perennial all-star Stephen Curry is among the new investors in Upwind in a $50 million round, which values the Israeli cybersecurity startup at $300 million. Caro.
He's pretty active in the VC world, as well as being quite the sports person. Let's talk about venture more broadly right now, Ed, because I'm pleased to say right here in New York is Drew Glover visiting for the time being. It's today's VC Spotlight, therefore. Partner at Fiat Ventures, of course, also Fiat Growth, an emerging VC focused in the fintech space. And what makes you different is not only, well, the focus on underrepresented founders, but notably also the way in which you advise alongside invest. Now, at the moment, is all the advising, all the discussion about watching these big companies about to come to market and whether or not we'll get more exits in the IPO area?
Well, it's really interesting. At Fiat Growth, we're able to, and Fiat Growth is the consultancy of the Fiat Ventures arm of the business. So we get to advise a number of these companies, but very much stage agnostic, early stage all the way to public companies. And then on Fiat Ventures, we get to invest in these companies because we actually contractually get the right to invest. So in short, yes to your question. We have all this incredible data and education that we get by actually doing the work on the ground with these companies. And one thing that we are seeing is a lot of very optimistic things happening in the public market right now. But also at the same time, we have to be really thoughtful in terms of how we're building products and how we're building strategies to bring some of these public companies to the public markets. So in terms of the trends we're seeing a number of trends. I mean, I'm hearing a lot of talk about AI and generative AI right now.
You don't get it.
And one of the biggest things is everyone wants to shift their business to an AI first business, where one thing that we are constantly pushing is AI is an incredible tool, it is an incredible feature, but it's not always the right product to shift to. Because what all these companies have is an incredible amount of data that AI can help empower to create really, really valuable features to their core products.
I mean, we're just talking to Mandeep Singh about the power of proprietary data. We're also talking about, earlier in the show, the fact that ARM might not be selling as much of its companies. Well, the amount raised might not be as much, and maybe the valuations are being questioned as it goes on its roadshow. Ultimately, how important is it for Stripe, for example, an area that you're going to be very focused on, a company that is in the world of fintech, but also looking at the public markets at some point?
Well, I think Stripe's in a great position. One thing that we've seen over the last, call it year and a half here, is us moving away from this application layer to the infrastructure layer of fintech. And just to break that down, the application layer is very much consumer fintech. You've seen like the crazy growth over the last 5 years or even 10 years of neobanks like Chime and other ones like Varo Money. I could keep going down the list there. But now we've moved into this infrastructure layer, and that's something Stripe was ahead of its time on. These are the fintech technologies that run the entire fintech ecosystem, but we can't necessarily see and feel it. Like we know that Stripe is powering the back end of Stripe, but we don't know it's Stripe. Or I'm sorry, the back end of Shopify, but we don't know it's Stripe. So one thing that we're seeing in the fintech market today is this infrastructure opportunity where we're going to see over time is every single action we make on every single app is going to be run by this fintech infrastructure. Every time we purchase, every time we get a loan, every time we refinance debt. And so I believe Stripe is going to see a big headwind here over the next couple years as they decide what their next step is.
Hey, Drew, good morning from San Francisco. It's Ed here. With everything that's happened in generative AI, has that pushed you at Fiat back to more sort of sole focus on fintech? And the reason I ask that is, look at Salesforce or NVIDIA, these big incumbents in AI who deploy big sums of capital. They've really